se logra una sonrisa de parte de cada persona que utiliza el dispositivo, ya que se pone en situación, entre comillas, de una persona discapacitada. Y ven que lo sorteamos de una forma agradable, porque el simple hecho de sentarse en un dispositivo ya es agradable.
Nace más como una solución de movilidad a personas con discapacidad, nace Mandados como una opción de generación de ingresos y nace Mad Tools como generación de ingresos y educación a las demás personas que no están en silla.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Central banks are showing no sign that they want to take their foot off the gas.
Domestic activity is still really in the doldrums.
We could see the first quarter dip back into negative territory.
I'm expecting a fairly tumultuous year coming.
The biggest stimulus that's going to come is the vaccine.
The post-vaccine rebound is going to be incredibly V-shaped and quick.
It will be V-shaped for some. It may not be V-shaped for others.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning. This is Bloomberg Surveillance on Bloomberg Radio and television. I'm Matt Miller here in Berlin alongside Carol Massar in New York City. Tom Keene, John Farrow, and Lisa Abramowitz all off today. Let's, Carol, take a quick look at the top stories in the markets that they're affecting. I think really the $2,000 stimulus check is still the biggest story for investors. It seems like that's what's driving us to ever new highs.
Well, investors excited about the prospect of maybe some more consumer spending happening, but that whole pandemic relief program getting through has really provided support. And I just think global support that we are seeing, whether it's central banks around the world, has really provided support and a bottom, if you will, to the markets. Quick check on how we are setting up on this Tuesday. Expected to be light trade. It is a holiday-shortened trading week, certainly here in the United States and elsewhere around the world. S&P futures, though, just up about 15 points. You've got the euro at $1.22, 10-year note yielding 0.94, and New York crude a little bit of support there as well. But if you take a look, we continue to see really records on some of those major equity averages. We saw that certainly here in the United States yesterday.
Yeah, absolutely. And we see really big rallies here, like on the FTSE. The first day of trading, I'll just remind everybody, for the FTSE since the Brexit deal was delivered. That happened on Christmas Eve. Of course, London was closed for trading on Christmas Day, just like everybody else. And then because the British are so special, they were also closed for Boxing Day, whatever that means. It drove them to new highs, up 2%. They've had a horrible year on the FTSE, down about 14-15%, but they've come back just a little bit. And it looks like investors really voting that they like that deal, or certainly liked it better than no deal.
Yeah, exactly. And we're seeing, a rise also in the CAC 40, also over in Germany. So let's talk a little bit about markets, if we may. Let's get to our guest. James Bevan is with us. He's CCLA Chief Investment Strategist joining us. James, how do you see it? How do you explain some of the trade? I do feel like we are in a market that reacts to headlines pretty quickly, whether they're negative or positive. You kind of get it out there pretty quickly.
Indeed, and right now I would say that there is more appetite to perceive good news in statements made rather than worrying about bad news. And of course, most news stories come with a bit of both. So if you take the Brexit announcement, for example, it's unambiguously good news that there is no deal, but it's certainly not good news for the services companies that still face an ambiguous future, and in particular financial services. But right now, markets are focusing on the good news.
Why do you think the pound isn't rallying more, James? I mean, I would have thought, we heard so many forecasts that were bullish up to 145, and especially on a day when the dollar is weaker once again, I would expect to see more than 135 in sterling.
Well, I certainly anticipate we could see 145 by the end of next year, but the pound still has some really quite serious challenges ahead. So the Brexit deal is a step in the right direction, but it most certainly does not provide for the full resolution of the problems that the UK faces. So we will likely receive real growth in the UK economy of perhaps up to 7 percentage points this year. But the UK is still poorly placed in terms of global free trade agreements. It's simply not made the progress that it wished. People say it's going to be easy. Actually, if you look at the regulatory luggage that the UK has to take as part of the Brexit deal, this issue in terms of getting free trade with the US is going to be really tricky. The chlorinated chicken story isn't going away, and I think that leaves people concerned about the outlook for the UK economy.
What about the city, James? You know, we've been talking a lot today about what happens to financial services there, and there still hasn't been any kind of equivalency agreement. I don't know if that's going to come even in Q1 2021. Do you see a lot of your colleagues moving back to Paris, moving back to Frankfurt, fleeing the city for the continent?
Well, I would say that we have seen a general drift of both people and business activities to the Eurozone over the last 4 years since the 2016 Brexit vote. That was the moment when the chief executives and boards of the major financial companies said, OK, guys, we've got to get ready. We know it's going to happen. We don't know quite when, but let's position now what inevitably will happen. So I don't think it's going to come as a major shock to anybody, but many businesses have already relocated either to Paris or to Frankfurt.
Yeah, definitely. That migration, that trend is definitely something we've seen and continues. Hey, James, we're going to leave it there. Thank you so much. James Bevan, he's CCLA Chief Investment Strategist. Have a good new year. We do want to talk about something that has definitely been I've been obsessed with it a little bit since those Apple headlines about really aggressively, again, moving into the EV market. But we want to get some perspective because there's a lot going on. There has been a lot this past year and a lot maybe in terms of expectations for the EV market come 2021. Mark Kaufman is with us, Ford Motor Global Electrification Director, and he joins us by Zoom on this Tuesday. Mark, it is so good to have you here with Matt and myself. Matt's a car guy, loves talking about all things car, but I am really interested too as well. So tell me about the Apple news. Let's start there. How significant is that in your view? And it's not something going to happen tomorrow, but in a few years.
Well, Carol, anyone who works in a traditional manufacturer, we're essentially going to expect disruption now from anyone that might be out there. Back, I know a couple of years ago when Dyson was considering getting into the EV business, at that point you realize any consumer product company could come into the space besides any startup.
So it's very difficult. It's very expensive to the point where, you know, globally dominant companies like Ford and Volkswagen are getting together, pooling resources. Can you tell us a little bit about your work with the German car makers over here in Wolfsburg?
Sure, Matt. Scale is so important, especially in the auto business. So in a case when we have a platform, most platforms have a range of products that it can be suited off of. And then in the case of our partnership with VW, we had the European market skews a little bit smaller than the U.S. market. So we found there was an equal opportunity for both of us, VW to get a bit more scale off their platform. And for Ford, it gave us an opportunity to have a product that's going to be slightly smaller than the product off of our dedicated platform that we have within our company.
I know one of the big problems here, Mark, is there just aren't enough charging stations. And although we hear from, partnerships like Ionity that they're building them as quick as they can, they're certainly not building them quick enough to be ready for the demand that's coming in the next few years. How do you think that issue gets solved?
Matt, that's a great question. And we know a combination of both range anxiety and the ability to charge your electric vehicle when you're traveling are top of mind for consumers. We believe range anxiety, as an example, our Mustang Mach-E has a range just over 300 miles, is helping on range anxiety. But at the same time, that charging infrastructure continues to get built out every year, especially for the high-power DC fast chargers. And it depends where you're at in the world, though. A lot of consumers we're finding are still charging at their residence if they have that opportunity to, because that certainly adds to the convenience of owning an EV.
What's interesting, too, though, is, and I do wonder, Mark, safe to say I think it's fair to kind of respect what Tesla and Elon Musk did, that kind of woke up the auto industry and showed that you can, maybe move faster than everybody anticipated when it came to the EV market. And I do wonder, in terms of strategy, when you look at maybe what happens next year, how has kind of the timetable changed dramatically? And could it change even more so, meaning sooner rather than later?
Yeah, I would say as I look back at 2020, I know for me the biggest surprise on the year is just how quickly the European market has moved in EV adoption. I would say that was a little bit higher than what we had forecasted at this time last year. And part of that is you're seeing more products come out. So as that EV offering is expanding from other manufacturers, both Renault and VW having products in the market in 2020 in the European markets, that has accelerated the growth. And at this point, we're seeing in both Europe and China, there's a clear race for leadership there in the EV space.
Well, listen, and on that point, we'll pick up on the other side of the break, because the Chinese market is one I find interesting, and Tesla obviously has been pretty aggressive there, but they've got their own domestic manufacturers that are moving to really, take hold, if you will, of the EV market. Mark, we're going to come back with you. Mark Kaufman, Ford's Global Electrification Director. He's going to stay with us, and we'll continue the conversation. Matt, I have to say, in our household, we think about what's the next car. We want it to be an EV, but my husband's kind of stuck on it should be hydrogen fuel cells. So he's like kind of waiting for a different technology, but we're thinking about our next car. We want it to be something that is better for the environment.
That's, you know what, I hope more people are thinking the way you and your family do, because it'll outweigh what I'm doing. The next vehicle I buy has to have at least 6.4 liters, and I only want naturally aspirated cubic inches.
What is wrong with you? What is wrong with you? You're not embracing new?
If Mark can figure out a way to put a big battery with my big block, then that would be even better. Because I think the battery could be the replacement for displacement that we've been searching for so long.
Have you seen one of these? It's really kind of amazing. I think they're called a cell phone, Matt. And it's amazing, the battery. It's really small. And look at what it powers. I'm just going to put that out for you. I mean, technology, listen, we see how it's been changing rapidly and getting better and better. And it will for EVs. Just saying.
I have to agree with you. Definitely, for sure. You're right. So we'll talk with Mark more about what they're coming out with on the other side of this block. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The House has passed a bill that would replace the $600 stimulus checks in the new virus relief bill with $2,000 payments. House Democrats and some Republicans voted in favor of the proposal backed by President Trump. That creates a dilemma for Senate Republicans. Many of them previously opposed higher stimulus payments, but Trump's approval could put political pressure on them. Meanwhile, the House has voted to override President Trump's veto of the $750 billion defense spending bill. If the Senate takes similar action as expected, it would be the first time one of the president's vetoes has been overturned. President Trump vetoed the bill in part because he wanted to attach an unrelated provision that eliminates content liability protection for tech companies. And here in New York, residents suffering financial hardships due to the coronavirus will get a break. They'll be protected from evictions and foreclosures until May the 1st. That's due to a law signed by Governor Andrew Cuomo. And the post-Brexit trade deal is essentially a sideshow for the City of London. EU officials must rule separately that British financial regulations and oversight are strong enough to create a level playing field. Without that, there could be a steady leakage of business for the UK's finance industry. Big banks have already started to shift people and assets to the continent. And big changes may be in store for Jack Ma's Ant Group. Ant is under siege from Chinese regulators. Bloomberg has learned that the company may fold its financial operations into a holding company that could be regulated more like a bank. Ant would likely be subject to more capital restrictions that could keep it from lending more. For the first time in almost 2 years, a Boeing 737 MAX will make a commercial flight in the U.S. American Airlines will be flying the plane from Miami to New York today. The 737 MAX was grounded in March of 2019 after 2 crashes killed 346 people. It cost Boeing tens of billions of dollars in lost sales, fines and damages. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Does it really enhance transmissibility as has been suggested? Does it really prevent antibodies from binding? These are still questions that scientists are hopefully going to answer in the coming weeks.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
They potentially could start making their own cars later in the decade, but that's more the core DNA of Cook and Cupertino in terms of going after this massive market opportunity. And I view a partnership with the likes of a Tesla, a VW, as likely the first step as they go after EV.
And that is Dan Ives of Wedbush Securities, analyst who covers the auto market and tech market, and talking specifically about Apple getting into the EV market, which I think really has been one of the more fascinating, more recently business headlines, Matt, that we've talked about. And I wonder, we're talking with Mark Kaufman. I do wonder if they would partner up with Apple. Maybe that's something we can ask him.
Yeah, well, I know that, when I was covering Ford more closely, I know that Bill Ford and Mark Fields at the time had invested a lot of money in, I think, an R&D facility out in Silicon Valley. I went out there and toured it. It was pretty amazing. I also saw one of the original GT40s in the Gulf livery, which I wish I should have prepared a picture, some video of that, because it was amazing. And they've been doing so much at Ford ever since, Bill Ford was convinced by the Sierra Club, I think the legend goes, to start doing better for the environment. And that's when he got rid of the big excursions that I loved and started getting more into the kind of EcoBoost engines. And now they're going, of course, for the full EVs. Mark Kaufman is still with us, Ford Motor Global Electrification Director. And Mark, I want to hear about some of the products. As you can tell, I'm very close to the Ford family. I've spent a lot of time with your boss. Alan Mulally is a very close personal friend of mine, and I wonder what's next. You've got the Mach-E, and you've got this partnership with Volkswagen. What else can you come out with that's going to blow our minds?
Well, first, coming late summer in 21, we've got the Mustang Mach-E GT, so that is the performance version of that product. So we're super enthusiastic about that. You've just got fantastic 480 horsepower, 634 foot-pounds of instant torque in that EV, so that's going to delight customers in that space. But even more importantly, with 35 years of commercial vehicle leadership, we've got a Transit full battery electric vehicle van coming out. And that comes in lots of configurations to meet a wide breadth of consumer needs, and that's also in 21. In late 22, we're tapping into probably our most iconic nameplate with an F-150 full battery electric vehicle launching.
And a lot of people know the F-150 is probably my favorite vehicle of all time. I had the 6.2-liter Raptor version, which was amazing. I love torque. If you could deliver it to me with a battery, I honestly don't care if it comes from internal combustion or electric. It sounds like it would work great in a Transit as well, which is an amazing product. What about your partnership with Volkswagen, though? We talked a little bit about it in the past block, and I'm wondering, can you envision another model? Can you envision deepening that partnership? Because it's such an exciting transatlantic joint venture.
Yeah, Matt, Ford continues to be open to strategic partnerships where they make good sense. And clearly, that first relationship with VW is a start. We also have equity interest in Rivian. So we've shown that where it makes sense for Ford, we're certainly going to be open to those partnerships.
Hey, Mark, I just want to follow up on what you said about the Mach-E, and I do wonder if you guys are going to allocate more to Europe next year to meet and comply with some of the tougher COT standards. Because I'd love to also get your thoughts about EV in Europe. Is it a breakthrough year next year?
Yeah, and let's start with I mentioned the growth in Europe this year, especially in markets. You've got your big three core markets between Germany, UK, and France that have really accelerated this year. So when we start thinking about that technology adoption curve, there's usually a break point from 2.5% is usually where you start moving into early adopters. And as we're finishing up 2021, all three of those markets now have tipped up to about 5% EV share of industry. So we're going to expect continued growth in those markets.
Does that mean allocating more Mach-E's?
We're always looking to get product to customers, and obviously having demand for those products in pull is going to be fantastic for us.
So one thing I want to ask you too, and going back to Tesla for a moment, because they really, like I said, I think everyone would agree that they really shook up the EV market. But I do wonder, some of the problems that they've had, quality issues, does that provide openings, do you think, for some of the established auto players?
Yeah, I don't think, for anyone who's coming new into the auto space, I think you shouldn't underestimate essentially the value of a good distribution network and the ability to take care of customers. So just maybe to give you some quick U.S. numbers, we have 2,100 EV certified dealers in the U.S., and we have 10,000 trained service technicians who are capable of dropping batteries off of cars. Unfortunately, accidents happen within the world, and for the ability to get cars into our service bays at Ford and back out, we think is going to be a continued advantage for us.
Yeah, I wonder about service bays. I mean, how necessary will they be when you have electric cars? I assume if you do a better job than some rivals at quality, you're going to need fewer repairs. You're also going to need actually fewer people to build them, right? Is it just going to be a less people-intensive business car making?
Yeah, it gives us, I think, a little bit of room to have more what we would call top hats or more product configurations off of a platform in a plant. So the line length for an electric vehicle is about 30% shorter than a traditional line. So it is a little bit more efficient. So in a case where before we might have just one product at a plant, we might be able to get two products in off of the same platform. So there are some efficiencies that we'll have. And while service patterns certainly change with that, we still think there's going to be good ongoing throughput. As I said, unfortunately, accidents do happen, so getting customers in and out quickly is going to be important for us.
All right, really fun discussion. Matt's all in on cars, but I just want, for the record, Mark, I also am into torque. I'm just going to put it out there, okay? Mark, thank you so much. Have a great new year. We look forward to talking to you next year. Mark Kaufman, he's Global Electrification Director over at Ford Motor. Yeah, Matt, I mean, I just think what's going on in the auto industry is fascinating, and I'll be curious to see what happens in 2021. We didn't really get to explore China too much, but it is a huge domestic market, and they are developing their own domestic players, and I don't know what that means for the rest of the world.
Well, I know, look, his boss, Dr. James D. Farley Jr., spent a lot of time over here, spent some time in Asia. He has so much experience globally, and he is such a car fanatic that you can be sure Ford is exploring, as Mark Kaufman just told us, all of the possibilities and partnerships that they can. So it'll be exciting to see what they can do.
Don't you feel like it's all about partnerships? It's just like the technology world, right? You have these strange bedfellows, and you're increasingly seeing that certainly within the auto industry, but it makes sense.
For sure. And you know what? Sergio Marchionne used to say this a lot, and people thought he was kind of crazy. But now, post Sergio Marchionne's death, a lot of people are saying he was right. They really need to get together and combine their resources.
He definitely liked you, too. Michael Herson is coming up, Eurasia Group Director of China. We're going to talk about that Alibaba news. Jack Ma, we've got to get into it. That's coming up on Bloomberg Surveillance, and this is Bloomberg.
to manage your debt. Things they didn't teach you in school, part 4. When we think of debt, we often automatically think of a horror film. But debt doesn't have to be the scariest thing in the world. If you found yourself with some debt that's stressing you out, here's how you can manage it. First, prioritize your payments and pay down the debts that are costing you the most. How do you find that out? Look at your interest rates on your monthly billing statement. If your credit card has a really high interest rate, you'll want to pay that off before paying off something like a student loan, which might have a low interest rate. The average interest rate on a credit card is 14.5%. So you're getting a good return on your money when you pay that debt off. Next, track your spending. Stick to a budget so you can know where you stand financially and start to save some money to pay your debts down. You can do this with apps like Digit, Acorns, and Stash. And lastly, breathe. Know that every financial mistake is fixable. You can always recover down the road, but it's best to get ahead of any mistakes that could lower your credit score. And a good credit score can save you a lot of money, earning you a lower interest rate in the future.
Substantial further progress means what it says. We'll be looking for inflation to be substantially closer to our 2% longer run goal before we start making adjustments to our purchases.
That's a long time to be very accommodative, but that's basically the horizon.
They can buy more bonds and they can buy longer maturity bonds, and that would put more downward pressure on long-term interest rates.
And a very good morning, everyone. This is Bloomberg Surveillance live on Bloomberg Radio and Bloomberg TV. I'm Carol Master at Bloomberg headquarters in New York, along with Matt Miller. He is in Berlin. Quick check on the market trade, because we are seeing certainly optimism around the globe. We saw records being taken out once again on those major U.S. equity averages yesterday. Some support once again on this Tuesday, just up about 0.4% on S&P futures, and we're just 1 hour away from that open. 10-year note, let's draw some attention to that, 0.94. There's a little bit of movement, though, and some support continuing in New York crude markets. And Matt's been really pointing out when it came to the European trade, we did see a rally over in the UK markets. That after that long holiday week, and of course, London markets were closed yesterday because of the Boxing Day holiday, Matt. So getting a chance to react to the Brexit news.
No one's explained to us yet what Boxing Day actually is. I know it's the day after Christmas.
Didn't you read Bridget Jones and see it in the movie? It's when you wear funny sweaters, isn't it?
No.
That's all I know.
Is it? I mean, it's nothing to do with the sport of boxing, right? And it's not like boxing presents. I don't really get it. But
London, could you call us right now and explain Boxing Day to us? Because we're having some problems here.
I should know. In any case, the rally there is remarkable. The FTSE is gaining by the most that we've seen it since November 9th. So it's been, 7 weeks since we've seen this kind of rally on the FTSE. And it's interesting because it means investors, either they like this deal a lot, or investors were worried that there would be no deal, and they're just liking it better than the no deal that we had. Let's get over to Michael Herson right now from Eurasia Group. He's the China director there, and we have a lot to talk about in terms of trade deals with you, Michael. Mainly the idea that Europe and China could trade closer has been one that has been pushed certainly out of Brussels for some time. And now it looks like we have more solid details that relationship is going to get deeper. Can you tell us about it?
Sure. Well, it looks right now like the EU and China are going to sign a bilateral investment treaty, or at least will finalize the deal in coming days. Now, there's still some potential complications. There are some quarters in Europe that are not happy about this deal. It's going to have to pass the European Parliament, but it looks like they're going to get the deal done. And I think you have to count this for now as a win for Beijing, which really wanted to squeeze this deal in before Joe Biden takes office and before the U.S. and EU form a common front against China on a variety of issues.
Listen, Michael,
yeah,
this seems like a pretty big deal. I mean, they've been doing and trying to get this together for some time, but I do think it, essentially will cement a relationship and kind of push the U.S. As Joe Biden comes into the White House, kind of push the U.S. to the side.
I think it's going to be an initial challenge for the Biden administration to be clear. And look, Europe is not going to align completely with the U.S. when it comes to China. It's too big of a market and too important. But, at the same time, Europe has really changed its tone with China. We need to also look past this deal. There is a growing sense from Europe that China is a strategic competitor. Europe has many of the same concerns as the U.S. on values issues like Hong Kong, Taiwan, and China's treatment of the Uyghurs. So I think there's going to be some potential for Biden to work with Europe on a variety of issues. This deal shows it's not going to be a layup by any means.
Well, and it's interesting. Well, what do you think will be ultimately some of the implications? Let's be specific. Let's drill down. What does it mean? What is potentially the U.S. maybe squeezed out of? What does it mean in terms of opportunities for China and Europe specifically?
Well, I think in terms of market access, European firms are going to have a bit of an advantage, and that's going to come in areas from financial services to autos to a variety of other areas, especially as the U.S.-China relationship is only going to get, I would say, very moderately better under Biden. So I think for market access, if you're thinking about European firms for whom China is a large market, this is an advantage over the U.S. But this is an investment treaty. It's not a bilateral trade agreement. It's not it's not a blockbuster deal. It's a big deal, yes, but I think it means market access for European firms in China.
Does the Brexit deal or does the sort of UK behavior also take out another competitor? I mean, is Europe able to create this bridge to Asia and get a leg up on not only the U.S. but also the UK in terms of trade?
I think to some extent it's going to be interesting to see what the UK does with China now, because a UK without Europe means that China is that much more important. But in the UK, you see the same kind of pushback against China that you've seen in the US, in Australia, and a number of other quarters. So I think it's going to be challenging for the UK in terms of financial services companies to really look to have the city and London play a larger role as an offshore financial center for China. I think that's going to be a political challenge now.
Hey, Michael, one thing I've got to ask you about, and, we didn't really cover it too much yesterday, but we've all been following it closely, is what's going on with Alibaba and Jack Ma specifically. And the headline today is that Ma is planning with Ant Financial to fold its financial operations into a holding company. Basically, it's about appeasing Chinese regulators. They were too concerned about how powerful and how big, especially when it came to the financial sector, that Jack Ma and Ant Financial was getting. What does this say about Chinese companies specifically in China? Is there a bigger, broader message? Because we did see some of those Chinese tech companies sell off yesterday, rallied a little bit today. What's the message here?
I think the message very simply is that if you are a private company in China, you need to stay within the lines. Some of those lines are political, and Jack Ma had criticized China's regulators, which I think turned the heat up on him. But it's also about market power. For Beijing, private companies exist for a reason, and that is really to serve the broader interests in China. They need to be good corporate citizens, and that means not abusing market power and not playing fast and loose with financial regulatory rules. So I think for the very large Chinese fintech players and large Chinese e-commerce platforms, you need to incorporate that political risk. If there is a sense that they are moving too far, too fast, that they're too powerful, I think Beijing is clearly now going to cut them down to size.
Yeah, certainly, and moved quickly. Hey, listen, we're going to leave it there. Michael, thank you so much. Appreciate your time. Michael Herson, he's Director of China over at the Eurasia Group, joining us on this Tuesday. I do want to mention a few headlines crossing the Bloomberg, and this is coming from President-elect Joe Biden. He is expected to say later on, to make some remarks, if you will, later on from Wilmington, Delaware, to say that the Trump administration vaccination pace is lagging. He's also expected to say COVID infection rates are seen increasing. So to make some official statements, you know, what's interesting, Matt, is for a long time, certainly after the election, President Biden, President-elect Biden, I should say, was very careful in terms of commenting on the vaccine progress, on the virus, but he's definitely coming out at this point because I think as we get closer to him taking over, concerned about the transition and making sure it's smoothly, especially as we see these numbers growing.
Yeah, he's going to want to hit the ground running,
Totally.
certainly. And I think this is something that you're seeing now from many other countries as well. So Germany has plans to get the vaccine out faster. France and the UK are trying to do it as well. John Lauerman, Bloomberg News health editor, joins us to talk a little bit more about this. And John, is this partially, are we going to see countries try and make grabs for the resources that are out there? Is this going to start to get really competitive?
Well, good morning. Yeah, we may see some of that. I mean, we've already seen that, right? That's been going on for a while. The U.S. And Canada, really, the U.K. as well. Those have been the countries, the wealthiest countries have been the ones to reach out and grab the vaccine as quickly as possible. I think the interesting thing that you're seeing right now is that the rollout probably isn't going as well as had been anticipated. Part of that may have to do just with the mechanism of the rollout itself. In other words, that there's some growing pains. Part of it may have to do with demand. It just isn't clear yet exactly what's happening on the ground, why the vaccine isn't rolling out, at least here in the U.S., I think in other countries as well, quite as quickly as we had anticipated. I mean, a few months ago, or a few weeks ago even, we were talking about, 20 million doses by the end of the year. It seems pretty clear that that's not going to happen. And this is a good opportunity to plug a feature that we have in the Bloomberg that some of my colleagues have been working on, which tracks the number of doses that have actually been administered worldwide. And that's just over 4 million so far as of December 28th.
Well, John, this is so interesting because one of the things that kind of caught my attention too is that we are seeing European governments talking about planning to track the number of people getting vaccines to help chart a path out of the crisis. Germany is considering some legislation to ensure that unvaccinated people are treated fairly. I mean, what they're thinking about, we talk about, testing and tracing, but now we're moving to another stage when it comes to who got the vaccine and kind of tracking them as well. And I think about where Joe Biden's coming out, he's concerned about the transition. It's not necessarily going as smoothly, and how crucial all of this is getting to a point where come summer, we can kind of move back towards a more normal society. Are we going to have to do this kind of tracing when it comes to the vaccine in order for the world to start reopening?
Well, maybe before we get to that, we got to start thinking about confidence in the vaccines.
Yeah.
This is something that has been an issue for a while now. Obviously, there's been, concern about vaccines among certain quarters of population. Throughout the process of developing the vaccines, I think health officials have tried to bolster confidence. The name Operation Warp Speed, for example, there was concern that name might imply that corners were being cut in the vaccine. We've seen some very rare reactions to the new vaccines,
right,
that have raised some concerns. So I think what we have to do is I think Dr. Fauci is trying to do, keep on reinforcing the safety of the vaccine, and then try to make sure that people are confident enough to take the vaccine. And then, of course, we have to get the supplies out there as well. That's another issue too.
None of it's easy, Matt. That's for sure.
Actually, another cool thing is, John, you worked on a story with Scott Squires and Jake Rudnitsky about Argentina kicking off the vaccination drive with Russia's Sputnik 5. And I think it's interesting. We focus, of course, on the Western vaccines in the Western countries, but it's interesting that there are other efforts going on. This is a global issue. So I'm glad to have run across that story on the Bloomberg today. John Lauerman there covers healthcare for us here at Bloomberg. Thanks so much for joining us. Carol?
Yeah, and there you can see that headline that President-elect Joe Biden expected to give a plan to boost those vaccines. So we're going to get some more specifics. All right, folks, coming up, Bloomberg Television and Radio. Just keep in mind that later on we're going to hear from Adam Posen over at the Peterson Institute, see what he has to say, certainly about what's been going on, some of those big headlines, virus and other, and the economic impact. You are watching and listening to Bloomberg Surveillance. Carol Master, Matt Miller, and this is Bloomberg.
With the First Word News, I'm Rishika Gupta. The House is now daring the Senate to follow in its footsteps on stimulus payments to most Americans. Democrats and some Republicans approved a measure that would replace the $600 payment in the new virus relief bill with $2,000 checks. It's a proposal that's backed by President Trump. Many Senate Republicans previously opposed payments larger than $600. French fashion designer Pierre Cardin has died. Cardin was a visionary who dressed both the famous and the masses. He wasn't just about clothes. Cardin also struck his brand on a wide range of products, everything from bath towels to fragrances. His career lasted more than 3/4 of a century. Pierre Cardin was 98 years old. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Do is take a consumer-first approach. We really want the consumer to guide us on how they want to see content. Right now, they're telling us that they really want to see more and more content on Disney Plus and Hulu.
That was Bob Chapek, Walt Disney Company CEO, speaking to us back in October. Of course, Disney Plus is one of the businesses that has really, I don't know if I could say cashed in on the pandemic. That sounds bad. But they've done well during the pandemic because people are staying home, because people are locked in, and
Winners
there's
and
little else to
losers.
do besides watch content.
Winners and losers. I agree. It's like a little uncomfortable to say it, but man, they have, as you said, really benefit. Netflix, the same thing, right? Everybody is just watching everything and anything on streaming.
Yeah, absolutely. And don't forget Amazon and Hulu. And there's so many different channels that I'm waiting for one package that wraps them all together. Like, remember when we were kids, you could get cable? There was this cable thing, right? And you would get it and it had all the channels on it. That's what I want now.
Well, we're rebundling. It's just streaming. All right, let's get to our reporter, Ryan Vlastelica of Bloomberg News, watching what's going on when it comes to streaming this year. It is all about content. We heard it from Bob Chapek of Disney. Ryan, I watched Wonder Woman with my daughter. Seems like a lot of other people did too. Big screen going to streaming. I do wonder if we are at a tipping point, kind of a pivotal change when it comes to
Hang on, you watched at home or in the movie theater?
No, at home, safely with my own popcorn.
Oh, okay.
So I do wonder, Ryan, are things going to change dramatically? Are things going to stay this way where we're going to see things going straight to streaming post-pandemic?
Good morning. That's a great question. It's obvious that streaming is here to stay, and we're going to see a lot of content go directly there. We might see more hybrid models like we saw recently announced with HBO Max. Major titles like Wonder Woman 1984 debuting on streaming platforms and in theaters on the same day. This is actually a really important test case of Wonder Woman 1984. It did quite well in theaters over this past week and made about $17 million, which was above the high end of expectations here. Shows that there are a lot of people who still want to go out, want to go to a theater and see a movie. You know, this number is especially impressive considering that you have major markets like LA and New York. They're still closed. In the theaters that are still open, they have seating restrictions, so there is a lot of pent-up demand to see this, even if there is an option that you can watch it at home essentially for free with your monthly subscription. So it's very likely that as the vaccine gets rolled out, as theaters reopen, as all these major movies that were delayed from 2020 start opening next year, it's likely that we'll see a lot of people who just want to get back into the theaters, even if there are at-home options.
Right.
So and I have to agree, going to a movie theater is a fantastic experience. I haven't done it since, I think, February, but it's something I want to do. Again, Ryan, how is this changing the picture in terms of studios? I mean, the major studios in Hollywood, are they losing the clout that they had, and that's going to the Netflix, the Amazons, the Hulus? Are we seeing even movie industries in other countries that are starting to gain a stronger foothold? Because I believe Hollywood kind of got its power that way in the first place.
Yeah, absolutely. I mean, it's pretty clear that if you have these major players, Netflix being the most prominent example, you have a lot of major filmmakers who want to work with them, a lot of major actors. There's a lot of great distribution and promotional stuff going on there. You're not seeing that as much in the same way with some of these, traditional studios. There was a lot of controversy when, the HBO Max and things being put directly there. A lot of the filmmakers who were impacted by that, expressing disappointment that their films weren't getting sort of an exclusive theatrical release. But I do think that over the longer term, you're going to see these major films really focus on the theater because that's where you make the bulk of your money, even though Disney, for example, has put some titles on streaming first, like Seoul this past week, they have indicated that they're going to continue to do a sort of traditional distribution platform and roll things out in the theaters.
Yeah, I heard some of the folks on Bloomberg TV earlier talking out of Europe, talking about Seoul. I do wonder, Matt says, please, can you at least plug Midnight Sky by George Clooney? I watched it. What's interesting too, Ryan, is I think we saw it with Reese Witherspoon. Like, these are big movie stars who are embracing streaming in a big time. It's given it almost validity, and I do wonder, how we see even more of that going forward.
Yeah, absolutely. It's hard to think of many, A-list movie stars who haven't done something for streaming. Like right now, the only one who really comes to mind is Tom Cruise. I mean, we had Tom Hanks did a film for Apple TV Plus. Really down the line to mention George Clooney. Brad Pitt has done it. So just there's so much interest in streaming. There's a lot of money right now for content. A lot of filmmakers and actors have sort of the freedom to make, their dream projects. So right now, it's really a bonanza on streaming. You're not seeing that as much with the traditional model, which is more, focused on major franchises and so forth.
The other thing, I was kind of reading in and doing some research to ahead of talking to you, and the first ever NFL game to be shown exclusively on streaming platforms, that happened, I think it was Saturday night, between the 49ers and the Arizona Cardinals, had solid numbers. So, I do wonder, what is the real success story? Is it a combination of great content, which we've seen already? Is it also sports really kind of increasingly embracing the streaming space here, Ryan?
Yeah, absolutely. I know sports is one area within streaming that hasn't quite been achieved the same kind of success that other forms of content have, just because there's a lot of live elements and so forth. It's not really an on-demand kind of thing that you want to, you can watch the George Clooney movie whenever you want, but you probably want to watch the game as soon as it happens, so you're not, getting spoiled on how it comes out. So this is an area that there's been a lot of interest in. Disney has ESPN, and they're trying to integrate it with Hulu and other packages. So this is going to be one area that's going to be worth watching going forward. Yeah, just real quickly, 30 seconds here. Who's going to be the big winner, you think, when it comes to 2021, when it comes to streaming? Is it all about Disney at this point? Disney and Netflix are just so big right now. I would probably say it's going to be so much focus on Disney. They have so many of these major titles and properties. They've recently announced all these new Star Wars-related shows, all these new Marvel shows. So, certainly if you are invested at all in pop culture and these major titles right now, that's really where you have to be. Yeah, exactly. All right, good stuff. Ryan Vlastelica of Bloomberg News, who's been tracking the streaming space for us. Great stuff. Good stuff. Really appreciate it. All right, folks, just about 36 minutes away from the opening bell on this Tuesday. And we've been talking about, we've seen a lot of market support globally here. Once again, the enthusiasm over finally getting a Brexit deal, getting that second pandemic relief package, and just a reminder that global central banks will continue to do anything that they really need to really prop up economies, especially as we continue to see those virus cases continue to rise around the world. We continue to see shutdowns of the economy, even as the vaccine rollout happens. But again, as we heard from our John Larriman, it's not always so easy, and there are certainly difficulties when it comes to the logistics. You can see S&P 500 futures just up about 15 points, and also looking at that 10-year of that yield firming up just a little bit, up to 0.94. All right, coming up on the open on Bloomberg Television, Matt Brill. He is Invesco's senior portfolio manager and head of U.S. So we're going to talk about the markets there, as our own Matt Miller will count you down to the open on this Tuesday. We're going to also expect to hear from President-elect Joe Biden a little bit later on. He's got some thoughts about that vaccine rollout and those increases in those vaccine numbers. So we'll be tracking it all right here on Bloomberg. I'm going to go back over to surveillance on radio.
Chinese brands now account for 7 of the country's top 10 cosmetics lines, up from just 3 in 2017. That has pushed out foreign brands like L'Oreal's Maybelline, which has seen its share of China's makeup market plunge by half since 2010. For more, we're joined by Bloomberg editor Bruce Einhorn. Bruce, why the drop?
Chinese brands are becoming much more adept at reaching Chinese consumers, especially now at a time when more consumers are reluctant to go shopping outside. People are spending more time at home. People are spending more time on social media. Chinese brands are very good at using social media, using live streaming, using other things in order to market. Chinese brands also tend to be less expensive. And so at a time when the economy is struggling a bit, there's a lot of uncertainty, people are more budget conscious, Chinese brands have a bit more of an advantage.
If they're not, then it is fines, another fines, repeated fines, behavioral commitments, but there is the option eventually to ask for a divestiture, splitting up a company as a last resort.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Good morning. Good morning for our viewers worldwide. I'm Matt Miller, in for my brother from another mother, John Farrow. The Open starts now, or the countdown to, just 30 minutes to go. The big issue, stocks pointing to fresh records for another day. Headwinds, though, moving to the rear view mirror. It's no longer a concern. Maybe that in itself is a worry.
The fiscal aid is a good thing. It certainly is buoying markets.
The package overall has been passed. If there is a risk, a positive risk for markets, it's actually overstimulation.
There are a lot of questions already early in the calendar for next year.
There's already signs that we may look for a second fiscal stimulus.
These Georgia runoffs, what happens there?
The markets at the moment are sustained by the sentiments of investors that are very, very open to risk.
You see very little, if any, concern priced in via the equity market.
You have a new breed of investor that really is trading on sentiment and emotion.
I'm a little bit concerned of where we are in markets right now.
A lot of great news has been priced into the markets, that's for sure.
Senate Republicans now facing a dilemma in Washington after a vote by House Democrats to send $2,000 checks to most Americans, a move backed by President Trump. For more, let's bring in Bloomberg's Kevin Cirilli and Abigail Doolittle to talk about the markets. Kevin, we'll start with you. How difficult is this for Senate Republicans that have to either back President Trump or, in a lot of cases, go back on their words?
It's unknown whether or not Senate Majority Leader Mitch McConnell will, in fact, have a vote for the $2,000 stimulus checks. This, of course, having at a time in which unanimous consent would be the procedural hurdle that this measure would have to clear. It would require 2/3 of a majority in the Senate because of its ability to be fast-tracked, as it's called, in the nation's capital. Again, some procedural dynamics at play here. In contrast to that, what you saw yesterday in the Democratic-controlled House of Representatives were centrist Republicans, many of them representing more suburban districts around the country, backing the $2,000 stimulus check measure. I spoke yesterday with Congressman Fred Upton. He is a Republican from Michigan. Michigan. And what he told me was that he believes that this $2,000 stimulus check, it would help families that have been pummeled as a result of the pandemic on a host of different ways, not just and including the virtual learning It's unknown whether or not Senate Majority Leader Mitch
$1,000 checks. I'll remind everybody, though, that even George Washington, bought you beer and wine before you went to the polls. Kevin, I wonder what the other big issue that President Trump made a big deal about was the social media protections. He wanted protection stripped from big social media companies for things that their users posted. Is that just going in the corner to die if they veto or if they overturn his veto on the defense bill?
Absolutely not. And in fact, many of the Republicans who are coming out to support the overriding of the veto, which based upon my reporting, I fully anticipate will be seen across the finish line in the less than 48 hours. But many of the Republicans, like Senators Marsha Blackburn, like Senator Tom Cotton, they have all come out and said that Section 230 of the Communications Decency Act needs to be dramatically overhauled, that there needs to be a new type of conversation pertaining to big tech regulations. I contrast that, based upon my reporting, with how Democrats have argued that more regulation is needed for big tech companies in terms of breaking them up. Chairman Cicilline comes to mind in terms of his antitrust investigations. All of this comes at a time in which the Department of Justice, as well as state officials, have been looking at big tech companies and, of course, have brought in various lawsuits across the country pertaining to them as well. So no one is saying that there doesn't need to be a structural change on big tech. It's just a matter of how they plan to do so.
Gotcha. And, of course, who gets credit for it? Kevin, thanks so much for joining us. Kevin Cirilli there from Washington, D.C. For more of the market action, a lot of it driven by the stimulus out of Washington. Let's go to Bloomberg's Abigail Doolittle in New York. Abigail?
Hi there, Matt. Well, it's interesting because these $2,000 stimulus checks, the possibility that they could come into play because, of course, as you and Kevin were just talking about, the Democrats siding with President Trump. However, we still have to see whether the Senate will vote on it or will pass it. And it seems as though they are likely to block it. So I think that what we have going on here is more seasonal tailwinds. This is typically the time of the Santa Claus rally. We have had the S&P 500 up several days in a row, plus just the idea that there is support, whether it's $600 or $2,000, the American economy is supported. So with this, we have these synchronized all-time highs for the major averages. It's really pretty incredible. Let's not forget, we had a brief bear market earlier this year when the Russell 2000 actually was down more than 40%. Out of those March lows, though, more than a double, up 109%. That's the kind of recovery that we're seeing because not just the support, the fiscal support, but of course the monetary support that we'll be taking a look at in a moment. And this really goes against the grain of this pandemic year. You would think that stocks would be falling, but that has simply not been the case, especially for some of the big cap stay-at-home stocks, the most momentum stocks. Tesla up nearly 700%, Moderna, Peloton, Zoom, all up more than 400%. And Matt, it really has to do with the Fed, as so many people are expecting, because if we take a look at the Fed's balance sheet, it has absolutely ballooned to, I believe, above $7 trillion. One of my favorite charts in the Bloomberg terminal shows the money supply and the S&P 500. Earlier this year, there was a big divergence as the money supply was going higher. The S&P 500 went this way. They've both converged, so here we go. Something to keep in mind, though, the Russell 2000 actually retreated from its all-time high yesterday, so some interesting divergences also to keep an eye on against all of this exciting background, Matt.
Yeah, but Tesla up 700%. I love it, Abigail Doolittle. The price-earnings ratio, 1,051 on Tesla shares right now. Let's bring in BTIG's Julian Emanuel. We expect the rally to continue into next year. Julian, you're writing, quote, we see the S&P 500 at 4,000 at the end of 2021, despite the market being very overextended in the near term. Earnings growth is coming. Financials are set to lead, and the history of years like 2020 tend to be followed by higher prices in the subsequent year. How can these kind of PE ratios, certainly nothing else is like Tesla, but we're looking at 30 on the S&P, continue for another 12 months?
Well, you really do need a confluence of things to go right. And essentially, the way the setup is, the base case is that the majority of these things will go right. Obviously, the public inflows, particularly in the options market, have been a very strong determinant of prices, certainly in the second half of this year. The public bullishness is a near-term concern. But in essence, when you think about it from a longer-term perspective, the fact that there's enough cash on the sidelines, the fact that a new generation of investors has come into the market and has actually shown a tolerance for pain, which is surprising, I think surprising to all of us professionals, really bodes well in this environment of negative real yields for further gains next year.
So does every family then take these stimulus checks, buy 2 or 3 Teslas, and then drive from Airbnb to Airbnb for the entirety of 2021? I mean, are you counting on, are investors counting on all the liquidity being pumped into the market that to be spent immediately by consumers?
No, and actually, if you saw, an incredible burst of spending, that's something that may actually take away from investment flows. So what we think is you're going to see gradual increase in spending as the economy reopens, certainly towards the second half of next year, as well as sustained inflows, perhaps on the order of what we saw after the last election in 2016, to guide stocks higher next year. But it isn't likely to be a burst. And frankly, if it were a burst that resulted in a further burst in the stock market, we'd probably get incrementally more cautious.
How much cash is on the sidelines then right now, Julian, and how much of it is going to come in via Robinhood?
Well, so if you look at money market funds, they have come off their highs, but the spike is incredible. And when you think about what the personal savings rate is, essentially in the teens, whereas over the last 10 to 15 years, that average was more like on the order of 5 to 7%. It really is quite dramatic. But again, much like what we saw in coming off of the lows in 2009, the cash is being used to supplement consumption in the present. And that's why, for us, part of this story of higher markets in 2021 is contingent on the distribution of the current stimulus and the market's expectation that you're going to get further stimulus above and beyond this $900 billion.
And some of it, of course, is going to Bitcoin as well, Julian. I know you guys have a $50,000 price target for it at the end of 2021 as well. Julian Emanuel sticking with us. Kriti Gupta joining us now with a look at some of the stocks moving in the pre-market. Kriti, what do you see?
Well, Matt, of course, we're also seeing that defensive bid once again leading in the markets. A lot of this coming down to Apple. You can see those shares higher, poised to hit an intraday record. Of course, we saw it close at a record high just yesterday. Of course, shifting over to Alibaba as well. This is a company that's been dealing with a lot of antitrust scrutiny, of course, in China. So now they're coming out and saying, well, that Ant Group, that parent group, could actually be restructured to a holding company. So good news for the likes of Alibaba and, of course, other ADRs like JD, for example. Switching over to Nikola, that EV space getting another bid. An analyst over at JP Morgan saying it will see a less drama-filled 2021. Flip up the boards and look at the downside movers. You actually see vaccine makers taking a little bit of a hit as AstraZeneca could get approval over in the UK and, of course, nears a deal with Indonesia as well. That coming to the detriment of the likes of BioNTech, CureVac, and Moderna. Matt?
All right, Kriti, thanks very much. Kriti Gupta looking at some of the pre-market movers this morning. Coming up, a tumultuous 2020 is finally drawing to a close. Strategists taking their positions following an unprecedented year for global markets. That conversation coming up next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Bitcoin is the reserve currency of the crypto asset ecosystem. So it is the reserve cryptocurrency, which is a very important role. It's the flight to safety currency. We are extremely bullish. Our confidence in it has gone up since 2017.
Big boss there, ARK founder Cathie Wood, laying out the bull case for Bitcoin, topping $28,000 for the first time ever on Sunday. In a year that will be remembered for a global pandemic, many records were broken, leaving investors wondering how to position heading into the new year. Bloomberg's Abigail Doolittle joining us with more. Abigail, what an insane year.
What an insane year. And those comments were really pretty stunning, Matt. The idea that Bitcoin is the digital cryptocurrency and a safe haven. I'm not sure that that's how a lot of the folks investing in it view. Some clearly do, but something that's up more than 2,000% in such a short period of time doesn't exactly trade or feel like a safe haven. But it's not just Bitcoin that's on a tear. As you're mentioning, stocks right across the board. Earlier, we were talking about U.S. stocks set for new all-time highs, synchronized all-time highs. Stimulus a piece of it, but it's global stocks too, Matt, as you know. So I think it really makes the case that the bigger tailwind, central bank support around the world, the NASDAQ 100 doing the best, up 47%, but you have the S&P 500, the DAX, the all-world index, all at record highs, all higher on the year after that brief bear market earlier this year. Now, another look at liquidity, of course, super low rates. That makes the liquidity and the funding situation cheaper. That certainly has helped stocks. It's going to be interesting to see if we do see the 10-year yield finally back up above 1%. Will we see a repricing of risk, and what level would it be? 1.25%, 1.5%? Unclear right now, but that's something to think about for 2021. And then finally, speaking of 2021, analysts are super bullish. Yesterday, Chris Murphy at Susquehanna on Options Insight told me he does expect the S&P 500 to rally with sharp pullbacks. That seems to be the consensus. The average average analyst expects the S&P 500 to end above 4,000. The low, though, still above where we are now at 3,800. So really pretty extraordinary. Not what you would expect coming out of a pandemic year. And of course, the pandemic stretching into 2021, unfortunately, Matt.
I hate to use the term FOMO, Abigail Doolittle, but, you know, older people like myself used to call it animal spirits. How much of a role is that playing in this risk rally?
I think it's probably everything, Matt. Or my opinion is that it has a lot to do with it, certainly, and that's that liquidity, that cheap money being put into the system at the point that you have at first the safety stocks, the Apples being bid up earlier in the year, but as the year goes on, the Russell 2000 catching up in the second half of the year, then Bitcoin really taking off. So you have all this money in the system trying to find a home. That's certainly been happening in spades this year and pushing further out into the risk continuum as the year goes on. It's going to be interesting to see how it does play out in 2021. But again, street analysts are really pretty constructive.
All right, Abigail, thanks so much for joining us there on that. Abigail Doolittle on an outlook for 2021. Let's get Julian Emanuels from BTIG. He's still with us. And Julian, I'm pretty sure I read something from you, some research from you in the past couple of days about how much the sentiment, how much momentum has to do with this rally. How key is that, and how confident are you that it holds?
It's very important, as we were talking about earlier, Matt. The fact that you are basically at all-time record valuations in the S&P 500, by definition, makes it necessary that more things will need to go right in 2021, perhaps than in typical years. And sentiment is definitely one of them. Again, we've seen reasonably good inflows post the election. We've seen the options animal spirits continue to be very, very firm. The fact that you had virtually record call option trading the day before Thanksgiving is mind-boggling to us, but that is just typical of what we've seen in 2020. It doesn't necessarily need to go on at that breakneck pace, and frankly, we'd probably be a little more sanguine if the market marked time and the speculation calmed down for a bit, but that is a critical element in driving prices higher in 2021.
Where do you see yields, Julian? Are investors going to feel comfortable enough then this year to let go of the perceived safety of government debt and allow yields to float higher?
Well, we think that is part of the story, and really, again, part of the story driving equities and alternative assets as well. In a world where we know the Fed has said that they're not going to permit negative yields, certainly on the short end, and a world further where we do believe there's going to be greater stimulus. And, despite the protestations from certain people in Washington, the deficit is likely to rise even further. All of that point to higher long-end yields. Our year-end view is that the 10-year yield goes to 150. It does not necessarily need to be a disruptive event. What it likely will do within the context of a strengthening economy is cause this rotation that we've seen away from high multiple growth and towards value to accelerate in 2021.
You bring up a great point, a phrase I learned from Tom Keene about 20 years ago, financial repression. How much does that have to do with the rally in Bitcoin? I mean, how much is your $50,000 Bitcoin target predicated on what the central banks are doing throughout the next year?
Well, the flood of liquidity has certainly found its way into cryptocurrencies, into international markets, which we actually think outperform the U.S. Next year. It's all part of this combination of the globe going into the pandemic downturn together and exiting it. That process has already begun and we think accelerates in 2021 together. And that kind of globally synchronized growth has tended to cause a broadening of risk on rallies, whether it's, again, cryptocurrencies, international equities, and the source of funds has traditionally been, and we think it will be, coming from the fixed income markets.
Any reason to hold gold now?
Yeah, we think that gold continues to benefit from this view that inflation and inflation expectations are likely to move higher as liquidity remains very ample and as the global economy recovers. Higher inflation expectations is part and parcel of this recovery that we see, and really quite necessary when you think about the fact that confidence in general is still, very tenuous given where we are in the virus.
All right, Julian, great to get some time with you. Thanks so much for joining us. Julian Emanuel there from BTIG. Now, coming up, the analyst action you need to know about. That's next in our morning calls. Then later on, Teflon Tech leading the way this year with the rotation debate heating up. That conversation still ahead with Charles Lieberman of Advisors Capital Management. This is Bloomberg.
新型にはなんと2万点以上前進でついてます。なので2万点あることにより、その情報が取れない、平面がないんですね。なので全てをスキャンすることができるので。どちらにせよ自分のサイズを1回最初から、適正なものを発見してそれを買って、家に届いてきたらぴったり非常にハッピーというのがやっぱりしかるべき姿かなと思ってます。
If we can really get vaccines going in April, May, June, July, and August, by the time we get to the end of the summer, I think we can get to that goal that I'm talking about getting the overwhelming majority of the population vaccinated.
I'm Matt Miller in for John Farrow. This is the countdown to the open. It's time now for our morning calls, a look at some of the analyst recommendations on Wall Street this morning. First up, Goldman Sachs raising its price target on Snap to a street high $70 a share. The analysts expecting growth to accelerate next year amid recent innovations and a favorable macro backdrop. Next, Raymond James raising its price target on Wells Fargo up to $35 a share with an outperform rating. The analysts noting the bank's progress on improving its ESG strategy. And then finally, B. Riley raising its IMAX price target to a street high $26. The analysts expecting the big screen theater company to benefit from the return of moviegoers with vaccines starting to roll out, as we've been talking about a lot. Coming up, some of the stay-at-home winners taking a hit as we wrap up 2020. That conversation up next with Charles Lieberman of Advisors Capital Management. This is Bloomberg.
give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
We are 20 seconds away from the start of cash trading on Wall Street. Take a look at futures right now, pointing higher across the board. S&P and NASDAQ futures up about 0.5% after reaching all-time highs again yesterday. That's likely to repeat itself again today. There you hear the opening bell. Trade starts now at the NASDAQ, at the New York Stock Exchange, and on electronic exchanges across the country. No doubt the bullish risk-on mood will continue. We saw it, or we see it here in Europe, and we'll see it there in the U.S., at least at the open as well. You can also see Bitcoin continuing to ride. I put that in there, Bitcoin. I could have put really any currency other than the dollar, because the greenback falls and that boosts the euro, the pound, and even those coins in the currencies in the digital space, which a lot of people would consider simply commodities and not currencies at all. The 10-year yield continues to rise higher right now, 0.9481, so 95 basis points as investors let go of that protection. And NYMEX crude rising more than 1% to 48.19 a barrel. Let's head over to the markets desk. Bloomberg's Kriti Gupta joins us now with some of the stocks on the move in the very early trade. Kriti?
Well, good morning, Matt. That cyclical bid alive and well, kicking it off here under the hood with Boeing and American Airlines. The 737 MAX returning to the skies today, with American Airlines debuting their first flight in a long time with that plane from Miami to New York. Those shares really appreciating it, I should say. The travel sector bid ongoing with those cruise lines. Carnival up about 2%. It was up 2% in the pre-market, but 4% in London trading. So, of course, those cruise lines once again getting a bid. Looking at the Cheesecake Factory as kind of a proxy for other restaurants in line with that reopening trade, as well as those $2,000 stimulus checks. Really seeing those chain restaurants do well. Flip up the boards, and you'll also see that in line with that stimulus trade, you're also seeing Square benefit as well. For them, that first round of COVID relief checks coming out. The next round's coming out as soon as next week. And of course, Lemonade, one of the best performing listings of 2020, down 20% in the last 2 days, seeing a little bit of a bid now. Remember, the restrictions, those insider selling restrictions end this week. About 44 million shares could be entering the system. And of course, Matt, wrapping it up with what we have to talk about, Apple hitting an intraday record right off the bat. This is a stock that, of course, had a record close yesterday and is seeing quite a heavy volume going into year end.
Yeah, absolutely. Kriti, thanks very much for that. You mentioned Apple hitting the record, also among the biggest contributors to the S&P 500 this year. Just one of the many tech stocks leading the way in 2020. But the consensus trade favoring a rotation in 2021.
I would say that value over growth in the U.S. in the long run, and also just beware of mega cap stocks. There's a huge difference in valuations between the top 10 stocks in the S&P 500 and everything else. I think as uncertainty diminishes, momentum trades will also diminish. I think it'll be more about valuations. And there are good values in markets. They're just not in large cap growth stocks or in long duration safe bonds.
Bloomberg's Abigail Doolittle joining us now with a little bit more on this. Abigail, the big rotation is one that people have been calling for a while, and no one's been right about it yet.
Well, Matt, I'm not sure that that's true, because we have seen a bit of a rotation, actually a big rotation, at least relative to small cap. 2020 will certainly go down as the stay-at-home trade, the big cap trades. Apple, as you mentioned, a new all-time high. Pete Terrace, who I'm sure you missed here in New York, he just sent out a note saying that Apple has added $1 trillion worth of market cap in 2020 alone. However, the Russell 2000 over the last several months is outpacing the S&P 500 by far and the NASDAQ 100. And in fact, out of the March lows, more than a double, the NASDAQ 100 up nearly 80%, if you can say merely. So I'm making the point here that the Russell 2000, some of these small cap and value names, they've already been doing pretty well. Now, of course, the driver for stocks of all sizes and shapes, that has to do with earnings. And we're finally starting to see the forward-looking earnings EPS number for both the S&P 500, the Russell 2000, and the mid-cap S&P 400, all returning to pre-pandemic levels. So that's certainly encouraging because you can make the case that you have this just right everything rally where you do have the large cap hanging on, and then you have these small caps doing this big catch-up in the second half of the year. However, we have seen a little bit of weakness over the last couple days. Lemonade strong on the day, but on Monday, we saw some big weakness in Lemonade, Chewy, Moderna, Zoom Video, the hot stocks, the stay-at-home darlings this year, and you can see those massive, massive gains. Pretty amazing, Matt. Really perhaps comes back to that liquidity that we were discussing before, that these companies that, yes, taking advantage of the stay-at-home trade, but of course, valuation really obscene, but investors sort of holding their nose and buying away and doing quite well with it until Monday.
Can't fight the Fed, right? The central bank wants to push you out there, you're going to go. Abigail Doolittle, thanks very much for that. Chuck Lieberman of Advisors Capital Management joins us now, expecting a rotation out of growth, writing, quote, stocks that benefited the most from the COVID dynamic now have full valuations and should benefit less from the recovery. Others remain depressed, and much of their recovery still lies ahead. Chuck joins us, and this is kind of the rotation that I've been waiting for, Chuck. Out of growth into value. It's one that I think many have been calling and waiting for. Is it long overdue, or do you see it beginning?
Well, it really started a couple of months ago, and I expect it to continue. It's not that technology stocks are going to do poorly. Those companies are still in great shape. They're doing extremely well. We continue to move in the direction of technology. It's becoming more pervasive everywhere in the economy. But the stocks are fairly well priced, and the rest of the market is still quite depressed. 2020 was a year where the market was up 15% or more, but very little was up 15%. Technology was up 50%, 100%, 150%, and the airlines, hotels, those companies, not one of them is positive. They're all down sharply for the year. So there's great value there as the economy reopens with the vaccines, and that's where the value is most attractive.
Where do you expect the vaccines to work most efficiently? Where do you expect the rollout to work most efficiently? Where do you expect people to take them? Where do you expect the economy to bounce back fastest?
Well, they're obviously trying to roll out the vaccine as fast as possible. It's still a massive undertaking, so it'll take some time. But if their estimates are right, we could have 100 million people vaccinated by the middle of 2021. That would be an incredible achievement. In terms of where the economy bounces back, there are certain parts of the market that we think will participate relatively soon. For example, we like the financials. The banks are quite depressed. They're still extremely cheap. Wells Fargo and Citi both trade at discounts to book. There's a lot of upside there. Then you have insurance companies, which are very, very cheap. Lincoln Financial, Prudential, both very attractive companies trading at significant discounts to book. Again, tremendous upside potential. So there are a lot of places where the recovery should take place sooner. Then there are others where it'll take a little bit longer, but not a long period of time. For example, we'll go back to the office. That should be good for a company like SL Green.
Chuck, surely if you're counting on a rotation out of growth and into value, you got to look past Wall Street, across the Atlantic, and over here. I mean, the valuations that we're dealing with in Europe are nowhere near the likes of the NASDAQ.
That's right, but Europe also doesn't have as many technology companies, as many companies in the forefront of technology as we have in the U.S. There are no comparables in Europe for the Googles, the Microsofts, Amazon. So it's a different market. It's not to say that European companies aren't attractive. They are. They will participate in that economic recovery. In fact, one of the most important drivers that I see for the recovery is that it's going to be global in nature. Just as the shutdowns were global in nature and they were mutually reinforcing on the downside, with the vaccines, we're going to see a mutually reinforcing upside to economic growth around the world.
All right, Chuck, thanks very much for joining us. Chuck Lieberman there from Advisors Capital Management Company talking to us about his expectations for 2021. Let's head back over to the markets desk. Kriti Gupta joining us with another update on where we stand 10 minutes into the session. Kriti?
Well, Matt, of course, we're starting off with those home builders. Lennar, for example, getting quite the bid this morning. You saw Case-Shiller data actually say 20 city home prices are posting a beat, above their estimate, 7.95%, up on a yearly basis, the largest year-over-year gain since 2014. Also switching over to Alibaba, you are, of course, seeing those shares actually gain after taking quite a hit recently, simply on the idea that Jack Ma is actually coming up and saying that he's going to turn his company Ant into a holding company, a little bit limiting those gains, but still appeasing the Chinese regulation authorities. And, of course, wrapping it up with some of the vaccine makers, Novavax and AstraZeneca. Novavax coming out, making progress on their phase 3 trial. AstraZeneca getting near approval in the UK, still waiting on submitting that application into the EU. Nevertheless, those stocks getting a bid to the detriment of some of those other vaccine makers, Moderna, Pfizer, BioNTech. Matt?
Kriti, what kind of volume are you seeing? I mean, I know during a holiday season, a lot of people tend to stay home, but we don't typically have the kind of retail participation that we have in a year like 2020. There's so many day traders at home, and even the industry players want to get in on that.
Well, of course, Matt, volume this holiday season has been so notably different. You have, of course, seen low volume, light liquidity. So it's essentially the institutional traders haven't really been participating, so you're not seeing the kind of massive bids that you would traditionally during a usual market session. But what you are seeing is a lot of headline stories, and that is enough to move the stocks, and it can only be assumed that the retail trade is behind this. So even though it's a low volume, light liquidity day from an institutional basis, those retail traders still at work here.
All right, Kriti Gupta there looking at the open for us. 10 minutes into the session, 11 minutes into the session, and another new record high. Coming up, a year like no other for credit markets, risky bets turning into winning wagers. That conversation next with Invesco's Matt Brill. This is Bloomberg.
We've seen great recovery in the markets. We have not yet seen that recovery in unemployment, things like that in the economy. So we'll see that through 2021 as the vaccine has an impact. But you really need to see that come into the system And I think that's going to be the driver of credit.
Blackstone's Dwight Scott, they're expecting a stronger economy to drive credit markets after the Fed's unprecedented pandemic response to support corporate debt markets triggered a surge in prices and deals. For more, let's bring in Bloomberg's Abigail Doolittle. Abby, we've seen a lot of MA Go action lately. Certainly the end of the year has been really playing catch up.
The end of the year has been playing catch up because the first half of the year for M&A was not so great. So the second half of the year, and relative to credit, like so many other asset classes, Matt, it is a year for the record books, because who would guess that you would have corporate bond ETFs rallying about 30% on the year? Well, that, of course, is what happens when you put all this Fed liquidity into the picture. And you can see here in the Bloomberg terminal that HYG, which is high yield debt, and LQD corporate debt in yellow and blue, doing really quite well, in blue and white, doing really quite well after the Fed's balance sheet just absolutely ballooned, as shown there in yellow, going up to $7.4 trillion from $4 trillion. So really, again, coming back to that liquidity we've been talking about all morning. And as investors have been seeking yield, Matt, where have they been going? Well, to the junkiest of the junky, because corporate bonds on the year, not so bad for corporate credit, up 6.3%. But when you start to take a look at double B and B and triple C, take a look at that. Triple C, again, the junkie of the junkie, is up more than 20% on the year. Really pretty incredible. Works well when the liquidity is working well. Let's hope that there isn't any sort of a crisis, because if there is, you could really see air pockets there, Matt, where there won't be a bid for these bonds. And then finally, not surprisingly, companies and bankers doing what they do well, taking advantage of all of this liquidity. Record issuance in junk debt this year, Matt, more than $4 trillion. Really pretty incredible. Again, another record breaker for the books here relative to credit.
Yeah, absolutely. Hopefully we don't see that cascade of bankruptcies that Joe Stiglitz had been forecasting earlier in the year. Invesco's Matt Brill expecting spreads to grind even tighter as record investment-grade inflows persist into the new year. He writes, quote, "There is no better large liquid market to invest in with positive yields." He joins us now, and let's talk, first of all, Matt. I think it was during the last ECB meeting, I was messaging with Pharaoh, and I said, how come no one ever uses the term financial repression anymore? I feel like it was a lot more popular during the fiscal crisis. Do you see this happening in a very bold way now? The central bank's just pushing investors out the risk spectrum.
Yeah, good morning. That's exactly what they're doing. It's a domino effect, and essentially they're forcing you out of cash in the short term. If you're already in short term, you're going to intermediate. And if you're in intermediate, you're going out the curve. So the Federal Reserve is making it very punitive to be holding on to cash. And from that standpoint, it's making other buyers come in. We're seeing the inflows. And, even this week, we've got basically a full desk staffed putting money to work for Japan. And it just doesn't stop. And we don't think it's going to stop in 2021.
So why does it continue to last that long? I mean, I remember back when we all learned the terms CDO and CLO, and every investor thought asset prices couldn't go down. Of course, that ended with a big bust. Is that how it ends this time?
Well, yeah, it certainly ended in tears back then. I don't think for the high-grade market it'll end in tears this time. You have a subsector of the high-yield market. We're actually quite favorable on triple Cs right now, but there will be some challenges around travel and leisure for sure. But one of the things about investment-grade credit that foreigners particularly like is that it is high quality. These are companies that they know. These are the Apples of the world, the Microsofts of the world. They're not going anywhere. They certainly have added a lot of debt in the past year, a lot of leverage in the past year. But they're going to be around. These are household names that can get them positive yields. And then they're so liquid to be able to invest in. So you can get into them. And if you were to change your mind in a few years that you think that the economy is worse or these companies aren't what you thought they were, you could get out of them. And I think that's one of the key things versus structured. When you were in the structured market back in 2007, you saw the signs. You couldn't get out of it even through 2008. So, that's kind of the Roach Motel, and the investment grade market isn't that way.
Fair enough. So the high grade IG credit, I understand that kind of confidence there, but haven't investors already missed the boat?
We didn't miss the boat, but a lot of investors might have, sure. Back in March, it certainly became a very challenging time to invest. And, our indications, we were looking at, certain fundamental indicators that weren't as bad as people were saying. But at the end of the day, you needed the Fed to step in, and the confidence was there once the Fed stepped in. And so the Fed has actually only purchased about $14 billion worth of bonds in the corporate bonds. And that's about 0.2% of the market. So while the Fed has certainly supported the market through their words, they really didn't support the market through their purchases. And, when we think about buying investment-grade credit, it is about confidence. We know that the demand is there, but you just don't want to be the last one in. And so investors are certainly, worried as valuations have become more challenged and credit spreads have gone tighter. But there still is money that needs to be put to work. And so fundamentally, we actually think things get better in 2021. So that gives us a little bit more confidence, even without the Fed, as the Fed starts to pull away.
Matt, one of the things I've noticed, I've heard from people at MasterCard, we've heard it from Larry Summers, is that consumers are not only putting money away, you see savings rates rise, but also paying down debt. Do you see companies doing this as well, and what does that mean?
Yeah, we're seeing the exact same thing. And, people point out that leverage has picked up quite significantly for corporate market, but so has cash. And so corporations have added about $600 billion of cash this year. They have more cash than they've ever had in the history of corporate credit. So from that standpoint, the balance sheets are really distorted differently than they normally would. You don't have this imbalance of a lot of debt, but a lot of cash there. The reason why is the same reason that you have with consumers, that everyone's still worried that we could have another wave, we could have the economy shut down again. We just don't know when life will get back to normal. So let's hold on to a little extra cash. I like to call it a life insurance policy. As we go into 2021, I'm not upset that I had a life insurance policy for 2020. I don't feel like that was a waste of money. Corporations are the same way. Having cash on their balance sheet was a life insurance policy. They're more than happy to have spent that money to make sure that they got them through the worst of it and get them through on in 2021 when we think things are going to be a lot better.
All right, Matt, thanks very much for joining us. Really appreciate your input, especially on the high-quality IG, when, as Abigail pointed out, a lot of people are reaching out to the junkiest of the junk right now. You're a bit of a contrarian. Coming up, the market-moving events that you need to be watching. That's next. We bring it to you in our trading diary. This is Bloomberg.
Remember, this was not announced as a complete trade deal. This was announced as a phase one. So we and the Chinese both are well aware that there's much more to do.
When you get to the numbers that we're in right now, it really is very, very difficult to do effective identification, isolation, and contact tracing. In addition to the surge, we're going to have an increase superimposed upon that surge, which could make January even worse than December. We certainly are not at the numbers that we wanted to be at the end of December.
All right, so Dr. Anthony Fauci there delivering a message of pessimism, saying that January could be worse than December. He expects it to continue getting worse. It's time now for the Trading Diary, what you need to be watching this week. Vice President-elect Kamala Harris receiving the COVID-19 vaccine this morning. President-elect Joe Biden speaking at 3:45 p.m., and then a slew of U.S. data coming on Wednesday with wholesale inventories, or inventories, as they say it, funnily enough, in the U.K., pending home sales and Chicago PMI numbers, plus the U.K. House of Commons voting on the Brexit deal. Someone during that vote is sure to say inventories in a silly way. On Thursday, we get a final read on jobless claims for the year. And then finally, global markets are closed on Friday for New Year's Day, and for all of us to recover from, well, I don't know, is everyone going to have a hangover this year? Because there's really not very much to do. We're even banned from lighting fireworks here in Berlin. And in Berlin, that is what you do while you're drinking on New Year's Eve. 26 minutes into the session, let's get a check on how equity markets are rallying right now. You do see the DAX turning back down after hitting a record high in Frankfurt. The FTSE is still up almost 2% at 66.20. The NASDAQ and the S&P both gaining, not going gangbusters, but the S&P touching another record, up 10 points to 37.45. This was the countdown to the open. This is Bloomberg TV.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
It is 10 a.m. in New York, 3 p.m. in London, 30 minutes into the trading day in the U.S. From New York, I'm Alex Steele. Welcome to Bloomberg Markets. Welcome to another record. So you have the Dow, the NASDAQ, S&P closing yesterday at a record, another gap up today. You got Apple at another intraday record high. No signs of slowing down. It's why I'm calling it the equity melt up. The result of that is, can you guess it? You got higher yields and you have a weaker dollar. Nothing to write home about necessarily, but still that risk on trade continues. Is it just going to be sort of as we get into the new year or something more sustainable as the stimulus hopes that $2,000 check now permeating within D.C. and permeating within the markets? Some actually warning now, though, of a blue wave. What will happen if everything changes come January 5th? We will break that down. Well, speaking of stimulus, you had House Democrats and some Republicans are approving a measure that would replace the $600 in payments in the new virus relief bill with $2,000 checks. It is a proposal that's backed by President Trump and puts Senate Republicans in a new dilemma ahead of the Georgia runoff elections next week. Now, many Senate Republicans previously opposed payments larger than $600. We should be hearing from Senate Majority Leader Mitch McConnell later on today. Joining us now, Rick Davis, former campaign manager of former Senator John McCain's 2008 presidential campaign. Rick is also a partner at Stone Court Capital and a Bloomberg contributor. Rick, Mitch McConnell has been in hot seats before. This seems particularly hot. What does he do today?
Yeah, no matter what Mitch McConnell tries, I mean, every time he gets stung out on a policy issue with the White House, he says, I'm waiting for the White House to tell me what to do. White House, approved the legislation that was passed in Congress this year, and then Donald Trump rejects his own approval. So I think McConnell is going to be talking to Republican senators, and he's going to find out that none of these guys want to walk the plank for a $600 stimulus check. They have support in the House, passed it yesterday. They've got a control issue in the Georgia runoff elections staring them down in the face. And the last thing they want to look like is that they're the misers in a holiday season. So I would imagine there's a lot of internal pressure to relook at the vote today that Schumer's trying to pressure McConnell to do.
It's also, I don't know if I've ever seen something like this before when it comes to, say, the defense bill. I mean, it was a veto override in the House. It's going to the Senate. And then President Trump saying today on Twitter, attacking Republicans as weak and tired leadership that will allow the bad defense bill to pass. What's the strategy here? How is that going to set up the Republicans for Georgia?
Well, it's just Trump didn't get what he wanted out of the NDAA, the National Defense Authorization Act. He wanted to Christmas tree it with things that had nothing to do with the defense bill after it had already passed. And how the defense bill will impact Georgia, I mean, Georgia has a high contribution to the military, some very key military bases there. This is what funds the military on an annual basis. And for 57 years, this bill has been passed in a bipartisan, bicameral basis. And so Donald Trump really is making it difficult for these two Republican senators running for re-election in a runoff campaign, on the 5th of January by putting these kind of barricades into what should be a very positive message. They should be campaigning on the idea that they've increased spending on the military, increased, payments to military families. And yet now we're caught up in this rearguard action where the president has undermined the Republican bill that was fully endorsed by leadership in both the House and the Senate.
Yeah, and speaking of, Georgia, there was a report overnight that talked about how Senator Perdue was like, look, you have to help me in Georgia. You're not helping me. You need to sign the stimulus bill, even though he wasn't necessarily for it to begin with. So I wanted to quote you, Terry Haynes of Pangea. His note out this morning talked about blue, saying that all blue potential is underestimated by markets. It is a direct byproduct of President Trump's self-generated last-minute drama over COVID stimulus and government funding and defense legislation. He thinks now about 70% for a Republican win. What do you think?
It's very hard to predict a runoff election in Georgia. If you look at polls that lean Democratic, they show the Democrats holding a slight edge, all within the margin of error. And the Republican-based polling shows Perdue and Loeffler with a slight, edge. So It's going to be a close election. I can't imagine a scenario where there isn't sort of a unified approach, right, where voters vote for both Republicans or both Democrats, but not splitting that ticket. So in that regard, I doubt if we're going to have a hung situation where you have one Democrat and one Republican win. So you're either all in or all out, and there's no question that the debate around stimulus has been a disadvantage for Republicans, both the position they took going into this election cycle, but also the sort of scrambled eggs that the administration's put on the table as to not having a clear approach, and Donald Trump undermining, the Republican approach to this. The one thing you don't want to do at this stage of a campaign is change your strategy, and Trump has forced his strategy onto them. And, of course, he will show up the day before the election in Georgia to press his points, which should probably even create more confusion amongst voters.
It's going to be a really exciting few days, I got to say. All right, Rick, thanks a lot. Rick Davis of Stone Court Capital and Bloomberg contributor, and Happy New Year to you as well. Joining me now, Christopher J. Wolf of First Republic Private Wealth Management CIO. Christopher, what do you think about Terry Haynes' hypothesis that we could see more of a blue wave, not priced in by markets? How do you position for January 5th?
Well, I think if you have a blue wave, I think the first thing we're going to see is more stimulus. So the stimulus story has been one that's been dominating markets over the last several months. So more stimulus in this case is likely to help propel markets a bit higher. So a blue wave, I think in the very near term is probably not as bad as some folks would seem to believe. I think conversely, the longer term picture around redistributive taxation policies would have to come into play, but that's probably much later in the year. In the near term, it's probably a pretty good thing.
So if we have any sort of short-term sell-off on that, do you buy the dip?
Yeah, I think you do for a couple of reasons. One is, regardless of the politics that play out in 2021, the arc of the economy is bending towards reopening. The vaccine is helping to accelerate that. And I think what the market's doing at this point is looking beyond the 2021 earnings and already looking at the operating leverage that's building up through the use of technology into 2022. And you could be well north of $200 a share in EPS for the S&P 500 in a situation where there's a combination of operating leverage, a lot of stimulus still flowing through on the monetary side. That means cheap money, low interest rates, and you get the rapid deployment of technology because of all the COVID challenges that helps to accelerate the operating leverage. That could be a pretty strong upside story in 2022.
So then the narrative that we're going to see kind of money go out of tech and into value and small caps, that clearly had been dominating in the fourth quarter. Is that not then true?
It has been true. I think in the very near term, that's really what the arc of reopening looks like. It's a broader participation, not just in the economy, but also in the stock market. Keep in mind, there's a little bit of math here. I mean, one share of Tesla or one share of Amazon is worth many shares of these other companies. So if you're a portfolio manager and rebalancing, it doesn't take much in terms of share counts to start to create a lot of share-based demand for some of these smaller share-priced companies. And I think that rotation has been helped by that fact, number one. And number two is I think you're in a world where the combination of all of the debt that's being created and a little bit more concern about how the dovish policies of the Fed may work in this environment, it's going to push interest rates up a little bit. Pretty good for banks overall, but it's also good for a broader set of the economy. I think if you're getting towards reopening, that really reduces in some cases bankruptcy risks, and that should help multiples.
So, I mean, I hear what you're saying. I'm just trying to understand if tech has to sell off. Just look at today, right? We had a NASDAQ hitting another record yesterday, Apple hitting another record intraday high. They've given up some of those gains, but nonetheless, does tech have to sell off?
No, tech doesn't have to sell off. It just may not appreciate at the same rate. I mean, there's a lot of folks talking about this being a little bit like 1999. The big difference, though, is that there's a lot of earnings power in tech, whereas in 99 there wasn't so much. The other thing to keep in mind is that as we reopen with Europe in terms of trading partnerships or kind of restart the trading relationships, a lot of U.S. technology companies have massive opportunities in Europe. And so you're going to see, I think, some of that growth expectations actually be delivered on.
So does that mean that you need to be rotating out of the U.S.? And is the value small cap play really in Europe? And I ask that with hesitation because I feel like that call has been there for years at this point.
Mm-hmm. Well, I think it's been there really since the middle of this year or so. The real trade over the last several years has been to hide in high quality dividends, and that's worked out very well, and particularly post-COVID. But I think at this point, with the combination of vaccine news, and even though it looks very bad in terms of the COVID news, if things are going to get better middle of the year, driven really by vaccine and more prudent policies, some of the hardest hit areas already may rebound the most. And in some cases, that's going to be, I think, Europe. We'd be favorable there. Could be Japan, particularly on the back of the strength in the Chinese economy. So the opportunity outside the U.S. looks reasonably compelling on that ground. Add valuation levels, which are at 20 and 30% discounts, and you have a good story to be rebalancing and have a more global portfolio than one that was just concentrated in the U.S. in the last couple of years, which, by the way, did really well.
All right, well, one more question on the U.S., and then we're going to take a break and come back and sort of talk rest of the world and vaccine. If you take a look at the RTY, the Russell 2000, right, small cap stocks, rolling over the last couple days, but an unbelievable move, like you said. Do you need to be selling small caps here in the U.S., or can you have a value trade that's global?
I think you can have a value trade that's global. I wouldn't be surprised, though, if we get a correction somewhere along the lines here. Some combination of political events, there's going to be worsening COVID news, et cetera, could push sentiment in a negative direction for a short period of time. But I think that longer arc of reopening really argues for broader portfolios, not just necessarily style-wise, growth versus value, but cheaper companies value relative to the expensive, more growthy companies, not just in the U.S., but globally. So that rebalancing is a global rebalancing rather than just U.S.
Got it. Okay. Good stuff. Christopher J. Wolf of First Republic Wealth Management. You'll be sticking with me. We'll delve more into that. Coming up, Dr. Anthony Fauci says the U.S. is lagging with its COVID-19 vaccination rate as the U.K. and Europe look to bolster theirs. We're going to take a look at that path forward. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. The House has passed a bill that would replace the $600 stimulus checks in the new virus relief bill with $2,000 payments. House Democrats and some Republicans voted in favor of the proposal backed by President Trump. Now, that creates a dilemma for Senate Republicans. Many of them previously opposed higher stimulus payments, but Trump's approval could put political pressure on them. Meanwhile, the House has voted to override President Trump's veto of the $750 billion defense spending bill. If the Senate takes similar action as expected, it would be the first time one of the president's vetoes has been overturned. President Trump vetoed the bill in part because he wanted to attach an unrelated provision that eliminates content liability protection for tech companies. And French fashion designer Pierre Cardin has died. Cardin was a visionary who dressed both the famous and the masses. He wasn't just about clothes. Cardin also stuck his brand on a wide range of products, everything from bath towels to fragrances. His career lasted more than 3/4 of a century. Pierre Cardin was 98 years old. And more than 4.6 million people in 16 countries have received the COVID-19 vaccine. That's according to data collected by Bloomberg. 2 doses are required weeks apart. The US has administered the most doses, more than 2.1 million. But Dr. Anthony Fauci tells CNN the US is lagging with its vaccine rate and that officials had hoped to have more people vaccinated by the end of December. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks, Ritika. Let's stick with that vaccine news. The UK is likely to approve the AstraZeneca and University of Oxford COVID-19 vaccine today. A large part of the world now relying on it. Joining me next to discuss is Drew Armstrong, Bloomberg's senior editor for healthcare. First, let's just touch on what Fauci said. Drew, what's he talking about? Where's the disappointment here in the vaccine distribution?
So I think there is a sense when you look around the numbers in the U.S., the CDC shows that about 20% of the vaccines distributed have been administered. Now, we know that there is some significant lag in that data and that number is higher. But when you talk about getting 20 million doses out by the end of the year and only seeing 2 million of those actually reaching into arms, even if that number is double what the CDC is reporting, it's a little bit of a disappointment in terms of how fast this is proceeding out on the front lines.
So there's the AstraZeneca possibility of that getting approved in the UK, I'm sure, as a precursor to other countries. Does that change the narrative because it's easier to distribute?
Yeah, it certainly may help, but I don't think distribution right now is what appears to be the problem. I think it looks like the real problem that we're looking at is actually, again, shots going into arms. It's one thing to get these things shipped around the country. It's quite another thing to say, hey, everybody line up in this auditorium, and you're supposed to be here at your appointment time for that. That is what appears to be proving to be a little bit of a tricky part.
All right, Drew, thanks a lot. Really appreciate that. Drew Armstrong, Bloomberg's senior editor for healthcare, joining us there. Still with me, Christopher J. Wolf of First Republic Private Wealth Management. Christopher, as Fauci said this, as we get into the trading day, you're seeing tech down by 0.5%. The Dow and the S&P are now flat. I mean, what is the sensitivity to the markets to any vaccine headline?
I think it's actually still reasonably high, and it's reasonably high because some of the politics behind stimulus are still a little bit up in the air, $2,000 checks, for example. So I think that what we saw after Thanksgiving is a good example. After Thanksgiving, things weren't necessarily as bad, but they've started to worsen as December rolled on. So after the gatherings around Christmas, I think the expectation is that we're going to see another wave between here and the first part of January. That's going to coincide with the Jan 5 elections in Georgia. I think you have some moments where the market's likely to be highly sensitive to all sorts of news flow during that time period.
Fair enough. What's going to be the asset that's going to be most sensitive? I mean, we have fund managers super bearish now on the dollar, the most since 2011. We have rates near 1% on the 10-year. Where is it left to shake out?
Yeah, I think a lot of it's going to shake out in 2 places. The credit markets, first of all, because the idea that stimulus is going to get us through the first part of 2021, it really is only going to last until March at this point. We're kind of set up for another round of wait and see. And, what we've had in this go around is wait and see. It almost came too late. The stimulus almost came too late. So the credit markets, I think, are going to be very sensitive to rising or potential bankruptcy risks as the year develops, and they'll be sensitive to that stimulus piece. I think the second is outside the U.S., there's going to be sensitivity, particularly on the handling of COVID and any other stimulus that's coming in the European Union. So those are two areas that I would expect to have the greatest degree of sensitivity. And in Europe, it's mostly because the lockdowns have been so severe. So it's whether or not there's going to be any relief around those pressure points. Corollaries include small caps, include some of the value names, because those are all dependent on the arc of reopening bending in a more positive way.
And obviously all of that based on central bank support and fiscal support as well, as you pointed out. Where do we still have more room for both of that? And that can be, Japan, it can be China, it can be other emerging markets, it can be Europe, it can be the U.S.
I think really at this point, the over ownership is in tech. And I think we talked a little bit earlier, tech doesn't need to sell off. It just probably doesn't appreciate as much as we've seen in 2020, in 2021. Doesn't make it a bad investment. But I think that rotation into higher quality, cheaper companies that would be sensitive to economic recovery. Think pro-cyclical versus defensive. That's really, I think, the mode here. Unfortunately, it gets wrapped up in growth versus value. And I don't think it's just growth value. So pro-cyclical tends to be things like small caps, tend to be industrials, some of the consumer names. Interestingly enough, energy, even though there's a huge electric vehicle push, the real key here is the earnings acceleration driven by operating leverage. Quick statistic, small caps, for example, typically have earnings acceleration twice the rate of what you see in the large cap companies. So if things do improve, you'd expect some big pops in earnings in the small cap space, for example.
Many managers, when they're taking a look at what they like the best, they're always looking at Asia, particularly China, et cetera. Alibaba got a pop today after getting sold off pretty hard the last 2 days. What do you do with a country like China that now could have more regulatory interference when it comes to tech? There could be a PBOC dial back if we get sort of firmer growth next year as well.
Well, I think there's two things. The first is the long-held narrative of it's all about population and demographics, and therefore you should buy emerging markets, needs to be put on the side table and just not looked at for a while, because that's really not what's driving emerging markets. There are other factors here. The rise of China's growth, its dominance in terms of trading partners across Asia, and ultimately how it deals with its own debt burdens, and kind of the balance between dealing with those debt burdens and continuing to drive it, let's say 4, 5, or 6% GDP growth. That's really the key. For investors, our view is that you want to have a more selective approach than just kind of blanket buy emerging markets because of demographics. Like I said, I think that story's a little bit tired and needs to be put away. A more active approach is going to be sector and country based. There are consumer stories in parts of Southeast Asia. There's consumer stories in Japan, and even though it's not an emerging market, it's more Asia based. There are some consumer stories in Eastern Europe that are starting to revive, for example. There's industrial development in parts of Latin America. So it's much more of an active, almost sector, country, and name approach rather than a blanket.
Great distinction, Christopher. Really appreciate it. Christopher J. Wolf of First Republic Private Wealth Management. Thanks a lot for joining me today. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Does it really enhance transmissibility as has been suggested? Does it really prevent antibodies from binding? These are still questions that scientists are hopefully going to answer in the coming weeks.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. For the first time in almost 2 years, a Boeing 737 MAX will make a commercial flight in the U.S. American Airlines will be flying the plane from Miami to New York today. The 737 MAX was grounded in March of 2019 after 2 crashes killed 346 people. It cost Boeing tens of billions of dollars in lost sales, fines, and damages. Wonder Woman 1984 came through for HBO+. The new streaming service set a single-day record for downloads of its mobile app following the release of the superhero sequel. There were 244,000 downloads on Sunday. Meanwhile, the Disney Plus streaming service had about 2.3 million global installation of its mobile app over the Christmas holiday. And big changes may be in store for Jack Ma's Ant Group. Ant is under siege from Chinese regulators. Bloomberg has learned that the company may fold its financial operations into a holding company that could be regulated more like a bank. Ant would likely be subject to more capital restrictions that could keep it from lending more. And that is your Business Flash. Alex?
All right, thanks so much, Ritika. Let's dig a little deeper here on that Ant issue. The problem is, on a company level, China's online loan market is totally booming. So it hit about $673 billion in 2019, and it could outpace the U.S. as well as Japan this year. It's seen a big 130% jump since 2013, and accounted for, as you can see there, almost 3% of all the loans in China last year. So the deeper ripple effect of this is where the problem really lies. So these guys basically transfer their credit risk to their funding partners. So Ant Group has about 2,000 partners, followed by JD Digits with 600. Now, Ant kept just 2% of these loans on its books and 4% over at JD, which is why regulators are asking them to increase their credit exposure. And there's 2 stories ahead with this. One is that, hey, look, it's going to be clearer. It's a more predictable business model. There'll be more certainty with the company. Everything's going to be okay. Goldman did it. It's going to be fine. The other is that they fundamentally have to rethink how they're doing their business. And even if they siphon off everything into a holding company, it's not going to have the same kind of growth and profitability that it has right now. And that has to wind up re-rating. So really interesting thing playing out there. A lot of private equity guys involved in Ant. So watch that going forward. All right, still ahead, you got virus, vaccine, plus fiscal aid, all of that shaping the trajectory of the U.S. economy in 2021. We'll break that down with Gary Schlossberg, Wells Fargo Investment Institute global strategist. That's coming up next. This is Bloomberg.
Do you mind?
32 and a half.
The biggest hurdle we've had to face is the fact that we just can't see our customers. Traditionally, we would be away 4, 5, maybe more times per year on what we call trunk shows, where we visit cities all over the world to see our customers. That's not been able to happen this year, so we were thinking of ways that we could still make that happen. For example, in Seoul, we'd be there generally 4 times a year. With the robot, on site. If somebody's got a particular occasion they need to, rather than wait for us for our next trunk show, we can set that up so we can see them immediately almost.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Live from New York, I'm Alex Steele, and this is Bloomberg Markets. Well, the COVID pandemic has driven a wedge in the economy, pointing towards what many are calling a K-shaped recovery, where those on top continue higher, while the worst off face even more pressure. Abigail Doolittle is looking into the virus's impact on the economy. Abigail?
Alex, it really is quite a dichotomy here between the haves and the have-nots relative to that K. Starting off, unfortunately, with the have-nots. If we take a look at the employment picture, it is still pretty grim, but well off the peak unemployment. Going into the Bloomberg terminal here, these are the number of unemployed going back decades, and then here in early 2020, spiking to more than 20 million. The most of them, though, in white, these were temporary unemployed. Now we're down sharply, but discouraging is the fact that in blue, permanently unemployed, higher, 3.7 million currently, to temporary at about 2.7 million. So that's definitely a trend that's not very encouraging. And for all those folks who have lost income, we're hearing so much about evictions happening now. Fortunately, here in New York, they have been extended, the moratorium, until January 31st. But we really have a dichotomy here for those who are making less money, very little money, less than $25,000. Almost 2 million people to be evicted, and then between 25,000 and 50,000, another 2 million. But even above 100,000, Alex, there's the expectation that 300,000 people will be evicted. Who knew? And not surprisingly, it does come down to education. Folks who have a little bit of high school are the most vulnerable. Folks who have a little bit of college also vulnerable. And then those folks who have a bachelor's degree or higher are 68% employed today. So education has a big part of this for sure. And then finally, Alex, if we take a look here at the haves, the real look at the haves, and a piece of it, of course, was the education, the 68% of folks who are employed, the net worth for those who are doing well right now up 17.6% year over year through the pandemic, and far more than what we've seen in recent years. So it really is this year of the haves and have-nots, or that K-shaped recovery that you were talking about.
Abigail, I really appreciate it. Thank you very much. Let's dig in deeper to the U.S. economy. Goldman Sachs upgrading its U.S. GDP growth forecast following that fiscal deal. A new report, it says that we now forecast Q1 2021 growth of 5% plus. Now, the new path applies meaningfully higher levels of output in all 4 quarters and lifts 2021 annual growth to 5.8%. Joining me now, Gary Schlossberg, Wells Fargo Investment Institute global strategist. Before we get into some of the details, what's your projection for 2021? Would you agree with Goldman?
We think growth is going to be a little bit slower, probably in the order of about 4%. A lot of it, I think, really depends on the extent to which the economy, the growth recovery, can really gather momentum during the latter part of the year as that vaccine is assimilated into the economy. People are vaccinated. The lockdowns ease a bit. People increase spending. But we're a little more guarded on the outlook over the course of the year, beginning with a very difficult first quarter. We look for growth, but growth at a very modest rate.
And usually what most of the bulls would point to is that high household savings rate, that you have a lot of money in the bank. Therefore, when things open, you're going to rush out and spend it. People also make the same kind of call like Morgan Stanley about companies as well. Why do we think that is that actually going to happen?
Well, I think to some extent it will, and it really doesn't end there. The saving rate is high. It is elevated at the moment. We think that as confidence improves, as people get back to some type of normality, that saving rate will fall a bit more noticeably. That is dry powder for consumer spending. On top of that, earned income, you referred earlier to the haves and have-nots. Those with jobs continue to see an increase in earned income, which should provide good support to spending as well. And one big difference from the recession 10 years ago and its aftermath, household net worth, wealth, continues to rise. And unlike the collapse that we saw over a decade ago, and that should serve consumer spending well. On top of that, low mortgage rates, driving housing, and even business investment, building out those tech platforms to support increased online shopping should be supported by investment. So broad-based strength, but again, picking up from a modest rate in the first half of the year and then revving up a bit during the latter part.
So what kind of stimulus bill really needs to come out of D.C.?
Well, the stimulus bill that we've seen, the $900 billion, really is more a pandemic relief, fiscal support than fiscal stimulus. It really is directed at those have-nots. The one area, the $600 rebate check or direct income payment, is not really tailored only toward those have-nots. People that with jobs will be getting them as well. To some extent, that could provide some stimulus. Although here again, given the uncertainties in the first half of the year with the lockdown, rising infection rates into early 2021, we expect to see more of that income going toward that fiscal support, going towards saving rather than spending. Much like businesses, they've built up their balances with some of the borrowing that we've seen, very aggressive borrowing over the course of the past year.
So is your base expectation for any kind of stimulus in 2021 when Biden takes office or not?
Well, we could see some added fiscal stimulus from the government. Really, truly, the big stimulus will come from the vaccine and the effect that it has on the lockdowns, consumer spending, consumer confidence. Whether or not we see that added fiscal stimulus, a round two, either immediately after the new president takes office or later in 2021, a lot of that has to do with the January 5th runoff elections, of course. If the Democrats can gain control of the Senate, even with a razor-thin majority, then certainly the chances of more stimulus go up. Keep in mind, however, that with a Democratic majority in both houses of Congress, there's also an increased chance of higher taxes sometime later in the year, which could act as something of an offset. Fortunately, when the economy is truly gaining momentum, hopefully.
It seems like the other canary in the coal mine is the vaccine rollout. Dr. Fauci talking to CNN today specifically about that we're just not where we want it to be. And I guess my question is, what happens if things are just slower? It just takes longer to get the vaccine in people's arms. The fiscal multiplier isn't as big as maybe we expected.
Well, assimilation into the economy is certainly a big issue. Not only the logistics, getting the vaccine out, vaccinating people, and we are running behind there, as you pointed out, the willingness to be vaccinated, the efficacy of the vaccine, presumably it will continue to be at 95%, but we're dealing with a much larger sample, if you will, of the population. We're still counting on things gathering momentum, the vaccinations gathering momentum during the first half of the year. I can't speak to the ability to get back on target. Certainly, if we continue to run behind in those vaccines, then we'll probably see the economy's growth recovery really gathering momentum a bit later in the second half of the year, and that means that full-year growth will be a bit more modest.
All right. Well, it's really good to catch up with you, Gary Schlachberg of Wells Fargo Investment Institute. Thank you very much. We did want to sort of bring you an update. Oops, as I just dropped something on the floor. Sorry about that. Of a live shot of American Airlines returning to service with the MAX 737. It is on the runway, ready to take off. This is the first flight since those two deadly crashes prompted the longest aircraft grounding in the nation's history. It's going to go to Miami, to New York, LaGuardia, and then back again. American's president will be on both of those flights as sort of reassurance that they're safe, etc. The U.S. regulators lifted the flying ban last month after major revisions. We will continue to watch the plane as it takes off. This is Bloomberg.
is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We certainly are not at the numbers that we wanted to be at the end of December. You heard talking about 40 million doses for 20 million people. I mean, even if you undercount, 2 million is an undercount. How much undercount could it be? So we are below where we want to be.
That was Dr. Anthony Fauci, the U.S. government's top infectious disease doctor, sounding the alarm over lagging vaccination levels in the U.S. He also went on to express some concern over a possible virus surge in January. All of that comes as the news of a new strain of the virus continues to take hold in the U.K. and spread. For more on how to move forward, I'm joined by Andy Pekos, Johns Hopkins School of Public Health professor. Professor, it's truly a pleasure to talk to you. What fixes the problem that Dr. Fauci highlighted?
Well, you know, this really is, it sounds cliche, but this is an unprecedented vaccine rollout. So I think we should expect to see some speed bumps along the road. What we hope we're not going to run into is roadblocks. The rollout has been a little bit slower. There's some lagging in terms of reporting the number of vaccines a place gets versus how many administered vaccine doses there are. I have a feeling that we're working through some of the speed bumps right now, and I get a sense that we are picking up speed. So I imagine that these first couple of weeks are going to be a little bit bumpy, but we will go forward and really hit a stride come the beginning of January.
Is any of that due to people at the top? Like, I know that President-elect Biden is going to be speaking later on today about the vaccine lags, et cetera. Like, does this all get solved January 20th, or is this sort of just a hiccup because there's a lot to do?
I think it's just a hiccup. I think we also have to remember that the vaccine rollout is happening during the holiday season, and, you know, places aren't as staffed as highly as they should be. We're trying to take care of COVID-19 patients as well as administer vaccine in many places. My hospital here is a great example of that. So right now there's a lot of stresses on the system, and, you know, we have to make sure to keep the patients as the primary goal and taking care of the sick patients first. And these other things are going to start hitting their stride once we get past the holiday season.
What's the importance of the UK approving the AstraZeneca vaccine? What kind of difference might that make worldwide?
Yeah, so that gives us a third major vaccine. I think the critical thing with the AstraZeneca vaccine is it's much more stable at 4 degrees or refrigerating conditions, as well as at room temperature. So what that really does is it expands the capability of where we can vaccinate people. This goes into low resource settings. It breaks that freezer chain that the Moderna and the Pfizer vaccine have to have. So it really does allow us to speed up vaccinations and go to areas where we were really struggling to get to with the Pfizer and the Moderna vaccines because of that freezer requirement.
Well, speaking of more distribution, Russia's vaccine is going to Argentina today and should start vaccinations, despite the fact that a lot of Russians don't want to be vaccinated by it. How do we know which ones are okay?
Well, you know, fortunately here in the U.S., we have the FDA and its approval process, which is very open. It's very transparent, and we can see all of the data that the FDA is making their decisions upon. I must say that I haven't seen much of the Sputnik data come through. Presumably those countries have some level of comfort with the data that they're seeing. But at least here in the USA, and this goes true also for most of Europe, you will see the data on any vaccine that gets the emergency use approval. And so everybody will have the peace of mind to be able to see how those decisions were made.
Okay, well, fair point on that. What do you make of the new strain? I talked to the Novavax CEO yesterday, and many officials say, look, presumably these vaccines work against many different strains. It should be fine against this one that currently is spreading.
Yeah, it's a very interesting development. Couple things about this new strain. It spread very quickly throughout regions of England, so that's one warning sign. It also had a large number of mutations, much, much larger than other strains that are currently circulating. So those are two sort of warning signs that pop up to virologists like myself that say, well, I wonder if there's something that's changed about this strain. I've seen some data already. It looks like the vaccine antibody responses will cross-react to this virus. So I think that's one concern that that is going to be alleviated soon. I think why the virus is spreading is something that still is under consideration. We're seeing it appear in a couple of other countries. It'll be very interesting to see if the virus spreads there as quickly as it did in England. And there are many laboratories, mine included, that are trying to study this variant to see if it's actually behaving differently than other SARS-CoV-2 strains that are circulating right now. So I would say that there's some concern. We want to be cautious about it, but I would not say that it's that people should be overly concerned about this variant yet.
So I guess I'm also curious as to what the different mutations are, like why it spreads so quickly. And I know you're in the middle of studying it as well. And also how much of it is that when you have shutdowns, people just aren't abiding by the rules anymore because they're tired of it.
Yeah, every time you see spread of a virus, there are lots of things that could be driving that, and a few super spreader events and poor public health interventions could also lead to this virus spreading in the way it did too. The mutations are interesting because 3 of them occur in the spike protein, and that's the protein that the virus uses to attach to cells. It's also the main target of the vaccine. The mutations might change the ability of this virus to attach to cells, and that might change how the virus transmits, how easily people get infected, all of those things. So that's why those mutations are particularly of interest. But there's a whole host of other mutations in areas that we don't know if they're just mutations that have occurred randomly or if they really are mutations that are changing the way the virus functions. So the ones that we know and have identified and are clearly associated with the S protein are known. It's the other ones that are a little bit unknown that we need to study in the laboratory as soon as possible.
I mean, everyone's still wearing masks and washing their hands and using hand sanitizer. Yep. Like, what else can be done then if it can spread faster? Effective use of all of those things. I think that's the critical thing. These mutations aren't going to make the virus able to get through a mask, or they won't make the virus resistant to soap and water. We just have to be really good about implementing those public health interventions widely and making sure that we have as few possible holes in our public health intervention that the virus can get through. So it's really about the effectiveness and the implementation of those things. All right, Andy, thanks a lot. I think you just made my mom feel better. Andy Pekush, a Johns Hopkins School of Public Health professor. Thank you very much. And we should note that Johns Hopkins Bloomberg School of Public Health is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. All right, we do want to give you a check-in on some news outside the world of business. Here's Ritika Gupta with your first word news. Ritika?
Thank you, Alex. The House is now daring the Senate to follow in its footsteps on stimulus payments to most Americans. Democrats and some Republicans approved a measure that would replace the $600 payments in the new virus relief bill with $2,000 checks. It's a proposal that's backed by President Trump. Many Senate Republicans previously opposed payments larger than $600. Joe Biden is accusing Trump loyalists at national security agencies of obstructing the transition. The president-elect warned that U.S. adversaries could take advantage of the situation. He cited political appointees at the Pentagon and the Budget Office. The Defense Department says it has been working with Biden's team with the utmost professionalism. And federal officials are trying to piece together the clues to determine a motive for the Nashville Christmas Day bombing. Officials say suspected bomber Anthony Warner took steps that suggest he knew he wouldn't survive the blast, like giving away his home and his car. And a former neighbor tells AP that Warner said Nashville and the world are never going to forget me just days before the blast. Warner was the only one who died in the blast. 3 others were injured and dozens of buildings were damaged. The post-Brexit trade deal is essentially a sideshow for the City of London. EU officials must rule separately that British financial regulations and oversight are strong enough to create a level playing field. Without that, there could be a steady leakage of business for the UK's finance industry. Big banks have already started to shift people and assets to the continent. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks, Ritika. Also happening right now, we're paying attention to Vice President-elect Kamala Harris is about to be administered a COVID-19 vaccine at the United Medical Center in D.C. We don't know if it's a Moderna or Pfizer vaccine yet, but we'll bring you those pictures as they happen. All right, still ahead, you got gold climbing after the U.S. House passes a bill to boost household checks to $2,000. That's coming up next in today's Futures in Focus. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
If they're not, then it is fines, another fines, repeated fines, behavioral commitments. But there is the option eventually to ask for a divestiture, splitting up a company as the last resort.
All right, time now for Futures in Focus, and we're looking at gold up a little bit on relation to the $2,000 stimulus bill that passed the House yesterday. The Senate's going to have to confront that maybe later on today, so up to $18.83 an ounce. Joining me now, Bloomberg's Eddie Vanderwalt joining us. Hey, Eddie, you have a pretty good eye when it comes to gold. You can come at it with some skepticism here. What's the actual upside if we continue to get a weaker dollar, if we continue to get lower real yields?
Yeah, I think those are all the big talking points, Alex. But you know what? You hit the real nail on the head last time when we spoke. You talked about the upward trending 200-day moving average. And we're seeing, we saw that play a real role in boosting gold prices. And we bounced back a little bit. But I think the technicals for gold, the momentum for gold, it's sagged a little bit. Gold doesn't feel as uppish as it did in the first half of 2020. You know, all of that excitement is sort of drained out of the gold market.
Doesn't feel as uppish. That may be the quote of the day for me, Eddie. Does it move with what is its relationship with Bitcoin? I feel like a year ago, if we would have spoken, some might say that they're both safe havens, they're going to move together, etc. What's the deal with it now?
Yeah, so look, it's tempting to say that gold's up in 2020, Bitcoin's up in 2020. There must be some sort of relationship. If we look at the two assets, we've really seen very different drivers. And Bitcoin's rally came in the latter half of the year. Gold's rally came in the early half of the year. I think really they are being driven by different sets of investors, but there are things that they have in common. I think, you know, Bitcoin and gold are both partially driven by the fear that unconventional monetary policy have gone too far And they've also been driven by, just the excess liquidity sloshing around in the system. But Bitcoin star is in the ascendant, gold is fading.
So that means that you don't need to have investors sell out of gold to buy Bitcoin. They can be two investor classes, or someone can own both for the same reasons?
Right. I don't think these are necessarily competing assets. They have very little in common. They, in terms of their correlations with other assets, in terms of what they do in a portfolio setting, Bitcoin still a very risk-on asset, and it plays a lot more like venture capital might in your portfolio, whereas gold still holds its inflation-busting properties and haven demand.
Before I let you go, Eddie, what's your top metal pick for 2021? Where do you think the most flow is going to go to?
Oh, I feel like copper is so hot at the moment, but you know what? It just feels like that copper trade doesn't feel like it's tired. It just feels like that copper trade's got legs.
It does. That's what most everyone says, particularly if you take a look at, say, the shift into green energy. You use a lot of copper and all that new equipment. All right, Eddie, it's really good to catch up. Super appreciate it. Happy New Year, Eddie Vanderwald, joining us from Bloomberg. All right, coming up, you got Torsten Slok, Apollo Global Management Chief Economist, will be joining me next as we're kind of fading any kind of rally that we saw in the markets. You had a record for the Dow, the S&P, and the NASDAQ yesterday, so we're kind of flat at this moment. Apple hitting a record day high earlier in the session, right out of the gate, and now also just ticking higher by 0.2%. What we are familiar with, though, is a weaker dollar and higher yield. $0 at one point today hitting the highest level so far of this year. The question becomes, how much more juice is the trade of buy equities, sell dollar, and sell rates? We'll try and break that down globally as well. This is Bloomberg.
Chinese brands now account for 7 of the country's top 10 cosmetics lines, up from just 3 in 2017. That has pushed out foreign brands like L'Oreal's Maybelline, which has seen its share of China's makeup market plunge by half since 2010. For more, we're joined by Bloomberg editor Bruce Einhorn. Bruce, why the drop?
Chinese brands are becoming much more adept at reaching Chinese consumers, especially now at a time when more consumers are reluctant to go shopping outside. People are spending more time at home. People are spending more time on social media. Chinese brands are very good at using social media, using live streaming, using other things in order to market. Chinese brands also tend to be less expensive. And so at a time when the economy is struggling a bit, there's a lot of uncertainty, people are more budget conscious, Chinese brands have a bit more of an advantage.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Live from New York, I'm Alex Steele. I'm counting down to the European close on Bloomberg Markets. Here is everything you need to know from Europe at this hour. Brexit deal, the good and the bad.
Either the European Parliament will vote at the end of February or in the second week of March. This is still to be decided, and talks are ongoing with the Commission and the Member States, but also with the British side.
Europe pushes out the timetable to approve a deal while UK stocks fly higher. And EU and China inch closer. The two near an agreement on investment 7 years in the making and could be a stepping stone to a trade deal. And waiting for the next vaccine. The UK should approve the AstraZeneca treatment soon as the market seems to fade the vaccine news with each shot. All right, let's check in on the markets. This is an important day. It's the first time where UK assets have a real ability to react to that Brexit deal that was reached on Christmas Eve. And the result is that equities are flying higher. Most every sector, particularly like materials, industrials, those are really exposed to trade. So FTSE 100 up by almost a full 2 percentage points. Yesterday, what was really interesting is you had the cable rate was lower. It took a big dip lower, and everyone was kind of scratching their heads. Well, why? We have a Brexit deal. Why is the cable rate lower? We're reversing those losses on sterling today. You have euro sterling now pretty much flat, despite the fact that the euro is getting a nice pop against the dollar, hitting its highest level since in all of this year. And the trade is going to be definitely them buy gilts. You have yields moving lower by about 4 basis points in the 10-year over in the UK. So it's definitely a risk-on trade for the Brexit deal. The question becomes, can it last? And what individual sectors could still be a lot of question marks surrounding it? We'll break that down over the next hour. Well, speaking of the vaccine, the UK is also poised to approve the COVID-19 vaccine developed by AstraZeneca and the University of Oxford, giving the country yet another powerful tool to fight the pandemic. I want to get some more insight here on how the markets are dealing with that. Torsten Slok, chief economist at Apollo Global Management, which has $316 billion in assets under management, joins me now. Torsten, it's really good to see you. What do you think the market sensitivity is now? We're at the third vaccine shot to this kind of approval and vaccine distribution.
I think an important development in the last week or so has been the two key risks, namely Brexit has now become much clearer, and the fiscal stimulus has now also become at least significantly clearer than what it was just a few weeks ago. And with those two things away, we're still spending a bit of time on those issues, but with those two things, at least definitely less of a risk, the focus is indeed on the vaccine rollout. And as you just mentioned a few minutes ago, I mean, so far over the last 2 weeks since we started doing vaccinations, only 2 million people have been vaccinated in the US. So you can quickly figure out that at that rate is going to take a lot longer than the market is expecting at the moment. So the focus will be on what is the acceleration we're seeing in January in terms of the number of people that are getting vaccinated. Will it be faster than what it's been so far? And therefore, also ultimately, will we see the economy come back faster than what everyone at the moment has been expecting now for quite some time?
So, Torsten, does that mean that the catalyst is actually to the downside now when it comes to vaccine news?
Well, at least it's been a little bit surprising that we have seen this slow speed of progress in the number of people that are being vaccinated. I mean, 2 million in the U.S. over the last 2 weeks since this has been going on is not particularly impressive. So with that backdrop, it is the case that we need to monitor very carefully the speed with which vaccinations are rolling out. I mean, that being said, the upside risk for consumers are, of course, very strong. The economics here is clearly that income is getting better, including with the fiscal stimulus. The wealth levels, both from home prices and also from what's going on in the stock market, are very high. And on top of that, the pent-up demand in the economy, both from savings in checking accounts, also savings when it comes to household savings over the last 8-9 months, also very significant. So the outlook is very promising. So there are good reasons to upgrade forecast. But at the moment, as you started out asking about, it is really critical that the vaccine rollout is going very quickly and should come very soon to meet the expectations from the market here.
So if we do get the vaccine rollout, do we see higher yields? And where do we see them? I'm just trying to get a read on what's yet priced in markets and how much more juice is there left.
Yeah, this is a really important discussion. I mean, the traditional way of answering that question is to say, well, higher yields come when we see higher inflation. And the Fed is very clearly saying that we will not see higher inflation in 2021. If I look at my Bloomberg screen and type ECFC go, I also see that consensus expectations for 2021 in fourth quarter are that core PCE will only be 1.7. So that clearly points that the consensus does not expect higher inflation in 2021. The Fed does not expect higher inflation in 2021. That doesn't mean that long rates cannot go up. Long rates can go up for other reasons. It could go up partly because of more treasury issuance. It could go up because of the dollar going down. It could also go up, generally speaking, because the sentiment is that we're normalizing in markets and therefore rates have to normalize to the levels of rates that we had at the beginning of this year. But it's very important in this debate to discuss why is it that we would expect long rates to go up, because inflation clearly is not the Fed's expectation or the consensus expectation. So there must be some of these other reasons that should be the reason why long rates should be moving higher in 2021.
So does that mean that any sort of movement on that end won't be synchronous, that it'll be idiosyncratic more to the U.S. side versus like, hey, we're vaccinating, it's a global recovery, we're going to get back to pre-2020 GDP, all yields go higher?
Yeah, so that's a really important debate also, because that fits in also with the first topic we spoke about, namely the rollout of vaccinations and also the spike that we're seeing in the number of cases at the moment. And at the moment, it's very clear that those countries that have the virus most under control, which of course is China and the neighboring countries where we have seen more of a normalization than elsewhere, those regions that first get things under control should be expected to also see rates go up more and normalize more. So in that case, the pecking order here, if you will, is that China has normalized first. The US is now probably the second part of the global economy that will normalize. And then we have Europe and ultimately emerging markets also coming along. So with that sort of delay in the sequencing, you should also expect to see rates go up first in the US. But we have this little tricky issue in the US that they will probably not go up because of inflation. The consensus also, again, from my Bloomberg screen, expects that 10-year rates by the end of this year will be 125. Meaning the end of 2021 will be 125. That's not much higher than where we are today. And that's probably, again, because of the outlook for inflation being so dampened. So the answer to your question is that there is a clear list of where we will see recovery first. And that should probably also be driving differences between how quickly rates go up around the world.
Does that mean then the better the recovery equals the better the fiscal multiplier equals we can see central banks and governments in those corresponding countries kind of tap the brakes a little bit?
I think that's exactly right. So I don't think that we will see any central banks around the world tighten monetary conditions, even in China and in Asia, and definitely not in the US and Europe. And this is also what the Fed is very clearly saying by clearly stating that they expect rates will stay low and they will not hike before 2023. That being said, we should not forget that we started out this year with 10-year rates at 190. And with that backdrop, we should also then start to think about, okay, so even if we have some normalization, we should expect to see 10-year rates go up. But I do think that the dampener here will be, again, the lack of inflation and also the very clear message from the Fed that they do not see any reasons to hike rates before we get to 2023. So we need a spectacular recovery, which still seems unlikely. When you think about how many jobs have been more permanently disrupted, if you calculate, for example, in the restaurant industry, we've seen 17% of restaurants close in the US. That's about 110,000 businesses that have closed. Those businesses are not going to come back very quickly. You can't really quickly open up and turn on the lights when you have had all these issues with shutting down your business. So that's why a lot of the jobs that we still need to create, we need to create about 10 million jobs before we get back to the level of employment we had in February. And those jobs will not come back that quickly because a lot of the jobs that we have lost are probably now going to be gone at least through 2021 and therefore for longer periods. So the long answer to that good question is that I still think we're going to see dovish central banks throughout 2021. And for investors, that means hunt for yield, thematic investing in ESG and impact funds, in themes that still benefit from the broad hunt for yield and broad sort of resilience, even in an environment where growth is going to come back relatively slowly compared to what we would like to see.
Ending on Europe here, and then we're going to get to Brexit in the next segment, because presumably you have the European Recovery Fund, that headwind removed, like that's going to go forward. You have the budget. Brexit deal is now done. There could be a potential deal with China on investment. In theory, you're going to get a Biden and a Europe working together on issues rather than fighting over tariffs. Why aren't we like gangbusters into Europe right now? Like, why are we still negative, 57 basis points on 10-year over in Germany and Italy at 55 basis points?
I think there's a number of reasons for that. I mean, the first reason is, unfortunately, that we're also seeing a spike in the number of cases in Europe. The second reason is that the rollout of the vaccine is probably also going to be slower in Europe for a number of different reasons. And that also means that, again, that it will be lacking the U.S. recovery. And the third and final and probably most important reason is that the U.S. has shown a significant willingness to do fiscal expansion. Europe has also shown that in a somewhat different way with job retention schemes, but Europe just hasn't really been able to do the same type of fiscal expansion for a number of different reasons that we have seen in the U.S. And that also means, therefore, that overall, the European outlook is, unfortunately, therefore going to be somewhat weaker relative to what we all would have hoped for. So therefore, the backdrop is that if you're looking at where is the recovery going to be faster at the moment, the short answer is, well, China will probably come first, then we'll have the US, and Europe will unfortunately be number 3 in that ranking. And that means that we probably have to therefore get used to rates in Europe staying lower for longer and potentially even longer than what we have in the US.
All right, good stuff. Torsten, missed talking to you. Torsten Slok of Apollo Global Management. We're going to get his thoughts on the Brexit trade rally coming up next. Is a deal really done? What does it mean for markets? This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Investors poured into UK markets on the first full trading day since a Brexit deal ended years of uncertainty weighing over the nation's economic future. Analysts over at Jefferies actually raised their view on UK stock market to bullish, quoting that we estimate that UK flows relative to developed markets can increase by 5.6% to catch up with DM equity flows since the Brexit referendum in 2016. Torsten Slok of Apollo Global Management still with me. It's a pretty aggressive number. I mean, but we did see institutional investors really flee back in 2016. What do you think of that?
Yeah, I mean, it's a huge relief for markets that Brexit is now looking like it's more in the rear mirror here. There's still some finer details, of course, to work out, and there certainly could still be a few bumps on the road, but it's very clear that the markets have spent so much time on this topic for so long time that it is not a surprise that there is a relief today in markets. I mean, more broadly speaking, the connection between the UK and Europe and the way that the European Union works has, of course, involved, as we have found out in the last few weeks, a lot of different aspects that are very difficult to disentangle very quickly. So therefore, the short answer to that good question is that I think that a lot of people who've been very worried about Brexit for many years are now looking with fresh eyes at the UK situation. And with that backdrop, it makes sense to have the view that this is at least no longer a thing that we need to spend as much time on as we've done for the last 4 years.
So, I mean, in theory, you have technology, you have staples, right? You have the home builders, for example, doing really well. Today, though, the banks seem to be underperforming, pretty much flat on a really up market. And so I'm wondering, what areas of the market do we still not have clarity that isn't priced in yet?
Well, a lot of that will be driven by what happens to sterling. So if the expectation now is that sterling is going to go up, then meaning that there will be the relief that after sterling be under pressure for now many years, and with people saying, well, if the UK is going to go through this, then they might have lower growth. If we're now going to see sterling move higher, then that could, of course, also have some implications on different sectors, of course, those that are most export-oriented. But broadly speaking, I mean, the prospects for UK growth are now better than they've been for quite some time, simply because this uncertainty has been removed. Now businesses can begin to plan with a longer horizon, and therefore, with that backdrop, you would also expect, therefore, that the growth rate of the UK begins to look better than it's done for the last few years.
So where does this leave the BOE then?
Yeah, so this is, of course, the difficult thing for the BOE, because a lot of Brexit has 100% been a political decision, and a lot of their policy-making choices at the BOE have and would normally be driven by what's happened to inflation and unemployment. But at the moment, the Bank of England, of course, have also, and on top of that, with the virus, been stuck in a situation where it's been difficult to do much and say really much other than talk to the weakness of the economy. But I think that the Bank of England is also leaning back here and watching very carefully how the economy responds and how businesses respond, and even what the anecdotes are around the Brexit deal here. How are businesses going to react? Are they going to do a lot of capex spending? Are they going to do a lot of hiring, which you would ultimately expect? Well, that would certainly help a lot in terms of the Bank of England thinking around what the future path of the British recovery looks like here.
So when we did the pecking order before in the last segment of, you had China and then probably the U.S. and Europe and then more of developing markets, where does the UK fit into that now that you have this Brexit deal, potential catalyst or headwind removed, either way you look at it?
I would say that they would probably fit in between between Europe and the US. So the UK would be in the middle because they have, again, the exchange rate and the sterling freedom, if you will, that can give them a boost potentially. But that being said, a lot of the uncertainties here will have to be eliminated, and we need to see how companies respond to the Brexit deal. But broadly speaking, it is clear that this is something that will be helping, but they're still also hit by the virus. Unfortunately, UK also has this issue of the new strains that are appearing in the south, and all that, of course, also feeds into the very near-term outlook. So the answer to your question is that they're probably close to Europe, and are probably not going to see the same speed of the recovery that we're seeing here in the U.S.
All right, Torsten, really good to catch up. Happy holidays to you, Torsten Slok of Apollo Global Management. Thank you very much. Well, coming up next, the EU and China are very close to a major investment deal. We're going to talk with Reinhard Bütikofer. He's the chair of the European Parliament's China delegation. That's coming up next. This is Bloomberg.
Substantial further progress means what it says. We'll be looking for an inflation to be substantially closer to our 2% longer run goal before we start making adjustments to our purchases.
That's a long time to be very accommodative, but that's basically the horizon.
They can buy more bonds and they can buy longer maturity bonds, and that would put more downward pressure on long-term interest rates. If we can really get vaccines going in April, May, June, July, and August, by the time we get to the end of the summer, I think we can get to that goal that I'm talking about getting the overwhelming majority of the population vaccinated.
Live from New York, I'm Alex Steele. This is the European close on Bloomberg Markets. The EU and China are close to a deal that would open up the Chinese market further to European investors. A Chinese official saying talks are in the final stage. Joining us now is Reinhard Bütikofer. He is the chair of the European Parliament's China delegation. Reinhard, it's great to talk to you about this. You seem skeptical. You don't seem thrilled about the deal. Why?
Well, there are a couple of reasons, both on the substantive side and on the procedural side. For once, I cannot understand why there is this end-of-year rush, this end-of-year frenzy to conclude the deal without affording enough time to sort out all the concerns. Yesterday, the ambassadors of the EU member states met to discuss the deal, and the Italian ambassador complained that his capital had not seen the final text. That was just cast aside. The Polish ambassador said, look, maybe we should afford some time to have consultations with the incoming administration in D.C. That was also cast aside. The French and the Dutch said, maybe we should look more deeply into issues around forced labor and human rights. That was also cast aside. And this is really stunning, I must say. And then, of course, there are substantive issues, most notably on labor protections. China is famous for not having ratified 4 core ILO conventions, notably on forced labor. And the European Parliament, just before Christmas, voted a resolution with a huge majority demanding that guarantees on forced labor should be included in the deal, which is not. So I am indeed skeptical. And I must say that no deal that the EU concludes is a deal until the European Parliament says deal, because the European Commission needs the consent of the Parliament, and that's not just a formality.
So the story in the market is that this is going to be a precursor to free trade deal. Phew. Should it be, and will it be?
Well, that's been a claim from the Chinese side for many years, that they wanted to strike a free trade deal, and the European Union always pushed back, saying until we have concluded the investment agreement, we don't even talk about that. I would assume that this will now be presented as the next stage. However, if I look at the change in public perception of China, if I see how the positioning of the majority of the European Parliament has developed, I would be highly skeptical whether there is going to be an easy ride towards an FTA. I don't see that yet.
So to that point, who might not approve it? Which countries?
Well, you see, if this is, as I suspect, a EU-only deal, which means that it just pertains to union competency, then you need a majority in the Council and a majority in the Parliament. If it is a deal that also includes issues that pertain to member states' competency, then you would also need ratification by each and every member state parliament. That's what I do not expect to happen. But it's not a given, as I said before, it's not a given that the European Parliament would give its consent. And we will make a very, very tough scrutiny of the whole deal.
Where does this also leave the U.S., particularly when you're going to have a different administration that's going to be dealing with China and Europe?
Well, some people around Europe say, what's the big issue? President Trump signed his own bilateral deal without consulting with the Europeans, so why can't we do just the same? I would argue against that. I would say, well, fortunately, we now have the opportunity of forging a stronger transatlantic cooperation on China, and we have already started doing that with the Trump administration. We will certainly want to continue doing that with an incoming Biden administration. So why should we rush at this moment? I haven't seen a good reason for that.
What country stands to benefit most from this? I mean, is this a Germany thing because of the trade relationship that Germany is so embedded in when it comes to China?
Well, on average, European countries export about 3% of their overall exports to China. The rate for Germany is between 2 and 3 times that number. So clearly, Germany has a higher vested interest into investment relations and trade relations with China than any other European country. And certainly a few big German companies, particularly in the automotive sector, have invested a lot into China. They have put a whole lot of their eggs into the Chinese basket. And of course, they hope to be benefiting a lot from this deal.
Reinhard, thank you very much. I'm really good to catch up with you on this. I appreciate it. Reinhard Budefoker, chair of the European Parliament's China delegation, kind of throwing a little bit of cold water on if that'll even pass EU Parliament. All right, as we head to the close here in European markets, here's where we sit. It's a pretty solid rally in the FTSE 100. However, we are looking to close off the highs of its session. The DAX also looking to close a little bit softer. The CAC off its highs as well, as markets trade a little bit heavy after reopening in full force earlier on today. Also seeing a weaker dollar all across the board, so sterling getting a little bit of a relief rally here after yesterday's down move. We'll break down more in the close coming up next. This is Bloomberg. All right, markets just closing out over in Europe, and a headline crossing that the EU Parliament approves the post-Brexit deal that was came to agreement last Thursday on Christmas Eve. Now it has to go to all the individual countries. So, steps in the process are continuing. The UK should approve the deal this week as well. So that leads us to the market close, because this was the first time we really got a true reaction to the Brexit deal when it comes to UK assets. They were closed when the deal happened, and they were closed yesterday as well. So let's take a look at it. FTSE 100 closing off the highs, but still up by about 1.6%. Not a huge reaction to that EU Parliament news, but it's the small caps that did really well, up by almost 2 full percentage points. What ended flat, though, is really financials, not really getting that much of a boost either way. Financial services left out of this deal. That still needs to be negotiated upon. All of that part of the problem. The other part is what's happening in the bond market over in the UK. If you can just switch up the board for me, you can see money moving into the gilt market on the 10-year, so that means yields lower by about 4 basis points. That's never going to help a bank when you have lower yields and the yield curve doesn't really go anywhere. I did want to point out what's happening in the currency market. So euro sterling is now actually down by about 0.1%. Yesterday, you had sterling fall after the Brexit deal, and that was many were scratching their heads saying, well, why is that? That now reversed today. The euro obviously also getting a very strong boost from the weaker dollar, so it's even more significant that sterling is able to make some headway here. Two other idiosyncratic things I wanted to point out in the currency market. One is the Swedish krona. You're seeing that continue to move higher on part of this dollar weakness, but it's also the best performing G10 currency overall this entire year. And speaking of, the lira is actually on its strongest winning streak as well, outperforming all other EM currencies. Part of that also the weaker dollar story. Part of that also maybe a more aggressive central bank going to raise some rates, so providing a little bit of strength there for the lira. But want to dig pretty deep now into the individual sectors and stocks that are moving on the Brexit deal over in the UK. Emma Chandra has a look for that, as well as all of European markets. Hey, Emma.
Hey, Alex, thanks very much. And as you said, we've seen the UK stocks outpacing their European counterparts today. But take a look at the performance of those majors over the past week. And we're actually seeing that the FTSE 100 really playing catch up over the course of a week. It's still a gain of about 2.4%, but the gains for the Stock 600, for the DAX, for the CAC, all higher over the past week. So what we're seeing is the FTSE 100 perhaps catching up with those big moves we saw in the European bourses since the weekend. Nevertheless, today's move still significant given the underperformance of UK stocks. Remember, the FTSE 100 down some 12% this year. And if we take a look at a chart, we can show you it's been one of the big global laggards over the course of the year. We're looking here, those two bottom lines, the blue and the white one, that's the FTSE 100 and the FTSE 250. So US stocks really cheap. And what we're hearing from strategists is that the end, can we call it the end yet, of the Brexit saga, the end of the Brexit saga could be that trigger for people to take a closer look at the FTSE 100, and that is certainly what has happened today. A lot of stocks, a lot of sectors in the green. I've got Kingfisher here, one of the biggest movers on the FTSE 100 today, gaining some 4.4%. This, a big UK home improvement company. And when you get into the FTSE 250, we're also seeing the landlords, the likes of Derwent London and Great Portland Estates, also putting in gains of around 2 to 3%. Also, I wanted to mention Tesco, the biggest supermarket chain here in the UK, also putting in a gain today, along with the likes of Morrison's and Sainsbury's. They would have been really concerned if there'd been no trade deal, given how much food crosses the border. Also, I mentioned here Nobia. Now, this is a Swedish stock. It is a kitchen maker, and one of its biggest customers is the UK. Now, a small pop today, but a much bigger one yesterday when it traded for the first time since that Christmas Eve trade deal in Sweden yesterday. Now, some stocks are in the red. Let's switch up the board and take a look at some of the biggest losers on the FTSE 100. I'm talking about the UK banks, Lloyds, NatWest, Barclays, all with quite significant losses today, down 3-4%. Now, the trade deal, good for them, but not good in the sense that it didn't address financial services, and there are nerves remaining about what kind of accord will come between the UK and Europe eventually on financial services. And finally, a quick look at the car industry. Now, the car industry in the UK really owned by foreign companies. Looking at a few of those there is some concern that this Brexit deal, too late for those, as many of those companies had already talked about moving operations out of the UK. Alex.
All right, Emma, thanks so much. Really appreciate that. I want to dig a little deeper now into the auto sector. As Emma mentioning, Brexit deal may be too little too late. So joining me now is Craig Trudell to break it down from Bloomberg. He's a European auto reporter. Hey, Craig, is it too little too late for some of the international auto players that are based or had been based in the UK?
Yeah, you definitely have the case with Honda. They have a plant in England in Swindon that's closing next year. So they've pulled out already. You have Nissan, a company that has the biggest plant in all of the UK, that made some news recently by it's sort of coming out that they had decided against building an electric vehicle here, that they're just going to build in Japan instead. That's the second time in the last couple of years that there's been a sort of negative decision made, with regards to a production decision for their plant in this country, and there's real concern that, this is a plant that is massive, is one of Nissan's largest globally, but Nissan was really, worried about the fact that Brexit was potentially going to sort of render that massive factory, not competitive and sap from its business case. Again, it's definitely a sigh of relief that we have a deal, but it's definitely a last-minute one, and really sort of gave the industry a scare, and they had to sort of make some decisions in the meantime.
And the big issue, of course, is the rule of origin. So a certain amount of components in each car have to be made in the UK. They did seem to give a lifeline, though, to electric vehicles, giving them another 6 years to bring that amount of foreign content below that 45% threshold. So you would think that might be a win. I say that tentatively because it seems like that necessarily isn't going to stop any automakers from leaving.
Yeah, I think with that, it's definitely a win and a big, it's something that they really had to do. It was not really a sort of choice in the matter, unless you wanted to basically penalize electric vehicles for, having so much of the supply chain base in Asia still. So, do you want to sort of disincentivize people from buying cleaner cars? I think, both the UK and EU negotiators didn't want to see that happen. The industry didn't either. But the question is really how quickly can they localize that supply chain? And you mentioned the 45% content rule. That will ratchet up over the course of 6 or 7 years. And so, it's a question of, whether the industry is able to, sort of hit that timeline. We think it probably is the case that it will, because you're talking about local content being both the UK and the EU, and there's a lot of battery production going into into Europe in the next few years.
Really good point. All right, Bloomberg's European auto reporter. Thanks very much, Craig Trudell. So let's stay with Brexit, the auto sector, and the supply chain issue. Joining me now, Shane Brennan, Cold Chain Federation CEO. Cold Chain Federation represents temperature-controlled supply chain businesses in the UK with over 500 warehouses and 30,000 vehicles. Shane, it's good to talk to you. What we saw before we got a deal, preparing for the end of the year, is a lot of stockpiling. We saw, anecdotally, a lot of barges, ports being crowded, border crossings with tons of trucks miles long. Is that the future, or did we avoid that?
I think the jury's still out. We'll see over the coming weeks and months how bad the disruption is going to be. It won't be as bad as it was last week when we had the French government closing the border because of the COVID disruption. It will move, but it will probably move a lot slower. The paperwork involved in moving food between the UK and the European continent will be very, very different from the 1st of January, and then it will start to impact on coming back in the other way as well. So we've got a lot to work through, but supply chain professionals get problems solved. That's what they do. So we're going to focus on doing that.
And of course, you're referring to the incident in Kent, near Dover. You had police clashing with some of the truckers. They've been waiting and trying to get home for Christmas, and they couldn't because of COVID tests, etc. How do we avoid that, though, in some capacity when it comes to the Brexit deal?
Well, collaboration is how you deal with that. And the great thing is we have a deal. So a deal means the governments have now got an interest of working together. We're not in a political row about the friction on trade. So we now have a common interest to resolve those issues. So now it's all about the businesses being ready with the paperwork they need, and the officials on the border being able to deal with those queries and concerns and help to get them moving. And as long as we keep things moving, we'll learn how to do it, and we'll make it work.
What do you think it looks like then, now versus like 6 months ago? Like logistically, like I'm a trucker and I'm driving up, then what happens?
So, well, today, if I'm serving going into France from the UK, it's the same as going to anywhere else in the United Kingdom. It's the same country. From the 1st of January, it is a foreign export, so it's like going to somewhere else in the world. So that creates a significant amount of new bureaucracy and paperwork. It will be more complicated. It will be slower. It will be more expensive. But I think it's a lesson that we're going to have to learn how we go now between now and the next few months in order to make sure that the food supply chain does continue. It will. It'll just take some time to learn how to do these things in a new way.
Do you have a sense, Shane, of who, are companies and custom border agents staffed to deal with this?
Not nowhere near enough. I think because of the uncertainties, because we didn't know what sort of deal we were going to have until a few days ago, and the deal starts in a couple of weeks, that lack of implementation period means we haven't had time to skill up, whether it's in the businesses or within government. And I think that is our biggest risk area in the coming weeks and months, is not having enough people with the knowledge and the skills to be able to process this massive increase in border exporting and importing that wasn't there today and will be there in a week's time.
How long do you think something like that takes to get fixed?
It's going to take years. It's going to take years for it to bed down and become the normal way of working. We're going to have to learn as we go, and it will be rocky. There'll be ups and downs. There'll be fluctuations. There will be times when it works well. There'll be times when it doesn't work so well. We're going to have to live with that and make it work on the fly now. It's a shame we don't have an implementation period, but we don't. Yeah. And supply chain professionals now kick in and solve the problems. So
I wonder then what the repercussions. So as you're figuring all this out, do you anticipate some shortages of certain items, of certain things? Do you anticipate higher prices as we're kind of having to deal with that? What do you think?
I think a bit of both of those things. I think there will be some supply chain interruption. There are certain products that we rely on bringing into the UK at this time of year. We don't have them here in the UK. They need to come in from other parts of Europe. So there may be some outages of that. But also prices. It is going to be more complicated. There's going to be a lot more paperwork involved, and a lot more friction in the trade, and that means that there will be cost inflation. Who bears that cost, of course, is a big question. Whether it will ultimately be the consumer, there'll be a lot of people in the industry trying to avoid that being the case, but ultimately there will be more cost, and we'll have to absorb that.
Yeah, and I want to let you go, Shane, also without talking about the vaccine, as the UK is set over the next couple of days to approve the AstraZeneca vaccine. How's everything going there in terms of transportation? I mean, your cold storage, like, you're the guy who's going to be transporting the Moderna, the Pfizer vaccines. You need very cold temperatures to do that.
I mean, it's going well. So far, it's going well. You know, we've had a lot of people vaccinated already, about 500,000 people already since it started, the Pfizer vaccine, and we're seeing hopefully the AstraZeneca vaccine coming on stream hopefully this week. So we're going to see that ramp up massively over the coming weeks and months. And the cold chain is really in the spotlight. You know, something we do. We've been doing it for many years. We know what we're doing. We've got to do it on an unprecedented scale, but we'll deliver that. It's no problem for this is sort of problem we relish.
Okay, good. So that we can take care of. Shane, I appreciate that. Shane Brennan, thank you for joining me, Cold Chain Federation CEO. This is Bloomberg.
Let's check in on the Bloomberg First Word News now. I'm Rishika Gupta. The House is now daring the Senate to follow in its footsteps on stimulus payments to most Americans. Democrats and some Republicans approved a measure that would replace the $600 payments in the new virus relief bill with $2,000 checks. It's a proposal that's backed by President Trump. Many Senate Republicans, though, previously opposed payments larger than $600. More than 4.6 million people in 16 countries have received the COVID-19 vaccine. That's according to data collected by Bloomberg. 2 doses are required weeks apart. The U.S. has administered the most doses, more than 2.1 million. But Dr. Anthony Fauci tells CNN that the U.S. is lagging with its vaccine rate and that officials had hoped to have more people vaccinated by the end of December. And French fashion designer Pierre Cardin has died. Cardin was a visionary who dressed both the famous and the masses. He wasn't just about clothes. Cardin also stuck his brand on a wide range of products, everything from bath towels to fragrances. His career lasted more than 3/4 of a century. Pierre Cardin was 98 years old. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. All right, let's get to a corporate story here. Taking a look at Ant. So Bloomberg broke news that Ant is planning to fold its financial corporations into a holding company, and it could be regulated more like a bank. Also, Dow Jones just saying right now that Beijing could actually take a larger stake in Jack Ma's businesses. It's been raising a lot of questions as to how much the government oversight of Ant is about Jack Ma versus Ant itself. Well, joining me now, Bloomberg's Sonali Basak, Bloomberg Wall Street correspondent, joins me. Okay, let's pretend it's a holding company.
Right.
Is that so bad?
So it depends on how you look at it. On one hand, you have a business that's fast growing, and this puts some reins on that business. Now, regulation was going to come anyways. The fact that it's coming in the backdrop with all of these other political pressures and personalities, I think, is what's really scaring people here. One of our Bloomberg Opinion columnists made the point that, was it so bad when Goldman Sachs became a bank holding company? You're still able to grow. The question is how fast. The Financial Times had done a great analysis that said, it's a difference between 40 times price to earnings ratio versus 10. So again, if you look at it that way, perspective, it could be a very big barrier into how much it is worth in the near term.
So I'm curious as to then where this leaves the private equity. There are some really big names involved in this company that didn't get to cash out at all with any IPO. And then if they have to re-rate for growing at 10 times versus 40 times, what are they thinking about that right now?
So it is a fear, right? But it was always a fear. Remember, when they got in a couple of years ago, it was worth $150 billion. That is way more than any U.S. financial technology giant. So it was already a very big valuation. You fast forward to now, we thought that they would exit with a 40 to 60% return. That's not going to happen. However, with that said, it doesn't mean that they won't get a return at some point, and they still, on paper, are invested in one of the most valuable financial services company in the world that trumps the size of Morgan Stanley and Goldman Sachs and Citigroup.
Okay, fair. Will it change the way that they look at future investments in China, particularly if there is one that's based around a personality?
So here's the thing. I do want to take the long view on this, because if you're an investor in Chinese technology, particularly Chinese financial technology, the long view is that this is a fast-growing sector with a lot of demographic trends that will be good in the long term. Their credit business can have a lot of room to grow, even with the hamstrings on it, right? So that's the view you have to take with these kinds of companies. There was always this risk. It's not like Alibaba and Tencent have not had their issues in the past. But again, it's not great as it's happening in conjunction with what was going to be the world's biggest IPO. Mm-hmm. Alex, another statistic here, though, for Chinese IPOs, it was still a record year. And that's even without Ant. So, but again...
Perspective.
Yes, perspective.
Do you have a sense of how much role Jack Ma himself played into sort of wooing the private equity landscape?
A lot, right? I mean, when you're investing in these companies, you have to invest in the vision of the founder, right? That is the number one thing, because otherwise, what is stopping somebody else from getting into this space? Again, with Alipay, you have seen them waver in market share over the years. So Jack Ma really is the vision here, and his ability to oversee a sprawling empire. Remember, we've had financial services giants in the past in China, H&A, Anbang, that have gotten into very significant issues when it came to financial services. But there's trust in Jack Ma to diversify.
Really interesting. I can't wait to see how that plays out. It's been a really interesting few hours, a few days from that. All right, Bloomberg Shalai Basak, thank you very much. I really appreciate that. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Remember, this was not announced as a complete trade deal. This was announced as a phase one. So we and the Chinese both are well aware that there's much more to do.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Time now for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. For the first time in almost 2 years, a Boeing 737 MAX is making a commercial flight in the U.S. American Airlines is flying the plane from Miami to New York today. The 737 MAX was grounded in March of 2019 after 2 crashes killed 346 people. It cost Boeing tens of billions of dollars in lost sales, fines, and damages. One measure of U.S. housing prices rose in October by the most since 2014. The S&P CoreLogic Case-Shiller Index was up almost 8% from the previous month. The index measures prices in 20 large U.S. cities. Phoenix, Seattle, and San Diego led the way. It's the same story as it's been for months. Low mortgage rates and increased buyer appetite for more space are driving up prices. And shares of Snap are higher today. Goldman Sachs raised its price target from $47 to a street-high view of $70. Goldman cited a more optimistic view for revenue growth at the parent of Snapchat. The firm says ad checks suggest that Snap will outperform its initial guidance for the fourth quarter. And that is your latest Business Flash, Alex.
All right, thanks so much. Well, let's go to politics here. House Democrats and some Republicans are approving a measure that would replace the $600 payment in the new virus relief bill with $2,000 checks. Now, Senate Majority Leader Mitch McConnell is set to speak on the Senate floor in just minutes. Joining us now is Bloomberg's Laura Davison. Laura, he's in a tough spot. What's McConnell going to do?
Well, he will go out and do his normal, start of the Senate speech. He so far has been very mum on how he feels about these $2,000 checks. So anything he says today will sort of give an indication of what way he's going. Democrats, on the other hand, have been very outspoken about what they believe should be done. Senator Chuck Schumer, who's the top Democrat in the Senate, he wants to present sort of this fast-track vote to approve these $2,000 checks. The House passed it yesterday with mostly Democratic, but some Republican support. Schumer's hoping he can do that in the Senate as well, though it looks unlikely the way that the procedures work. Just one Republican could stand up and block this.
How does McConnell deal with a President Trump who's very angry at him for not backing him up in terms of overturning election results, to his base, to not looking like the guy who's not giving people money? Like, what's a procedure? Because how can he get out of this procedurally?
he can sort of deflect the blame a little bit. If another senator, another Republican stands up and blocks it who, doesn't have quite the same political stance that McConnell does, he can sort of deflect that. He can blame it on the clock, saying, hey, there's not enough time before the end of the year to get this done. But there's really kind of this interesting power struggle sort of forming between Trump, who's an outgoing president, and Mitch McConnell, who's fighting to keep his Senate Majority Leader spot. We saw both senators who are running for re-election, runoff election next week in Georgia, Kelly Loeffler and David Perdue, came out and said, yes, they do want those $2,000 checks, basically breaking with McConnell to go with Trump, which is interesting because, if they were to win their re-elections, they would be, working with McConnell and relying on McConnell, Trump, who will be no longer in office. So this creates a really interesting divide among Republicans.
Yeah, that's such a good point, because I wonder then if they do get elected, can we actually see a $2,000 stimulus check for people being passed if they're saying that they're for it now?
It's really tricky, and the politics of this will change, really just in the next week, depending where Republicans are and if they win. It's unclear that this has the support to get through the Senate. You have Republicans who are saying that, that this is too much, and it's not clear that there are, 10 or so of them to join with Democrats.
Well, fair enough. The GOP Senator Deb Fischer now says she is open to $2,000 checks. It's really going to be a really interesting hour or so watching what Ms. McConnell has to say. Bloomberg's Laura Davison, thank you very much. I truly appreciate that. All of those news headlines are not really affecting markets that much at all. You had a record high yesterday in the Dow, the S&P, and the NASDAQ, a big gap higher. And now we're just kind of taking a pause here with the yields not really going that much anywhere, with tech not really going that much anywhere. Although you are seeing Apple up by 0.2%, hitting another intraday record high today. And the dollar much weaker here. Euro dollar at the highest level since all of this year, I should say, actually. Happy Tuesday, everybody. This is Bloomberg.
Se logra una sonrisa de parte de cada persona que utiliza el dispositivo, ya que se pone en situación, entre comillas, de una persona discapacitada. Y ven que lo sorteamos de una forma agradable, porque el simple hecho de sentarse en un dispositivo ya es agradable.
Nace MAT como una solución de movilidad a personas con discapacidad, nace Mandados como una opción de generación de ingresos y nace MAT Tools como generación de ingresos y educación a las demás personas que no están en silla.
We explore the trends, investments, and competition of the European ETF industry.
Join us on Bloomberg ETF IQ Europe.
From the Bloomberg Bureau in Washington, D.C., to our TV and radio audiences worldwide, my name is Kevin Cirilli.
And from New York, I'm Taylor Riggs. Welcome to the world of balance of power, where the world of politics meets the world of business. And it is the world of balance of power, Kevin. Let's get right to the world of politics and economics now, and let's do that with Abigail Doolittle. Abigail, looks like sort of a mixed day. What do you make?
It is certainly mixed, and you could even say it's slightly jittery, even bearish at this point, because we opened with solid gains for the Dow, the S&P 500, and the Nasdaq, all-time highs there. But we have the Russell 2000 down for a third day in a row. Yesterday, retreating from a record high, so a bearish reversal, a bit of a concern on the close. And lo and behold, we have the Russell 2000 really underperforming today, Taylor, down 1.7%. So at this point, the S&P 500 and the Nasdaq have been fluctuating between very small gains and losses. So again, a jittery tone, and the fact that you do have the Russell 2000 down for 3 days. This is the first 3-day losing streak for small cap going back to October. It's also the worst 3-day slide going back to October. This, of course, this area has been on such a hot streak, not just out of the March lows, where it is more than a double, outpacing the Nasdaq 100, but this quarter alone adding more than 40%. So this just tells you some investors are getting a little bit nervous, taking profits no matter where they bought it, and maybe preparing for a cooler January, especially considering that this index is so overextended.
All right. Thanks, Abigail. And we are awaiting Senate Majority Leader Mitch McConnell, Taylor, in order to provide some type of update with regards to whether or not the Senate will take up that $2,000 stimulus check vote that passed with more than 2/3 of majority from the House of Representatives last evening here in Washington, D.C. Let's bring in Bloomberg's Anna Edgerton for more on the Senate, particularly on how Senate Majority Leader Mitch McConnell plans to navigate through this. What do we know, Anna?
So we are waiting to hear from Senate Majority Leader Mitch McConnell, like you said, and we haven't really heard from him yet on how he plans to handle this House bill that was passed last night that would increase the $600 indirect payments in the current bill, the bill that just became law, to the $2,000 that Trump has requested. So this is a big moment for McConnell. We'll see how he kind of navigates this difficult position that Trump has put him in.
In addition to that, we also haven't heard from Leader McConnell with regards to the defense authorization bill. Now, it's widely anticipated that there are enough votes to override President Trump's veto. What do we know about how McConnell's political orbit has been navigating what would become the first time that Congress has overridden President Trump's veto?
Yeah, this is something that Mitch McConnell and his fellow Senate Republicans just see as something they have to do. Consequences be damned. I mean, they see this National Defense Authorization Act as a must-pass bill. You know, it increases hazard pay for troops. It has more than $700 billion in defense spending that needs to be authorized, or it won't happen in fiscal year 2021. So this is the kind of thing where they say, thank you, Mr. President, for making this symbolic stand. We're going to go ahead and override your veto. However, it is a very important moment because this is the first veto override that the Republican-led Senate has authorized. So, definitely another point of tension between Trump and congressional Republicans.
It's so incredibly delicate, the items left on the to-do list for Congress right now, in addition to, of course, first and foremost, this delicate balance vote between Republicans who are concerned about the $27 trillion national debt and increasingly more moderate centrist Republicans who are on board with the $2,000 stimulus checks. In addition to the defense authorization, you also have January 6th in terms of the certification deadline for the Electoral College votes, also now boiling over within the far right of the Republican Party. How has Leader McConnell forecasted he will deal with that, Anna?
Yeah, he's actually asked his Senate Republicans not to join House Republicans in this kind of pointless quest from the president to try to overturn the results of the election. And the reason why is because it puts Senate Republicans in a really difficult position. They either have to go against the Constitution or go against the president. So, it's really a no-win situation that Trump has
put them in, and the fact that President Trump continues to kind of create these situations almost as if it were retribution for Mitch McConnell accepting the results of the election. It doesn't really bode well for Republican unity going forward, and also for the Georgia runoff races that will happen on January 5th.
You know, it really is incredibly fascinating to watch just how Senate Majority Leader Mitch McConnell, what could be really the biggest unknown for his political future in the next week or so, Taylor, with regards to the Georgia runoff, as Anna just mentioned. And Taylor, I got to be honest here, Leader McConnell is known in Washington, as Anna knows, as keeping all of his political cards close to vest. No one knows whether or not there is going to be a vote for these $2,000 stimulus checks, Taylor.
Yeah, you know, Kevin, I think that's a great point. Let me just do one final question here to Anna, and we do know that we'll bring you back when we do hear from Mitch McConnell. In the meantime, though, Anna, what is the relationship right now between the president and the Senate?
It's been better. Right now, it's not great because President Trump is still stewing over all of the Senate Republicans who have recognized Joe Biden as the winner of November's election. And we saw the president had two tweets this morning criticizing Senate Republicans and saying that, you know, they have weak, quote unquote, leaders, that they need to be stronger, or we need to elect leaders who are more strong. And of course, by strong, he means loyal to him. So, you know, this is not a good place for an outgoing president to be, especially one who still has considerable sway over Republican voters. You know, he could create considerable headaches for Republican elected officials, even when he's no longer in office.
Thank you, as always, Bloomberg's Anna Edgerton. And make sure to stay with us because we do want to keep you when we hear from Mitch McConnell. In the meantime, I want to turn to the virus. Dr. Anthony Fauci, the U.S. government's top infectious disease doctor, sounding the alarm over vaccination levels here in the U.S.
We certainly are not at the numbers that we wanted to be at the end of December. You heard talking about 40 million doses for 20 million people. I mean, even if you undercount, 2 million is an undercount. How much undercount could it be? So we are below where we want to be.
Dr. Fauci also expressing concern over a possible virus surge in January. For more on the path forward, I want to bring in Bloomberg medical science and tech reporter Michelle Cortez. Michelle, are we undercounting? Are we not where we need to be?
Well, we are undercounting. There's no doubt about it. We've seen that across all of the different types of products that have rolled out for coronavirus. We don't have a really great number of tests. We don't have a great number of masks and PPE. Even things like the number of cases. You see the COVID tracking project is being done by, a constellation of journalists. We see what's happening at Johns Hopkins. Bloomberg has a great tracker when it comes to vaccinations, but the bottom line is you have to get that from the health officials who are on the ground.
I actually want to interrupt here because we now have Senate Majority Leader Mitch McConnell at the podium reviewing his remarks, and we definitely want to hear from him. Let's listen in on Leader McConnell.
We'll call the roll. Mr. Alexander.
Waiting some remarks. Sorry, Kevin.
No, it's okay. I just to make sure he is behind his podium, and we're carefully monitoring this to await whether or not he will announce if there will be a $2,000 stimulus checks. Though, Michelle Cortez, go ahead.
So all I was saying was that we are undercounting, but as Dr. Fauci just said, when you're looking at hopefully having immunized 20 million people and you're only at 2 million, that is a heck of a shortfall, and just the undercounting is not going to be enough to account for all of it.
So is there any country, Michelle, that you think in Europe, for example, that has successfully executed the vaccination rollout compared to the United States, or is this something that countries around the world are having to deal with?
Well, it's absolutely something countries around the world are struggling with. But I tell you what we're hearing right now, early news out of Israel, they're saying that they have vaccinated 25% of their population over the age of 60. They've vaccinated about 5% of their population already across the board. Now, of course, Israel is a much, much smaller country than the United States and the continent of Europe, of course. But they definitely hit the ground running. They're thinking that
Michelle, we do want to cut you off again. My apologies. We are hearing from the Speaker, Mitch McConnell. Let's listen in.
For this chamber to follow suit. Soon this important legislation will be passed into law. President Trump has rightly noted that this year's defense bill does not contain every provision that we Republicans would have wanted. I'm confident our Democratic colleagues feel the same way. But that is the case every year. And yet for 59 consecutive years and counting, Washington has put our differences aside, found common ground, and passed the annual defense bill. Not once in 6 decades has a Congress let its differences prevent it from completing this work for our national security and our men and women who wear the uniform. This year's NDAA will continue our momentum in rebuilding and modernizing our armed forces. It will authorize the personnel, equipment, tools, and training we need to reinforce the national defense strategy and to deter great power rivals like China and Russia. It will cement our advantage on the seas, on land, in the air, in cyberspace, and in space. And the bill will help us continue to recruit, retain, and support the men and women who keep us safe. It provides a pay raise for the troops, improvements for military housing, child care, and more. So, Madam President, for the brave men and women of the United States Armed Forces, failure is simply not an option. So when it's our turn in Congress to have their backs, failure is not an option either. I would urge my colleagues to support this legislation one more time when we vote tomorrow. Now, on another matter, on Sunday, President Trump signed into law another historic bipartisan rescue package. It will provide major support to American families through what we hope will be the home stretch of our fight with the coronavirus. Congressional Republicans, Congressional Democrats, and President Trump's senior team had all worked together to pass hundreds of billions more dollars in urgent assistance to the people who need it most. This new law will set up a targeted second round of paycheck protection to save jobs. It will renew and continue federal programs that have helped laid-off workers endure the crisis. It will send more cash to households. It will invest billions in vaccine distribution so the success of Operation Warp Speed kills the pandemic as fast as possible, and much more. This bipartisan compromise was our shot at getting help to working families on the urgent timeline that they need. Once again, I want to applaud President Trump for signing the bill and getting this much-needed assistance into the pipeline. During this process, the President highlighted 3 additional issues of national significance which he would like to see Congress tackle together. First, as he explained, the President would like further direct financial support for American households. Second is the growing willingness on both sides of the aisle to at least re-examine the special legal protections afforded to technology companies under Section 230 of the Communications Decency Act, including the ways it benefits some of the most prosperous, most powerful big tech firms. And the third subject, since every American, regardless of their politics, should feel the integrity of our democracy is beyond reproach, is exploring further ways to protect the sanctity of America's ballots while continuing to respect the federal government's limited role in standing behind state and local government who actually run elections. Those are the 3 important subjects the President has linked together. This week, the Senate will begin a process to bring these 3 priorities into focus. I move to proceed to calendar number 480S3985.
The clerk will report.
Motion to proceed to S3985, a bill to improve and reform policing practices, accountability, and transparency.
To Senate Majority Leader Mitch McConnell making remarks on the Senate floor. He is urging lawmakers to back overriding President Trump's defense authorization veto. This would be the first time that Congress has overridden a veto. It is a largely expected move on behalf of Senate Majority Leader Mitch McConnell. He says that that vote will happen tomorrow. He also said that this week, the issues pertaining to $2,000 stimulus checks to American households, as well as Section 230, the concerns that the president has raised will come into focus, Taylor. So unclear whether or not that means there will be a vote, but saying that that will come into focus this week, Taylor.
Yeah, I think you hit it right on the head. We were all waiting to see if there would be those $2,000 stimulus checks or if it remains as is at the $600. and not getting any further clarity on that, Kevin. So I'm with you. I think coming in focus is a way of not addressing the issue today, though we will continue to remain focused on it as the Senate is. So make sure to stay with us. We'll be following that as more news crosses. And coming up, how concerned should tech companies be about China's crackdown? Donald Strausheim of Evercore, he joins us next. This is Balance of Power on Bloomberg TV and radio.
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Does it really enhance transmissibility as has been suggested? Does it really prevent antibodies from binding? These are still questions that scientists are hopefully going to answer in the coming weeks.
This is Balance of Power on Bloomberg Television and Radio. I'm Kevin Cirilli in Washington.
And I'm Taylor Riggs in New York. And Kevin, within the markets, China tech companies all back in focus. This after Beijing signaled a major change in its posture towards Alibaba and its affiliate Alipay, investigating Alibaba for monopolistic practices. Joining us now, Donald Strausheim, head of China research at Evercore. Always great to have you. And I am curious if this is, again, the risks that we all knew that investors are now aware of the risk of investing in China.
Well, I think everybody should continue to be, not afraid, but alert to the possibility that things can happen in China that don't happen in the same way they do in the U.S. And this is a perfect example. Beijing is acting aggressively. They put out draft regulations about this on November 10. They gave 20 days of comment period. Those are over. Now we are all just waiting for new regulations that are going to come out sometime. We don't have a timeline, but they're going to come out and they will be important.
What does this mean? I'm thinking big picture. U.S.-China trade, U.S. big tech taking on China big tech. Has the more increased influence by the Communist Party in China in their tech sector changed the game at all with how the U.S. now thinks about them?
No, I don't really think so. For a long time, China has wanted to sort of have its own tech sector separate and apart from the U.S. I think that continues to be the case. It's not going to change with the handover on January 20, the transition. And China is now very much alert that the U.S. is trying to separate itself from the tech sector in China. So their focus, it's not so much about Alibaba right now. The focus is for China to build its own tech sector with its own capabilities, separate and apart from the U.S., as a matter of self-protection, not of anything else.
Beyond the United States, is the Communist Party of China aware that their actions might actually risk driving away not just American investment, but European investment as well?
Well, I think, sure. They're aware of that. They also are aware of the risks that China now faces with the U.S. trying to separate itself from the tech sector in China. And so if they can build their own tech sector to their own satisfaction and be competitive with the U.S., this is likely to attract new investment from around the world rather than to slow it down.
Do they feel that Europe is moving toward that direction, or that in recent months that there's been the start of a new trend for Europe, particularly France, for example, to take a more hardline approach along with the United States against the Communist Party?
I don't see it really as a lot harder stance against the party in China right now. What we know is that President Trump is pounding the table on stop the China rise, hold China accountable, and so forth. And Europe is now trying to have the best of both worlds, to maintain or build a new relationship with the U.S., which was largely broken during the last 4 years, and also to be able to sell into China and to source from China without irritating Washington. That's going to be a balancing act, has been, will continue to be.
We're trying to fold in the relationship between politics here and the financial world that we do so well on Bloomberg. And reading through your latest note, it really did catch my eye that you say that we're confident Beijing has no interest in nationalizing Alibaba or anyone else except for Ant. And that is the perceived risk when it comes to financial sector stability. What do you mean by that?
Well, not nationalizing Ant. Ant. Think of Baba and Ant separately. Baba is e-commerce, and Ant is financial sector. And Ant is now sort of in the crosshairs because it potentially could pose some financial sector risk in China. And we saw the run up to the potential an IPO. You saw that Beijing, among others, wants to avoid any kind of financial risk in or now and on into 2021. So they're very separate. There's no interest in nationalizing these companies. State-owned enterprises in China have their role, especially in old China, not in new China, and that won't change in the future.
All right. Our thanks to Donald Strassheim, head of China research at Evercore. And coming up next, we head on down to Georgia, where we'll continue to talk about the Georgia runoff elections. And remember, Bloomberg Television and Radio will have special coverage on Tuesday, January 5th, starting at 7 p.m. Eastern. This is Balance of Power on Bloomberg TV and Radio.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points. So continuing in this knee-jerk risk-off feel.
Back in the air, Boeing stock trading in the green today with the return of that 737 MAX to commercial service here in the U.S. Bloomberg's Emma Chandra has the full story. Emma, pretty exciting pictures, I have to say.
Yeah, pretty exciting pictures and pretty good for the stock too. We saw it hit a 4-week high at the highs of this session. Paired that a bit, but still solidly in the green. But it is all about that return of the 737 MAX to commercial flying in the US. American, the first of the airlines to return it to the skies. We know Southwest and United due to do that in the new year as well. And Boeing really seeing this as the keystone for repairing its image and its battered balance sheet. The stock still down around 50% since it was first grounded almost 2 years ago. Revenues, if you look at the third quarter of last year, about $3.6 billion compared to that with a more than $16 billion in revenues we were seeing for the company in the fourth quarter of 2018. And it really is something that we know airlines are sort of backing the plane as well. We've seen new orders, big orders from the likes of Ryanair earlier this month. They see it as a game changer because of its fuel efficiency and increased capacity. Of course, the really important thing, Taylor, of course, is whether or not customers are going to back the flight. And American saying it's got 600 of these flights booked next month, and they're saying that customers are booking them just like they're booking any other aircraft.
Good news so far. Thank you as always, Emma Chandra. And you have the news here. McConnell blocking Schumer's vote to quickly pass those $2,000 checks. McConnell blocking the move to quickly pass those checks. This is Bloomberg.
新型にはなんと2万点以上前身でついてます。なので2万点あることにより、その情報が取れない、平面がないんですね。なので全てをスキャンすることができるので。どちらにせよ自分のサイズを1回最初から、適正なものを発見してそれを買って、家に届いてきたらぴったり非常にハッピーというのがやっぱりしかるべき姿かなと思ってます。
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Balance of Power on Bloomberg Television and Radio. I'm Kevin Cirilli in Washington.
And I'm Taylor Riggs in New York. But the news is all about your D.C., Kevin. And we are getting it that Mitch McConnell, the Senate Majority Leader, has indeed blocked Schumer's move to quickly pass those $2,000 checks. That is the floor of the live view of the Senate that you're looking at. And again, Senate Republicans on Tuesday blocking that attempt by Democrats to increase those direct stimulus payments from $600 to $2,000. So again, we will have to stay on this news in the next few days, as we heard from McConnell, that it will indeed be a focus in the coming days. Let's get a view on what else is going on in the rest of the world. We do that with the First Word News with Karina Mitchell.
Okay, Taylor, thank you. President-elect Joe Biden will speak in Wilmington, Delaware later today to address the slow rollout of the coronavirus vaccine by the Trump administration, and he'll outline his plan to pick up the pace. More than 2 million doses of the vaccine have been administered in the U.S. so far. That's far fewer than the 20 million the Trump administration promised would be given by the end of the year. Meanwhile, President Trump is lashing out at Republican leaders as an effort to overturn his veto of the defense policy bill. As it moves to the Senate, the House overturned it with bipartisan majorities. Trump tweeted, quote, "Weak and tired Republican leadership will allow the bad defense bill to pass. If the Senate follows suit, it will be the first time one of Trump's vetoes has been overturned." McConnell saying he will address that with the Senate this week. And the UK and the European Union will sign the treaty formalizing the post-Brexit trade agreement tomorrow. After European Commission President Ursula von der Leyen signs a document, it will be flown to London for Prime Minister Boris Johnson's signature. British lawmakers will have just 1 day to debate the agreement. It needs to be implemented by the time the Brexit transition period ends on December 31st. And federal officials are trying to piece together the clues to determine a motive for the Nashville Christmas Day bombing. Officials say suspected bomber Anthony Warner took steps that suggest he knew he wouldn't survive the blast, like giving away his home and his car. And a former neighbor tells AP that Warner said, quote, "Nashville and the world are never going to forget me." Just days before that blast, Warner was the only one who died in the explosion. 3 others were injured and dozens of buildings were damaged. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Kevin.
Joining us now is Adam Posen, president of the Peterson Institute for International Economics. And Adam, thanks for joining us. I want to ask you about this breaking news in which Senate Majority Leader Mitch McConnell has now formally blocked Democrats' efforts in the Senate, to bring the $2,000 check stimulus to a vote. But it also comes at the same time that Senators David Perdue and Kelly Loeffler, the 2 Republicans up for re-election in Georgia in just a few days, have come out in support of it. This is a political maneuvering that has a lot of implications.
Absolutely, Kevin. And frankly, you're much better on some of those than I am. But I think in economic terms, what we have to focus on is we have unnecessary human suffering and a lot of uncertainty for poorer people or unemployed people because of the disruption in getting the $600 checks out the door. But the stimulus package that is going to get approved or has been approved is really one that includes some of the key aspects you need, which is extending unemployment insurance, extending it to gig workers, backing the moratoriums on evictions, giving some aid to school systems. What's missing is state and local government aid, which McConnell also blocked previously. In terms of the dynamic you talked about, it's hard to imagine. It's just like the people who've been writing commentary. Maybe if Trump had passed stimulus earlier, he would have won the election. People do seem to value a check in their hand, so it's hard to understand why McConnell is opposing it.
Adam, I want to get to some of that aid to state and local governments, but first, I want to get to something that we spoke to about Larry Summers and the actual size of those checks that you were referring to. And he said Democrats capitalizing on the rift between Senate Republicans and the president might be good politics for them, but it isn't good economics, saying that this sort of arbitrary number of 2,000 is not as targeted as it should be. Do you agree?
I disagree with Larry on this particular point, because if the choice was getting out the $600 or getting out the $2,000, and that was the choice, then obviously get the $600 out, because it's more important you get it out timely, and it's more important you get the whole package out. And probably Larry agrees with that. The idea that the 2,000 is going to be that big a difference versus 600, I mean, what you'll end up doing is a lot of people will put it in their savings accounts. So you won't get maximum stimulus, but a lot of people have a lot more than $600 need. So if it goes into their savings accounts, you tax it, you'll get it back later. I don't view this as a big deal versus making sure that the stimulus we've got passed. I wish it had been even faster. If you were designing this from the start, and this is where I agree with where I think Larry was going, if you designed this from the start, you would have wanted more emphasis on needs, on state and local government, on unemployed people, on evictions. You already have some of that, but have more of that, on loans to small business, not based on giving everybody a check.
There are baby boomers who are having to act as child care centers. There are parents who have been having to pay for tutors. Definitely that $2,000 can go a long way to the middle class as well as the lower middle class. And that should be something everyone agrees on. Let me ask you this in terms of where the United States, in terms of stimulus checks, compares to other European countries. For example, how has the United States stacked up against other countries in terms of providing stimulus check relief to its citizens?
The U.S. has put out there more than most European countries and most other rich democracies, Kevin, but the gap is smaller than the top line number, because in every other rich democracy, the welfare state's much more generous. You have health insurance, you have college paid for, you have various other provisions. So this is more what the U.S. calls discretionary spending every time Congress has to pass it. Even if you take that into account, though, the U.S. has spent more. Then there's a debate about whether it's done more good or not, because a lot of the European countries, France, Germany, some of the others, have tied their aid much more to keeping people in their current jobs and keeping current businesses afloat. In the U.S., as my colleague Jason Furman has written about, it's been more disengaged. It goes to unemployed people. It goes to people who may be leaving their jobs. And there's pluses and minuses to that. So, yeah, the U.S. has spent more, but it's partly catch up because we don't have a big enough safety net. And it's definitely we've spent differently. And only over the next year or two will we see what difference that makes.
When are we going to start to care about fiscal deficits?
Not for a while.
I mean, 2022, 5 years from now, 10 years from now?
I mean, to be cynical, as many people have pointed out, obviously the Senate Republicans are going to start caring about fiscal deficits the second they lost the election. So, that sort of caring, quote unquote. There are serious people who care about deficits, and we're going to be publishing new work on that from Peterson soon. The issue is you've got to worry a lot more about the quality of what you spend it on. And that's a harder discussion to have than simply tossing around numbers. But it matters a lot. When interest rates are this low, there are a lot of things that it's worth investing in, Taylor. But then there are things that are just handouts whether or not the interest rates are low. It's just like you get a home equity loan when rates are low. You can decide whether to spend it at McDonald's or decide whether to spend it on improving your house. And you got to make those choices. And I think that's where the debate should be.
I do love French fries. I should note that I think what you touched on is incredibly important, and it's really gotten lost in the conversation over the past couple of weeks, which is that the president, in coming out and backing $2,000 stimulus checks, also wanted a reduction in what he labeled as wasteful spending. And so it wasn't just a backing of increased and more spending. It was also reducing spending in other portions of the $900 billion bill. And candidly, that's gotten way lost in the conversation over the past couple of days, in part because there was no time. Final question for you, which is the Republicans who have come out in favor, like Senators Loeffler and Perdue, if they are reelected, and in favor of these $2,000 stimulus checks, as well as the moderates in the House yesterday, is that a signal to President-elect Joe Biden's team that they might be willing to get some more stimulus in President-elect Joe Biden's first 100 days of office?
I hope so. I hope at a minimum it's a signal that they can get agreement on a real budget. Actually passing more stimulus is not quite as important as thinking about the budget and getting it through without deadlock. My fear is, I don't know about those specific Senate candidates in Georgia, but my fear is a bunch of Republicans will change their mind suddenly when Biden's in the White House and say, no, we can't spend. There should be a moderate agreement, as we saw from the moderates in the House on both parties, to building out the stimulus in a prudent fashion.
All right, well, stay with us because we're going to head from U.S. domestic policy to geopolitics with the Peterson Institute president, Adam Posen, and we'll have much more with him after the break. This is Balance of Power on Bloomberg Television and Radio. This is Balance of Power on Bloomberg Television and Radio. I'm Kevin Cirilli in Washington.
And I'm Taylor Riggs in New York. And we are back with Adam Posen, president of the Peterson Institute for International Economics. Adam, we had a great conversation with you in the previous section about sort of the U.S. view of things. I'd love to go global with you. Thinking about the U.S.-China relationship, particularly in recent days, China appears to be cracking down on some of their big tech, highlighting monopolistic practices, some antitrust concerns. How do you think about further intervention from the government in China tech and then the relationship then with the U.S.?
It's a really good question, Taylor, and thanks for having me for this part of the discussion. I think the Chinese crackdown has to be interpreted in a way it wouldn't have been a few years ago, that it is the reassertion of the power of the party and the state over companies. Not that that was in doubt, but obviously cracking down on Ant right before the IPO was an incredibly powerful signal. Now, like a lot of other things the Chinese Communist Party leadership does, it has an economic logic to it, too. There is, just as we're seeing in the US and Europe and Japan, there is a real discussion about how you regulate and oversee these platform digital companies that may have monopolistic power, not just in terms of pricing, but in terms of diminishing innovation from others, diminishing competition, exploiting informational advantages, and frankly, financial stability issues for a company like Ant. So it's not entirely a power grab, but it does underline that you have to be very concerned about property rights in China, particularly for very large visible companies, just as it became the case for companies in Russia and just as became the case for companies in other countries with autocratic governments. And this, unfortunately, we got a little bit of a taste of that under the Trump administration as well, with them picking winners and losers in the corporate sector. So this is something generally bad.
Adam, when will we know whether or not the Communist Party of China has miscalculated whether or not this will deter foreign investment to China as a result of these actions?
It's a good question. I think it should deter some foreign investment, but you're always going to have people. There's two buckets, let's say. There's the speculative bucket, and then there's the direct investment corporate tie-up bucket. In the speculative bucket, unless the Trump administration regulations go through, people are going to want to diversify broadly into the China index, and they don't have much to fear. In terms of the deal-making bucket, though, this is a major issue. Now, you've got a bunch of financial services firms who say they're getting better access, as my colleagues at Peterson, Nick Lardy, and Tianlei Huang have argued. But, a bunch of people are going to have to pause. And this really has to make you worry about technology transfer. But again, what's important here is this is a domestic Chinese company that's getting slapped down. This wasn't oriented towards foreign investors, which in a sense makes it scarier.
Adam, we'd love to... Oh, I'm sorry, Kevin. We'd love to
I was just going to say good point.
We'd love to get your thoughts on big picture trade relations between the U.S. and China. One of the ways that we can do that is talk about currencies. This really was the first year, Adam, that I read at least two strategist notes, one being from Goldman Sachs, that there is a risk that the dollar may not be the reserve currency. They increasingly see it as maybe the yuan, not in 5 years, but this is more of a 20-year picture. Do you think that that's a risk further down the road?
I think so, but I would put it in a different way. As the economic historian Barry Eichengreen has pointed out, and many others, you don't have just one reserve currency, especially nowadays. You can see many currencies where countries are able to issue debt in their own currency, borrow money in their own currency. And so, for small economies, for poor economies, no. But the question is more about how much overuse the dollar has. The dollar is incredibly overweight in global financial markets, in official reserves, in cross-border lending, in trade invoicing, considering the U.S. doesn't do as much trade as other countries like China. And so the question is, are we going to see a downstep in that overweight on China, on the U.S. dollar? And I think, yes, for several months now, I've been arguing, I think for the first time in decades, that's realistic. But I think the beneficiary, frankly, is going to be the euro, not the yuan, because of what you all just raised, that this is not a safe place to put your money in and get your money out in China. And as long as that fear is there, I can't imagine people who are moving reserves or long-term cross-border loans or long-term trading contracts want to be in yuan. And so instead, I think there will be a step down, maybe a little bit of an increase in yuan, step down for the U.S. and a rise in the euro's share in a lot of these areas.
Let's stay in Europe for a second, because does the Biden administration strengthening ties with NATO, with Europe, European allies, how does that impact China, especially if the U.S. and Europe are coming at this from the same approach and the same geopolitical playbook?
I think you put your finger on it, Kevin. The problem is it's not as easy to get to that approach, even though the Biden administration has professed a desire, or the incoming Biden administration has professed a desire to do so. And the key thing, which I know your colleagues have been reporting on at Bloomberg, is this idea of an EU-China investment treaty. It was very clear that the Biden administration was particularly hoping to look towards the EU and Japan and Australia to join with them on rules about cross-border tech transfers and cross-border investment. Have something like CFIUS in the U.S., overview and get common standards, and that could put a unified front on China. But as reported today, you've got Chinese officials saying, we're going to have this bilateral treaty with the EU, and that's going to at least partially break through the U.S. attempts to encircle us. And you saw Jake Sullivan, the nominee for National Security Advisor in the Biden administration, actually tweet about this a week ago, saying, I hope EU thinks twice before they do this. And he had to tweet because the Biden administration types have said very clearly they're not going to meet directly with foreign officials until the inauguration, which is the right thing to do. But this was sufficiently big to the Biden team that the key national security official tweeted about it. And then the former head of NATO, the Norwegian general, whose name I forget, came out, Stoltenberg, said, listen, EU. I'm not saying the EU is wrong to do this, although I think on balance they probably are. But I mean, it's hard to trust the U.S. if every 4 years you completely turn around the foreign policy. But the long answer, sorry, Kevin, is to your main point, which is the best way to deal with China would be to get alignment from allies, but recognizing that doesn't get it done. You got to actually get the allies lined up, and that's not happening yet.
What is the biggest geopolitical risk that you see in the next year?
Taiwan and North Korea between the U.S. and China is, to me, the biggest. Also, the potential for climate change problems causing strife in Southeast Asia and South Asia that leads to national security problems. And then you've got questions of stability in some other key countries around the world, but I'd really concentrate on those. I mean, from what I know.
You know, let's stick with North Korea, because typically every time there's a transition in power in the United States, the North Koreans test missiles or try to provoke to test out the U.S. And if you look at the calendar, historically speaking, we're coming up to that time for the North Koreans. How might the U.S. and a Biden administration be forced to respond to North Korea in a Biden administration's first 100 days?
Like you say, there is a pattern, Kevin, of whoever's in charge in North Korea at a given time picking on the new American president and testing them, and also just saying, hey, pay attention to me. And even if we get a new leader in North Korea, you should expect that. My colleague at Peterson, Marcus Nolan, has written about this. There just isn't that much room for sanctions to directly affect North Korea because of the controls there. You have to try, but any resources they get go to the military elite and go to the party elite. So it's I think what the Biden administration has to do is basically line up with South Korea and Japan to try to say a message to North Korea. No, I'm not looking to exchange love letters with you. We are monitoring you. I don't think there's that much else they can do, but there may be people out there who have better ideas.
Thank you, as always, Adam Posen. The extended conversation there with us for a good 20 minutes. We're so grateful for your time, the president of the Peterson Institute for International Economics. And make sure to stay with us, because on the close today, I guess this is my humble brag, Kevin, Romaine and I are going to be speaking with David Kotok, Cumberland Advisors, 2 p.m., going to get all his thoughts on the markets coming off the record highs that we saw yesterday. This is Balance of Power on Bloomberg TV and radio.
If they're not, then it is fines, another fines, repeated fines, behavioral commitments. But there is the option eventually to ask for a divestiture, splitting up a company as the last resort.
This is Balance of Power on Bloomberg Television and Radio. I'm Kevin Cirilli in Washington, D.C.
And I'm Taylor Riggs in New York. And Kevin, we get to both share the news of the big news in D.C. that you're following, and then my love, of course, for the markets. And we are getting a report to talk about those markets from Intel. The shares are up almost 6%. This is a report coming from Reuters, but the hedge fund Third Point, led by their CEO, Dan Loeb, urging Intel to explore some deal options, other strategic alternatives. Remember, this is a company that provides chips for companies like Microsoft and Apple, both of whom have said that they're working on creating their own chips in-house to replace Intel. That wasn't good for the company. Competitors like AMD just been on a tear as Intel's been dealing with a lot of delays and some manufacturing problems with their chips. So this is good news for Intel shareholders if indeed hedge fund really pushing for some strategic alternatives here for the company.
Riggs, I feel like our worlds collided this hour with
Perfect
the news
storm.
in D.C., the perfect policy storm. And it's going to be fascinating to see how the developments of the last hour play in the runoff election in Georgia. I can't stress that enough, Taylor, in terms of Senators Perdue and Loeffler going to political battle in Georgia in just a few short days and coming out in favor of these $2,000 checks, despite the move of Leader McConnell to say we're not going to have that vote.
What's the key takeaway from this? Are we going to get a vote in a few days?
I think the key takeaway is that there was a lot of forecasting for the Biden administration that there are Republicans who are willing to have additional economic relief. They're willing to negotiate on that. I was struck by how many Republicans in the House actually came out in favor of that. Taylor, we're going to have to leave it there, but remember that coming up on Balance of Power will continue over on Bloomberg Radio, and I will continue these conversations pertaining to these $2,000 stimulus checks and about the Georgia runoff elections. For Taylor Riggs in New York, I'm Kevin Cirilli in Washington, D.C., and this is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
I'm Karina Mitchell. Let's get the first word news this afternoon. Senate Republicans went against President Trump's wishes today. They blocked an attempt by Democrats to increase direct stimulus payments in the COVID-19 relief bill from $600 to $2,000 after Trump demanded the change. The motion passed the House yesterday. Majority Leader Mitch McConnell says the Senate will address 3 of Trump's complaints this week, including amount of the stimulus payments and concerns about election fraud. Meanwhile, Vice President-elect Kamala Harris and her husband have received their first doses of the coronavirus vaccine. The shots from Moderna were administered at United Medical Center in Washington. Harris says she wants to encourage everyone to get vaccinated, saying, quote, "I trust the science." And congressional staffers can begin to get vaccinated against COVID-19 as well. According to a memo sent to lawmakers and staff, Congress has been given a limited number of vaccine doses. They'll be given first to critical staffers whose jobs involve in-person interactions. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
It is 1 p.m. in New York, 6 p.m. in London, 2 a.m. in Hong Kong. I'm Alex Steele. Welcome to Bloomberg Markets. Here's some of our top stories on the Bloomberg and from around the world that we are following. Stocks turn into the red after that move by Senate Republicans to block an attempt by Democrats to increase direct stimulus payments. We're going to talk to Michael Purvis in just a few moments on how you hedge the Georgia election risk. Plus, investors keeping their eye on for a global rollout of vaccines. I'll be speaking later with the CEO of the Russian Direct Investment Fund about their involvement with the Sputnik vaccine and the rise of telemedicine. We're going to hear from Dr. Renee Dua, the co-founder and chief medical officer of HEAL, about how the pandemic has now changed the way we deliver health care. Let's get a quick check-in here on the markets. Right around the lows of the session for the S&P. We did have a record yesterday of the Dow, the S&P, and the NASDAQ. We're now coming off that. NASDAQ, the underperformer, down by about 0.4%. Also, the weaker dollar, story of the day, euro dollar at the highest level that we've seen so far this year. The curve modestly steeper, but also giving up some of those gains. We did see a sell-off in the long end a touch, which yields up by about 3 basis points. That's now reversed and softened just a little bit. I just should point out, though, that volume is really, really light. So we have to take that into account as well. Trading is going to be pretty thin and really subject to some whippy action, either from Senate, from the House, or from vaccine news and COVID news. So let's get to that news. Senate Republicans on Tuesday blocking an attempt by Democrats to increase direct stimulus payments in the newly enacted COVID-19 relief bill from $600 to $2,000, bucking President Donald Trump, who demanded the change. Here to discuss the market reaction, Tallback and CEO Michael Purvis. Michael, I don't think I've really ever seen anything like this before, in that you had President Trump going out on Twitter attacking the leadership in the Republican Party, his own party. How do you hedge this kind of political risk?
Yeah, no, it's really interesting. And, Alex, there's this big discussion about, are we going to get $600 checks or $2,000 checks and so forth? But there's a longer-term implication that's actually coming right into the foreground on January 5th in Georgia, right, which is that if Trump's actions here are serving to fracture the Republican Party, right, and really give a longer-term edge to the Democrats so that, they can get potentially Senate control on January 5th and then potentially really enact the Biden policies that he articulated, before the election, right? What does that really mean for the markets, right? Because that's really, I think, almost certainly a more important longer-term discussion than the 600 versus 2,000. It's really, what does this mean for the political makeup in 2021 and 2022? So I will tell you, I think people have different opinions about what a Dem sweep really means, or a delayed blue wave, I guess you could say, what that really means. Some people would look at it as a market negative. I would say, given that we're in the middle of a pandemic, that you're probably looking at the rotation trade to get a lot more fuel there. And that rotation trade looks like it's kind of run out of fuel recently there over the last couple of months. So I would expect that in some ways, the way to hedge that is to buy, get long materials, get long small caps, get long cyclicals there with the notion that the probabilities of not just this current COVID package, but a series of more more persistent and potentially in scale fiscal packages are delivered over 2021, right? Because what we're talking about right now is sort of something to square off against the COVID spikes to get us through the winter here, right?
But, Michael, I think that the other side of that is that we're going to have higher taxes if you do get more of a Democratic sweep, right? And that's going to sort of put the brakes on growth. Some of the policies that have been expansionary under President Trump are going to take a back seat. How do you factor in those negatives as we head into Tuesday?
Yeah, I mean, I think that's interesting. Biden sort of talked about splitting the difference between where the Obama-era corporate tax rate was and where Trump brought it down to, I think 29% there. So that would certainly, if that becomes a policy priority on January 6th or after the inauguration with a Dem Senate, then I think that is something to factor in here. But that doesn't, that's going to certainly augur or probably means that high tax companies like the big banks are going to, are going to be certainly at least on a transitional basis at risk. Whereas, small caps, which tend to be not be big taxpayers, may be sort of immune towards that. I think the regulatory dimension here, will get some more teeth here as well. There, but I don't think this is going to be anything like a deep blue large wave type mandate, right? I think if he does get both Dem seats in Georgia, my sense is that he's going to still navigate the waters pretty carefully. Yeah. The House is still vulnerable to the Republicans getting it back in 22, and I think my own sense, I defer to people like Kevin, your colleague, about the political analysis, but my own sense is that Biden is leaning towards a more careful thing. So maybe we get some COVID packages this winter, and then maybe an infrastructure later, but nothing super grand and nothing along the lines of what Bernie Sanders and AOC have been talking about.
So what do you do on just a base level? I understand you're saying materials, et cetera, industrials. What do you do with the VIX? Because you do see a big spike in the VIX curve sort of right around February, a little bit earlier. Is there another way to kind of hedge using options?
Well, yeah, it's funny. I'm looking at my Bloomberg Oman screen right now, and I'm actually not looking at the VIX. I'm looking at the SPX weekly options, and you can see on from January 4th to over to January 8th, there's a chunky 4-point jump right there, and then like the VIX curve, it kind of stays constant at that level, which is sort of interesting. But the other thing that's really interesting here is that the calls and many of the expiries are richer, are more expensive than the puts, which is, as you know, very unusual for equity derivatives to see that. So there's a lot of greed and complacency in the market here. And I think if you want, depending on how you're positioned, what you can do is leverage those richly priced calls. You can sell those against long positions, or you can sell them to buy puts. As well. Look, there's no question here that sentiment over the last couple of months has built up to very frothy levels. We're technically overextended. You're seeing II bull bear metrics overextended. You're seeing the option skews doing something. It's not, it's sort of speaking a lot more of greed than of fear. And so I think it's a good time to start thinking about layering into some hedges, and you can do that creatively with some of these options with this distorted skew. But you have to be careful and know what you're doing as you sell options.
Hey, Michael, just one more quick question. Do you like Bitcoin here?
Bitcoin, I cover the wide swath of major asset classes, and I don't really write or think too much about Bitcoin. I'm more of a gold guy. Maybe I'm more of a boomer but I would just say look, there's no question that breakout that we saw a few weeks ago from the previous high, that's, it could be any security, right, or asset, and that was a very juicy technical break. Here, I don't really have a fundamental view on Bitcoin one way or the other here, but I would simply say that trend and that breakout was certainly a very obvious and exciting breakout to be on the long side of.
Okay, Boomer. I got to say that one. All right, Michael Purvis, good to catch up with you. Thanks a lot. Nice to chat. All right, coming up, you got AstraZeneca setting to test combining its COVID-19 vaccine with Russia's Sputnik V. We discussed with the CEO of the firm behind Russia's shot, Kirill Dmitriev of Russian Direct Investment Fund, will be joining us next. This is Bloomberg.
Lo tomé como una terapia. Realmente logró la contención que yo necesitaba en ese momento.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Markets. I'm Alex Steele. The UK is poised to approve AstraZeneca's COVID-19 vaccine as early as this week. This is as the company plans to start a clinical trial combining its own vaccine with Russia's Sputnik V to determine whether the two can actually work better together. Our next guest worked to arrange that agreement. Russian Direct Investment Fund CEO Kirill Dmitriev joins us now from Moscow with more. It's a big day for you guys. You also just recently mentioned that Venezuela will get Sputnik V. Argentina is getting their first shot today. The administration starts today to distribute it. How quickly can you get these doses to Venezuela?
Well, I think we can get some already in January. And as you mentioned, Argentina is very important because vaccination started today. There is huge demand from Latin America, and we will be trying to get as many doses as we can starting from January to some of the key nations in Latin America, and then we'll increase and supply more in February and March. For countries that have not worked with us before, we can only start supplying in March of next year.
When does Argentina, for example, get the second shot? There's been a lot of questions in the market as to sort of where that shot was made, where it's coming from, and if you have enough to satisfy, say, Russian demand as well as these other countries.
Of course we do. So they will get their second shot on schedule, which is, in January, and we will basically go exactly through the schedule that we agreed with them. And of course, Russia is vaccinating Russians, but we are also working with a number of nations who understand the benefit of our vaccine, which is proven safe platform of human adenovirus and high efficacy. So we'll be supplying them, of course, on schedule.
I thought so. Does that mean that the shots are being made somewhere else? Because I thought that officials said that the Sputnik V won't be sent abroad before Russians get their vaccines.
Well, we actually have great 4 companies in Russia who are manufacturing Sputnik V vaccine, but we also set up partnership to manufacture Sputnik in Brazil, India, Korea, and China, and some other nations. So today is actually a good day for us. We received the first batch manufactured in Korea. So we have set up manufacturing base to produce more than 500 million doses, people doses next year. You know, in US, you call it 1 billion doses because you count one people dose as, 2 doses. So basically, we have a big supply base outside of Russia that will be supplying markets outside of Russia.
I see. Okay. There's also been some reports that not a lot of Russia necessarily wants to take the Sputnik V vaccine. How many people have been vaccinated there, and how do you get them to want to get the shot?
Well, first of all, lots of people do want to get the shot. You know, our estimate is, and we did the survey, that more than 42% of the people would like to get vaccinated, near term. And this is similar as in many other nations where it's about 50-50. We believe that as people see empirical evidence that their neighbors have good immunity, the numbers will increase. But again, lots of people want to get vaccinated in Russia, and there is just very negative narratives that some of the Western media are trying to portray about Russian vaccination, Russian vaccine, that is just done for geopolitical reasons, frankly, is highly unethical. And the real narrative is we have a great vaccine and we will be a major player in vaccines and we'll be saving lots of lives in Russia and outside of Russia already this year.
So if that's the case, then why won't you get published peer-reviewed data?
Well, first of all, we did publish phase 1 and phase 2 in the Lancet magazine. We will publish phase 3 in a top peer-reviewed magazine, I think, in the next 2-3 weeks. And the data has already been submitted. And basically, we have full transparency. It's another part of fake narratives that some of the Western media are portraying. We will publish our protocol of studies. We have done studies on 31,000 people. We've done clinical studies in UAE, India, Venezuela, Belarus. So this is just part of the fake, false narratives that is propagated by people who want to contain Russia. And we actually want to be partners. And, our AstraZeneca deal you mentioned as an example, where we showed that one of our components would be useful to AstraZeneca vaccine, and we offered it right away. So I think time will tell, and time will show that we have a vaccine that is very safe, very efficient. We don't need minus 70 degrees for our vaccine. It's +2, +8, and it will be a major solution for many countries in the world.
I mean, there was a Levada poll that was published this week that said that only 38% of Russians want to get that vaccine. Do you think that poll is totally made up then?
Well, no, you said 38%, our poll showed 42%, so those are close numbers. But again, it's very clearly that you see, and you will see in January as well, our vaccine is demanded by many people around the world. In Russia, people are being vaccinated. We have lots of people vaccinated. I myself also got vaccinated. So, you just said that we see, and you sort of sense a little bit in your questions, this sort of sad narrative trying to portray, for competitive reasons, Russian vaccine in a negative way. And what we should really do is a blind wine taste of the vaccines. And if you do blind wine tasting, you see that we have much safer track record. We have better price than many vaccines. We are +2, +8. And very importantly, we believe that our shot, because we use 2 different vectors for delivery, will last longer. So if you have blind wine tasting of vaccines, Sputnik wins. And this will be very clear to many nations. But once again, we want to cooperate with other vaccines. We'll announce a major vaccine partnership with a Chinese manufacturer in the next couple of weeks as well. So we are setting this trend of cooperating and cooperation between different vaccine producers.
I don't think I've ever heard that one, wine tasting a vaccine. Kirill, thanks a lot. We appreciate your time today. Kirill Dmitriev, a Russian Direct Investment Fund CEO. Thank you very much. All right, coming up, let's stay with medicine here. U.S. officials ramping up efforts to boost the public trust of the COVID-19 vaccines. We want to get perspective from co-founder and chief medical officer of telehealth company Heal. That's next. This is Bloomberg.
Substantial further progress means what it says. We'll be looking for inflation to be substantially closer to our 2% longer run goal before we start making adjustments to our purchases.
That's a long time to be very accommodative, but that's basically the horizon.
They can buy more bonds and they can buy longer maturity bonds, and that would put more downward pressure on long-term interest rates.
If we can really get vaccines going in April, May, June, July, and August, by the time we get to the end of the summer, I think we can get to that goal that I'm talking about getting the overwhelming majority of the population vaccinated.
This is Bloomberg Markets. I'm Alex Steele. More than 2 million doses of the COVID-19 vaccine have been given out in the U.S. since the process began on December 14th. But could that have happened even earlier? In his remarks later today, President-elect Joe Biden will address the slow rollout of the COVID-19 vaccine by President Trump's administration. That's according to a U.S. official. In the meantime, Vice President-elect Kamala Harris received the vaccine in Washington. Joining us now, Dr. Renee Dua, co-founder and chief medical officer at Heal. That's a telehealth company. Doctor, thanks for your time. We heard from Dr. Fauci also earlier today that what's holding it up is just understanding who gets the shots when and following up and being able to clear that pipeline. How can we do that more efficiently?
I think there's a total lack of clarity, right? For example, I am an outpatient provider of healthcare. I have managed to get vaccinated because I have hospital privileges. But in fact, many hospitals are dealing with COVID infections. So how are they able to staff actually vaccinating their own people, right? So there's a lot of confusion in the rollout and the logistics. Ultimately, in my mind, we need to focus on those people who are keeping patients at home and out of the hospital if they don't need to be hospitalized. And so more transparency on how outpatient physicians, nurses, therapists, even school teachers, frankly, so kids can get back to school, more knowledge on how those people can get vaccinated would be very helpful.
Where does that need to come from for someone like you who runs Heal to get that clarity?
You know, it's a great question. And on a daily basis, we reach out to our various Department of Health in each of our markets to try to get the very same information. And we aren't coming up with much. We anticipate that, of course, the federal government will share information. The state governments will share information. I'm also turning to my colleagues in the hospital setting to find out what they know. But again, to your point, there isn't one great source of information. Here in California, you know, specifically in places like Silicon Valley and Los Angeles, which are huge tech hubs, it's strange to me that you can't click on your XYZ social media page to say, yes, I was vaccinated and here's my zip code. And even that would give some clarity to what is happening around the nation.
Well, speaking of that, there was a great article over the weekend here at Bloomberg about a nurse who got a shot, wrote about it on Twitter, and got attacked by a lot of anti-vaxxers. And I'm just wondering what your experience with getting the vaccine was like in terms of any side effects and also in terms of any reaction you got from people that you know.
So my experience was wonderful. The nurses that took care of me and vaccinated me were exactly as I anticipated they would be. They monitored me for a few minutes after I received the shot. That night I did have a little bit of fatigue and arm pain, but ultimately I was fine and I feel fine, and I'm very, very grateful to be vaccinated. Most of my colleagues that have been vaccinated, we are also very grateful and we are doing just fine. As far as people who don't believe in vaccines or think that our immune systems will protect us, that is one of the most troubling things about the COVID infection. If you get COVID, you don't know how you will be responding. And having witnessed patients in hallways, not able to be intubated, having to see doctors make very difficult choices, certainly here in Los Angeles, about who to give care to. I mean, this is a very troubling time for any physician or nurse or provider of care. So it is, in my opinion, the best thing you can do if you are offered a vaccine.
As we just wrap up here, you know, you talked about essential workers and then some of the elderly, like at nursing homes that have gotten vaccinated. What about the next tier of the elderly, like over 65? Like, how do we know when they should be vaccinated?
Yeah, and I think to your point exactly, immunocompromised probably first, elderly probably second. Even those people in nursing homes, maybe we have a little bit of time if their staff is vaccinated because they're not leaving their nursing home. But then on my mind very much are the people who carry out the work of our daily lives. If they help us mobilize around the city in transit, if they are cleaning the restaurants, if they are our school teachers, those people are vaccinated, we can continue to have them help us build herd immunity so we can get back to normal living.
And before I let you go, talking about herd immunity, has the threshold for herd immunity gone higher now that we have this new strain that seemed to emerge from the UK that seemingly spreads faster?
Well, it seems that the vaccine options we have right now will help us against that strain. So provided that we can get this vaccine rolled out more efficiently in the coming weeks, I think we should be in good shape.
All right, Doctor, thanks a lot. I really appreciate your time. Congratulations on getting the shot, and thank you for your insight. Dr. Renee Dua, a Chief Medical Officer and co-founder of HEAL. Let's check back in here on the market after you had Mitch McConnell, the majority leader over in the Senate, kind of torpedo any stimulus hopes. You're right around the lows of the session now with the Dow off by about 0.3%. Should point out volume is it's not bad, relatively flat, a little light in the S&P, a little higher at the Dow, and a little bit flat there on the NASDAQ. But nevertheless, you're going to have an interesting week. It's going to be shortened week. You're going to have thin liquidity, et cetera. But you're also going to want to take a look at the dollar and what's happening with yields, how high can yields actually go, and what happens with the dollar. You had euro-dollar hitting the highest level so far this year as the dollar kind of dropped like a stone. But if you don't get the $2,000 stimulus checks, you're stuck with the $600. What does that wind up meaning for the reflation story here in the U.S. and the rotation story? Small caps not liking it, down for a second day there. All right, well, coming up on the program, economic activity plunging in many major economies over the holidays. We'll take a look at why. This is Bloomberg.
How to manage your debt. Things they didn't teach you in school, part 4. When we think of debt, we often automatically think of a horror film. But debt doesn't have to be the scariest thing in the world. If you found yourself with some debt that's stressing you out, here's how you can manage it. First, prioritize your payments and pay down the debts that are costing you the most. How do you find that out? Look at your interest rates on your monthly billing statement. If your credit card has a really high interest rate, you'll want to pay that off before paying off something like a student loan, which might have a low interest rate. The average interest rate on a credit card is 14.5%. So you're getting a good return on your money when you pay that debt off. Next, track your spending. Stick to a budget so you can know where you stand financially and start to save some money to pay your debts down. You can do this with apps like Digit, Acorns, and Stash. And lastly, breathe. Know that every financial mistake is fixable. You can always recover down the road, but it's best to get ahead of any mistakes that could lower your credit score. And a good credit score can save you a lot of money, earning you a lower interest rate in the future.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
I'm Karina Mitchell. Let's get the first word news this afternoon. President Trump is lashing out at Republican leaders as an effort to overturn his veto of the defense policy bill now as it moves to the Senate. The House overturned it with bipartisan majorities. Trump tweeted, quote, "Weak and tired Republican leadership will allow the bad defense bill to pass." Senate Majority Leader Mitch McConnell says the chamber will take up the veto with a vote tomorrow. Meanwhile, more than 4.6 million people in 16 countries have now received the COVID-19 vaccine. That's according to data collected by Bloomberg. 2 doses are required weeks apart. The U.S. has administered the most doses, more than 2.1 million. But Dr. Anthony Fauci tells CNN the U.S. is lagging with its vaccine rate and that officials had hoped to have more people vaccinated by the end of December. And President-elect Joe Biden will speak in Wilmington, Delaware, in just a couple of hours to address that slow rollout of the vaccine by the Trump administration. And he'll outline his plan to pick up the pace. He's due to speak at 3:45 p.m. Wall Street time. You can see that live right here on Bloomberg Television. And China is struggling to get the world to trust its coronavirus vaccines. The Chinese shots could have been a diplomatic win for Beijing, but developing nations are wary. There's been little information about how the Chinese vaccines have performed in final stage clinical trials. Only the UAE and China itself have endorsed the shots for emergency use so far. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Live from Toronto, I'm Greg Bonnell. Welcome to Bloomberg Markets.
And from Bloomberg World Headquarters in New York, I'm Alex Steele. We're both joined now by our Bloomberg and BNN Bloomberg audiences. Welcome. Here's from the top stories that we're following from all around the world. Bitcoin's rally will face some ups and downs, but the cryptocurrency is proving to be here to stay. We're going to break down its rapid move to possibly 30,000. And after the mayhem of 2020, we're going to take a look to next year and the possible opportunities in private capital as a result of the Fed's support. And plus, insurance provider Lemonade is trading more than 350% above its July 1st initial public offering price, but roughly the 44 million shares will be eligible for sale today. Can the stock keep up? Greg.
Alex, you take a look at the markets, of course, with the resumption of trading yesterday on Wall Street. We had these indices making new all-time highs on the heels of stimulus finally being signed off on. And the big package now, of course, the drama in Washington is the size of those checks. $600, not enough, says President Trump. The Democrats agreed with them. Just about in the last hour, the Republicans in the Senate said, no, we are not boosting that amount. So it seems like we still have some drama on that front to play out for this week. A bit of a mixed picture out there. The broader read of the market, the S&P 500 is down modestly, a little more than 0.1%. NASDAQ showing a little bit of strength there, and the Dow down about 0.25%. As we take a look at the U.S. dollar, of course, it's been an incredible ride for the U.S. dollar this year. All that money pouring into it in the early innings of the pandemic in March. Now we've seen this long sort of road lower and lower. It's again that lower by 0.33% today. And a lot of bets are that this is a bit of a longer term story for the U.S. buck. When we look at the action on the screen, of course, the conversation is about stimulus. And we know that activity in several of the world's largest economies actually plummeted over the Christmas holidays. That's according to Bloomberg economics data. Things like mobility, energy consumption, and public transportation usage all down dramatically. That is a pretty telling chart right there. Joining us now, Peter Coy, economics editor for Bloomberg Businessweek, to dig a little deeper into this, Peter. And clearly, when you see lines plummeting like that off the end of the chart, that is not a good picture.
No, it's pretty scary. Bloomberg economics does a good job of tracking a composite of a bunch of different indicators here. One of the things, though, you'll notice about this is that it starts back in the beginning of this year and goes through December, so you're not really seeing a year-over-year comparison. What you want to know is, well, doesn't this happen every December? So actually, I dug into that a little bit since I know I was going to appear on your show. And it turns out that most of this really is COVID-related. There is some seasonality, to be sure. I was on the phone with SafeGraph, which tracks the cell phone usage. And it turns out that last year, there was like a 2 to 4% decline in December versus, say, October, November. This year it's 13%.
Wow.
So that's the difference between 2 and 4 and 13. You can also look at things like gasoline consumption. It's down since the summer by 10% this year. In past years, over the same period, it was down 4, 5, 6%. So again, there is something real going on here. It's not just because every December is slow.
Hey, Peter, question for you. Do you have a read on which of those countries was more effectively shut down? I'm just trying to understand if the slower growth, slower movement, slower mobility was because of government rules, or was it because people just, had their own mind and was like, I'm staying indoors, forget this?
Yeah, that's always hard to disentangle because you don't know why. You can't look into people's heads why they're doing things. But take a look at that chart for a second. Look at Japan. Japan is like the only country where they're just, hey, we're fine here. The only country that is among the ones that are tracked here. The United States way down, Norway, Spain, sharp drops in December. So it could be partly because they're doing because they have to and partly because they want to.
Peter, we think about what might change the direction of those lines. And of course, it brings us back to stimulus, the whole point of putting money into the pockets of households. Yeah. Huge story right now in the United States. As we look globally, I mean, is there a reason for investors to say perhaps that there is a push towards fresh stimulus to get things through? It's going to be a tough winter.
It is going to be a tough winter. It's always interesting when you do a stimulus, what is the purpose? If you are trying to put money into people's pockets so they will go out and spend, go back to restaurants and retail, you have a problem if you're simultaneously telling them to stay home. On the other hand, if what you're trying to do is make sure that they can cover their bills so they're not thrown out of their homes, well, then you have a better argument. And I think that the stimulus that's been done so far is trying to do, stimulus is not even the right word, but coronavirus relief. Trying to do some of each. It's trying to, extend the moratoriums on evictions and so on, which are an unalloyed good that will clearly save a lot of people from being out on the street.
Peter, here's an unfair question to round out the conversation. Which country so far is doing it right that has the best chance of having a V shape?
Well, two different questions, because if you're really doing it well, you don't need a V-shaped recovery. That's the category Japan is in now. They never had a severe recession because they shut it down correctly. China's not on this map, but they too have managed to power right through this one thanks to successfully suppressing the virus. Clearly the U.S. is no role model. We started to have a V-shaped recovery in the U.S., but then it turned into a W.
Yeah, and then there's the K, and there's the whole alphabet there.
Oh,
Peter,
yeah.
Thanks a lot. We really appreciate you joining us on that. Peter Coy, economics editor for Bloomberg Business Week. All right, coming up, how to put money to work. We're going to talk to Eric Lloyd of Barings on which private assets are looking attractive into 2021. We'll discuss that next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Remember, this was not announced as a complete trade deal. This was announced as a phase one. So we and the Chinese both are well aware that there's much more to do.
This is Bloomberg Markets. I'm Alex Steele in New York alongside Greg Bunnell over in Toronto. So U.S. markets in 2020 saw a lot of mayhem. What they avoided was a breakdown in the credit market. You take a look at the spread on high yield, for example, still sitting about 3.6% yield over treasuries. Unbelievable, all in fact due to Fed monetary policy. Joining us now is Eric Lloyd, global head of private assets over at Barings. So, Eric, there's a lot of narratives in the market. One is that there's lots of opportunities because there's still some distressed areas of the market. And the other is at some point you're going to have a shakeout in the credit market. And it's going to leave a lot of people in the private market hurt. Tell me where you see the opportunity in both of those things.
As you said, there's been a lot of purchases out by the Fed, and what we're seeing really the opportunities are very broad. Use our middle market direct lending business as an example. Think of that as bank replacement type of lending for companies between $100 and $500 million of enterprise value, where we can generate origination yields of 7 to 8%. With a first lien senior secured collateral package on those companies. And so we think that's attractive relative to other opportunities in the world where you have a floating rate asset and a senior secured credit backing you.
Eric, throughout the year when I would talk to people in your space in private equity, they would intimate sometimes or come right out and said that they felt that the Fed, through the actions they took to put that much liquidity, put lending programs out there, sort of messed with their traditional business and robbed them of some opportunities. Was that true of 2020? And how would that picture look different for 2021?
You know, I think it's one of those situations where the intentions were really good, right? Whether it be the Main Street program or other business programs where they're looking to support businesses. Sometimes some of the technical elements in those made it difficult to invest side by side with some of those programs. But I really believe that public-private partnership is what will get us through this. Obviously, there's a lot of businesses out there suffering, a lot of people that are challenged. And, you know, our middle market direct lending business, as an example, is one that partners with some of those public programs so that we can provide capital to these businesses and hopefully give them the liquidity to make it through to the other side.
The story of 2020, in some ways, was everything moving together. I mean, with the Fed coming into the bond market, or at least saying it, not even doing that much of it, but all yields kind of moved lower. Is 2021 going to be the year of idiosyncratic moves in the credit market? And if so, specifically, where are the opportunities?
So, Alex, I think you just hit on it. I think it's going to be differentiation in the marketplace. Let's use real estate debt as an example. If someone wanted to say, I'm going to make an allocation to real estate debt, let's think about what that could mean. It could mean an allocation to an industrial building that is there set up from a logistical hub that is really benefiting during the COVID situation and the pandemic, or that could mean an asset or an investment into something that's more challenging right now. So I think it's really where asset allocation and industry and subsectors intersect is where you're going to have that differentiation, both to the positive and to the more challenging side. Specifically to your question as to what some of the opportunities are, we do think infrastructure debt and equity will be an interesting place to be, not just traditional infrastructure like ports and airports and the like, but more digital and green and sustainable infrastructure, we think is a real trend that we'll see going forward and one that we've supported in a very significant way.
Eric, you touched a bit on real estate there. It's been fascinating to me on both sides of the border in terms of the hit the economy took from COVID-19, the hit the labor market took in this country and in the United States as well. And real estate has been unbelievably resilient. Now, people in real estate say that continues in 2021. Do you have a call on what happens in that space?
I think it's really time frame, right? What is your time horizon? I think of myself and my own family situation where we haven't been able to go on holiday, and one day when we can, it'll be wonderful to go to one of those resorts and support the people there, support the catering companies and everybody that is there. And so I think it's really the time frame that we have, and when is the rollout of the vaccine going to occur so that enough people are immunized that allows people to really, move around the country freely. And I think that will move a lot towards where real estate goes. And obviously the big question is office. Office space is probably the big unknown. What smaller footprint will companies need? Maybe a little larger in certain industries, smaller in others. And then how do you balance that with developing a real culture in your firm? As I have responsibility for hundreds of people here at Barings, I really balance what's best for the business and what's best for the mental health of our employees, and giving them that flexibility while establishing a culture that we're really proud of, and continue to build on the culture we're proud of, and balancing that with, frankly, the cost of office space.
Fair enough. Globally, where do you see the best opportunity based on the thesis that you've just laid out?
I'd say globally, the best opportunities we've seen have actually been in a number of the European credit markets right now on the direct lending side. So that would probably be the first place I would go. Secondarily, where I'd go would be some form of infrastructure equity in the non-traditional spaces. So not like ports and airports, but more sustainable infrastructure equity would be the two places I would look to.
Now, would there be a fight, I guess, among governments in terms of spending that money on infrastructure? We love to hear about infrastructure because we need it, particularly in North America. Could it be a bit of a pitch battle, though, to get those dollars out the door?
Yeah, well, I mean, I'm not going to predict anything on governments these days. Let's hope that people can come together and what's best for their country, or whether it be America or other countries. Obviously, there's challenges in getting that infrastructure money passed and what all comes with it. But again, some of this is, again, public-private partnership, and we see the private markets come in with infrastructure equity, and then there's infrastructure debt providers around that can build out some of their own digital platforms or e-commerce platforms in order to support these businesses.
Eric, pleasure to have you with us, and great to get your insights. Eric Lloyd is the global head of private assets at Barings. Well, a lot of asset classes have moved higher in 2020, and one that particularly catches the attention, if you're into digital coins and you're into crypto, it is Bitcoin. We're going to have a discussion about where it could be headed in short order and through 2021. This is Bloomberg.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Markets. I'm Greg Manell in Toronto alongside Alex Steele in New York. Well, if you're into crypto and you're an enthusiast, then 2020 was clearly the year for you. The run that Bitcoin has had is now on track for its longest monthly winning streak in more than a year. Hit new highs over the weekend, getting people excited about 30,000 and beyond. Let's bring in Bloomberg's Olga Karif for more on the velocity we're seeing here and where we just might be headed with Bitcoin, Olga.
Well, in the past, we've seen huge rallies and also huge drops in Bitcoin. So it's a very volatile asset, and we might see it go to 30,000, or we could see it dropping 80% next year. Either one is possible.
Do we have an idea of who's been buying in this recent rally, this recent leg?
So basically, so there are companies and institutional investors that are starting to buy into this asset class. MicroStrategy is one company that's been putting its corporate cash into it. Square is another, and a number of hedge funds have also been kind of pouring their money into Bitcoin. One reason for companies to put their corporate cash in it is that in this environment of zero and negative yields on traditional assets, they feel that this is a better investment. So that kind of trend could continue into the next year as surveys by the likes of Fidelity Investments show that there is increased interest among institutions in Bitcoin.
Yeah, Olga, that seems to be the story of 2020 for Bitcoin and other cryptocurrencies, the fact that institutional players started to put some sort of faith in it, I guess. But then it sort of leads me to the question, are they simply saying we cannot ignore this ride? Look at the gains in Bitcoin. How can we sit on the sidelines? Or do they actually believe there was a place for Bitcoin in our society at some point beyond just being a speculative asset?
I think a lot of them are saying that they believe in Bitcoin, but I think it really remains to be seen whether this is just a kind of a quick speculation that some of them are doing, or if they really believe in it in the long term. One thing to keep in mind is that about 2% of anonymous accounts control 95% of supply of all Bitcoin. So it's a very, very concentrated market, not a lot of liquidity here. So, a few speculators can run the price up very quickly. And, but at the same time, you also have to always be aware that, as quickly they could also potentially get rid of their holdings.
So some believers in Bitcoin are going to point also to fundamentals, though, like it's a pure supply and demand situation, and that it is, in that essence, a safe haven like gold. What's the truth and what's the false in that?
So it is true that the supply of Bitcoin will be limited at 21 million coins, and so it is a limited supply asset. But it still remains to be seen whether it really is digital gold. I think it all depends on whether people believe in it long term, whether people hold it long term. I think a lot of it is sort of psychological, whether this proves out to be something that people really keep long term, and it's going to take time for us to find out.
All right, Olga, thanks a lot. Bloomberg's Olga Karif. Appreciate that deep dive. All right, now it's time for the stock of the hour. Lemonade has been on a roll since its July IPO until the impending expiration of an insider share lockup took some steam out of its gains today. Ritika Gupta is here with more. Hey, Ritika.
Hey, Alex. Well, it's one of the best performing listings of 2020, but it's poised to enter the new year with a fresh bout of volatility as this lockup period expires. About 44 million more shares could be made available. That's about $5 billion more worth of trading. And as a consequence, we're seeing trading volumes double the 20-day average at this time of day. But volatility, it is the name of the game. With such a large quantity of shares being made available, option markets are pricing more volatility, and that so we can expect higher price swings. Over the past 2 days, Lemonade has been down and as much as 14% yesterday, but we are bouncing back. If we look at the price action over the past year, since it IPO'd in July the 1st, it's up about 300%. And the company's shares soaring on this idea that it will create a digital platform that will create a niche for homeowners and renters. In fact, in December, the stock actually doubled on optimism that it could even enter some new markets like pet and auto insurance as well. Alex?
Also, Lemonade's been one of the big IPO winners, though. Tell us about that.
Yeah, well, 2020 has, of course, been the year for listings. Think Snowflake, think Unity Software, not surprising with such high valuations. But Lemonade actually beating all but one of the IPO listings this year, over $250 million. Alex?
All right, Ritika, thanks very much. I appreciate it. Ritika Gupta joining us there. Greg, it is interesting, though, because for all the idiosyncratic moves in the market, like a Lemonade, like a Bitcoin, it's still dependent on where the virus goes and where the money comes out of what government. And to that really brings us to the U.S. and those potential $2,000 stimulus checks.
Yeah, when you think about what's going to carry people through this winter and some of those challenges, yeah, we've had some crazy performances among asset classes, but the broader markets right now, and they are dancing around all-time highs on Wall Street, but they are a bit concerned as you take a look about what's happening in Washington. Yes, you had a tumultuous weekend until the president finally signed off on the latest stimulus bid, but now this fight, and a strange fight too, right? It's the Democrats siding with the Republican president and the Republicans in the Senate blocking this attempt to get that stimulus check up to $2,000. So a bit of caution in the markets right now. Of course, it's a holiday week too, so yeah, you have to wonder. People are out there, they're trading, and they're willing to play in the markets, but still, it should be a bit quieter. But should be and the words 2020 probably don't go together very well, Alex. But right now, the tech stocks, this is fitting for 2020, right? They're doing the heavy lifting on a day when we're a bit uncertain. That seems to be the story of tech for this year.
Yep, indeed, especially when you're taking a look at the VIX, though, still pricing in a jump around the January 5th elections, which will really be the do or die when it comes to stimulus for the first 2 years of President-elect Biden's term. All of that, though, weighing a little bit there on the dollar. Also, yields kind of getting a little bit of a boost. You had some money come into the 7-year, although the takedown was still a little bit light compared to last time. All right, from New York and Toronto, have a wonderful Tuesday. This is Bloomberg.
Chinese brands now account for 7 of the country's top 10 cosmetics lines, up from just 3 in 2017. That has pushed out foreign brands like L'Oreal's Maybelline, which has seen its share of China's makeup market plunge by half since 2010. For more, we're joined by Bloomberg editor Bruce Einhorn. Bruce, why the drop?
Chinese brands are becoming much more adept at reaching Chinese consumers, especially now at a time when more consumers are reluctant to go shopping outside. People are spending more time at home. People are spending more time on social media. Chinese brands are very good at using social media, using live streaming, using other things in order to market. Chinese brands also tend to be less expensive. And so at a time when the economy is struggling a bit, there's a lot of uncertainty, people are more budget conscious, Chinese brands have a bit more of an advantage.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry,
buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Does it really enhance transmissibility as has been suggested? Does it really prevent antibodies from binding? These are still questions that scientists are hopefully going to answer in the coming weeks.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I'm Karina Mitchell. Let's get your first word news. More than 400,000 Americans will be dead from the coronavirus before President Trump leaves office. That grim prediction today from the Centers for Disease Control and Prevention. The U.S. has one of the highest mortality rates of nations hit hardest by the virus, behind only Italy, Spain, and the U.K., scaled for population. The current U.S. death toll is more than 335,000. Meanwhile, the traditional inaugural luncheon to honor the new president and vice president has been canceled. The congressional committee planning Joe Biden's swearing-in ceremonies say it's no longer safe to hold the event due to the virus. While not as widely watched as the president's inaugural address, the luncheon serves as an important symbol of bipartisanship during the transfer of power, giving congressional leaders the opportunity to toast the new president. And Vice President-elect Kamala Harris and her husband have received their first doses of the coronavirus vaccine. The shots from Moderna were administered at United Medical Center in Washington. Harris says she wants to encourage everyone to get vaccinated, saying, quote, "I trust the science." And the UK and the European Union will sign the treaty formalizing the post-Brexit trade agreement tomorrow. After European Commission President Ursula von der Leyen signs the document, it will be flown to London for Prime Minister Boris Johnson's signature. British lawmakers will have just one day to debate the agreement. It needs to be implemented by the time the Brexit transition period ends on December 31st. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
2 p.m. here in New York, 7 p.m. in London, live from Bloomberg World Headquarters. This is Bloomberg Markets to Close. I'm Romaine Bostick.
And I'm Taylor Riggs. Caroline Hyde is off today.
U.S. stocks turning lower, struggling. Small caps heading for their biggest drop in 2 months, with the Russell 2000 tumbling 2%. The S&P 500 edging off record highs, all as hopes fade over those $2,000 stimulus checks. And blocked by McConnell, the Senate Majority Leader squashing an effort to increase those direct relief payments after the measure passed the House, despite it winning over an increasing amount of support from his own caucus. And return to flight. How about this? After 2 deadly crashes that forced an unprecedented 2-year hiatus, Boeing's 737 MAX jet back in the sky in the U.S. American Airlines flying from Miami to New York. We're going to talk about that and so much more today on this beautiful Tuesday afternoon here in New York. But let's get a check here on the markets. Coming off those record highs that we saw yesterday, Taylor, not quite getting it there today. We did see the S&P 500 open higher on the day. That was primarily led by some gains that we saw in the healthcare space, particularly with a lot of those medical device companies. But a lot of those big cap tech names, some of those discretionary names, really weren't participating much in the rally today. Apple, which at one point was trading at a record high, also pulling back slightly here on the day. So call it flat. We did see a little bit of enthusiasm over in Asia, the MSCI Asia Pacific Index rallying today. A lot of that because of a rebound that we're seeing in Alibaba, JD.com, Pinduoduo, and a lot of those Chinese tech names that have been sold off because of concerns about regulatory issues. Dollar weakness. We're going to talk about that a lot today. And one of the reasons why you're seeing that dollar weakness is that line you see at the bottom of your screen. Inflation expectations, once again, for a second day, scraping near that 2% mark. We're going to talk a lot about what the Treasury market is telling us, what inflation expectations are telling us, and what the dollar could be leading us to.
Well, if you're trying to get inflation expectations to creep to 2%, you're looking at a 10-year yield that's also trying to creep to 1%. We're only up about a basis point. I kind of sound like a broken record. But again, we're at 93 basis points. The long-term trend since the summer has been upwards. But, well, we are nowhere near
where we started the year. I want to talk about another stock that is nowhere near where it started the year. Romaine, Apple. It's the world's biggest company. It also managed to increase its market cap by $1 trillion. And then Microsoft there in blue, starting the year at 1.3 trillion, ending the year at about 2.3 trillion. 88% return. What do you make of that?
That's been a pretty good year for Apple. I mean, it's the second year in a row. I think they've topped 80% price return there. So definitely a bet, and for some people, a bet that they missed out on. Let's talk a little bit more about the markets, about the economy, and everything in between. David Kotak, we love him. He's the chairman and CIO over at Cumberland Advisors, joining us today from Sarasota, Florida. David, great to have you back on the program. Let's start out with the general outlook here going into 2021. On the whole, right now, things look relatively positive, don't they?
Well, they do. First, let me just say Happy New Year, Romaine, to you and to Taylor. It's nice to be with you. Thank you for having me on before the end of this year, which we're happy to say goodbye to, and I'm sure you've heard that now 100 times. Yes, the outlook is for recovery. That's underway. There are questions. There are stumbling points. When you think about this year, after March, 33 million people applied for an unemployment benefit. So we really had a shock. And as you just reported, we're going to have 400,000 people dead in the United States. That is another shock. And when the GDP numbers for this year are done, we'll have a down year of 4 or 5%, another shock. So substantial shock from which this volatile, sort of crazy kind of recovery is happening.
Yeah.
And it probably continues.
Yeah. So, David, when you look at obviously a lot of pain out there in the real economy, I guess the economy that you and I see on the ground, we did not necessarily see investors get as spooked. Obviously, there was that big sell-off in March, but by the time we got to May and June, so many people were willing to come back into the equity markets and into other risk assets. And so far, that's been a bet that's paid off pretty handsomely. What do you think explains the disconnect between the two?
Well, if you break down the population of the United States into three cohorts, the very affluent or the affluent, the middle, and the lower income or working lower income folks. They're the ones who are the upper levels, the wealthy, the affluent, the professional class that was worked by Zoom or Teams. They're almost whole. They've been able to continue their incomes. I'm an example. We remote working with almost 46 people the entire time. We really sliced the U.S. economy into different pieces. The pieces that are hurt badly. The pieces that are intact, and Cumberland's an example of them, are growing, continuing, working. And the middle is stressed. And that's how we start 2021. The whole key is to have the people hurt the most recover enough so they can begin to flourish again.
David, over the years, you and I have talked a lot about treasuries and the role of bonds in a portfolio. Does full faith in credit at 93 basis points make sense to you as a buyer?
Taylor, I was waiting for you. The answer is no.
Am I that predictable?
Well, you're wonderful, and the fact is, you're a runner. You know what it's like to have to go a distance, and I wouldn't put my money at 93 basis points in a 10-year treasury. I cannot do it for a client. Now, there are clients who have no choice. They have to own governments. But if you have other choices, if you can make the allocation decision then I would underweight long treasuries. There are much better places in bonds for opportunities. The municipal bond market is one of the sectors. I know you understand and work with that sector. And there's the stock market. And there are other things, too, if you can stray away from liquidity into less liquid places.
Are one of those less liquid places high yield, or have those spreads contracted too much?
Oh my gosh, the spreads, look at what happened to them. I mean, some spreads blew out 1,000 basis points in March and April. They've all come back. If you looked at the spreads today and you looked at the spreads 1 year ago, you would say nothing happened. And that's not true. We've got a shock. So I worry about high yield. I think you really got to take a deep dive in credit. You want to get paid. Traditionally, you're not getting paid by traditional standards for the junk bond risk that you would be taking at these spreads. There are a lot of people doing it. We're not among them.
When we talk about inflation expectations, David, and the idea that we could get to a stage where we see some of those price gains eroded by inflation, is that a shorter-term worry for you, meaning in the next year or so, or is that not something that you think investors should be too worried about?
Well, no, I would worry about inflation. I think an investor should always worry about inflation every single day. Set that aside and look at market-based pricing right now. And if you take the TIPS adjusted treasury yield and inflation forecast at 5 years, you get roughly 2%. I think it's 1.9 right now, something like that. If you take it for 10 years, you get 5 basis points more, which is an unusual relationship for me, because when you do a forward rate analysis of live market-based prices, you would say, gee, the market is projecting a 2% inflation rate for 5 years, and for the next 5 years, no change. How can that be? How can the market be pricing what I think is a pricing anomaly? Shouldn't there be a risk premium for the second 5 years, which we know so little about? We have enough trouble with the first 5 years. So I don't know how to wrestle down this inflation question. It's a very difficult one. I might add, if I have a quick few seconds, we have every major central bank in the G7 targeting 2% inflation. They measure it different ways, but 2% inflation. Not one of them's been able to hit it for the last 10 years. So you have to say to yourself, what's it going to take for us to get inflation above 2% on a sustained averaging basis, which is the Fed's target number? It might take 2 or 3 or 4 years to get there. I think that's distinctly possible.
Well, those are questions that we're going to let you grapple with and then hopefully come back in a few months and give us some more answers to. Thank you as always there, David Kotok, Chairman and CIO of Cumberland Advisors. And coming up, taking flight after a 2-year hiatus, the Boeing 737 MAX resumes flying, but will passengers feel safe? Plus, that stimulus standoff, how $2,000 has President Trump fighting against his own party and siding with the Democrats. We have the latest. And testing Fubo TV's rally, how the new year may fuel new declines for the sports first streaming platform. All that and much more coming up. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
There's some sad news about the Boeing 737 crash about 20 months ago. And then, of course, the good news of returning back to business today. The bad news, though, certainly reflected in the share price. When you take a look at Boeing there in purple, off about 45%. American Airlines, since the grounding of these airlines, also off about 50%. They're underperforming not only the airline index, but the S&P 500 over that period of time. For more on this, I want to bring in Justin Bachman, who covers airlines, travel, and commercial space for Bloomberg. And Justin, I think for today with Boeing, no news is good news, right?
That's exactly right. Today, when you have the MAX returning to the United States for commercial service, what American and Boeing want to see is absolutely nothing unusual about the flight. They don't even want to see a slight delay for anything. And that's what they got on the first flight today from Miami to New York.
And as far as just the general confidence, I guess, in the potential buyers of this, we know this is obviously the plane with the biggest backlog for Boeing here. Are we sort of, are you at a stage now where you can start to model in some of these orders as actual revenue down the road?
Yes, they're at the point where Boeing is able to resume deliveries, and you won't see a whole lot this year because it's so close to the end of the year. But for 21, the MAX is really going to gear up, and Boeing has had some pretty good results in the last few weeks as far as customer orders from Ryanair, which is taking 75 more jets, and Alaska, which added to their MAX order. So you put in the combination of the pricing and the airline's desire to move on to a more fuel-efficient jet than what they were flying before, and you're going to see some major deliveries next year.
I want to talk about the deliveries and the impact on the balance sheet. I remember when the grounding first started, a lot of analysts were defending Boeing. This is a company that at the time was pulling in $11-12 billion in free cash flow annually. There had been some concerns lately, though, as free cash flow turns negative, trying to shore up cash on the balance sheet to make sure that they were okay to pay off some of the debts and loans. How does this now impact the financials of Boeing?
Well, the big issue and the big problem for Boeing is going to be this pandemic, as it is for Airbus and every airline on the planet. And what really, they need to see happen is that people have confidence to travel again, and you start to get back to more normal patterns of behavior. And until then, everything is really kind of up in the air in terms of what kind of fleet strategy will airlines pursue? Do they want more airplanes? And will Boeing be able to actually deliver a lot of what they've got on the books? And I think what everybody's looking for next year is the pace of vaccinations and the pace at which the consumer says, I can return to what I used to do. And we haven't seen that yet.
It's been a challenging couple of years here for Boeing and really the airline industry as a whole. But, of course, good news here, seeing that 737 MAX just about an hour ago making its landing here in New York at LaGuardia Airport. Justin Bachman, we'll catch up with you soon. All right, coming up here next on this program, we're going to talk about that stimulus. Mitch McConnell, Senate Majority Leader, sidestepping the debate right now on that $2,000 stimulus check, despite increasing support from his own party. We're going to head down to Washington next. This is Bloomberg.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
We have quite the news coming from Washington, D.C. It was interesting. I want to pull up a tweet from Republican Josh Hawley, who said that the Senate had enough votes to pass legislation boosting those stimulus checks to $2,000 from $600. But then, well, not quite. Mitch McConnell came out and vetoed that vote. For the latest confusion, to help clarify it all for me, let's bring in our Bloomberg Chief Washington correspondent, Kevin Cirilli. Kevin, remind us what happened in that noon hour with that big veto.
All right. Three big things. First and foremost, Senate Majority Leader Mitch McConnell largely expected. He said that there is going to be a vote on the Defense Authorization Act sometime within the next 24 hours. Remember, President Trump had vetoed this. Republicans for weeks have been forecasting that they have the votes to override this crucial national security vote for the United States. And in fact, Leader McConnell saying that vote will be held in the next day. As it relates to the stimulus checks and the 2,000 stimulus checks, the Cash Act has been voted upon in the House of Representatives, in the Democratic-controlled House. It did garner Republican support and cleared the House with more than two-thirds of votes for it because of a procedural hurdle known as unanimous consent and a fast track, which would require two-thirds of a vote. Then it got to the Senate. Leader McConnell blocking Senate Minority Leader Chuck Schumer's effort to have an immediate vote on the 2,000 stimulus check. What is unknown is whether or not this is a done deal and that there will not be any vote on this in the next week or so. The politics of this, as you've rightly pointed out, Taylor, are fascinating. Senator Josh Hawley, largely thought of being a 2024 presidential contender. He has introduced legislation, bipartisan legislation with the likes of Senator Bernie Sanders, for example, supporting $2,000 stimulus checks. Yeah. Then you've got Senators David Perdue and Kelly Loeffler up the Republicans for re-election in the Georgia runoff, also coming out in favor of the $2,000 stimulus checks, a populist streak of republicanism that President Trump is now behind.
Yeah, and we also saw Hawley tweet a little bit earlier saying that the Republicans actually had the vote to do this. So it'll be interesting to see whether McConnell continues to push back. I am curious. A lot of people, Kevin, have their eyes on January 6th. Of course, that's the day the electoral votes are supposed to be tallied, or I guess certified, if you will, by Congress. Any sense here that that could go awry?
Well, there's virtually no chance that this will be overturned. What's important to note is the positions that Republicans take on that date. I'm thinking, for example, of Vice President Mike Pence, as well as some other Republicans who are looking at their long-term political futures, and the comments that they make could be an issue in a potential primary season ahead of the 2024 elections. But it's the last week of 2020. It's been a long year for all of us, right? We don't need to be thinking of the 2024 presidential cycle. But you know me, Romaine. I love presidential politics. I live for it. I live for it. I'm ready to get back on the campaign trail.
All right, put up the countdown clock. 4 years ago. All right, Kevin Cirilli, our chief Washington correspondent. Get some rest. We'll catch up with you shortly. Right here, right now, let's get a quick check on the Business Flash headlines. Global lockdowns have proven to be a big boost for the world's largest cigar producer, much, of course, to Taylor's joy. The Dominican Republic is on track to export a record $1 billion worth of tobacco products this year. That would be a 6% increase from last year. The president of a trade association says that cigar smokers are spending more time and more money on their habit since the pandemic hit. And shares of Fubo TV, another favorite of Taylor's, are down again today. This after falling 38% the previous three sessions. Shares of the Sports First streaming platform had more than quadrupled after a $197 million additional offering back in October. But analysts, they've cautioned investors on that run-up, and restrictions on insider selling, well, they start to expire tomorrow. And it's a first for the National Football League. Carolina Panthers tackle Russell Okung will be the first pro football player to collect a portion of his paycheck in Bitcoin. Okung is going to get about half of his $13 million salary in the cryptocurrencies. He's doing this through Zap's Strike product. So we should point out, Taylor, that the NFL isn't technically paying him in Bitcoin. They're still paying him in the traditional fiat currency. And then Zap has a Strike product where effectively it converts it immediately into crypto. He's been advocating this for a while. And anyone who doesn't know Okung, he's been banging this drum, not only on Bitcoin, but really on the idea of financial independence for football players for quite some time now.
You know, it was interesting. Yesterday, we were speaking to a lot of guests, and we asked about the use case of Bitcoin and if it looks in the future like the same use case that we're using today. And I think the guest said that it's a tough question. And this sort of shows, I think, the ever-evolving nature of Bitcoin. Yeah. My question, Romain, you going to get your bonus in Bitcoin?
Should I get paid?
Convert 50% to Bitcoin.
I don't know. Maybe I'll take it in Dominican cigars. That's up 6%, right?
Fubo TV.
Well. All right, let's get a quick check of where we stand in the broader markets here. Of course, Taylor, yesterday we had the S&P 500 at that record high, the Dow, the NASDAQ as well. Today, well, you could pretty much call it flat. And we should point out, too, Taylor, I mean, volumes over the last couple of days have been well below average, as you would generally expect here after the Christmas holidays. Again, this is a shortened week, so not sure how much you can make of some of these price gains, though the Russell 2000, an interesting move here, Taylor.
And those are the trends that continue. A little bit of a sell-off in the Russell 2000, the small cap stocks, those that really benefit from stimulus, while FANG, big tech, the only sector that, well, it was in the green, and that continues to be the safe haven.
And some of those Chinese internet tech stocks rebounding a little bit today, clawing back some of those losses that they had over the past couple sessions. We'll be back in a moment. From New York, this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
I'm Karina Mitchell. Let's get the first word news. President-elect Joe Biden will speak in Wilmington, Delaware today to address the slow rollout of the coronavirus vaccine by the Trump administration. And he'll outline his plan to pick up the pace. More than 2 million doses of the vaccine have been administered in the U.S. so far. That's far fewer than the 20 million the Trump administration promised would be given by the end of the year. You can see Biden's remarks live, scheduled for 3:45 Wall Street time, right here on Bloomberg Television. Meanwhile, congressional staffers can begin to get vaccinated against COVID-19, according to a memo sent to lawmakers and staff. Congress has been given a limited number of vaccine doses. They'll be given first to critical staffers whose jobs involve in-person interactions. And Senate Republicans went against President Trump's wishes today. They blocked an attempt by Democrats to increase direct stimulus payments in the COVID-19 relief bill from $600 to $2,000 after Trump demanded the change. The motion passed the House yesterday. Majority Leader Mitch McConnell says the Senate will address 3 of Trump's complaints this week, including the amount of the stimulus payments and concerns about election fraud. And federal officials are working to piece together the clues to determine a motive for the Nashville Christmas Day bombing. Officials say the suspected bomber, Anthony Warner, took steps that suggest he knew he wouldn't survive the blast, giving away his home and his car. And a former neighbor tells the AP that Warner said, quote, "Nashville and the world are never going to forget me," just days before the blast. Warner was the only one who died. 3 others were injured and dozens of buildings were damaged. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
This is Bloomberg Markets The Close. I'm Taylor Riggs.
And I'm Romaine Bostic. A little after 2:30 here in New York. Let's get you caught up here on the moves that we've been seeing in the oil markets. NYMEX crude futures right now settling in at an even $48 a barrel. The $47.98, of course, on your screen. That's the tick into the new session here. Most of the gains we saw today largely related to some of that dollar weakness. You're seeing natural gas futures rebound. Of course, remember that we had that big drop over the last couple of days on concerns that weather wouldn't be cold enough. Some of those bets being dialed back a little bit here on the day. Gold futures also getting the bid. Of course, that's also tied to some of the moves that we've been seeing in the dollar and in real rates here. And then down at the bottom, copper. Copper showing a little bit of weakness here on the day, but still setting up here for one of its best years in quite some time, Taylor.
I want to go to another commodity, and that's the price of your home, which just appreciated 8% in the past year. We got our 20-city home price index rising about 7.95% year over year. It was the biggest gain since 2014. The biggest gainers by city remain Phoenix and Seattle. This highlights the migration trends that we've been talking about into Arizona, into Washington. You can't leave out Texas either. And a little bit of this flight out of some big cities like, well, maybe San Francisco and New York.
Yeah, well, let's talk a little bit more about that and get a sort of broader look at the economic landscape as well. We're going to bring in John Taylor, of course, professor of economics at Stanford University, and really a long resume that's just a little bit too long to go into every sort of data point here. But, John, let's start off with the migration patterns here.
The audio has gotten quite weak, but I can roughly hear what you're saying. There's some of the big firms here. Hewlett-Packard is one is going to move their headquarters. Oracle. Elon Musk is talking about moving his residence. And so there's a lot going on. And I think it's culminated because of Zoom and the ability to work away from the office, which we're all seeing the consequences of. But it's an issue, I think, that California needs to address and soon.
How much of a regulatory burden is also helping to facilitate these migration patterns?
It's part of it. There are some studies that show that the regulatory burden in California is very high. Some show it's second in the country in terms of all the things, occupational licensing, wages, et cetera, like that. And they tend to be under the radar screen. People don't notice it that much. It's hard to measure. It's hard to get your hands around. But there's quite a big of difference, and I think that's one of the reasons people are moving. I've been noticing it for a while. Sometimes I give talks for Stanford, for the Hoover Institution where I'm located, and they used to be all in California, but now I find myself going to Texas, going to Florida, And that's because people have moved there and they're continuing to do so. And I think part of the reason is, as you say, the regulatory differences are quite a lot.
It's interesting, though, that those regulatory differences, to a large extent, sort of is what led to the growth in population, the growth in businesses in California many decades ago, more than a century ago, really. Eventually, regulation had to catch up with that population boom, with that increase in businesses. Do you worry that we're going to get into a situation where the Texases and Floridas of the world will have to respond with their regulatory system in some way?
Well, I would prefer if the response is to make both Texas and California more business friendly, because we need to grow more in the United States. We need to have a system that's conducive to growth. And you're quite right, Romain. The people who came to California goes back to the gold rush. It was tremendous opportunities, and people came here. A lot of them didn't find gold, but they found a wonderful place to do business. And some of the places I mentioned, I'm speaking here from Silicon Valley, where Stanford is. And a lot of them were started here because of the agglomeration, the ability to make progress and to do work together. And it's important to preserve that, I think, and to make it more general in the country.
We love that your blog is titled Economics 1, which is the class of course that you teach there at Stanford University. Broadening out, we started this segment looking at home prices, the biggest gain that we've seen since 2014. Does any of this sound unsustainable? I'm hesitant to use the word bubble, but it does liken back to some of the big price gains that we have seen in decades past.
So I think some of it is depending on the regulations. The land use regulations in California are quite a bit. So that bids up prices in certain areas and makes the prices lower in other areas. I think if we could have a better land use policy, that would be better. Texas has very little. They're sensible. And so that's why you see some of the firms opening there. So it's a bubble only in the sense you can do something about it, and you can make some changes that make things better. So I hope some of this migration, this exodus, this stampede, is waking people up. Say we've got to do something. This is a business decision, and we want jobs. We want income growth in California to continue.
John, I want to get your broader thoughts here on economic stimulus and the debate here over how you sort of deal with an economic crisis, economic shortfalls, without at the same time stoking inflation or stoking sort of a negative response in the economy. What's your general view here as to what the fiscal approach should be?
I think the main thing is to show how we're getting back on track eventually. Right now, there's the $900 billion, of course, has passed and ready to go. There's a question of adding more to that. What I would like to see, whether or not that goes, and the evidence says that's probably not the most important use of the money, and we're probably going to get more, is to have a way to undo it, to go back to normal. And that's also true of monetary policy. Monetary policy actions in earlier in the year, in March and April, were needed and they're appropriate. But now even monetary policy needs to think about a return to normal. And, we have the vaccines coming on board. That's a promising thing. And so economic policy needs to be aware of these changes, both monetary and fiscal.
When is it appropriate for us to begin re-examining debt as a percent of GDP and fiscal deficits with all the helicopter money?
I think it's a problem that we're facing now. It's very important to do what's necessary in this environment, but somehow you also need to get back to normal. And I think we're mixing the two together. I've written about this in the crisis, the global financial crisis, 2007, 8, and 9. Some of those actions were not very beneficial. We had a relatively weak recovery. I want to have a strong recovery. And so that's why it's necessary to not just deficit, but recognize that eventually that has to slow down. And so does money growth.
All right, John, always great to have your thoughts. John Taylor, of course, a professor over at Stanford University, of course, one of the most influential economists out there today. And, of course, one of his main contributions, the Taylor Rule, which, of course, has nothing to do with Taylor rigs. All right, coming up here next on this program, we're going to talk about Intel. The shares there spiking today. some interest here by activist investor Dan Loeb. We're going to talk about some of the strategic changes his hedge fund, Third Point, is pushing for. That's our stock of the hour. Coming up next, this is Bloomberg.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week. Although the COVID-19 vaccine is set to become more accessible as companies like AstraZeneca get approval for distribution, Johns Hopkins University senior scholar Amesh Adalja believes we'll still see a spike of cases as people fail to avoid holiday gatherings. He spoke a little bit earlier with Bloomberg's Guy Johnson about currently overwhelmed hospitals and a record number of cases in the U.S.
I definitely think it can only get easier as we get more candidates on the market, especially if they don't have really strenuous cold chain requirements the way the Pfizer vaccine does. And the AstraZeneca vaccine, I think, is going to be a win for the world, because if you think about trying to keep the cold chain intact in parts of the developing world where there is not very stable electricity, let alone access to deep freeze storage, I do think that this may be the vaccine for the world when it does get its approval.
One of the big challenges at the moment appears to be staffing. And it appears to be, and I keep bringing this up, there appears to be a zero-sum game that's working. On one hand, we have the need for staff to deal with the ongoing spike in cases that we're seeing around the world. On the other hand, we need staff to vaccinate people. Is it a zero-sum game? And in the moment, are we finding ourselves in a situation where we simply don't have the people to deliver the vaccines that have already been delivered?
Staffing in healthcare centers has almost been something that's kind of defies what happens in other markets where there is an increased demand for labor and then more people go join that because there's so many barriers to becoming a healthcare provider. You can't just hire people. And, it's unfortunate because we've had a long lead time. We knew that there was going to be this surge of cases in the winter, yet many hospitals didn't really have the resources to increase their staffing, increase their capacity. And it is true, if your hospital is busy dealing with so many COVID patients and you've got staff out sick because they're getting COVID in the community, you're going to have a much harder time having enough people to vaccinate. We are seeing vaccinations in the United States at least ramp up now. It was something that kind of trickled out in the first days of the vaccination. I waited a couple of days before I was able to get my vaccine, but now it seems to be moving at a much more rapid pace. But yes, I do think as we move into the community, away from hospitals and nursing homes, we're going to need a lot of community vaccinators to be able to get enough shots in the arms of people to hit herd immunity. So I do think this is something we have to really think about, a sustainable approach to vaccination.
In terms of what you're expecting over the next few weeks, Are we going to see a spike in cases as a result of the holidays? How big a spike do you think we are likely to see? I think I was on one of the front pages of the newspapers this morning that we have seen post-pandemic records in terms of air travel over the last few days.
It's inevitable that we're going to see a spike in cases. You have to remember that this virus thrives on social interaction, and many people traveled from one state to another and went to private gatherings where likely they let their guard down, didn't wear face coverings as meticulously as they should have. So we're going to see some level of transmission. Hopefully it's not something that really puts us kind of on a surge on top of a surge on top of a surge, to borrow Dr. Fauci's phrase, but it's likely that we will see some level of increase at a time when we already have record numbers of cases and record numbers of hospitalizations. Hopefully people took some level of precaution so that we won't see as the worst case scenario. I think that happened in some parts of the country during Thanksgiving. We did see increases all over as a country as a whole in the United States, but some states we did not. And maybe, hopefully, that will happen again in Christmas. But I do think we have to be prepared for more acceleration of cases as we get into the next few weeks.
Johns Hopkins University senior scholar Amisha Dalja speaking earlier with her own Guy Johnson. And your favorite disclosure, Johns Hopkins Bloomberg School of Public Health is supported by Michael R. Bloomberg, the founder of Bloomberg LP, which is the parent company of this network. Now let's get a quick check on some of the latest business flash headlines and other stories that we're following in. While Remain DNA testing company 23andMe has raised more than $80 million in equity in a financing round. The round was led by Sequoia Capital and New View Capital. Consumer genetics firms like 23andMe have turned recreational DNA testing into a widespread phenomenon. More than 12 million customers have spit into a tube, that's gross, to learn about their ancestry and their health backgrounds.
Science, Taylor.
Traders have boosted their bets against the U.S. dollar to the highest in almost a decade. Net short positions in futures linked to the ICE U.S. dollar index have risen by the most since March of 2011. U.S. deficits and Federal Reserve policy seen as weighing on the greenback. That conversation coming up in just less than an hour as well. And Apple shares have rallied to a record. That continues a year-end surge that has locked in its lead over Amazon's 2020 best-performing large tech stock. Apple is up more than 16% this month, 88% for the year, all thanks to demand for that new iPhone. There's also optimism about Apple's self-driving car project. Romaine?
All right. Time now for our stock of the hour. We're talking about Intel. I mean, come on. Intel, the worst performing stock this year in the Philadelphia Semiconductor Index. Today, it's the best performing stock of that index, almost up 8%. Abigail Doolittle is here to tell us what's going on. Abigail.
Well, Romaine, you have these headlines with Dan Loeb and Third Point basically rattling the saber, saying that something needs to be done here. They are a significantly large shareholder of Intel, basically saying that this company has not done what they should with their assets. They frittered away their top positioning in the chip market, and they've also overcompensated executives. So they haven't gotten too specific, but basically making the case that some sort of sum of the parts situation here could be more attractive. As for the stock itself, in terms of why they might want this to happen, you were talking about that underperformance. Take a look at the stocks outperforming on the year, up about 50%. Intel down on the year. So really pretty stunning that you could see that kind of underperformance given the hot nature, the space of chips. Relative to the fundamentals, well, maybe Dan Loeb does have a point, and Third Point has a point, because they have put up revenue declines for 4 quarters in a row, really underperforming. AMD, of course, hot on their trail, pressuring them in a big way. That's showing up in the numbers. So I think it's a combination of the numbers just not working in the right way, and you see that their big portion there of data center platform need to be able to do more with that and expand to some degree, Taylor. When you combine that with the stock down in such a big up year, it causes activist investors, again, to get active.
I want to speak about active. Some of the largest holders that I see here are some of the big buy-side guys. Where does Dan Loeb and Third Point fit in terms of the holdings of Intel?
Well, it's an interesting question, Taylor, for sure, because his holding is thought to be somewhere around $1 billion, which undoubtedly is a large amount of money. But the largest shareholders, including Vanguard, BlackRock, and State Street, as we're seeing here, much, much more significant in terms of the overall holding. So, you could make the case that Dan Loeb in Third Point relatively small, but he has a big name. He's a well-known activist. So when he makes this kind of an announcement, sends a letter, shareholder letter to the board, investors clearly take note with, again, as Romaine was saying, as you were saying, Romaine, the best day since May. Yeah, best mover today right now in the second best mover, I should say, out there right now in the S&P 500 and best in the Philadelphia Semiconductor Index. Abigail Doolittle, our stock of the hour, Intel, 8%. Coming up, a Wall Street reality check. We'll talk about those bonuses. The biggest U.S. lenders tempering expectations for employee bonuses despite all that soaring revenue. That's coming up next. This is Bloomberg.
If they're not, then it is fines, another fines, repeated fines, behavioral commitments, but there is the option eventually to ask for a divestiture, splitting up a company as a last resort.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising. All right, time now for our top calls to look at some of the movers on the back of analyst recommendations. Snap first up. The price target being raised to a street high $70 over at Goldman. The analysts expecting revenue growth to accelerate amid recent innovations, product partnerships, and a favorable backdrop for online advertising. Shares right now up 5% on the day, tripling on the year. Next up, Tesla, stock of the year, obviously. That price target being boosted to 380 from 300 over at Cowen. A little behind the times, but the analysts expecting a strong close to the fourth quarter of 2020 shipments, with deliveries picking up steam in December in the U.S. and in Europe. Shares of Tesla basically flat on the day. And finally, let's take a look at Wells Fargo. The price target going to 35 from 32 over at Raymond James. Not much, but the analysts noting Wells Fargo's progress on improving its ESG standing, though he does believe it will take some time for the bank to reap the full rewards of that. Wells Fargo shares call it flat on the day. And Taylor, those are some of our top calls.
And we want to stick with some of the banks in that theme, Romaine, because Wall Street banks are actually tempering back some of the expectations for bonuses this year, despite a huge trading bonanza. For more, I want to bring in our finance reporter, Linan Nguyen. Interesting, though, that given the good performance, bonuses are being tempered. As you take a look at all the banks out there, who's the best? Who's giving out the worst?
Hi, Taylor. Yeah, well, it looks like Goldman Sachs and JP Morgan are going to be the most generous in terms of their bonus pools, possibly raising bonuses by as much as 20% from 2019 levels. But still, in this very unusual pandemic year, we are seeing some pessimism across the street, some signs that, performance is not necessarily going to translate to those big bonuses that you've seen in years past. And of course, at Bank of America and Citigroup, there is potentially a flat bonus pool at B of A and flat for the Citigroup equities traders as well. So there are some, kind of disgruntled noises across the street right now.
Well, as you would expect, I mean, the whole sort of social compact on Wall Street is that performance and pay are pretty inextricably linked there. What's the general rationale for not providing, I guess, a commensurate bonus pay based on the performance?
Well, Romain, it's a little bit of a, what goes around comes around. Obviously, traders have done really well this year, but they're going to have to carry some weight for the consumer divisions of the banks, which obviously are struggling in this pandemic environment. And at the same time, trading divisions have not been doing particularly well over the past few years. And during those years, the consumer divisions were the ones that were kind of propping up the bank's results. So if you want to talk about a kind of diversified businesses, the banks have some divisions that do better in situations like this, during, crazy volatile markets, and it has divisions that do better under different economic circumstances. So right now it's time for the traders, I think, to carry the load.
Tech firms said that if your employees work from home, they're actually not going to cut their pay because they have to pay more to keep the employees at the company, and they don't want to lose the talent. Do you get the same feeling that banks, too, are going to be competitive in that way?
I think banks do have to be competitive in terms of pay, and for sure, I think the rock stars this year are going to be, handsomely compensated relative to what they've done for the banks. But I think it's going to be a lot more varied, a lot more spotty. The recruiter we talked to said it's going to be very messy this year, given the kind of divergence in performance across multiple desks. So it's not going to be a very straightforward story of, the rising tide lifting all boats. It's going to be some people getting cuts, some people getting zeros, and others getting big bonuses. So it's going to be very, very diverse across the street.
All right. What's my bonus going to be, Lenan? Do you know?
Bitcoin.
Bitcoin? All right. Bloomberg's Lenan. She's speechless. I guess that means zero. Bloomberg's Lenan Nguyen. They're giving us that update there on what Wall Streeters can expect with regards to bonus season this year. Let's take a look here at the broader market here as we get ready to count you down to the close. Taylor, 37.27 on the S&P 500.
We have much more next as the small caps continue their underperformance. This is Bloomberg.
Do you mind?
32.5.
The biggest hurdle we've had to face is the fact that we just can't see our customers. Traditionally, we would be away 4, 5, maybe more times per year on what we call trunk shows, where we visit cities all over the world to see our customers. That's not been able to happen this year, so we were thinking of ways that we could still make that happen. For example, in Seoul, we'd be there generally 4 times a year with the robot on site. If somebody's got a particular occasion they need to, rather than wait for us for our next trunk show, we can set that up so we can see them immediately almost.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
I'm Karina Mitchell. Let's get the first word news. More than 400,000 Americans will be dead from the coronavirus before President Trump leaves office. That grim prediction today from the Centers for Disease Control and Prevention. The U.S. has one of the highest mortality ratios of nations hit hardest by the virus, behind only Italy, Spain, and the U.K. scaled for population. The current U.S. death toll is more than 335,000. More than 4.6 million people in 16 countries have received the COVID-19 vaccine. That's according to data collected by Bloomberg. 2 doses are required weeks apart. The U.S. has administered the most shots, more than 2.1 million. But Dr. Anthony Fauci tells CNN the U.S. is lagging with its vaccine rate and that officials had hoped to have more people inoculated by the end of December. And China is struggling to get the world to trust its coronavirus vaccines. The Chinese shots could have been a diplomatic win for Beijing, but developing nations are wary. There's been little information about how the Chinese vaccines have performed in final stage clinical trials. Only the UAE and China itself have endorsed the shots for emergency use so far. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Live from New York, we're counting you down to the close. 1 hour left in the trading day. I'm Romaine Bostick.
I'm Taylor Riggs. Caroline Hyde has the day off today, but we still got you covered.
Yeah, we have you covered, Taylor. I would never leave you in the lurch here. Let's take a look at where the U.S. markets stand right now. Off the highs of the day here. We opened pretty much around a record high, but again, taking a little bit of a breather. We should point out volume relatively low. You're really the only activity you're starting to see here is a lot of the healthcare names. No real news there, but a lot of the device makers are rallying today, but not much else. You see industrials, energies, pretty much the main laggards here. If we flip up the board here and go over to some of the individual movers, the talk of the day has really been about Apple. Apple, of course, flirting with those record highs once again, pulling back a little bit at the moment here. But, of course, everyone is sort of looking to see what the next leg up for this company is. An 80% rally this year. That's on top of an 80% rally the previous year. Snap also traded at a record high at one point on the day, pulling back a little bit, but still up 5.5% on the day. Keep an eye on Lemonade. That lockup expired. Remember, this is a float of about 16 million shares here, Taylor, and you got about 44 million that potentially could be released this week should folks actually decide to sell. And Fubo TV, another lockup expiration for folks to keep an eye on here.
I still have that song Lemonade in my head.
Yeah. Well, you know, it was a popular drink, and it still is.
Let's take you from drinks on over to volatility, Romaine, because while we removed some of the uncertainty risk with the elections, a lot more remains. Take a look at this quote. This is from Stuart Kaiser, over the head of equity derivatives research. He's saying that the bipartisan stimulus bill driving a sizable upward revision to their growth estimates. That has removed uncertainty, but other risk still remains. He talks about slowing U.S. data, the Georgia runoff, maybe some scar tissue from 2020. That's leaving option premiums really high. Romaine, this is as we take a look at a spot VIX up about 2 points today. That's not much, except spot VIX still 12 points above realized vol. So you're getting future implied vol still higher than what's actually being realized in the market. So there could be some more uncertainty on its way.
All right, for more insight into what's happening in the market and beyond, let's bring in John Buckingham. He's portfolio manager over at Covis. John's also, of course, the editor of The Prudent Speculator and joins us today from Laguna Beach, California. John, great to have you here on the program. I guess we'll start with the basic question I think everyone has on their mind. Coming off what is probably, I guess by many measures, an improbable rally this year. And I guess people would just want to have some sense here as to whether there's some sustainability of this rally deeper into 2021.
Well, I certainly think there is. Valuations for the majority of stocks are very reasonable. Interest rates are extraordinarily low, which should make stocks more interesting to investors, especially dividend-paying stocks. And the economy is likely to have much better growth next year. You know, the Federal Reserve is suggesting more than 4% growth in 2021. So while there certainly are areas of the market that are very frothy and expensive, I really think that the average stock is inexpensive, and value stocks, inexpensively priced stocks, are very attractive today.
Talk to us about that, because when you note the value sector, we think some of the smaller caps, the Russell 2000, a lot of people saying that this breather is good given a slew of record highs and coming off some of the best months that it's had. So does that still look cheap?
Well, yeah, small and mid-cap stocks have lagged behind significantly. You know, this has been a very narrow rally in terms of the biggest winners. You know, you mentioned Apple, and Apple is our largest holding. You know, we own that stock, but you know, big caps have been what's driven the market higher, and the average stock has not had much of a gain this year at all. So again, I think small caps, mid caps, dividend paying stocks are very attractive, and I think investors will gravitate toward those as we start to see some better economic numbers. And of course, that all stems from the pandemic starting to fade as vaccines really take a hold.
You know, John, a lot of people are kind of looking for sort of that next sort of big transformational market opportunity. The idea here that you had these work from home stocks, you had a lot of cloud names, and just a lot of technology names and even non-technology names that sort of made a case that they could sort of be the next Apples and Alphabets of the world here. Are you seeing those type of sort of transformational opportunities out there right now?
Well, we've owned many of those names. You know, they were value stocks to begin with, things like Target, you know, Lowe's. We like a smaller cap home builder called MDC Holdings with a big dividend yield. So there are opportunities in the home, the work from home, the live at home, and certainly technology is a place where we think will continue to benefit. And as a value manager, we are very much overweight technology. But we think we're overweight, you know, reasonably priced technology. You know, Apple, Microsoft are big holdings for us, but a company like Juniper Networks, which is trading at a PE of 13, 14, buying back stock, a dividend yield of over 3.5%, and should still benefit from some of these longer term trends in technology that we think will drive, you know, even the big caps higher. But some of the lesser known names, I think, have much greater upside potential from here.
Can some of those big tech names that you mentioned, as well as the value that you like, both benefit, though, if rates tick up a little bit?
Well, interestingly, rising interest rates have actually been a positive for value stocks, as you might imagine, given that many financials are value stocks and they do better in rising rate environments. But we crunch a lot of data and numbers in our shop, and when we look at rising rates and value returns and growth returns, value's done really well relative to growth in rising rate environments and in rising inflationary environments. So we do think that a spike up or even ticks up in interest rates will actually be good news for value stocks.
What about the rest of the world? I mean, a lot of focus is here on the U.S. markets and what it offers investors here. When you look overseas, and whether it's developed markets like in Europe or even some of the emerging markets in Asia, and I include China in that basket as well, do you see reasonable opportunities there?
Right. Well, one of the areas of focus for us is on international stocks via American depository receipts or U.S. companies that derive a lot of revenue overseas. So, yes, the foreign markets have lagged behind. So there are opportunities. You know, we own, again, many stocks in our portfolios, 80 or so stocks on average. And so we're going to have 7 or 8 ADRs in our accounts. One that I like in particular is a big French drug maker, Sanofi. 3, again, a dividend yield. So there's a common theme here. We like yield, over 3% yield there and a very reasonable valuation. And we think a solid drug pipeline. So there are a lot of opportunities around the world. And, you know, we're always looking for what's the next big thing. You know, I know that you know, it's been a good year for the overall market. It's been a good year for us as well, relative to value especially. But, you know, you always want to think about what's going to happen going forward. And we like to go where the opportunities are, the bargains are. And I think there are bargains in the foreign markets, and U.S. investors can participate in them.
As long as you get that dollar weakness. John Buckingham of Kovitz, thank you as always for your time. Appreciate it. And coming up, well, not so confident, why China is struggling to get the world to trust its vaccines. We have the latest. Plus, while betting against that dollar, why speculative traders are ending 2020 doubling down on the greenback to the highest in almost a decade. And will it be sour for lemonade next year? Why the insurance app might enter 2021 with some extra volatility. All that and much more coming up. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
If we can really get vaccines going in April, May, June, July, and August, by the time we get to the end of the summer, I think we can get to that goal that I'm talking about getting the overwhelming majority of the population vaccinated.
All right, welcome back to Bloomberg Markets to Close, counting you down to the close. 48 minutes to go here in the trading day. The S&P 500 coming off those record highs from yesterday, tried to extend those gains today, but ran a little out of steam here on the day. You see sort of the sentiment here right now, though, reflected more in some of those small cap and cyclical names. For a second straight day, we're seeing that underperformance in the small cap space. We should point out a lot of these names that we're seeing in the Russell 2000 as a lot of the biotech names really getting sold off here as well. The FANG stocks holding their own. So you're seeing Amazon, Facebook, Netflix move higher. The biggest gainer in the FANG index, Alibaba up 7%, the ADRs here, and you see that reflected in the KWEB, the Korean shares index, the ETF, I should say, that tracks, of course, a lot of those Chinese tech names, which had sold off pretty heavily over the previous 2 days, gaining back some of those losses today. You flip up the board here and take a look. This is the interesting story here. There's your 10-year yield, the first line. Your second line, that's your real yield. You take the difference between those two, a negative and a positive. Well, you get inflation expectations. Inflation expectations right now, your 10-year break-evens reapproaching that 2% mark. Got really close to it yesterday. Not quite there today, but that's why you're seeing that weaker dollar here. The Dixie down on the day, and that's why you're seeing those continued bets for further dollar weakening into 2021. Bitcoin taking a little bit of a breather here after flirting with those record highs earlier in the week. Taylor.
Well, we're going to go from your favorite topic of Bitcoin to your favorite geopolitical story, and that is Brexit, Romain. The European Parliament giving the final vote on the EU-UK trade deal at a later stage, which could be extended until March. Bloomberg's Maria Tadeo spoke exclusively with David McAllister. He's the member of the European Parliament and head of the UK Coordination Group.
This agreement will be operational on the 1st of January. This means certainty and clarity for businesses and citizens. It will be applied on a provisional basis. But what this means is that the European Parliament will give its final consent at a later stage. In the moment, in the draft text, the two sides have agreed that the provisional application will last until the 28th of February. so the European Parliament could vote on the 23rd of February. If the European Parliament needs more time to scrutinise the text, then the British side and the European side would have to agree for a further extension of this period. But the clarity for businesses and citizens begins on the 1st of January, and I welcome that the member states are now green-lighting this agreement, because this all avoids the consequences, the negative consequences of a no-deal scenario.
And you make it clear that you want to take a look at the deal and you want to do it in detail. What areas specifically do you want to really focus on?
Well, we got this agreement as a kind of a Christmas present on Christmas Eve in the afternoon, and I have had time over the Christmas holidays to have a look at the about 1,300 pages. What I've read until now, I must say this seems to be a fair and balanced agreement. It's a good agreement for the European Union because this draft agreement protects our citizens, it protects our single market, and it protects our long-term economic interests. However, even with this agreement, EU-UK trade and agreement, UK-EU trade and cooperation will not be the same as before. We are expecting big changes on the 1st of January, but this, of course, is the result of the decision of the UK to leave the European Union, the single market, and the customs union.
Right. And since we're on Bloomberg, I do want to ask you about financial services. It's interesting that the Prime Minister did say perhaps we didn't get everything that we wanted from this, but we could perhaps revisit that in the future. Do you see or foresee a situation where the European Union does that, when they go back on the deal and they agree on just giving the UK more rights on that financial services industry and do this periodically? Is that something that could potentially happen?
The European Union and the United Kingdom will now form two separate markets, two distinct regulatory and legal spaces. And of course, this will recreate barriers to trade in goods and services and to cross-border mobility and exchanges that have not existed for decades, in both directions, affecting public administrations, businesses, citizens, and stakeholders on both sides. But these are unavoidable changes as a result of British politics to leave the European Union, the single market, and the customs union. Now, what does this agreement mean for financial services? Well, this agreement covers financial services in the same way as they are generally covered in the European Union's other free trade agreements with third countries. But this agreement doesn't include any elements pertaining to equivalence frameworks for financial services. These are unilateral decisions of each party and are not subject to these negotiations.
All right, David McAllister there, of course, member of the European Parliament and head of the UK Coordination Group, speaking a little bit earlier there with our very own Maria Tadeo. All right, now time for Options Insight with our very own Abigail Doolittle. And Abigail, you're taking a look at that small cap sell-off today.
It's hard to ignore, Romaine, now that we have the Russell 2000 down 3 days in a row, the longest losing streak since the end of October, the biggest losing streak since the end of October. And I know Matt Rao of Headwaters Volatility, CIO of Headwaters Volatility, that pullback, the pause here for small cap has caught your eye too, because there's been the quote-unquote froth there. It's pretty amazing that Russell 2000 has literally doubled from that March low, actually outpacing the NASDAQ 100 at this point.
Yeah, it is. And, you know, you can look at December on a standalone basis and see that small caps, as represented by the Russell 2000, have done extremely well, even including today's sell-off. I believe they're up a little over 6% since December 1st. But it really falls into what I would categorize as the way that people are taking risk as opposed to whether they are or they aren't taking risk. You know, people like to be long stocks that can double. It's one of the reasons why value strategies have suffered as much as they have. So on a day like today, I think you're seeing people not necessarily de-risk their portfolio, but they're changing the way that they're taking risk, and they're taking some profit on those small cap December rally, and you know, maybe reallocating it into names like Amazon on a day like today.
Well, I know in the past that you've told us that super low yields, of course, are a big piece of why investors are stretching into new areas of risk. We'll have to talk about that another time, because something else that's really standing out at this point is the skew index, which is sometimes called the panic index, really out of the money puts. It is spiking back to the levels earlier this year, I should say, the end of last year, ahead of this year's bear market, and then back in 2018 and 2016. It's a pretty accurate timer more recently of corrections to come for the S&P 500, but usually, a month to 2 months in advance. What are you seeing here? Does this make you more concerned about the possibility that there is some froth for stocks?
Yeah, it does. And, there is something to consider here, the year-end effect of how people want to paint their portfolios as far as how hedged they are or aren't going into the end of the year. But I do think that there is some validity to this, especially when the put-call ratio is where it is, and pricing is looking this way. So people that I'm talking to are cautious. They feel like they're more long equity exposure than they want to be, but they feel like they have to for career safety reasons. And, I think there's validity to that signal.
So it sounds like some caution and some complacency with that put-to-call ratio. And so I know that you want to be long vol, small cap vol.
Yeah, I think, I like the trade of selling call spreads on the Russell 2000 and the IWM to fund buying put spreads. It can be a way to de-risk your portfolio without bleeding a lot of premium, as they say. But I do think that if you do get a risk off or a change of risk attitude, that we're likely to see some pretty significant underperformance out of the small caps.
And so this would be a nice strategy to play that. Well, Matt, look forward to chatting with you. Happy New Year, because I know this will be our last conversation of this year, and hopefully in the new year we'll talk yields, which I know you love to talk. Matt Rao of Headwaters Volatility, thanks so much for joining us for Options Insight. And from New York, this is Bloomberg.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
We're going to get the story of dollar weakness in about 10 minutes. But until we do that, we can fold that over into the equity markets, because dollar weakness has certainly been a boost to some of the EM stocks. As you can see here, Romaine, this is the emerging market ETF. It is back almost near record highs you had on the 17th. That, of course, was the big record. But it has been pretty much an everything rally, a lot to do with, of course, handling on the virus, some of the vaccine rollouts. So for more on EM and all things FX and equities, let's bring in our own Bloomberg's Sherry on. Sherry, what's behind the rally?
Yeah, and all things also to do with Alibaba, because we saw that huge sell-off, and right now with Alibaba having the heaviest weighting on the MSCI Emerging Market Index with 7%. The rally in Alibaba right now, which is gaining the most since July, helping really with the emerging market equity sphere. And of course, this coming at a time when we saw a huge sell-off given this antitrust scrutiny. But investors have said perhaps this could be a buying opportunity. Sources also talking about Ant Group, the affiliate that its IPO has been shelved, but they're folding their financial operations into a holding company that could be regulated more like a bank, so perhaps a little bit more clarity on that front. When it comes to emerging market FX, we are seeing the Brazilian real rallying, the Turkish lira rallying, with the Brazilian unemployment rate climbing for the first time in about 10 months, and the lira also continuing to rally right now, given the rate hikes and more confidence on their new economy team.
Yeah, so Sherry, I mean, we talk about the vaccine optimism out there. I mean, there was a great story on the terminal, of course, about how there's some concerns about from certain countries in accepting the vaccine that's being produced by Sinovac and some of the Chinese companies.
Some of the Chinese companies, also some of the Russian companies. But let's talk a little bit about the Chinese mistrust out there when it comes to those vaccines, because one of the key points that China wanted to gain from this pandemic was diplomatic vaccine win by supplying to these poorer nations. But we have seen mistrust growing on China's vaccines, given, not to mention earlier this year, compounded by China's exports early in the pandemic of subpar tests and personal protective equipment. Still, China's foreign ministry saying that the vaccines strictly comply with the law and clinical trials in the first 2 phases, showing that the shots were safe and effective. And here's what the foreign ministry spokesperson Zhao Lijian had to say over Twitter, which was really interesting. It may be the only choice when it comes for governments that haven't secured supply so far. It's estimated that of all the 12 billion vaccines to be produced globally next year, the wealthy countries have booked 9 billion. So for most countries that haven't got any vaccines, the Chinese made once maybe their only choice.
We were also showing photos there of Sputnik 5, Russia's vaccine making its way onto an Argentinian airplane. Does Argentina say that they have no other choice, as you sort of alluded to in that tweet, but to accept any vaccine that they can?
They're very confident about the Sputnik 5 vaccine, but you said it, there has been skepticism about the Russian shot as well, especially after the fact that President Putin approved its use without the results of their final stage clinical trials. We still have seen Argentina take those shots. 300,000 people are expected to be inoculated in Argentina starting today.
All right, Sherry on. Always great to have you. Emerging action there. Of course, you can always check out Sherry every night right here on Bloomberg Television. All right, let's get a check here on what's happening in the broader markets here in the U.S. as we count you down to the close. A little more than 30 minutes to go. The S&P 500 call it flat on the day. The Russell 2000 been under pressure all day, continuing those losses from yesterday. FANG stocks getting a little bit of a boost. Alibaba, ADRs up 7%. This is Bloomberg.
新型にはなんと2万点以上前身でついてます。なので2万点あることにより、その情報が取れない、平面がないんですね。なので全てをスキャンすることができるので。どちらにせよ自分のサイズを1回最初から、適正なものを発見してそれを買って、家に届いてきたらぴったり非常にハッピーというのがやっぱりしかるべき姿かなと思ってます。
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Remember, this was not announced as a complete trade deal. This was announced as a phase one. So we and the Chinese both are well aware that there's much more to do.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Let's get the first word news. I'm Karina Mitchell. President Trump is lashing out at Republican leaders as an effort to overturn his veto of the defense policy bill moves to the Senate. The House overturned it with bipartisan majorities. Trump tweeted, quote, "Weak and tired Republican leadership will allow the bad defense bill to pass." Senate Majority Leader Mitch McConnell says the chamber will take up the veto tomorrow. And the traditional inaugural luncheon to honor the new president and vice president has been canceled. The congressional committee planning Joe Biden's swearing-in ceremony says it's no longer safe to hold the event due to the virus. While not as widely watched as the president's inaugural address, the luncheon serves as an important symbol of bipartisanship during the transfer of power, giving congressional leaders the opportunity to toast the new president. And Vice President-elect Kamala Harris and her husband have received their first doses of the coronavirus vaccine. The shots from Moderna were administered at United Medical Center in Washington. Harris says she wants to encourage everyone to get vaccinated, saying, quote, "I trust the science." Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
All right, about a half an hour ago here in the trading day. This is the countdown to the close. I'm Romaine Bostic.
And I'm Taylor Riggs. Caroline Hyde has a well-deserved day off, but we still have you covered. As we just mentioned, about 30 minutes ago, and remains certainly a defensive tone underlined the individual sector levels that we can see with the S&P 500 off the record highs yesterday. You do have healthcare, some of the big tech up in the lead. And on the bottom, Romaine, really is the risky tone. Real estate, energy, industrials, those are the big laggards dragging us down off those record highs.
Yeah, and take a look at some of the individual movers. Of course, a lot of people talking about Boeing. Those shares had been beaten down. They've actually seen a little bit of a revival. The 737 MAX getting its first commercial flight here in the U.S., going from Miami to LaGuardia and back again. A very symbolic move here for Boeing. Of course, the travel industry is still under pressure. Intel also rising. Of course, we had that news. The Dan Loeb, his hedge fund, Third Point, actually seeking changes in Intel, strategic options, if you will, potentially even a breakup of the company. We'll see. Investors trying to jump on the back of that, trying to jump on the back of Amphastar as well. The FDA giving approval to that hypoglycemia drug. That's giving a list to the shares there. And keep a eye on what's been going on in Bitwise. Of course, that's that new vehicles, kind of not quite an index, not quite an ETF that allows you to invest in crypto. It's gotten caught up in that whole drama with Ripple and XRP. They basically had to sell off the holdings of XRP because of the regulatory issues that were tied to Ripple. The shares of this fund are down right now about 7.5%, Taylor.
And we go across asset. We have to take a look at the dollar. We're looking at dollar weakness to levels we haven't seen really since April or May of 2018. That has been the story and really the trade all year with central bank intervention. But you see the trade in speculative positions. Now, bear with me. This is large speculative dollar net positions. Now, that's the most short since earlier this year. And then you have to go back to May 2018. But there's another number that we're also citing as well. General non-commercial positions, those also have the biggest net shorts since March of 2011. That is almost a decade. Hard to fight the trend. Every strategist we've spoken to says dollar weakness is the trade for next year.
Yeah, well, looking at that chart, you can see everyone pretty much believes that. Whether they're going to be right or not remains to be seen. Now, let's get some insights here from Jens Nordvig. He's Exante Data founder and CEO, joining us right now. Let's start there, Jens. Everyone's talking about dollar weakness, the idea that it is going to persist into 2021. Is there any sense here that maybe all those people are right?
So the first thing I would say is that it's sort of common that you do year ahead outlooks and then it sort of has to come up with a narrative, and then a couple of weeks into the new year, all those narratives fall apart. But this cycle is a bit different, right? We've had some huge macro moves in 2020, and going into 2021, we're also going to be seeing some big macro moves. So it's not going to be little wiggles. So I think there's better chance that a big move in the dollar is really potentially ahead of us. And it doesn't matter so much that a number of people are writing about it at the same time, because it's a big move. It's not like a little wiggle. And I would also say that when we look at positioning, and we have a lot of proprietary data we look at for positioning, it matters a lot of what you look at. So you made a reference to what is going on in the futures market, and clearly there's a very significant amount of dollar shorts in the futures market. But if you look at the real money community, if you look at the positions there, the real money community was really long dollars aggressively early in the year, and they've been getting back to neutral. But I don't think it's the case that there's like a huge dollar short in the big real money community. And those are the investors that can add to dollar short positions in coming months, coming quarters, and help sustain the dollar weakening trend.
I want to talk about the sort of economics behind this. A lot of people have said, of course, and we heard it a little bit from Trump in the last 4 years, dollar weakness, it lowers the value of the goods so that you can export them, and other countries find it cheaper to buy here. So that could be a good thing. But then, of course, other economists say, like Janet Yellen, the incoming Treasury Secretary, you want a strong currency, a sign of strength. Where are you then on the economics of what it means to have dollar weakness versus dollar strength?
I think from a trade perspective, it's pretty clear that having a more competitive dollar would be helpful over time. But the U.S. is not a country that is sort of competing on cost in a lot of sectors. Just because we have a somewhat weaker dollar doesn't mean that we can suddenly start to compete in textiles and all those types of things. So the dollar really needs to move quite significantly for that to have a big impact on trade. And the dollar was very strong. Like if you think about where the dollar was in March, April this year, it was very, very strong compared to levels we saw back in 2014. So the dollar has a long way to go before it starts to get competitive again, starts to get a real gain on that front. So we've just started the dollar weakening, so to say, over the last 6 months. And typically when you have these cycles, they can run for multiple quarters at least, and sometimes multiple years. So I think it's fair to say that if we have a global environment where the global growth outlook is improving, obviously from a very weak starting point, but improving and improving further, that's really the environment where you have investors in the U.S. getting comfortable with international risk assets, putting capital to work, and sustaining a weak dollar trend.
And at the same time, Jens, there's sort of a lot of conversations out there about inflation, or at least inflation expectations, the idea that those expectations are starting to move maybe a little bit closer into the near term than maybe what it was a few months ago. I am curious that given all the talk about fiscal stimulus, the potential that you could have a new presidential administration and a new reshaped Congress that is willing to expand that fiscal stimulus, that fiscal support. Do you worry at all about the impact of inflation and I guess the timing of it?
So in the short term, I don't really have any major concerns about inflation. We're still in an economy where there's spare capacity, and we can have a lot of growth before we get into those capacity constraints. But I think what is worth thinking about is, are we entering a new political regime? And I think today's news cycle is very interesting, where you have GOP senators pushing aggressively to get an extra $2,000 in stimulus checks emailed to a broad set of the population, right? There is something new going on with the debate about fiscal stimulus. And if that becomes a persistent trend where we can get political support behind backing aggressive fiscal stimulus, then we can enter a new regime where maybe on a multi-year horizon, we need to think differently. And we can already see that in the market to some degree, right? Because there's certainly less concern about deflation than there was. Break-even inflation is going up towards 2%. And that means the real interest rates in the US are compressing. And that's part of the dollar weakening story too, that real interest rates are actually going down in the US, and around the world, they're not moving very much because they had already hit a low level a couple of years ago.
Our thank you, as always, Jens Nordvik of Exante Data. And, of course, his 2013 book sitting nicely behind him, The Fall of the Euro. That'll maybe be something I'm going to have to read. Thank you, as always, for joining us. We appreciate it. And we just want to check, of course, on the markets as we come into the closing bell. You kind of heard it there. It is a risk-off tone with tech as the big defensive name. Small caps are lower, but you have a drift up in VIX. And, well, you heard it here, dollar weakness. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Substantial further progress means what it says. We'll be looking for an inflation to be substantially closer to our 2% longer run goal before we start making adjustments to our purchases.
That's a long time to be very accommodative, but that's basically the horizon.
They can buy more bonds and they can buy longer maturity bonds, and that would put more downward pressure on long-term interest rates.
All right, we're talking about Lemonade, the insurance provider. Shares have had a volatile week. Shares are the best performing listing of 2020, actually, rising today. Second round of insider selling restrictions expiring. For more, let's bring in Bloomberg's Drew Singer to talk a little bit more about what's going on. Drew, Lemonade, of course, this was a really popular listing when it hit the market. We're seeing this lockup expiration here. And the difference, I'm just amazed at the difference between the current float that's out there and the amount of shares that are at least eligible now to be sold into the market should some of those investors choose to do so. What's going on?
Yeah, and that's something that investors seem to have been anticipating as well. We saw a decent sell-off yesterday in Lemonade heading into the lockup expiry that might have been tied to traders saying, just in case tomorrow is a little volatile, let's collect our gains now. I mean, the stock is trading about quadruple its initial public offering price in July. This has been a really hot year for IPOs, and Lemonade is certainly the hottest.
Interesting, though, analysts on the street are a little mixed. I think a few have called the valuation a little bit high, of course, after the run-up. But then a Piper Sandler analyst said that they do remain positive on the long-term opportunity. The company warrants an expanded multiple. What is the consensus out there about the multiple at this moment?
Yeah, there's still a couple bulls still out there on Wall Street. They have an average price target around $80 right now, which is pretty significantly less than what it's currently trading at, which is closer to $120. So in general, Wall Street thinks this stock is trading a bit higher than it's worth. This is still an unprofitable company, but I think investors are looking kind of longer term, and they're excited about new markets like pet and auto. Traditionally Lemonade has focused on renters and home insurance, so there's quite a growth story behind this stock.
Yeah, that's cute that you bring up profitability, Drew. I mean, it seems like I feel like the majority of the listings that we had this year, and it's been a record year, of course, most of these companies are unprofitable. The overwhelming majority of them are, Drew. Is there any sense here that the willingness for investors to embrace these names the way they did this year, that's going to continue into next year?
Yes, there is, and I think that's part of the risk-on trade that we've been seeing kind of throughout the market near the end of 2020, heading into 2021 with stocks pressing to all-time highs. I think this is investors looking beyond the uncertainty we've had the past year related to both the pandemic as well as the political situation in the U.S., and they're hoping for better times ahead.
Drew, I'm going to sort of follow on what Romaine was saying, not to be a naysayer, but there's been this consensus, and I'm wondering if you two hear it, that when I grew up, profitability meant net income. And now it seems like we're just moving up the income statement, and to be profitable, you only have to be EBITDA positive. Has that narrative changed, or am I crazy? Speechless.
You left
Romaine,
them speechless.
Speechless. The way you left Lenon speechless when you asked for a bonus.
Taylor.
I can't talk about profitability
Drew
anymore.
couldn't hang. Well, you're the runner. You can go the distance. Anyway, our thanks to Drew Singer, of course, who covers this. And I mean, in all seriousness, Taylor, I mean, IPOs, obviously, when you look at the data, I mean, just crazy. Not only just in terms of the IPOs themselves, but you talk about a record for secondary listings and, of course, a record this year for SPACs.
And we have our favorite IPO ETF, our favorite SPAC ETF, both outperforming the S&P 500. We are getting some comments from the incoming President Joe Biden. Take a listen.
And as we end one of the most difficult years as a nation, I remain optimistic about our future. The vaccines have been discovered and developed, and there's more to come, we believe, give us enormous hope. Our economy is poised to come back and come alive. And I can see a return to normalcy in the next year. I also see incredible opportunities for our nation in the years ahead, in job creation, clean energy, racial equality, and much more. But we need to be honest. The next few weeks and months are going to be very tough, a very tough period for our nation, maybe the toughest during this entire pandemic. I know it's hard to hear, but it's the truth. As Roosevelt said, I think the American people can take whatever we tell them if we tell them straight from the shoulder. We need to steel our spines for what's ahead. We need to follow even more closely the recommendations to slow the spread of the virus. And each of us needs to do what we can to protect ourselves, our families, and our fellow Americans. We're going to get through this. Brighter days are coming. But it's going to take all the grit and determination we have as Americans to get it done. So today, I want to be clear about 5 things every American should know about our efforts to contain COVID-19 and where the vaccine stands today. First, things are going to get worse before they get better. In September, we passed a grim milestone, 200,000 deaths. At that time, in this very room, many of you remember, I warned that we'd hit 400,000 deaths before the end of the Trump administration in January. Critics said I was being too alarmist. and negative. But as I've said all along, I will tell you like it is when it comes to COVID. And the reality is, it looks like that we're going to hit that grim milestone. We've just crossed 330,000 deaths in America. We're averaging daily death rates of nearly 2,200 people, which means we'll lose tens of thousands of more lives in the months to come. Hospitals are being stretched beyond capacity. And that's data before we see the impact of the cases coming from the recent holidays and this upcoming holiday of New Year's Eve. People getting infected today don't show up in cases for weeks. And those who perish from the disease die weeks after initial exposure. So we have to anticipate that the infections over the holidays will produce soaring cases counts in January and soaring death tolls into February. You know, turning this around is going to take time. We might not see improvement until we're well into March, as it will take time for our COVID response plan to begin to produce visible progress. The second thing to know is the Trump administration's plan to distribute vaccines is falling behind, far behind. We're grateful to the companies, the doctors, the scientists, the researchers, the clinical trial participants, and Operation Warp Speed for developing the vaccines quickly. But as I long feared and warned, the effort to distribute and administer the vaccine is not progressing as it should. A few weeks ago, the Trump administration suggested that 20 million Americans could be vaccinated by the end of December. With only a few days left in December, we've only vaccinated a few million so far. And the pace of the vaccination program is moving now, if it continues to move as it is now, it's going to take years, not months, to vaccinate the American people. Which brings me to the third thing every American should know. The Biden-Harris administration will spare no effort to make sure people get vaccinated. I've laid out 3 challenges in our first 100 days. One of them is ensuring that 100 million shots have been administered by the end of the first 100 days. If Congress provides the funding, we'd be able to meet this incredible goal. It would take ramping up 5 to 6 times the current pace to 1 million shots a day. But even with that improvement, even if we boost the speed of vaccinations to 1 million shots a day, it will still take months to have the majority of the United States population vaccinated. I've directed my team to prepare a much more aggressive effort with more federal involvement and leadership to get things back on track. We'll find ways to boost the pace of vaccinations. But as Dr. Fauci and others have stated these past few days, this will take more time than anyone would like and more time than the promises from the Trump administration have suggested. This is going to be the greatest operational challenge we've ever faced as a nation. But we're going to get it done. But it's going to take a vast new effort that's not yet underway. And to get things, and that gets me to the fourth thing that we should know. I'm going to move heaven and earth to get us going in the right direction. I'm going to use my power under the Defense Production Act when I'm sworn in order private industry to accelerate the making of the materials needed for the vaccines, as well as protective gear. Vice President Harris and I have been speaking with county officials, mayors, governors of both parties to speed up the distribution of the vaccines across the nation. We're planning a whole-of-government effort, and we're going to work to set up vaccination sites and send mobile units to hard-to-reach communities. And we also know there's a vaccination hesitancy in many communities, especially Black, Latino, and Native American communities, who have not always been treated with the dignity and honesty they deserve by the federal government and the scientific community throughout our history. That's why we will launch a massive public education campaign to increase vaccine acceptance. We'll do everything we can to show the vaccines are safe and critically important for one's own health and that of their families and the communities. That means we're also going to make sure vaccines are distributed equitably, so every person who wants a vaccine can get it no matter the color of their skin or where they live. And we're going to ensure vaccinations are free of charge. Fifth, while the pandemic rages on, and as we increase the supply, distribution, and administration of the vaccine, we have to remain vigilant. As part of the 100-day challenge, I'm going to be asking the American people to wear a mask for the first 100 days of my administration. It's not a political statement. It's a patriotic duty. Our administration is going to require mask wearing where I have the power to do so, for federal workers, in federal facilities, on interstate travel like planes and trains. And we've been working directly with county officials, mayors, governors to implement mask mandates in their cities and their towns and their states. Masking has been a divisive issue in this country. But COVID is a killer in red states and blue states alike. So I encourage you all to wear a mask. Encourage your family and friends to do the same. It's one of the easiest things we can do that will make a huge difference and to save lives. Another 100-day challenge is opening most of our K through 8 schools by the end of the first 100 days in the spring. Look, we can only do that if Congress provides the necessary funding so we get schools, districts, communities, and states the resources they need for those so many things that aren't there already in a tight budget. They need funding for testing to help reopen schools, more funding for transportation so students can maintain social distances on buses. They need it for school buildings, for additional cleaning service, protective equipment, ventilation systems. This is going to require an additional tens of billions of dollars to get this done. And Congress also needs to fund and provide more protective equipment for frontline health workers who are still reusing masks and gowns. We need to scale up testing so anyone who needs one can get a test. After 10 months of the pandemic, we still don't have enough testing. It's a travesty. All this, vaccinations, testing, protective gear, is going to require more funding from Congress, more than was just approved. That's why I'll propose a COVID action package early next year and challenge Congress to act on it quickly. Look, my ability to change the direction of this pandemic starts in 3 weeks. With thousands dying every day between now and then, let me conclude by discussing what needs to happen now. I congratulate the bipartisan majority on passing the president's and then the president on signing the COVID relief bill. It's still, it's a step, an important step, still moves in the right direction. And it will help people in need. And it'll pay for some, but not all of what we need to fix the COVID response. It's a down payment. But now, with that done, I hope the president will also clearly and unambiguously promote mask wearing. I give former Governor Chris Christie credit. He and I have disagreed in a number of things. But I'm thankful he's now encouraging people to do the right thing and wear masks for themselves, their loved ones, and their country. I hope that President Trump will listen to him. He can do it too. It would make a huge difference for President Trump to say, wear masks. I hope the president will clearly and unambiguously urge all Americans to take the vaccine once it's available. I took it to instill public confidence in the vaccine. President-elect Harris took hers today for the same reason. And when the president's doctors recommend it, President Trump should take it and instill the same degree of confidence. Let me also say this to the American people. We can save, all the experts tell us, between 60 and 100,000 lives in the weeks and months ahead if we just step up together, wear a mask, socially distance, wash our hands, avoid large indoor gatherings. I know all these are not easy to ask, but I'm asking you to make a sacrifice. You're already making tremendous sacrifices every single day. It's hard on your lives, on your livelihoods, on your kids, on your families. It's not small what we're asking of you. But we're in this together. And the actions we take now are going to help us contain the pandemic and get us back to our lives and to our loved ones. So the American people, to all of you, I know there's a lot that we have to do, but I want you to know there's also much we can do. We're the United States of America. We've been through hard times before as a nation, and we'll come through this as well. I promise you we will. So please, I wish you a Happy New Year. May God bless you and may God protect our troops. Wear a mask.
That is President-elect Joe Biden making remarks in Wilmington, Delaware, all about the vaccine. Remain really nothing new. We've heard a lot of this before. Dark days ahead. He wants to vaccinate in his first 100 days, 100 million people. He wants to create mask wearing for the first 100 days, really wants to propose a COVID package early next year. Part of that will include testing funding that requires tens of billions of dollars, but needs the testing to help reopen schools and to launch an information campaign about the vaccines. In the meantime, we do have a lot going on in the markets. Take it away.
Yeah, I mean, and let's get back to the markets here. I mean, you're looking at the major indices here, getting ready to close here on the day, closing down. Remember, all of these indices were at record highs yesterday. A little bit of a pullback. We should point out volume is light. In fact, it's actually lighter today than what it was yesterday. And it's well below the average that we've seen over the past 3, 6, and 12 months here. But to the point that you were making there, Taylor, and specifically with what Biden was getting at too, is the idea of reopening the economy here. And there was a great story on the Bloomberg today that talked about a lot of the mobility data out there that has shown a real drop-off in activity. A lot of this, of course, is because of the holidays, but also because of the rise in COVID cases and the winter months here. And of course, he started off that speech, that statement today by saying things will get worse before it gets better. And I think that's what you're seeing right now, Taylor, with the market sort of trying to sort of wrestle between some of these short-term concerns and I guess some of the longer-term optimism about, valuations and things.
Yeah, and we're lucky that we have Brian Levitt here, who's with us to break all things down in the market. Brian, thanks for being patient with us as we're sort of navigating the world of politics with the world of markets. Brian Levitt, of course, Invesco global market strategist. Talk to us sort of just broad. I want to get out of the day-to-day and sort of how you're thinking about where we ended with stimulus. It then kind of feels priced in, but then you have the Russell 2000 knocking off the highs in the past few days. How are you thinking about these markets? What's priced in, what's not as we wrap up 2020?
Yeah, so the markets were expecting some type of fiscal deal, and we got that now. We're moving past Brexit. We've moved past the election, so a lot of the political uncertainty starts to abate. The reality is now, as you're talking about, we're dealing with a rise in COVID cases, a slowdown in mobility, and the market was well aware of that. The market's been expecting that. The question over the next weeks is, does it get worse relative to expectations? But what's more important for investors is the next couple of years. And, this is an economy that fell to a depressed level. It's recovering. The output gap is still wide, meaning policy is going to be accommodative for years to come. It suggests a good backdrop for risk assets. That doesn't mean that there's not going to be some challenges as we progress over the next couple of years, but markets should continue to go higher.
And with all the sort of the debate right now going down in Washington, and of course all the people who watch Washington with regards to fiscal stimulus and sort of what's the appropriate amount to stimulate the economy, and maybe what's too much that would, I guess, maybe have a negative impact here. Does that give you any concern right now that maybe policymakers aren't necessarily making the right moves, I guess?
Well, we got the first agreement through, and so that was important. And whether you want to put that right number at $900 billion or $2 trillion, we could debate that. I think it has real implications for the economy. It has real implications for American households. It has real implications for small businesses and select municipalities. But the reality is the markets are going to be focusing on a recovery, and that recovery is going to play out whether it's $900 billion fiscal deal or $1.5 trillion fiscal deal. We felt it with depressed level, and this economy is going to recover over time. The extent of the fiscal support tells us how strong this economic recovery is going to be. So I would tell investors to think back to the period in the aftermath of the global financial crisis. We got the fiscal deal. Many said it wasn't large enough, and we ended up growing at a pretty slow pace for a lot of years, which was not great for the real economy, not great for job creation, not great for wages, but ended up being quite good for markets because a modest growth, benign inflation environment can be supportive for risk assets. And so I suspect we're heading back into a similar environment as that.
Romaine has been doing some smart analysis today, Brian, on inflation and the relationship with equity markets as 10-year break-even start to approach that 2% level. Higher inflation's good for higher stocks, even if it means higher yields?
Yeah, I'm not worried about high and rising inflation at this point, Taylor. I mean, high and rising inflation would be probably a high quality problem at this point. I mean, we were staring at the deflation abyss. We responded to it. Things are starting to improve. It's nice to see inflation expectations back to where they are. But remember, we've got cyclical challenges. We've got high unemployment. We've got a big output gap. That should all keep a lid on inflation. We also have secular challenges with an aging population globally. So I don't view inflation as something that's going to get out of hand and put pressure on equity multiples. I believe that this improvement in inflation expectations is really indicative of the policy support that we've had, the success of the policy response, and is in line with this idea of an improving economy and one that should be supportive for the reflation of asset prices, not necessarily of goods prices.
Yeah, and I saw some data that Invesco had put out showing just the amount of fiscal support as a percent of GDP out there, and the U.S., of course, leading the way on a percentage basis, outpacing a lot of other countries there. Brian, I am curious when we talk about the consumer side of the equation, consumer spending. Obviously, that's been reshaped. It's been pulled back a little bit because of the COVID crisis. There's a general theory out there that because household savings have risen and we've seen the supply of money rise, that should this COVID pandemic finally be put behind us, that there would be a flood of money back into some of the discretionary spending areas. Do you anticipate that to be the case, or is the savings that we've seen, is that money going somewhere else?
Yeah, I don't know if I would necessarily call it a flood, because there are challenges given the extent of the number of unemployed in this country. But you are right, savings rates are up. And there's a lot of pent-up demand. I mean, you speak to people, I think we all talk to people who are clamoring to get back to the type of activities that they were participating in, some of the discretionary spending that they were doing before the COVID outbreak. And so it should support the more discretionary parts of the market. I wouldn't get ahead of ourselves and call it a flood, because we are still dealing with significant unemployment levels in this country. But yes, for those who have come through this, saving rates are elevated, pent-up demand. The consumer should be supportive in this. And again, that's all in line with the recovery story that we expect to play out in the coming year.
What do you see as the biggest risk next year?
Well, I think you mentioned it. I mean, you talk about inflation. I mean, my thesis on all of this is that policy is going to be accommodative for years to come. And in an environment where policy is accommodative, that means cycles can play out for far longer than most suspect. It also means that the dollar can be stable or weaker. We don't go back into that strong dollar environment, which happens when the Fed tapered their asset purchases or raised rates in 2015. So that would be the risk. If for some reason you start to see this money in the system circulate too fast and the productive capabilities of the U.S. economy don't keep pace with it, then you'll see some inflationary pressures. That would be unexpected. The Fed would have to raise interest rates, but that is not my base case scenario. That is a low probability event, in my opinion, but would be a high risk to risk assets.
Low probability, high risk. I hear that phrase more than you would know, Brian. Brian Levitt, Invesco Global Market Strategist. Thank you, as always, for your time. And more markets coverage coming up here on Bloomberg Markets to Close. We're going to talk about that pandemic-era savings. Is it here to stay? This is Bloomberg.
have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
All right, welcome back to Bloomberg Markets. The close, we did get that close. A down day on Wall Street, pulling back from yesterday's record highs on the Dow, the NASDAQ, and the S&P. Pretty much flat on the day across the board. There really was no impetus here at all on the day. We did open higher on the day. We did see some of the large cap tech names get a bid, but then those gains started to reverse a little bit later in the day. Apple was at a record high. Snap was also at a record high. But again, some of those names did pull back. We did see healthcare names, interesting enough, not in the biotech space, Taylor, but mostly a lot of those, I guess, what do you call them? Medical devices? Hips?
Is that
hearts,
what we're calling them these
pumps?
days?
I don't know. You call them whatever you want.
I'm waiting for my fake hip to come in after all my running. Let's get back to the markets.
You go the distance.
We're going to do that with Bloomberg Markets reporter Kriti Gupta, because the best thing right after the closing bell, Kriti, is we can sort of take a breath and go cross-asset, and that's really what we want to do. We just came off this great interview with Brian Levitt over at Invesco talking about risks, some of the key risks for next year. How do you take a look at some of the positioning that you're seeing in this second quarter and sort of the setup for next year? Because it seems like every asset class is at all the gains for this year.
Absolutely. Well, they're all looking ahead to that second quarter of 2021. It's this idea simply that we're going to see this inflation shock. The vaccine will be widely distributed. Essentially, everything will go back to normal starting that second quarter. And there's so much of that built up that it leaves markets extremely vulnerable to what happens in those first 3 months. And you've heard Dr. Fauci come out and say those 3 months could be extremely challenging. The Christmas virus fallout could happen in the middle of January. So a lot of the kind of investor focus right now will be on that economic data. Are we seeing that momentum that we need to get to that explosive growth we're expecting in that second quarter?
Does the market really care about this fiscal stimulus at this stage? I mean, it just seems that what was priced in earlier this summer off of the original CARES Act, that kind of had its course through the market. Now you have this new bill that's going to make its way into people's hands at some point, I guess, maybe this week or next week. Is it going to have that much of an impact on valuations?
Well, it's pretty interesting. You've actually seen a lot of that priced into markets. You're seeing that. These have been month-long negotiations, and every time we saw a stimulus headline that there was some progress being made, you saw buying right on that headline. So now you're going back into kind of this phase of how much of that stimulus is priced in and how much of more stimulus are we going to see in 2021. Both President-elect Biden and Senate Majority Leader Mitch McConnell have said, well, there's still work to do. We still have to talk about state and local aid, COVID liability protection, and, of course, even more stimulus rounds. And that's why some of those Senate races in Georgia are so important going into 2021, because it really matters for investors. How easily can that additional stimulus be passed, or is it just going to be a month-over-month long negotiation once again?
You talk about that stimulus. I want to push forward to the segment we're doing next, and Romain sort of brought this up, rightfully so.
Love it.
I give credit where credit's due. All about the savings rate, and there is some concern that we've all learned to save so much. All of our trips were canceled. Those of us who haven't seen an income drop due to the pandemic, do people keep saving, or do they get a flood of spending in the first quarter? And there is that, quote, sort of overheating that Larry Summers hinted at or sort of alluded to.
Well, absolutely. So there is still a lot of cash on the sidelines, whether you're talking about the people who are, everyday consumers, the average American, as you will, but also a lot of cash on the sidelines in terms of investing. And what that essentially does is, I'll start with the consumer piece of it first. When you see the savings rate this elevated, it kind of hinders that economic momentum story. At the end of the day, the U.S. economy is a consumer-driven economy. That means we need to see retail sales. We need to see that spending. And when you see these kind of stimulus checks, people would hide them kind of under their mattress, for lack of a better term, as opposed to go out and spend them. That's where you see that disconnect between what you're seeing in the markets, that cyclical recovery play, versus the fundamental underlying economy. And that's the major risk on the consumer side. On the investor side, of course, a lot of people missed out on this rally, the kind of quick acceleration that you saw based in tech after the March lows. So a big question is, there are a lot of people are looking for entry points, and the first quarter may provide that.
All right, great little wrap up here. Kriti Gupta, of course, covers markets for us here at Bloomberg. All right, let's get over now to the first word news. Karina Mitchell. Karina.
Okay, Romaine, thank you. President-elect Joe Biden says the coronavirus pandemic is going to get worse before it gets better. He spoke in Wilmington, Delaware, just earlier after getting a briefing from his COVID-19 advisory board. Biden criticized the Trump administration for the pace of distributing vaccines, saying it is, quote, falling far behind. He says he's aiming to have 100 million vaccines administered in his first 100 days in office, and he reiterated his call for Americans to wear masks. Meanwhile, more than 400,000 Americans will be dead from the coronavirus before President Trump leaves office. That grim prediction today from the Centers for Disease Control and Prevention. The U.S. has one of the highest mortality ratios of nations hit hardest by the virus, behind only Italy, Spain, and the U.K. scaled for population. The current U.S. death toll is more than 335,000. And Senate Republicans went against President Trump's wishes today. They blocked an attempt by Democrats to increase direct stimulus payments in the COVID-19 relief bill from $600 to $2,000 after Trump demanded the change. The motion passed the House Monday. Majority Leader Mitch McConnell says the Senate will address 3 of Trump's complaints this week, including the amount of the stimulus payments and concerns about election fraud. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Does it really enhance transmissibility as has been suggested? Does it really prevent antibodies from binding? These are still questions. that scientists are hopefully going to answer in the coming weeks.
In economic terms, what we have to focus on is we have unnecessary human suffering and a lot of uncertainty for poorer people or unemployed people because of the disruption in getting the $600 checks out the door. But the stimulus package that is going to get approved or has been approved is really one that includes some of the key aspects you need, which is extending unemployment insurance, extending it to gig workers, backing the moratoriums on evictions, giving some aid to school systems. What's missing is state and local government aid, which McConnell also blocked previously. In terms of the dynamic you talked about, it's hard to imagine. It's just like the people who've been writing commentary. Maybe if Trump had passed stimulus earlier, he would have won the election. People do seem to value a check in their hand, so it's hard to understand why McConnell is opposing it.
Adam, I want to get to some of that aid to state and local governments, but first, I want to get to something that we spoke to about Larry Summers and the actual size of those checks that you were referring to. And he said Democrats capitalizing on the rift between Senate Republicans and the president might be good politics for them, but it isn't good economics, saying that this sort of arbitrary number of 2,000 is not as targeted as it should be. Do you agree?
I disagree with Larry on this particular point, because if the choice was getting out the $600 or getting out the $2,000, and that was the choice, then obviously get the $600 out because it's more important you get it out timely, and it's more important you get the whole package out. And probably Larry agrees with that. The idea that the 2,000 is going to be that big a difference versus 600, I mean, what you'll end up doing is a lot of people will put it in their savings accounts. So you won't get maximum stimulus, but a lot of people have a lot more than $600 need. So if it goes into their savings accounts, you tax it, you'll get it back later. I don't view this as a big deal versus making sure that the stimulus we've got passed. I wish it had been even faster. If you were designing this from the start, and this is where I agree with where I think Larry was going, if you designed this from the start, you would have wanted more emphasis on needs, on state and local government, on unemployed people, on evictions. You already have some of that, but have more of that, on loans to small business, not based on giving everybody a check.
There are baby boomers who are having to act as child care centers. There are parents who have been having to pay for tutors. Definitely that $2,000 can go a long way to the middle class as well as the lower middle class. And that should be something everyone agrees on. Let me ask you this in terms of where the United States, in terms of stimulus checks, compares to other European countries. For example, how has the United States stacked up against other countries in terms of providing stimulus check relief to its citizens?
The U.S. has put out there more than most European countries and most other rich democracies, Kevin, but the gap is smaller than the top line number, because in every other rich democracy, the welfare state's much more generous. You have health insurance, you have college paid for, you have various other provisions. So this is more what the U.S. calls discretionary spending every time Congress has to pass it. Even if you take that into account, though, the U.S. has spent more. Then there's a debate about whether it's done more good or not, because a lot of the European countries, France, Germany, some of the others, have tied their aid much more to keeping people in their current jobs and keeping current businesses afloat. In the U.S., as my colleague Jason Furman has written about, it's been more disengaged. It goes to unemployed people. It goes to people who may be leaving their jobs. And there's pluses and minuses to that. So, yeah, the U.S. has spent more, but it's partly catch up because we don't have a big enough safety net. And it's definitely we've spent differently. And only over the next year or two will we see what difference that makes.
All right. Adam Posen there, Peterson Institute for International Economics president there, speaking exclusively with Taylor Riggs a little bit earlier in the day. We're going to continue this conversation because stimulus, of course, remains a sticking point in Washington. It remains a talk of the town there and pretty much everywhere else out there. There was hope for some sort of expansion of that bill that got passed to take that stimulus check from $600 to $2,000. A lot of questions here about the pace of the economic recovery. Let's bring in Jason Schenker. He's president of Prestige Economics, and he's chairman of the Futurist Institute. He's also the author of After the COVID Vaccine, in which he examines futurist scenarios of risk and opportunity post
pandemic. Jason, great to have you here. We're, of course, hoping we'll get to post-pandemic as soon as possible. Let's talk about the economic recovery, which is done okay. A lot of people still left behind. But in aggregate, it appears that the U.S. economy and a lot of the other major economies in the world right now are in recovery mode. Are you confident that the trajectory of that recovery is going to continue?
Well, I don't think it's necessarily going to be one way up from here. I think the next few months could be quite challenging. There's a chance we could blow it. For all intents and purposes, some folks think that on January 1st, we're going to enter 2020 and COVID is over. But it's not like that. And really, the next few months are going to be critical until we can get vaccinations to scale for those industries that have suffered the most to recover. That's going to be absolutely critical.
Jason, some have been making the argument that we're giving stimulus checks at the wrong time. By the time they get out there, the economy and some of that vaccine distribution that you talked about will start to be underway. And I know the risk of overheating right now sounds crazy, but it could be a threat next year if you have not only the stimulus checks, but everyone who's been saving all spending as well at one point. Do you see that as a risk at all?
Well, I think there's two pieces here. And the first is there are, according to the most recent jobless claims report, about 20.4 million people claiming some level of unemployment benefit. That's a huge number of people. Even if magically on January 1st, 2021, everyone were vaccinated and it all could be done at once and the 2 doses instantly, we would still have 20.4 million unemployed people. So that's a lot of folks. There's a lot of suffering there. There's a lot of income insecurity. There's risk to housing. There's all kinds of challenges around that. But as for the inflation piece, I think one of the biggest challenges will be what the data looks like. And when we roll into the second quarter, the year-on-year inflation rates could look quite high. We're expecting CPI in Q2 2021 to be 2.5%, core at 2.2%. But then it's likely to fall back down. We see the year average for both headline and core CPI is below 2%. But those numbers in the second quarter, because of the year-on-year base effect from the second quarter of this year, could happen at just the wrong time. As we're going into recovery, suddenly we see these big year-on-year inflation numbers, and it's more base effect, but that could wreak havoc in the financial market.
Jason, I want to get your thoughts on the much longer-term view and about some of the changes that have occurred in U.S. policymaking because of the pandemic. I mean, the embrace for that first fiscal stimulus bill back earlier this year was pretty much unprecedented for Congress to, in a bipartisan way, to agree on that type of spending like that. Even the second bill almost seemed improbable, say, if you went back 2 or 3 years ago. Even what the Fed has done has sort of moved into areas of, I guess, unprecedented definitions. And I'm curious as to whether some of the shifts that we've seen by the Fed and whether we've seen by Congress and fiscal policymakers, whether these shifts are going to mark sort of a permanent change in the way policymakers view our economy and view the solutions to dealing with economic crises.
Well, I wish I could say this time was different, but a lot of what we've seen from the Fed was already in the cards, right? We knew a number of years ago. It was at Jackson Hole in 2016 where Janet Yellen said that the Fed in the future might want to look at buying a broader range of assets. We knew that was going to happen someday. And now we saw, in a response to COVID-19, massive balance sheet expansion. Is the Fed going to expand it again in the future? Very likely. Is it easy to reduce the balance sheet? Not at all. The Fed tried it 2018, 2019. The result was cut rates and the Fed re-expanding its balance sheet before COVID-19 happened. And of course, if we look at what happened when the European Central Bank tried to reduce its balance sheet size between 2012 and 2014, the result was negative interest rates, which they've now had for more than 6 years. So a lot of the Fed expansionary stuff going to happen every cycle going forward.
Jason Schenker of Prestige Economics, thank you as always for joining us, and Happy New Year. And happy days for me because I'm done with Bloomberg Markets to Close, but it's also happy days for Romaine because What Did You Miss is coming up next.
It's my favorite half hour of the day.
Joe Weisenthal is set to join.
It's a treat.
All about Bitcoin.
The stalwart.
This is Bloomberg.
it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Live from Bloomberg World Headquarters in New York, I'm Romaine Bostick.
I'm Joe Weisenthal. Caroline Hyde is off today.
Let's take a look at where we stand in financial markets at this moment. The S&P 500 and the rest of U.S. stocks fade on the day, but emerging markets get a bid.
The question is, what'd you miss?
Well, what'd you miss? Well, we're talking about what's been happening in emerging markets, what's been happening in China. Some of the recent moves by Chinese authorities against companies like Alibaba, driving a lot of fears about regulatory scrutiny that could spread around the country's most powerful corporations. Now, as a result, we've seen volatility in Chinese tech shares over the past week. Joe, China's crackdown, just one of the possible obstacles, potential obstacles for emerging markets in 2021. And we have, of course, everything from the COVID vaccine distribution to geopolitics, even in the recent port strike, tugboat strike, I'm told, in Argentina, Joe.
Yeah, huge news. Of course, we start off with Alibaba, which, of course, absolutely high-flying stock for a long time, one of these the mega Chinese internet names. It had also expected to get an extra boost this year with the IPO of Ant Financial, which we know never happened. That the plug was pulled on that a couple months ago. And you see how that stock peaked at the end of October, having plunged significantly since then, and then more in the last few days with further regulatory crackdowns, both on Chinese internet in general and Ant Financial, one of its holdings specifically. So trouble in this area. Joining us now, Bloomberg's Sam Mahmoodi, who covers in part finance in China. Sam, thank you very much for joining us. It's hard to figure out exactly what is the core story here. Is it a crackdown on Ant? Is it a crackdown on Jack Ma? Is it a crackdown on the power of some of these tech mega caps in China? What do we perceive as the goal here from Chinese internet regulators?
Hi, Joe. The answer to your question is everything, all of the above. I think primarily right now the focus is on Ant Financial, and Alibaba is also under an antitrust investigation. So I think it's fair to extrapolate that Jack Ma is clearly in their sights. As I'm sure you know, he made some controversial comments about Chinese regulators and their low risk tolerance back in October, which may have set things off. He is the richest man in China. His two companies are, they straddle the entire economy. And with or without those comments, it could have just been a question that the regulators, the party, felt it was time to rein him in.
Yeah.
When you look at what companies such as Tencent and Meituan have done, there is a sentiment among investors. These companies have fallen 15, 20% since the Ant Financial IPO was scrapped. So investors definitely think it could be a sector-wide attack as well.
There does seem to be, at least among investors, Sam, here, the general assumption here that, at least with Jack Ma and Ant, that they kind of flew a little bit too close to the sun. But the idea here that he's being made an example of, and that if you're a CEO or any sort of a tech entrepreneur out there in China right now, you have to be mindful of, I guess, just the government system here, and maybe that there are some limitations here into not only how much you grow, but how you grow. As an investor, how do you sort of get around that?
Well, that's a big question, isn't it? I think that there is the party genuinely, from a very kind of technical point of view, they do take financial risk extremely seriously. The political system there obviously is very different to what we see, in other market systems, but they are constantly tinkering with their rules and regulations to make sure that there's no systemic risks, to make sure that the average individual investor is can be made as whole as possible. And so, I think on some level they could just say, look, things are a little bit out of control and we're trying to balance them. But as you say, for investors and just for the market, I mean, China has arguably been the most entrepreneurial economy in the world in the 21st century, and it creates millionaires and billionaires at a very rapid clip. And Jack Ma himself is an extremely famous, popular person in China. And so I think they have to walk a fine line between saying, whatever the underlying political reasons there may be in the background, but just to the world and to the markets to say, we're trying to control things without giving the sense that they have become anti-entrepreneur or anti-tech or anything along those lines that could really scare money away.
Sam, let's talk about Ant Financial, the business itself, and what it looks like now and what it could look like going forward. So we know there's Alipay, which is a popular, massively popular payments app. The aspect that's more controversial is sort of the more fintech, banking, lending aspect. How big of that is that within the Ant Financial universe, and how much does that sort of shrink the eventual ambitions of the company and by implication Alibaba if that part is curtailed?
That is where the growth expectations are. And so that is the issue for the company and for the investors. So, I do say Alipay is everywhere. It's everywhere in Asia, and who knows, maybe it'll be everywhere in the world one day. But there's a certain, it's a steady business. But the wealth management side, the insurance side, the loans business, the connections they have to connecting the retail investor with bank loans and that is where all their business, that's where their growth is coming from. That's where the higher valuation comes from. Today, our colleagues in Asia reported that Ant is looking at creating a holding company where all the very sort of bank-like activities would get put. If that did happen, it would mean that all those activities in the holding company would have to take financial licenses. They would have to have enormous capital requirements, something like they'd probably need 10 billion extra capital injected in it just to kind of meet the regular sort of boring old bank financial regulations. So then it just becomes much more just like banking, like a bank, which, banks are profitable, they make money, but they're not really a tech growth story.
But I'm curious about that because, I mean, the whole, I guess, I don't know if you call it social, but just the kind of the networking effect of how Alipay evolved and, of course, all of the services that evolved around that. I mean, that's kind of what made it not only successful, but really useful to the end consumer. If you sort of say, we want to push this back into the corner where it's just a bank, from the consumer's perspective, doesn't that make it less attractive?
From the consumer perspective, I think it would remain to be seen how different the consumer experience would be as a customer. From the investor perspective, it makes them much less interesting. Right now, China flirted with P2P for a few years, and that was going to be a really big thing where people who maybe can't get bank loans can get bank loans from other people using fintech products. That kind of got shut down by the regulators because of risk factors. Alipay, Ant Financial itself has been, as I say, kind of almost like getting a bit more bank-like in its activities. So for the consumer, it may not affect things, but for the investor, I think it definitely. Our colleague Bloomberg Intelligence in Hong Kong estimated that the valuation of the company would go from about 300 billion to about 150 billion if it does adopt this kind of holding company becoming a boring sort of financial company plan. Mm-hmm. The other aspect is, I believe today the Wall Street Journal was reporting that if such a plan came to pass, then maybe some of the big state-owned banks would start injecting. They would take stakes in the holding company, which again, as you can see there, then it really just gets sucked into the kind of massive state-owned financial system, which again, much more staid.
All right, Bloomberg's Sam Mahmoudi there, giving us that update there on what's happening with Ant Financial and a lot of the other big Chinese tech companies. We're going to continue that conversation. We're going to broaden it out a little bit more and talk about what's going on in the emerging market space, investing in China, investing in Asia, investing in a lot of those emerging market names, and sort of whether this crackdown going on in China may have broader effects. Emily Weiss of State Street, love her. She's coming up next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
All right, today we are focused on emerging markets as we head into 2021. And Joe, I mean, we talk about the performance in the emerging market space this year, and particularly, I guess, since the big downturn in March. And it has really been on fire, in fact, outpacing a lot of the gains that we're seeing in developed markets. But of course, a lot of that is because of the rebound that we saw specifically in China.
Yeah, absolutely. China, of course, the virus started there, but the incredible economic rebound poised to end the year at a higher level of economic activity than it started. Various measures, China's Bloomberg's own monthly GDP estimate rebounding sharply. Another measure of Chinese industrial activity also rebounding sharply. That's a V. I mean, that's a V-shaped recovery. So regulatory crackdown on tech aside, is clearly a big source of global demand, global activity.
You're ignoring that parallel line there, which kind of makes it a little bit of a vase. But,
oh, okay,
right,
yeah,
but we'll talk about that after the show. Let's bring into this conversation State Street emerging market strategist Emily Weiss. Emily, let's start with China. They are a big driver of global growth, obviously a big driver for a lot of EM trades out there. Generally, how are you viewing the recovery in China right now?
Yeah, so it is somewhat of a V, or maybe a U, as you alluded to there, where we have this kind of bounce back in activity that we've seen on both the consumer side of consumer-led demand rebounding as people go out for luxury goods, jewelry, big purchases. And then we also see that on the manufacturing side, they've really had this rebound, thankfully, due to their involvement in sort of the global supply chain and essentially being able to really participate in that sooner than the rest of the world because of the way they've reacted to this coronavirus crisis. So the fact that the economy was able to get control sooner has provided them with that base to rebound.
So what is the nature of this growth? Because even prior to the crisis, there was a lot of talk about very imbalanced growth in China and this idea that is very investment-led, that it eventually needed to balance back towards more consumption, redistributing some of the wealth toward more household purchasing power. Is that happening in any meaningful sense, or does what we're seeing now in China simply look like the previous growth regime?
I think we are starting to see that shift. And in particular, we've now seen it encoded in policy decisions. As China now has this dual circulation strategy where their direct focus over the next 10 years or so is to make it a more consumer-led economy and have that approach rather than just reverting to the old model of what they've traditionally done. So we have started to see that take place, but on the same side, I think we also do see this constant sort of background sort of hovering of the concerns of the past. And I think that gets to a little bit of some of these regulatory burdens that have come up in recent weeks, and also that we've seen a little bit more scrutiny from the government side, because there has been this big focus on sort of cleaning up balance sheets, looking at shadow banking, and making the growth more sustainable going forward. But that does come with that push and pull.
It comes with that push and pull. A lot of investors are looking for yield, foreign investors. A lot of them are looking towards China, especially when it comes to fixed income, sovereign yields, and the differential that you see versus what we have here in the U.S. How much of that is going to be a driver of investor interest going forward?
It certainly is. In this world where we have some negative yielding countries in the developed market side, and even yields on the emerging market side have become fairly compressed over the last 6 months or so, we do see that China has one of the higher spreads against U.S. Treasuries in the emerging market space, and notably has been one of the few countries that hasn't turned to unconventional policy during this COVID pandemic, and really hasn't even loosened policy all that extensively during the COVID pandemic. So yields are pretty high, and that certainly is juicy for investors who are looking to emerging markets for yields generally. There's plenty of some options there, but China is certainly one, which I think surprises some folks.
So one thing that we've seen is cooled off a little bit, this incredible sort of commodities industrial rally. Whether you look at China or other EMs in their state of recovery, is demand for commodities and sort of demand due to the industrial rebound, in your view, going to stay pretty intense for a while?
Yeah, I think it will. We've certainly seen that the Chinese-led demand for particular copper due to infrastructure investments has been reflected in copper prices for a while now, where we have just a little bit off the highs. At the same time, oil demand hasn't quite recovered as much as maybe I would have expected. I think when we look to the next 6 months or so, we are looking towards a period where folks have started to realize that we will have this kind of gradual normalization, even though the next month or two might be particularly difficult. So it does seem like we're at a place where those emerging markets tend to be very closely connected to commodity cycles and commodity demand. And that does seem like we're getting to that place where there is further room to go as the world starts to reopen.
When you start to look at a lot of the other Asian EM nations out there, Emily, are they able to sort of grow in a way that isn't completely dependent on China's fortunes?
Yeah, it's a good question, because we have seen a little bit more of the general sort of Northern Asian economies really excelling during this time of COVID, really because of their connectedness to the global supply chains and their ability to deal with the crisis and then continue to sort of have their economies functioning almost as normal in some cases, which has been rare, even especially in the emerging market space. But we have seen this divide between North Asia and South Asia, where some of the Southern Asian economies still have a ways to go and aren't quite as connected to China anyways, but there's kind of a regional differentiation where the northern, particularly trade-oriented economies, one that are really exposed to tax, are still doing quite well and are really able to kind of function somewhat on their own.
Do you have a sense, I mean, when Trump was elected, of course, the relationship with China and how that might change was a huge part of the storyline of his presidency. Do you have a sense or a forecast of how it might change, or whether you expect the status quo to continue, the new status quo to continue under Biden?
Yeah, I think that's certainly something that gets talked about a lot, is that there's going to be this easing of tensions as we head into a new administration. At the same time, I think there's still a lot of demand in Washington for that pressure on China to remain. And if anything, I don't quite see a rollback of the tariffs that have been put on in place and the sort of pressure on the trade FX policy front that we've seen under the Trump administration carry over to the Biden administration. One thing that I do think it will be is slightly more predictable, and I don't think anyone will sort of, I think that's been said before. Definitely being able to have a little bit more predictability in policy is helpful, and I think will provide a smoother talking point going forward.
All right, our thanks there to Emily Weiss. Always great to have you on. Hope to talk to you soon. If we don't hear from you soon, have a wonderful new year. Of course, State Street emerging market strategist there. We have some breaking news here. This is coming out of the state of Colorado here in the U.S. The governor tweeting that the first U.S. case of that COVID-19 variant, basically this new strain that was first reported in the U.K., that they do have a case in Colorado. Again, this is a variant. We do know that these viruses mutate all the time. We don't have any more details about whether this poses any sort of immediate threat, but something we'll definitely keep an eye on. All right, we want to get back to our discussion on EM. And after we come back from the break, we're going to turn from Asia to Latin America. Soybean worker strike leaving over 100 ships waiting at ports out there. We're going to have the latest from Buenos Aires. That's coming up next. This is Bloomberg. All right, welcome back to What You Missed. Today, we are focused on emerging markets. Joe, we were talking a little bit earlier about Asia and China, but there's some issues going on in Latin America that might actually have investors sort of reassessing how they view things down there.
Yeah, lots going on right now. Joining us with the latest, Bloomberg Buenos Aires Bureau Chief Carolina Milan. Carolina, thank you so much for joining us. So obviously a lot of EM rallying, commodity prices surging, recovery, but also labor strife going on in Argentina. What's the big picture story?
That's right. We're seeing workers at Argentina's soybean processing plants have been on an ongoing strike since December 9th. That has sent Chicago futures to a new high. Workers are asking for more pay, including a 25% base salary increase for 2021. And while that may sound high, inflation is expected to end the year around 40% higher than the previous year. So it's a fair point.
And so when we talk about, I mean, look, I feel like Argentina has sort of been, I don't know, I'm trying to, let me prevent myself from getting in trouble here, but it's been a complex situation for investors the last few years here. And I'm wondering whether this actually changes the calculus, because a lot of investors, EM investors, had really started to bet that Argentina had finally put some of its issues behind it and was on a path to a little bit more financial stability and financial predictability.
Yeah, that's right. A lot of investors were confident and hopeful that Argentina's debt restructuring was going to change the tone for assets going forward. What we have seen is that the bonds have been trading in deep distress even after the restructuring finished in September. The reason for that was that investors were looking for more signs from the government of a solid plan ahead. Instead, the government continued to tackle some of the issues that inflation or growth in a piecemeal fashion, and that sent assets tumbling. So now the next big hope is for a new program with the International Monetary Fund.
On the strike question specifically, and you connected to the rally in soybean prices, how much is it hampering global supply? How much of the country's soybean product is getting out? Talk about that specific bottleneck and sort of some of the ramifications of it.
Yeah, so what we know is that there's about 151 ships waiting to leave, and so that has had an impact on global soybean prices and on the markets in Chicago. And so, this strike has been ongoing since December 9th. It's been several weeks already, and so today, the Argentine government started getting involved. The labor ministry is now involved in the talks, and there's a lot of anticipation for a resolution. Certainly, investors in grains markets are looking forward to finding out whether this will be resolved before the new year.
And, I mean, what happens here? I mean, we're showing pictures right now of all these sort of boats, these barges right now parked presumably off the coast, just waiting for some sort of guidance as to what's going to happen. Do some of these contracts, I mean, are they going to get rolled back, or are they just basically these boats are going to ride this out until they get clearance to offload their product?
That's a moving situation. So it's unclear how exactly the bottleneck will be resolved, but certainly as soon as the situation is resolved, all these shipments will be looking to get out and continue.
So does the surge in soybean prices and the potential lost revenue that's accruing to the people selling it because they can't move it, does that increase the likelihood that the labor situation gets resolved given the opportunity cost of not taking advantage of these high prices?
Absolutely. That's a very good point, because actually every day that the shipments stay stuck in the river and they're unable to leave is lost money for Argentina, which is, as you know, trying to get fresh dollar funds from multilateral organizations, payments to the International Monetary Fund. So for Argentina, this money, these dollar exports, these dollars that come from the exports are very important, and that's part that these unions have. As you know, Argentina's foreign reserve through the year, and so this is key also for the national government.
All right, Carolina, great to have you on. Of course, Carolina Malanch is our bureau chief down there in Buenos Aires, Argentina, giving us that update there. Interesting strike here. I mean, Joe, you actually brought this to my attention earlier about all the tugboats down there and the impact on soybeans. I know you're a close follower of the commodities space here.
Naturally.
But in all seriousness, there is sort of a sense here that some of the disruptions we're seeing there could potentially have some spillover there to some of the other nations and to the broader market in general.
Totally. And look, there's that, and there's so many. I mean, you look at basically any commodity chart right now: lumber, copper, iron ore, hot-rolled coil steel futures. They're all soaring to the moon right now. So I think we're seeing the surge in demand coupled with crimping supply. Pretty remarkable stuff happening across a range of areas all around the world.
Yeah, it's just really shaping up to be an amazing year for all assets. All right, that's all for What'd You Miss, Joe.
Have a great evening. This is Bloomberg.
Chinese brands now account for 7 of the country's top 10 cosmetics lines, up from just 3 in 2017. That has pushed out foreign brands like L'Oreal's Maybelline, which has seen its share of China's makeup market plunge by half since 2010. For more, we're joined by Bloomberg editor Bruce Einhorn. Bruce, why the drop?
Chinese brands are becoming much more adept at reaching Chinese consumers, especially now at a time when more consumers are reluctant to go shopping outside. People are spending more time at home. People are spending more time on social media. Chinese brands are very good at using social media, using live streaming, using other things in order to market. Chinese brands also tend to be less expensive. And so at a time when the economy is struggling a bit, there's a lot of uncertainty, people are more budget conscious, Chinese brands have a bit more of an advantage.
If they're not, then it is fines, another fines, repeated fines, behavioral commitments, but there is the option eventually to ask for a divestiture, splitting up a company as a last resort.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Welcome to Bloomberg Technology. I'm Emily Chang in San Francisco. We're looking back on our biggest interviews of the year this week, a year unlike any other. While a global pandemic created tidal waves of uncertainty for many companies, the tech sector seemed to do what it does best: adapt. One of the companies crushed hardest by the pandemic was Uber, as commuting halted and ride-sharing stalled. It's not the first crisis Uber CEO Dara Khosrowshahi has had to navigate. He was also an executive in the travel industry on 9/11. When we caught up with him in mid-March, he described the pandemic as being even scarier than the attacks over 19 years ago.
I think the financial panic was financial in nature,
that found its way into everyday life and obviously a very negative way. So it was deeply worrying as to the financial institutions and how they would hold up. And to some extent, what we're seeing now, it's actually the opposite, which is it's Main Street. Corona has affected everyone's lives all over the world, almost instantly. It is moving so fast. And the worry is it going to creep into the financial system versus the financial system kind of creeping into the mainline system? So this is a scary time.
Since that interview, we saw daily case numbers in the U.S. fall, only to rise again by the tens of thousands. Restrictions that were once lifted are back in play, but help is on the way. Pfizer and BioNTech were the first to report their COVID-19 vaccine was more than 90% effective in human trials. Then Moderna announced its vaccine candidate, 94.5% effective. We sat down with Moderna co-founder and chair Noubar Afeyan to discuss the data and a vaccine distribution timeline.
There will be some 20 million doses prepared by Moderna for shipment in December if we can get the emergency use authorization. So that's the number that we've been working towards. Of course, a subset of those will go out first, several million doses, followed by shipments, repeat shipments thereafter to fulfill that goal.
Now, Moderna has said you could potentially make up to 1 billion doses by the end of next year. How many of that 1 billion doses do you think, based on what you're seeing in the supply chain, you will actually be able to make?
We've said that we are poised to make 500 million to 1 billion doses. Under different circumstances, we may be on the high end of that. We'll also be watching for demand. One of the things, Emily, that none of us knew as recently as a month ago, and we still don't know over the next few weeks and months, is just how many of the vaccines will actually get over the finish line, show not only safety, but efficacy sufficient for broad adoption. And that in turn will have a role to play in dictating how much volume each of the vaccine manufacturers needs to make and can make. So the capacity is one thing, the utilization will be another. So we've been thinking in the 500 million to billion range, maybe in the middle of that, but it's still early for us to determine exactly where that'll be. We've certainly made a lot of upfront investments to be in a position to reach those goals should we need to.
Okay, so if you can share any more details about capacity, then are there any particular ingredients that are in, let's say, short supply, or do you have everything you need to get to that, 750, maybe a billion doses based on what you're seeing right now?
Based on what we're seeing right now and the volumes that we've already committed to with our partners, the governments that have already pre-ordered vaccine and that we foresee ordering in the near future, we have certainly the supply chain in place. Again, let me commend the close collaboration with our OWS colleagues who played an important role in securing some of the key items that we needed help with, making sure we get in a timely way. And so I think the system is in place. Of course, there may be disruptions, there may be surprises, but right now I think certainly the 200 million doses that have so far been secured by the U.S. government and whatever we foresee for the rest of the world, we're in a pretty good position to make. And the key supplies are being secured, have been secured. And as we go along, we may increase those.
Your production, which has been an incredible feat, has been watched with great fascination. How has Moderna been able to get such a leg up on Pfizer in producing more doses of a similar vaccine in initial weeks? What's been the secret sauce?
Well, Emily, I can't speak to the specifics of what Pfizer's been doing, but I hold the company in the highest regard, being quite an old established company with vast resources and vast expertise. This vaccine, the messenger RNA vaccine, is something that Moderna has been working on for almost 7-8 years, and the whole technology we've worked on for 10 years. And as the pioneers in this space, as you may know, we spoke earlier about this, we have experience across 10 different human vaccines that we've tried in trials and are currently being pursued for other diseases. All of that, all of the 10 years of expertise, the hundreds of millions we'd invested in production, in optimization, all have supported us in what we've been trying to do in a very short time frame, which is to scale what is an unprecedented vaccine. But it comes on the heels of significant technology, process development, analytical investments we've made, among them being how to make sure that we can store our vaccine at conditions minus 20 degrees centigrade that are more compatible with vast distribution than would have otherwise been the case. 5 years ago, we had processes that also needed to be kept at ultra frozen conditions down in the minus 70, minus 80 degree range. I'd say that's an important part. The other important part is the people. We're fortunate to have attracted some of the most experienced people in this industry under the leadership of Juan Andres, who came to us from many, many years, if not decades of experience at Novartis. And the leadership he and his broad team provided was, in fact, absolutely essential for a small company. Usually small companies have less experienced leadership, and when put to this kind of test, everything is being done for the first time. Well, here, they had done this before in prior pandemics even,
right,
but simply not at Moderna.
Did your work with the NIH and Operation Warp Speed help potentially smooth out the process at all, like the onboarding of manufacturing facilities, perhaps?
Our work with the NIH was primarily in the vaccine development itself, the science underlying the spike protein that's been well covered, and of course the years of work we've done together on evaluating mRNA as a rapid response technology, and that has been well described and much appreciated by us and every single person who will receive our vaccine. OWS, on the other hand, has been deeply involved in supporting and advising the work that Moderna has done in preparing itself to produce at these scales and to distribute, and that has been essential. I cannot overstate the central role it played. General Perna, Moncef Slaoui, and their whole organization, I think, played an important role. It's unfortunate that we've been in a rather politicized environment where every single action ends up being interpreted multiple ways. But when you strip all that away, hopefully we'll come out of a political environment relatively soon. What they have done is an essential part of where we are today.
That was Moderna co-founder and chair Noubar Afeyan. Coming up, our conversation with San Francisco Mayor London Breed, how the tech city is coping during the pandemic, and what she has to say about those relocating to urban areas next. This is Bloomberg.
Lo tomé como una terapia. Realmente logró la contención que yo necesitaba en ese momento.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
One of the numbers that really jumped out at me from our report is that more than half of small business owners don't expect they will be able to rehire the employees they'd laid off, within a reasonable period of time. And that means that we have our challenges cut out for us in getting America back to work.
That was Facebook's Sheryl Sandberg back in May. Now, San Francisco was one of the first cities to shut down as the pandemic hit the United States. An aggressive approach has likely kept COVID deaths down. But that has come at a cost, including a crisis for local businesses and a big budget shortfall. We spoke with San Francisco Mayor London Breed back in October.
It's unfortunate when anyone gets COVID. And what we hope is that people are, especially leaders, are leading by example. I don't like wearing masks, but I wear them. I don't like social distancing. I want to be around people. But I understand that I could infect somebody and they can infect me. So it can't be about me. It has to be about the behavior that I model so that others can follow. They need to understand how significant this is and how it could basically be devastating to a densely populated city like San Francisco. And this is important. And so from my perspective, this is why from day one, I have tried to communicate everything I know and the facts and use data in the decision-making process of this virus. And just to remind people, yes, we want it to be over. We're tired of COVID, but COVID is not tired of us. And it's just not going to go away because we want it to. We have to do our part.
Now, many states and cities have been following the president's lead on this and reopened potentially faster than San Francisco did. And I wonder if you think the president's condition will change the way this plays out, change how some of these other cities and states are reacting.
Well, I hope it does. I think that, what it shows people is that no one is immune, that it can happen to anyone at any given time. And when you think about, someone who is possibly, elderly and maybe unhealthy, it could be even worse. The impacts of COVID could be devastating. So I hope that this is a wake-up call for so many people who are refusing to wear masks and who are moving forward with their lives as if nothing is wrong, as if we're not still in a pandemic. And this should be an example for sure.
Meantime, rents are falling sharply in major metropolitan areas and in San Francisco. How concerned are you about an economic slowdown in San Francisco, given that tech companies are paring back workers and people are leaving the city, and that means you're going to have a lower tax base?
Well, I will say that I'm very concerned. I just balanced a budget with a $1.5 billion budget deficit. And not to mention, there are over 200,000 people who have filed for unemployment in this city. We have businesses that I've been going to since I was a kid that have closed permanently. So I am definitely concerned about the economic impacts of what's happening. It's not about just tech companies fleeing. It's about business in general, in light of COVID and working from home and having more flexibility and the cost of living, and also the number of tax measures and other things that have really put us in a situation where I think we're going to have some challenges over the next couple of years. But the fact is, we're San Francisco. We're a major city, and people love coming to this city. They love working in this city. They love going to restaurants in this city. And so you can't just create this someplace else in a suburb. You only get what you can get from a place like San Francisco by being in a place like San Francisco. It's going to be hard for us for some time, but I think eventually we'll get back to a better place.
That was San Francisco Mayor London Breed. In October, cities like San Francisco and New York reintroduced indoor restaurant dining with some restrictions, and it couldn't come soon enough for the sector hit hard by the pandemic. But the effort to increase revenue is often a game of chance, and in some regions, rising virus cases now mean more restrictions. We spoke to the CEO of OpenTable, Debbie Su, about how the industry is faring.
It's pretty bad. Even before the virus, restaurants were operating on razor-thin margins. And now added on to that are the capacity constraints and the added costs for all the safety precautions that restaurants have to be taking. It's been a really devastating time. And if you look at restaurants even just in San Francisco or the Bay Area, it's been gut-wrenching what's happening there, both because of the virus and because of the fires. Their outdoor dining activity has decreased because the outdoor air quality is poor. So there's never been a more difficult time, I think, to be in the restaurant business. At OpenTable, as you mentioned, our mission really is to help restaurants forge through this crisis as best we can. To that effect, we've waived our subscription and reservation fees and launched a myriad of products to help restaurants run more productively, efficiently, and safely.
Now, you told us last month that you see 1 in 4 restaurants completely closing out of this, that reservations have been down, seating down 80%. Is that still the case? Is it getting any better or worse?
In markets like San Francisco, dining activity is actually down 88% compared to down 43% for the U.S. as a whole. In markets like New York, down 89%, Seattle's down 81%, Chicago's down 75%. So there are a lot of cities and big cities in the U.S. that have been really, really impacted by this in terms of dining activity. We do see pockets of growth and activity. What we've seen is as restrictions lift and people feel safer and more comfortable dining out, they do dine out. In a recent OpenTable survey, we actually found that 25% of survey respondents in the US and Canada are dining out at least once a week. So there are some glimmers of hope here. Other trends we're seeing is that outdoor dining has really picked up. So if you look at dining in September of this year versus September of last year, we've seen an 18x increase in parties sitting outside.
So how do you expect the restaurant industry to look different after this? I mean, we don't know when life is going to go back to normal. We don't know what normal life is going to look like. I mean, are people going to go back to restaurants as much as they ever did? I mean, will it ever be the same?
We are going through an evolution of what dining out means right now. And I think there's never been a more important time for online reservations or restaurant tech companies like OpenTable helping restaurants, again, run safely and more efficiently. I think some of the trends that we're currently seeing during COVID are likely here to stay. Restaurants, love taking online reservations because it makes their business run more efficiently and seamlessly. And trends like contactless pay or, not having to check in with a host or online menus, those are all things that I think we'll continue to see. Also, the rise of delivery and takeout, as we've seen during COVID, I think will persist as well. It's become a meaningful and significant part of restaurants, businesses, and their P&Ls, and it's a way of dining that users and diners are more used to.
That was OpenTable CEO Debbie Su. Still ahead, working remotely, a pandemic trend or new normal. A number of tech companies will start allowing employees to work from home forever. That includes Reddit. Our conversation with Reddit CEO Steve Huffman next. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
and the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
If we can really get vaccines going in April, May, June, July, and August, by the time we get to the end of the summer, I think we can get to that goal that I'm talking about getting the overwhelming majority of the population vaccinated.
The community social website Reddit says it will allow most of its U.S. employees the flexibility to work remotely forever, with some exceptions. And they will still be paid the same, even if they choose to move out of high-cost cities like San Francisco and New York. This as other tech companies like Facebook, VMware, and Stripe have decided to pay workers more or less based on their new location. Here's our conversation with Reddit CEO Steve Huffman.
We had that original policy as well, but it had some obvious flaws, which is, first of all, there are so many decisions, personal decisions that one might make in their life that affect their quality and cost of living, such as whether to have a family, whether to rent or own, what part of the city to live in, and of course, which city you live in. And so there's so many variables at play here. We figured the most fair thing to do is to simply pay at the top of the market and pay for performance and pay for the role. And we think this will be an advantage for both recruiting and just simplify, I think, a lot of what I would call like garbage in, garbage out, math that we were trying to do.
So how many employees do you think will take you up on this offer and move away from headquarters to other parts of the country? And how do you expect that to impact your sort of talent redistribution, if you will?
It's a great question. And if I'm being completely honest, we don't know. We've surveyed our employees and found that only a small percentage need to be in the office. But many, the vast majority, would like to be in the office sometime, but would also like the freedom in their life. And just speaking from my own experience, I think my own feelings have evolved on this. I think there's pros and cons to working from home and working remotely that we're still learning. And so the core of our approach is to be flexible and let people make these decisions, let teams maybe experiment with different approaches. And I'm as curious as you are to see how the dust will settle when all of this is over.
So what does a return to work look like for you when we get to some sort of normal or new normal?
Well, so the first question is it legal to open our offices, right? Given the various restrictions in different cities. So we're not even there yet. And then is it practically safe to open our offices? And then the big question is, do we as employees feel comfortable being in our offices? I think we don't yet know how our habits have changed, the PTSD of being afraid of just being around people generally is going to affect things. So I think no matter what the law says, there's going to be a matter of kind of practicality that will require us to kind of inch our way in and feel our way as we go.
Now, we're just 6 days away from the election, and I know that you have spent many, many years trying to find the right balance of free speech and moderation on your platform. As we get closer to the election, I know you've made some moves over the last several months, for example, banning the subreddit, the Donald, for example. How do you feel about the community that you've created with now days to go?
We've spent the last, not just few months, but number of years refining our policies, learning from all of the lessons that we've seen over the last couple of years. Some we've learned the hard way. Some we can, have a better sense of what the challenges might be going forward. So based on everything that we've learned and that we know, we feel that we're very well prepared for, the kind of various scenarios that may come up over the next week. But that said, we are watching things very closely. Our communities are watching things very closely. We just sent out a message to our moderators, bringing hopefully them all in on the same page, because really we're all in this together. And I think that's one of the things that actually makes Reddit special, is that we, our moderators and our users, are all sharing this collective space together.
That was Reddit CEO Steve Huffman. And that does it for this special edition of Bloomberg Technology. Stay with us because Studio 1.0 is up next. I'm Emily Chang. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
She grew up in rural Indiana, the oldest of 4 siblings and a homecoming queen. While many of her female classmates dropped out of college to marry, she took a job at Clorox, where she helped launch
Fresh Step, the only paw-activated cat litter.
Fresh Step Cat Litter, and the beginning of a storied career. She went on to become the CEO of a software company, best known for its hit trivia game. You don't know Jack! And later, the first company to sell movies online. But it was the online pet store, known for its popular sock puppet Spokes dog, that catapulted her to the center of the dot-com boom, then became the poster child of the bust. As CEO of Pets.com, Julie Wainwright took the company public, then closed its doors within a year. 20 years later, she's looking for a better ending. In 2011, Wainwright launched The Real Real in an attempt to disrupt the online luxury consignment market. The company raised $300 million in a splashy public debut in June 2019. But the stock took a big hit on a report about the authenticity of its products. For this edition of Bloomberg Studio 1.0, I spent the day with Wainwright at RealReal's first retail store in downtown San Francisco, right before the global spread of the coronavirus shut down retail stores and other non-essential businesses across the Bay Area, and before the company withdrew its full-year outlook.
Joining me today on Bloomberg Studio 1.0, the RealReal founder and CEO, Julie Wainwright. Julie, it is so great to be here.
Oh, thanks for coming.
So the arc of your story is so fascinating. You took Pets.com public at the height of the dot-com boom, and then it became the poster child of the dot-com bust. 2 decades later, you take the RealReal public. Is there any sense of deja vu there, or is this a completely different story?
Oh my goodness. Well, the times are different. So if you look at when Pets.com went public, I think worldwide there were 200 million people on the internet. You had people really, really worried about shopping online. Look where we are now, 20 years later. Shopping online is, everyone shops online. In fact, I would say for most people, it's preferred.
So do you think you were just 20 years too early?
Oh, absolutely. Way too early.
Getting a little bigger picture, we've got the lingering trade tension between the U.S. and China. We've got the coronavirus right now, which is disrupting supply. We've got potentially gloom and doom about economic growth in the future. How does that impact your business?
This business was born out of a recession. We should fare extremely well because people get more value. There's $300 billion of goods trapped in people's homes worldwide. So we have a long time here. So I think we're going to do incredibly well. We're also not fad driven. We're value driven. We're environmentally driven. I think we're going to be really, really great. You know, consignment stores have been open forever, but no one's done it this way. And no one's focused on pulling the best product, describing the condition, authenticating it, offering it online, thousands of new products added every single day. And here we sit in our store. We have experts staffed in the store. So we'll have gemologists and watchmakers. We have stylists. And I think when you walk in, and you've seen it, I saw your eyes, you walk in and it's like the store comes alive.
Right. I can barely contain myself. I'm so distracted by all of these beautiful things.
It's a little treacherous. But you can rest assured, Emily, if you buy it, you can reconsign it.
At the same time, you've got the Macy's and JCPenney's of the world closing. So where is retail going?
Well, clearly it's restructuring. If you go into every major city, which I do, you see retail stores and department stores really struggling. Retail isn't going to go away. It has to be redefined.
Now, I want to talk a little bit about where you came from. You grew up in rural Indiana, the oldest of 4 siblings.
That's right.
What did you like to do?
Wow. Well, let's see. First, my parents went to art school. My father graduated. My mother didn't. She dropped out to marry my father. The big thing was when I was very young, like 4 and 5, neighborhood plays. So what do? So my job in the plays, I don't think this will surprise you, I was the person who picked the play, I casted the play, I collected the money, sold the tickets, collected the money, and other people were the actors. Then the other thing I did was I had a library. And so I lent books to people and I charged late fees. I was very strict on the late fees for some reason. When you grow up in Indiana, I'm outdoors all the time. I mean, the other thing is we all had much, when you look at it now, what we did, but we all had motorcycles from the age of about 10.
So hang on, you were a 10-year-old girl riding a motorcycle.
Well, by the time the youngest was 10, I was older, but sure. Now we all rode motorcycles, dirt bikes. So we rode motorcycles, we had go-karts. We used to ski Michigan, which isn't, which is fine if you live in Indiana, but it's not really skiing. It's mostly trying to not fall on ice. So we were out a lot. You were always outside.
Your mother was diagnosed with multiple sclerosis when you were young. I believe you were 8 years old. How did that change life for you?
Consciously or unconsciously, probably a little bit of both. I actually sort of became like, oh, I've got to step up. I was the oldest in the family. So the good news is, like, while daily things really bug me and I can get irritated, big things I can just roll with. It really does build up a grit as, my personal capacity to withstand a lot of change, to deal in a crisis is pretty high versus other people. I tend to get very calm. And I'm sure it's an early childhood training.
And yet you were the girl who rode motorcycles and still became homecoming queen.
Well, I was also good at school. I was homecoming queen, for like sophomore homecoming queen. I was on the student government. I graduated from high school not realizing how hard it is for women to do anything because I felt very empowered.
Were most of the women of your generation dropping out of school, getting married?
They were.
And
that was a little disappointing.
Like?
Well, I almost did it. I don't know. I probably haven't talked about it. I actually was engaged in college, and I was going, and he was a graduate student. And after he got his job, I was going to have to follow him. And I used to walk the invitations. I walked the invitations to the mailbox for a week. I could not put them in. I'm like, I don't want to get married. I kept thinking my life was going to get smaller. So I called off the wedding 6 weeks before the wedding. I was like being, it's hard to fight. It's sort of hard to fight crowd thinking and certainly cultural norms. And it was a cultural norm.
You took a job. You got a job at Clorox.
I just kept thinking I'm so young and it's the bigger world out there. I knew I was good at brand management. And my one professor made a call to the head of Clorox's research, said, you have to interview this person. Even though I was an undergraduate, they were only interviewing graduates. And I didn't even give it a second thought. Packed up, left, came here.
And you launched Fresh Step cat litter.
That's right.
Perfume. That was your big break.
Encapsulated perfume. Well, I started on bleach, liquid bleach. But yes, it freshened with every step. See, I even remember. So when I was at Clorox, there was women at my level. But at the general manager level, there were no women. And the rock star women were being put in, their career path ended up in HR. I kept thinking, I'm so young, I want to take risks, and got a call and joined software publishing, one of the first software companies, as a product manager.
So you became the CEO of a company called Berkeley Systems in 1994, which is best known for a game they marketed called You Don't Know Jack. And I don't want to gloss over this because the year was 1994 and you became a CEO as a woman. What did that take?
Let's be clear. It was failing. The company was failing. So,
but I don't want to minimize it either.
No. I turned it around. But look, I mean, at the end of the day, women do not get as many opportunities on really great companies. So the company was failing. The founder was tired. He didn't know what to do. I came up with a game plan. First, they promoted me to president. Then they promoted me to CEO. And we made it happen.
And then you kind of launched this career as a career CEO because you became CEO of another company, Real.com, the first company to sell movies online, and then came Pets.com.
Right.
It's easy to, remember that it went bust and maybe it was 20 years too early. But even Jeff Bezos back then had purchased a big stake in Pets.com. And I just wonder what you learned from that whole roller coaster of an experience.
It was incredibly hard on me. I didn't brush it off lightly. And, I learned to get over stuff and move on because I don't want to say wallow, but I would say, it's sort of like I went on my own odyssey. It almost took 10 years too. It was hard. It was hard on me personally, professionally. My marriage broke up. You
got a divorce at the same time.
Exactly, same time. But you know what? I have to tell you, if you're in a trench with someone and they're like, "I surrender," you're like, "Whoa!" You don't want to go to war with people like that. So look, at the end, I always say, when things are bad, then you know who your real friends are, and things get real. And in my case, they got real. We are the only company that works incredibly hard to keep fakes off the market.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Julie Wainwright is focused on disrupting the online luxury consignment market with The Real Real, a company with over 2,300 employees, including more than 150 in-house gemologists, horologists, and brand authenticators, and about 15 million members. The company rose 45% in its first day of trading after a spectacular $300 million IPO in June 2019. But since then, there have been bumps in the road, including having to withdraw the company's outlook for the full year of 2020 as a result of the coronavirus.
In 2011, you founded what became The Real Real. What was the germ of the idea that made you think this story would have a different ending?
I wanted to get back into e-commerce. How do you compete with Amazon? So I had this framework, a lot of good ideas, and it was really luxury. They can't do luxury. They can't do this. They can't do beauty well. So then I'm shopping with a girlfriend. I love to shop, and there's a little bit of consignment in the back of the store. She bought consignment. Now, this is someone who I have shopped with many times. I've never seen her walk into a consignment store. When we walk out, I'm like, what just happened? I was like, my mind was in. She was like, you just bought consignment. She goes, oh, who cares? I bought beautiful things at a great price. And then I said, have you ever consigned? She goes, no, have you? And I said, no. So that was it. And so I thought, this is a huge opportunity. Now you combine that with a recession, which had happened, pretty aggressive recession in 2008. People became value conscious. And by setting up a way for people to make money off their personal luxury goods, it actually changed the equation. We were telling our friends with this little warehouse in San Rafael, and we had visual merchandising. So meaning we had a rack, like, here's our Gucci, here's our Dior. How do we have 30 items that we can build a sale? We had a sale every third day. Instead of counting, we're like, oh, we got a rack, we can do a sale. I knew right away it was going to be a big success.
You were actually renting U-Hauls, picking up consignments, unboxing, boxing, right? Like everything. You were doing that yourself.
Of course I was. Who else was going to do it?
You did end up raising more than $350 million. You took the company public, huge, very successful IPO. Tell me about that moment and what that felt like.
It was actually just a fabulous day and a fabulous moment and a critical milestone for the company. It raised our visibility, gave us the capital, and I feel good about being a public company.
At the high, the company has been worth $2.5 billion. CNBC did a big investigation about authentication at the company, and they say that they found hundreds of items that were faked. What went wrong there?
We are the only company that works incredibly hard to keep fakes off the market. We have great processes, incredible sophistication, a great QC team, but it's still mostly human driven. We use AI and technology mostly to get rid of bad consigners, and also note, what happens, especially during the holidays, fakes filter in through the system. For our gemologists, they have a lot more equipment. Some of it's highly proprietary. That one is very, very, very sophisticated. But when you're looking at a handbag, we have people looking inside, checking serial numbers. So do we make mistakes? Sure. Do we make a lot of mistakes? No. In October, we processed over 420,000 items. We actually had 20 items out of those that were suspect.
I want to read the statement that you put out. You said, The RealReal has the most rigorous authentication process in the marketplace. We are the only resale company in the world that authenticates every single item. There is no other resale company doing more to remove fakes from the market every day and put counterfeiters out of business. How many fake items do you catch, and how many fake items do you think you miss?
Well, we know in October we probably missed 20. But here's the most important thing. For a consumer, you get a free return. We re-authenticate. We're not trying, our goal is to keep fakes off the market. Amazon reported in their last earnings, we have fakes that may hurt our business. It was stated as a risk to their business. That's not us. What we do is we try to keep them off. They're obviously comfortable with keeping counterfeits on. That's not us. Our goal is we take responsibility for our platform.
Yeah, so how is Amazon's approach different?
I think you'd have to ask them. They come across as agnostic because there are counterfeits up there right now. The key for us is to really keep that trust going. We have a great customer service department. We're here to keep counterfeiters off the market.
How does technology help you identify a real Chanel bag or that a piece of jewelry is truly authentic?
It's easier on the jewelry because we have so many machines that measure alloy content, for example, this is where a gemologist should be here, talking about the refraction of the colors, understanding the origin of the gemstone. I usually wear a lot of Cartier bracelets. We know the alloy content. We know how they cut diamonds. You can look at the bezel. We have magnifying equipment and also refraction. So we have logs of all of this. So we can go through and you can say right away, fake, fake, fake.
And what about the bags? I've been to China. I've seen the markets. I've seen the fake bags. Some of the fake bags look and feel really good.
I'm not going to say it's not easy. It's very, very hard. It's very hard. We have skilled people. We have a lot of data. We use scales. We use black light. We have a lot of techniques that we use regularly, and then all that knowledge is stored and shared. But look, it is hard. Counterfeiters get smarter. We have to get smarter. The jobs have changed in our operations center, and they will change. But it's also because we're automating what we can automate it to free up more time for deeper authentication. I think the board should do the right thing and have governance, absolutely. And that book will be written on how SoftBank makes investments.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
The market value of the company went from $2.5 billion to now $1.5 billion. What do you think is next for the company that is going to turn that around?
Well, look, I mean, the stock market, we have to be conscious of it. We have outside investors. But the key is, ever since we've gone public, we beat plan every single quarter. So we've done better than we said we're going to do, and we're going to keep executing. It's really as simple as that. My belief is the gap will correct itself. Our brand isn't very well known. We're at about 20% awareness. Getting our brand out, satisfying our customers, the stock price will take care of itself.
What's next for The RealReal in the next 5-10 years?
So given the fact we have about less than 2% penetration of all potential consigners and buyers in the U.S., we have a long way to go in the U.S. We have huge opportunities in Europe also. So worldwide, we're going to be a worldwide company. There's no doubt about that. We're looking for good locations. We're maybe 10 to 15 stores in the U.S. total. We're at 4 now, so we have a ways to go there. Retail goes hand in glove. Men's is really a high growth category for us. We're underdeveloped there. So we have a long way to go there. We have a long way to go outside the U.S. We're just getting started.
Folks like Jen Hyman, the CEO of Rent the Runway, she's made the argument that in the future our closets will be rented. We might buy a pair of jeans or a white t-shirt, but everything in our closet we will rent, like Netflix movies. Do you buy that?
Rental has a really strong place. So I don't think everything, I mean, if you think about it, if you spend money to rent but then you own nothing, people are going to buy. I think a large portion of it will be rented. Clearly, they've done a great job, but we're going to have a place. I mean, at the end of the day, if you buy something and then you resell it, to be honest, we have people that buy and resell from us all the time. It's cheaper than renting because you're buying something that has intrinsic value that can be resold if you take care of it.
What was it like pitching this idea to mostly male investors?
It was a zero-sum game. We had Matthias Schilling of eVentures that got it right away. I always say he doesn't count because he's European, right? So he understood luxury. No other male actually invested in Series A, and I met with all of them. As soon as I met with a female early stage investor, they're like, don't go anywhere. We're going to do a term sheet. This is awesome.
Clearly, we've talked a lot about how there are not enough women investors, not enough female entrepreneurs, not enough women getting funded. But what do you think is worse in Silicon Valley? Is it sexism or is it ageism?
Oh, I don't know. They both go hand in glove. So look, there's a lot of unconscious on both sides, unconscious sexism. There's blatant sexism. I actually graduated from college with only a couple professors making sexist comments, but thinking the world was mine. And then you get here and you just get stopped and stopped and stopped. So you fast forward 40 years later, and we haven't made that much progress. As a person sort of at the end, you know, let's say I've got another 15 years really working hard and loving it. It's sort of heartbreaking that you sort of walk out and all your innocence gets stripped. I think we have a long way to go.
Well, let's talk about the age thing because this, you know, some would argue, you know, part of the problem was the prioritization or idolization of these super young male founders. You know, I wonder what you think of that.
Yes, the bro culture is real. I actually blame Andreessen when they had all that money. They're like, oh, founders we're never going to fire a founder. In my head, that's where it sort of clicked in, where the culture shifted.
Really?
My job was replacing founders. I wasn't the founder of Pets.com. I replaced the founder. I replaced the founder in Real.com. I replaced the founder in Berkeley because boards were very active. All of a sudden that goes away where founders are king. I mean, you've got young kids, a lot of money, a lot of irresponsible, horrific behavior. That is on the venture capital firms, and they have to take a hard look at the way they're managed. They're not professionally being stewards of the businesses. So that's on them, and it is really bad. And the stories come out, and you're like, how about the WeWork thing? Come on.
So do you think more founders should be replaced?
I think the board should do the right thing and have governance, absolutely. And that book will be written on how SoftBank makes investments and how they govern. But it wasn't just SoftBank. Mm-hmm. But, think about it. He's got this plane. He's got this. He has his ice spa in his office. Come on.
So then what still needs to change?
Everything.
Here?
I think at the end of the day, public companies would not accept this.
Do you still feel like you face some of these behaviors, or you face some of this discrimination, even though you are kind of like a unicorn in that you are a woman who succeeded when no women were succeeding in Silicon Valley? Like, is it something that you still feel yourself?
Yes, I felt it recently, and it was really interesting. It was sort of unpalatable. But, you know, here's the other thing. When you look at what happens, my age is in the press all the time. Fine. But do you really ask male CEOs, how old are you? Of course not. I mean, that's just crazy. But, I mean, you know, at the end of the day, you got to pick your battles.
And what's your advice today to women, young, old, black, white? Would you tell them to lean in?
Look, I don't think it's about leaning in. I think it's about continuous learning, being curious of what you do, figuring out where your values lie, and aligning what you do with your values. I think it's critical. Harder to do when you're younger. Use every opportunity to learn. And the other thing, own something. So, for instance, if you say, I did this, and here are the results, and here's what I learned, you're so much more valuable than not owning something.
Julie Wainwright, founder and CEO of The Real Real, thank you so much for joining us.
Thanks, Emily.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Remember, this was not announced as a complete trade deal. This was announced as a phase one. So we and the Chinese both are well aware that there's much more to do.
Good morning, I'm Paul Allen in Sydney. We're counting down to Asia's major market opens.
I'm Sherrian in New York. Welcome to Daybreak Asia. Our top stories this hour. Asian markets look set to fall as futures point lower. Hope is fading for bigger relief checks to American households. The dollar continues its decline. The $2,000 check stumbled in the Senate, with Mitch McConnell blocking Democrat hopes of quick action. President Trump says Republicans have a death wish. The UK and the EU will finalize their Brexit trade deal later today, formalizing last week's accord. It will be signed in Brussels first, then flown to London. Let's kick things off with breaking news out of South Korea. We are getting the industrial production numbers for the month of November. Now, the month-on-month number has missed expectations, but the year-on-year number has beaten expectations, growing 0.5%. This after a contraction in the previous month, a revised upwards contraction of 2%. The month-on-month number missed expectations, growing only 0.3%. But we have to mention that these numbers have been pretty volatile this whole year. We do have a strong electronics industry with exports rebounding in South Korea, but of course we have continuing COVID infections around the country, really muting domestic demand and also dampening economic prospects. Again, the year-on-year number beating expectations, growth of 0.5%, Paul.
Well, let's take a look at markets now. We have just opened for trade here in Sydney. We're kind of flat at the moment. It is early days, though. We do, of course, have the staggered open here, although our BHP is trading a little higher at the moment. We are watching those iron ore miners today. If we take a quick look at New Zealand, that's been trading for a couple of hours now as well, currently higher by about 0.1%, continuing to nudge those record highs. Futures for the Nikkei looking kind of flat, and E-minis for the United States in slightly positive territory as well. And that does bring us nicely to our top story for the day. Those hopes for higher $2,000 relief checks for American households did stumble in the Senate. Majority Leader Mitch McConnell blocked attempts by Democrats to force quick action on a bill that the House had passed earlier. So let's get the latest on this from our government congressional reporter, Emily Wilkins. So, Emily, Mitch McConnell's move there did anger President Trump. He said Republicans who don't support this change have got a death wish ahead of the Georgia Senate runoff. So what's next in store for those $2,000 checks?
So McConnell hasn't given up necessarily on these $2,000 checks. Obviously, neither has President Trump. McConnell said today that he could potentially see bringing a vote on those checks to the floor, but it would be in a larger bill that would contain opening up an investigation into potential election fraud and reworking a law that shields technology companies for being liable to user content. Now, such a bill is not expected to pass in the Senate. But remember, even though we are seeing some Republicans come out and voice support for these $2,000 checks, a number of other Republicans are really sticking to their fiscal conservative roots and saying we cannot increase the federal deficit by the amount that these checks would require.
Yeah, and Emily, those direct payments actually going to start arriving by tonight, according to Secretary Stephen Mnuchin, saying that the direct deposit payments may start arriving by tonight. The paper checks will start being emailed or mailed actually tomorrow. So let's talk a little bit about the Georgia runoff races that Paul mentioned, because, of course, these checks very critical on what could happen January 5th.
Absolutely. I mean, as soon as Trump said that he supported these $2,000 checks, you saw the two Democrats in the race, John Ossoff and Raphael Warnock, immediately say, yes, we do want Americans to get more funding. They think this is something that's going to be very popular, obviously something that Democrats have backed. For a while, this put the Republicans in a very awkward position. Did they want to support fiscal conservatism, or did they want to back Trump? Today, they decided they want to back Trump. Both Republicans who are running in the Georgia Senate race came out in support of the $2,000 checks. And this really speaks to how important Trump's support is going to be for turning out Republicans in the Georgia Senate runoff.
Our government congressional reporter, Emily Wilkins there. You can get more on the stimulus developments and a roundup of the stories that you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers go to DayBgo on your terminals, also available on mobile in the Bloomberg Anywhere app. Let's now get to Karina Mitchell with the first word headlines. Karina.
Sherry, the top U.S. infectious disease doctor, says the country's vaccination plan is lagging and repeats his worry about a post-Christmas infection surge. Anthony Fauci tells CNN that he had hoped more people would have been given a shot by now. Elsewhere, the EU will take an additional 100 million doses of the Pfizer-BioNTech vaccine, with the reported virus variant in the UK described, quote, as a game changer. Meanwhile, the UK and the EU will sign their Brexit trade deal later Wednesday, formalizing the accord they eventually agreed last week. It will be signed in Brussels first, then flown to London for the Prime Minister's approval. British lawmakers will have only one day to debate the deal, with Boris Johnson wanting it on the statute book before the UK finally leaves the EU on New Year's Day. And the EU and China are set to agree an historic trade deal, an investment deal, later Wednesday, after 7 years of often intense discussions and concerns about control and human rights. Sources in Brussels say a provisional agreement will be announced later after Beijing committed to ratifying ILO rules on forced labor. The deal is seen as a blow to the America First campaign promoted by President Trump. And Hong Kong media tycoon Jimmy Lai is stepping down as chairman of Next Digital after being arrested and charged under China's sweeping national security law. He says it's to spend more time dealing with its personal affairs and comes as prosecutors allege he colluded with foreign forces by calling for sanctions against China. Lai is free on bail, confined at home, and prevented from giving interviews. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Sherry.
Right, still ahead, we speak to TPW Investment Management CIO Jay Pawlowski about his strategy heading into the new year. He joins us next. This is Bloomberg.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Substantial further progress means what it says. We'll be looking for an inflation to be substantially closer to our 2% longer run goal before we start making adjustments to our purchases.
That's a long time to be very accommodative, but that's basically the horizon.
They can buy more bonds and they can buy longer maturity bonds, and that would put more downward pressure on long-term interest rates.
Asian futures under pressure after U.S. stocks retreated from record highs. Our next guest says that overbought conditions could lead to a further pullback in the near term. Joining us now is Jay Pawlowski, CIO and co-founder of TPW Investment Management. Jay, always great having you with us. Then does this mean that this could be a rather healthy correction? And what should investors do in the meantime as they position for 2021?
Yes, Sherry, I do think it's quite healthy, and we're in the middle of the Santa Claus rally. The period December 24th through January 5th is the best 7-day period of the year. And more importantly, if markets are up during that period, it suggests that the first half of the next year is up on average 5%. And so I do think pullbacks are healthy. This period right here suggests we're going to do well. The other point I would just mention is that November and December, the S&P is up over 12%. There's only been 7 other times in history where those 2 months have been up over 10%. And when that happens, the next January, so next month, average is up 5%. So I think it's important to stay invested and to prepare for 3 big things as I see them: a global economic boom leading to a great rotation and a golden age for asset allocation, particularly around different thematics being expressed in the markets.
Tell us a little bit about those thematic investments that you will be pulling your money into, given where we're headed in 2021.
Yes, well, I think first off, we're going to have a continued bull market in equities, but investors need to think about outside the U.S., need to think about value, financials, energy, need to think about commodities, and a bear market in bonds, very importantly. Thematically, I'm a big believer that COVID speed, something we focused on since the spring, is now breaking out beyond healthcare to climate, cyber, and other major global issues. And there's a absolute abundance of money and liquidity, and the markets have seen the model. We got a vaccine in less than a year, where it typically takes almost a decade. That is now going to be focused on climate, and you see it already in the markets in terms of very intense investor interest in a very few number of instruments available to express these ideas. And that's where I think investors should be focusing their attention, not just stocks versus bonds, not just U.S. versus non-U.S., but thematically, where are you positioned in cyber, in crypto, in electric vehicles, et cetera?
Jay, I just want to briefly interrupt you there. We are getting some breaking news from Texas and an update on new virus cases there. You can see it on the bottom of your screen at 26,990 new cases, and that does shatter previous records and also dovetails with the warning we heard from President-elect Joe Biden a little earlier about the situation in the U.S. Getting worse before it gets better. So nearly 27,000 new COVID cases in Texas. Jay, I just want to return, if we can, to that point you made about COVID speed developments. So we certainly have seen a rapid pace of change in 2020. But does that mean COVID-style volatility heading into 2021 as well?
No, I don't think so, Paul, because we're not going to go back to a complete outbreak, a pandemic. We're on the other side of it already, and markets are forward-looking, which is why the news that you mentioned really doesn't affect the market. The market believes that knows a vaccine is in place, multiple vaccines. No people are going to get inoculated, bring down the death rate, bring down the hospitalization rate, and lead, and I believe, to within 6 to 9 months, a completely different outlook, much more similar to pre-COVID than 2020. And in that environment, I think investors need to really focus forward and think about opportunities in the areas I mentioned a minute ago.
Yeah, let's talk a little more about those areas. You've nominated quite a few, including electric vehicles, clean energy, financial technology. Do you have any names in those sectors that you particularly like the look of?
Well, I focus primarily on ETFs, as you know, and I think there are a number of ETFs, things like ICLN, for example, on the climate side, or CARS, KARS, for electric vehicles. I think there's opportunities in cyber, particularly things like HACK, H-A-C-K. Crypto, folks know about the fusing of fintech and crypto, focused based on primarily a worry about inflation and lack of inflation protection given where bond yields are. I think that's going to be the big thing that's going to surprise people in 2021. You are going to get an inflation scare. Bonds are going to go higher. Currency debasement is visible in the dollar. And so real yields go lower. And I think there's going to be an opportunity set both in precious metals as well as in cryptocurrencies. And we're fusing cryptocurrencies with fintech as things like PayPal take Bitcoin as payment mechanisms. And so the speed that I'm talking about, Paul, can be expressed. We used to be driving at 55 miles an hour. Now we're driving at 65 miles an hour, and we're not going back. The market has seen the model of abundant financing, government focus, intellectual property, and getting a vaccine. That is now shifting in the climate space and in other spaces, and that's what's going to be the surprise, I believe, of the next several years, supported by central banks allowing inflation to go higher and not stepping on the brakes till 2023 or 2024. We have a couple of years, I believe, of very strong global growth and abundant returns in risk assets.
All right, Jay Pawlowski, CIO and co-founder of TPW Investment Management. Thanks for joining us today with your insights. Let's turn back now to U.S. relief. Peterson Institute President Adam Posen says it's hard to imagine why Mitch McConnell blocked Democrat attempts to pass higher checks. He spoke exclusively to Bloomberg about the stimulus package.
In economic terms, what we have to focus on is we have unnecessary human suffering and a lot of uncertainty for poorer people or unemployed people because of the disruption in getting the $600 checks out the door. But the stimulus package that is going to get approved or has been approved is really one that includes some of the key aspects you need, which is extending unemployment insurance, extending it to gig workers, backing the moratoriums on evictions, giving some aid to school systems. What's missing is state and local government aid, which McConnell also blocked previously. In terms of the dynamic you talked about, it's hard to imagine. It's just like the people who've been writing commentary. Maybe if Trump had passed stimulus earlier, he would have won the election. People do seem to value a check in their hand, so it's hard to understand why McConnell is opposing it.
Adam, I want to get to some of that aid to state and local governments, but first, I want to get to something that we spoke to about Larry Summers and the actual size of those checks that you were referring to. And he said Democrats capitalizing on the rift between Senate Republicans and the president might be good politics for them, but it isn't good economics, saying that this sort of arbitrary number of 2,000 is not as targeted as it should be. Do you agree?
I disagree with Larry on this particular point, because if the choice was getting out the $600 or getting out the $2,000, and that was the choice, then obviously get the $600 out because it's more important you get it out timely, and it's more important you get the whole package out. And probably Larry agrees with that. The idea that the 2,000 is going to be that big a difference versus 600, I mean, what you'll end up doing is a lot of people will put it in their savings accounts. So you won't get maximum stimulus, but a lot of people have a lot more than $600 need. So if it goes into their savings accounts, you tax it, you'll get it back later. I don't view this as a big deal versus making sure that the stimulus we've got passed. I wish it had been even faster. If you were designing this from the start, and this is where I agree with where I think Larry was going, if you designed this from the start, you would have wanted more emphasis on needs, on state and local government, on unemployed people, on evictions. You already have some of that, but have more of that, on loans to small business, not based on giving everybody a check.
There are baby boomers who are having to act as child care centers. There are parents who have been having to pay for tutors. Definitely that $2,000 can go a long way to the middle class as well as the lower middle class. And that should be something everyone agrees on. Let me ask you this in terms of where the United States, in terms of stimulus checks, compares to other European countries. For example, how has the United States stacked up against other countries in terms of providing stimulus check relief to its citizens?
The U.S. has put out there more than most European countries and most other rich democracies, Kevin, but the gap is smaller than the top line number, because in every other rich democracy, the welfare state's much more generous. You have health insurance, you have college paid for, you have various other provisions. So this is more what the U.S. calls discretionary spending every time Congress has to pass it. Even if you take that into account, though, the U.S. has spent more. Then there's a debate about whether it's done more good or not, because a lot of the European countries, France, Germany, some of the others, have tied their aid much more to keeping people in their current jobs and keeping current businesses afloat. In the U.S., as my colleague Jason Furman has written about, it's been more disengaged. It goes to unemployed people. It goes to people who may be leaving their jobs. And there's pluses and minuses to that. So, yeah, the U.S. has spent more, but it's partly catch up because we don't have a big enough safety net. And it's definitely we've spent differently. And only over the next year or two will we see what difference that makes.
That was the Peterson Institute's Adam Posen speaking exclusively with Bloomberg's Kevin Cirilli and Taylor Riggs. Coming up next, Boris Johnson looks set to avoid a Commons rebellion when his Brexit deal is put to the vote. Details ahead. This is Bloomberg.
we have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Does it really enhance transmissibility, as has been suggested? Does it really prevent antibodies from binding? These are still questions that scientists are hopefully going to answer in the coming weeks.
The UK-EU Brexit deal will be formally signed later on today, even as the British outcry over the deal's failure to address key issues continues to grow louder. Bloomberg Global Economics and Policy Editor Kathleen Hayes joins us now with more. So, Kathleen, where are we at with the approval process and what comes next?
Well, the approval process is making great strides. Look, we had the big breakthrough when they announced the deal last week. What was it, Christmas Eve? Quite a Christmas present to a certain extent to the people of the UK and the European Union. But where we are now is the European governments have all approved the Brexit deal. This is not a surprise. Remember, the EU ambassadors all approved it on Monday. So this is the next step. But now the door is wide open to get the deal in place in time for January 1st, when the transition period has ended. Now, today in the UK, what was very important is that a group of Tory hardliners, conservatives in the UK Parliament, the European Research Group of Conservative MPs, also got on board because they say the deal reaffirms the sovereignty of the UK. What they're referring to is laws. They are adamant that they want the UK to make its own laws. They don't want the European Court of Justice or anybody like that involved in what the UK is doing. And in fact, for a lot of people who voted to leave the European Union, this was what was driving them more perhaps than trade or anything like that. So that was a victory for Boris Johnson. And so now when the House of Commons votes tomorrow, they're supposed to vote about 2:30 in the afternoon, UK time. House of Lords then votes in the evening. Everyone is expected to put this through, even the Labour Party, because even though they've criticized it as being inadequate, they don't want a hard Brexit deal. So that's why so many are on board.
Kathleen, in any agreement, there's going to be an industry or two that gains less or just completely loses out. What are we hearing?
Well, I think the biggest thing we're hearing, and we saw a big rally in the UK stock market today. It looked like an applause. You got the Brexit deal done. It gives you free trade if you're in the UK, but bank stocks tumbled. And I think now what many commentaries have said that the UK government is all going to be hard-pressed starting right now to get some things settled like equivalence. They no longer can automatically, financial services companies, that is, from the UK, do business in the EU. They're going to face all kinds of obstacles. Apparently, they have only obtained 2 of 39 equivalences in the negotiations, so that keeps them in a not-so-great position. The Brexit deal did not provide for accountants, UK accountants' credentials to be recognized in the EU. That seems kind of a surprise. There's like 500,000 people in the UK who work as an accountant. A lot of that business done with the EU. That's another big complaint. Now, the Scottish First Minister, Nicola Sturgeon, not surprising, say the Brexit deal is going to be disastrous for Scotland. Interesting to see how their move to get independence and rejoin the EU goes. And finally, even on the other side of the English Channel, there are complaints. Irish fishermen are going to lose about 15% of their national quota of the UK's fishing rights by 2026. So a lot of displeasure. Nevertheless, this deal surely looks like it's going through, Sherry.
our global economics and policy editor, Kathleen Hayes. And here's a quick check of the latest business flash headlines. Apple briefly touched an intraday record at its year-end surge, sends the stock above Amazon as 2020's best tech performer. Shares have gained 16% in December alone on strong demand for the iPhone 12 and optimism about its venture into self-driving cars. Wall Street is increasingly bullish about Apple's prospects in 2021, with the COVID recovery scene fueling even more demand for its products. Activist investor Dan Loeb is calling on Intel to explore new strategies, including a possible breakup and the sale of assets. Third Point has built what he calls a significant stake in Intel, and Loeb says he intends to push for change, including at board level. He adds that Intel has dramatically underperformed in recent years, losing more than $60 billion in market value this year alone. Hong Kong Exchanges and Clearing loses its chief executive this week with no long-term successor in sight, and is now said to have lost other senior figures in recent months. We're told General Counsel Furi Mohammed and HR head Eva Chow have left this year. HKX has appointed Chief Operating Officer Calvin Tai as Charles Lee's interim replacement, with a full-time chief executive to be named later. And of course, we do have that exclusive interview with Charles Lee. He opens up about the reforms that helped transform the city into the world's top fundraising venue. This is Bloomberg.
This is Daybreak Asia. I'm Karina Mitchell with the First Word headlines. Attempts to boost relief checks for American households to $2,000 stumbled in the Senate, with Majority Leader Mitch McConnell blocking Democrat hopes of a quick action. His move triggered anger from President Trump, who tweeted the Republicans may have, quote, a death wish by failing to act. Higher checks would cost about $460 billion, which worries fiscally conservative Republicans. Meanwhile, Russia is stepping up pressure on opposition leader Alexei Navalny, opening a criminal case against him for alleged fraud. Prosecutors say he spent about $8 million on personal use from political donations. Navalny says President Putin wants him in jail after a failed nerve agent assassination attempt in August, and that the latest move against him is Kremlin hysteria. Carolina Panthers tackle Russell Okung has become the first NFL player to be paid in part, at least in Bitcoin. The team will continue to compensate him in dollars, but Okung half of his $13 million salary to the digital coin using Zapstrike. The platform facilitates payments that are translated into Bitcoin from traditional currencies. Ocon's Twitter bio reads, "Life, Liberty, #Bitcoin." And fashion game changer Pierre Cardin has died at the age of 98. He upended couture in the late 50s when he broke with traditional design houses and offered ready-to-wear clothes in department stores. He made his name with the space-age look, pioneering bold geometric patterns in vinyl and plastic. Fashion was only a part of his empire. He also designed eyeglasses, umbrellas, perfume, luggage, even skis. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Sherry.
Colorado has just announced it's found the first known U.S. case of the reported virus variant that originally emerged in the U.K. It comes after President-elect Joe Biden attacked the current U.S. vaccination plan, criticizing the slow rollout under the Trump administration.
The Trump administration's plan to distribute vaccines is falling behind, far behind. With only a few days left in December, we've only vaccinated a few million so far. And the pace of the vaccination program is moving now, if it continues to move as it is now, it's going to take years, not months, to vaccinate the American people.
For more on the latest virus developments, we're now joined by our healthcare reporter, Michelle Cortez. And Michelle, let's start with that UK variant already in the U.S. How concerning is this when we continue to see this surge of infections around the country? Just now, Texas logging almost 27,000 new cases, shattering its previous record.
Yeah, that's exactly the issue. The fact is that this variant is up to 70% more transmissible than the previous variant. Now, it doesn't look like it's more dangerous. It doesn't cause more severe infections, and it's not more likely to kill you. But at this point, we're really trying to lock down and stop these cases from spreading. We have these vaccines that are arriving now, and it does appear that they will be effective against this variant. But really, we want to shut it down. We don't want this variant or any other strain of the virus to be spreading, because that's when mutations can happen. What we really want to do is avoid it entirely. So the fact that we know that an easier to spread version of the virus is here in the U.S. is just a worrisome sign that it could accelerate the pace of the outbreak.
Michelle, is Joe Biden's criticism of the pace of the vaccine rollout a fair statement? Because this is a monumental undertaking and it's very early days. Is it all the Trump administration's fault?
It's not all the Trump administration's fault, in that anytime you're getting something started at this kind of level, there is going to be hiccups, there are going to be challenges. Certainly things could have been done better right from the beginning. There could have been a national, federal policy in place for how to roll this out. And we have known that these vaccines were coming. Certainly we didn't know that they were all going to be as effective as they were, but we are seeing these vaccines get out to the states. Most states have tens of thousands, if not millions of vaccines already available in their locations. It's just a matter of getting them from those packages and from that frozen state into the arms of their residents. And that's a challenging process. Certainly, there could have been more money put towards this. There could have been better planning. There could have been more routes of administration available to folks so that we wouldn't just be trying to handle all the nursing home residents, all the first responders, all the healthcare professionals, and leaving everyone else at the beginning. There could have been a broader approach and a more federal organized approach. That being said, no one has ever done this before in the history of the world. And we're trying to vaccinate everyone.
We continue to see vaccination rollouts also across the world, and this coming at a time when Argentina today just started inoculating its citizens with the Sputnik shot. But skepticism out there on not only the Russian vaccine, but also the Chinese one.
We don't really have an awful lot of information on either one of these vaccines, and that is what is making people in the U.S. and some other Western countries concerned. We really do like to be able to drill down, look at the details, know what kind of side effects were emerging, how effective the vaccines might be, and who's going to respond to them best. When you don't have that kind of information, it's really hard to gauge how safe and effective they're going to be. That being said, there is no doubt that we need vaccines. We need a wide variety of vaccines, and we need them all across the world. So we certainly hope that the Chinese and Russian scientists who developed these vaccines and the public health officials who are administering them and rolling them out are putting their own health and their own reputations on the line here, and that they wouldn't be bringing anything to market that was going to be causing damage to people who are receiving them. That being said, we are having to take it on faith at this point, and we will know in the next couple of weeks to months just how effective those vaccines are going to be.
All right, healthcare reporter there, Michelle Cortez. Johns Hopkins University senior scholar Amesh Ajal told us what more approvals for the Oxford University AstraZeneca vaccine are going to mean for the world and the challenges healthcare workers are facing. He spoke to Bloomberg TV earlier.
I definitely think it can only get easier as we get more candidates on the market, especially if they don't have really strenuous cold chain requirements the way the Pfizer vaccine does. And the AstraZeneca vaccine, I think, is going to be a win for the world, because if you think about trying to keep the cold chain intact in parts of the developing world where there is not very stable electricity, let alone access to deep freeze storage, I do think that this may be the vaccine for the world when it does get its approval.
One of the big challenges at the moment appears to be staffing. And it appears to be, and I keep bringing this up, there appears to be a zero-sum game that's working. On one hand, we have the need for staff to deal with the ongoing spike in cases that we're seeing around the world. On the other hand, we need staff to vaccinate people. Is it a zero-sum game? And in the moment, are we finding ourselves in a situation where we simply don't have the people to deliver the vaccines that have already been delivered?
Staffing in healthcare centers has almost been something that's kind of defies what happens in other markets, where there is an increased demand for labor and then more people go join that, because there's so many barriers to becoming a healthcare provider. You can't just hire people. And, you know, it's unfortunate because we've had a long lead time. We knew that there was going to be this surge of cases in the winter, yet many hospitals didn't really have the resources to increase their staffing, increase their capacity. And it is true, if your hospital is busy dealing with so many COVID patients and you've got staff out sick because they're getting COVID in the community, you're going to have a much harder time having enough people to vaccinate. We are seeing vaccinations in the United States at least ramp up now. It was something that kind of trickled out in the first days of the vaccination. I waited a couple of days before I was able to get my vaccine, but now it seems to be moving at a much more rapid pace. But yes, I do think as we move into the community, away from hospitals and nursing homes, we're going to need a lot of community vaccinators to be able to get enough shots in the arms of people to hit herd immunity. So I do think this is something we have to really think about, a sustainable approach to vaccination.
In terms of what you're expecting over the next few weeks, are we going to see a spike in cases as a result of the holidays? How big a spike do you think we are likely to see? I think I was on one of the front pages of the newspapers this morning that we have seen post-pandemic records in terms of air travel over the last few days.
It's inevitable that we're going to see a spike in cases. You have to remember that this virus thrives on social interaction, and many people traveled from one state to another and went to private gatherings where likely they let their guard down, didn't wear face coverings as meticulously as they should have. So we're going to see some level of transmission. Hopefully it's not something that really puts us kind of on a surge on top of a surge on top of a surge, to borrow Dr. Fauci's phrase, but it's likely that we will see some level of increase at a time when we already have record numbers of cases and record numbers of hospitalizations. Hopefully people took some level of precaution so that we won't see as the worst case scenario. I think that happened in some parts of the country during Thanksgiving. We did see increases all over as a country as a whole in the United States, but some states we did not. And maybe, hopefully that will happen again in Christmas. But I do think we have to be prepared for more acceleration of cases as we get into the next few weeks.
Are you expecting more transmissible variants to now be a feature of the landscape in the United States? And if so, does that push the herd immunity point out even further into 2021?
I do think, based on what we're seeing in the UK and South Africa and what we know about the lack of sampling and sequencing we do in the United States, this variant has been in the United States. These more transmissible variants likely have been here, and it shouldn't be a surprise when they actually detect that these variants are here. They've already detected the variants in Canada, for example. But I do think that if everything that we know about this variant, I think it's not all fully been proven. A lot of this is laboratory modeling. If we can actually show that this is what's happening, that this transmissibility is due to these mutations, and I think that's a fair hypothesis based on what we're seeing, I do think it does raise the herd immunity threshold, because the more contagious something is, the more of your population needs to be protected against it. I think that kind of ratchets it up closer to 75, 80% needed for herd immunity if you're looking at the population at a whole. But I think we'll see benefits from the vaccine once we get our vulnerable populations vaccinated, because that's really what's putting pressure on hospitals. It's those vulnerable populations, nursing home patients that are taking up hospital beds, that are using that are in the ICU, and that are a big proportion of our deaths. If we can get that group protected, I do think that you'll see a difference in the way we perceive the risk of this virus because of those vulnerable populations being immune.
Johns Hopkins University senior scholar Amish Adalja speaking to our colleague Guy Johnson. That school is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. And here's a picture across equity markets in Asia. We are seeing the ASX 200 under a little bit of pressure. We are seeing real estate and technology stocks leading the declines after 3 sessions of gains, and Kiwi stocks also at the moment reversing some of those earlier gains. But remember, Kiwi stocks were at a record high and 4 sessions of gains already seen this past week. U.S. futures unchanged after stocks fell from record highs, and you can see Nikkei futures under a little bit of pressure, but this, of course, after closing at the highest level since August 1990. Let's take a look at what the key drivers this year for Japanese stocks has been. We're joined by Asia Equities editor Kurt Schussler in Tokyo. Kurt, so we have seen this huge rally in Japanese stocks recently, especially with the rotation towards cyclical stocks. Who have been the biggest winners?
Well, Japan is known for video game makers, and they really came to the fore this year with the stay-at-home lifestyle trend driving up demand for home entertainment. 3 of the big game software makers, that's Nexon, Koei Tecmo, and Capcom, also their share prices double on the year. Among the big console makers, they had Nintendo jumping 50%, and Sony climbed 40%. Also, online retail did very well, as we saw around the world with Amazon and JD.com. Here in Japan, virtual flea market operator Mercari saw 100% gain. Also, big gains for drug makers, anything involved with coronavirus treatments and vaccines. Another interesting area is online health. Now, the biggest advancer on the Nikkei 225 this year was a company called M3, which does telemedicine, and they also have a service that allows pharmaceutical makers to virtually market their drugs to doctors, which was really helpful this year with all the social distancing measures.
Kurt, how about those stocks that did not perform so well? Which ones were the biggest losers?
Well, the slide in oil hurt 3 of the biggest Nikkei decliners this year. Companies involved in energy exploration and related engineering projects, Inpex, JGC, Mitsui E&S, all those stocks dropped by around 40 to 60% on the year. Another big loser was luxury and travel goods, suffering from lockdowns and other restrictions. We had a camera maker, Nikon, watchmakers, Citizen, and Seiko. Those stocks all slid about 50% on the year. And anything to do with transportation and retail saw substantial losses. Shares of the Japan railway companies and the airlines, ANA and JAL, fell like 30%. And the department stores all took big hits as well.
All right, Kurt Schussler there. Thanks very much for joining us. That's Asia Equities editor Kurt Schussler. Still to come, traders at the biggest U.S. banks are bracing for less than stellar bonuses despite soaring revenues. We'll have that story in a moment. This is Bloomberg.
a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
The biggest U.S. banks are tempering expectations for bonuses this year, despite the huge trading bonanza. Finance reporter Lanan Nguyen has this story. And Lanan, of course, traders crushed it, but that doesn't mean the rest of the business did that well.
That's right, Sherry. So the traders this year appear to be carrying water for the rest of the banks, particularly in banks where there's a large consumer division, which may, kind of see some strains from the pandemic. So it looks like this year bankers and traders might be disappointed by their bonus checks, despite trading revenue going up significantly.
So if we consider a scale of the most generous to the least generous, where do the banks stack up?
It looks like JP Morgan and Goldman Sachs will be among the more generous. Their trading revenues were up more than 40%, and probably the best paid traders there can expect bonus pools to rise by about 20%, whereas Citigroup and Bank of America are maybe going to be more on the conservative side. Bank of America may have a flat bonus pool, and Citigroup may also be flat in the equities division.
So for those dissatisfied traders, perhaps, could we see them jumping ship?
Well, it's very difficult to jump ship in an environment like this, right? This is not a good time to be interviewing for a new job. Jobs in banking are scarce anyway, and it's highly competitive, and the banks have been making cuts for the last few years. So maybe the highest performers will be able to sort of command, new offers from competitors. But for the most part, I think it's a question of kind of like it or lump it here.
In the last few years, the banks have also been facing a lot of scrutiny when it comes to pay. So how much does politics play when it comes to making these bonus decisions?
Well, I think it's partly an excuse as well, because the banks obviously face a lot of scrutiny when it comes to pay. And, it's not a good look this year when so much of the economy is doing poorly and so many people are struggling to then pay mega bonuses to bankers or, see bankers driving around the city in Ferraris. So, that does play into this. The optics are very, very important this year. So, it makes sense for banks to be conservative because, it helps them to conserve their capital, but it also doesn't set up an embarrassing situation where they've, paid someone so much and, the rest of the economy is hurting.
Bloomberg finance reporter Lanan Nguyen there. Well, coming up next, how the pandemic is changing the oil trading industry and how banks are more wary of financing small companies making bold bets. And be sure to tune into Bloomberg Radio to hear more from the day's big newsmakers and get in-depth analysis from the Daybreak team. Broadcasting live from our studio in Hong Kong, you can listen in via the app, Radio Plus, or BloombergRadio.com. Plenty more ahead. Stay with us.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
If they're not, then it is fines, another fines, repeated fines, behavioral commitments. But there is the option eventually to ask for a divestiture, splitting up a company as the last resort.
Let's check in on some of the stocks we've been keeping an eye on in Sydney. We have seen the iron ore price easing a little bit overnight, and some of the big miners here are easing a little as a result as well. BHP kind of flat right now, but Fortescue, which is a pure play iron ore, off by 0.5%. Rio Tinto also gets the bulk of its revenue from iron ore. That's off at 0.75%. IGO there recently purchasing a lithium mine from a Chinese developer as well. That's easing a little bit as well. But the broader ASX index is also a little weaker right now. If we have a look at the oil price, though, that's performing slightly better, currently finding some strength at around about $42 a barrel for a barrel of West Texas. And Dan Murtaugh is here to talk a little more about that. One firm in particular making a wrong way bet earlier in the year. And the fallout from that is changing the $4 trillion global oil trading industry. Asia Energy reporter Dan Murtaugh has been looking into this. So, Dan, that shocking collapse of Singapore oil trading legend OK Lim and his firm Hin Leong still reverberating through the world of commodity merchants as we stand on the eve of 2021. How have other trading houses been impacted by that?
Well, it's made a bit of a dichotomy. The larger trading firms are doing quite well, actually, while the smaller ones are hurting. And that's mostly because of access to financing. The larger trading houses, the VTOLs and Trafigura's of the world, are still have the confidence of banks. And so they're still getting the money they need to be able to do their business. And they've been able to profit off of these wild swings in oil prices that saw, prices drop as much as 70%, go into negative territories in America this year. Smaller firms, though, they're getting squeezed out because banks see what happened to Hin Leong, and they're worried that these other smaller companies might have that same sort of risk. So they're seeing less money, they're having their credit squeezed, and they're struggling to thrive.
Why is financing so important to the commodity trading business?
It's a good question. It's because the commodity trading business requires such huge upfront amounts of capital. A single cargo can run anywhere from millions of dollars to more than $100 million for some of the biggest cargoes of oil. And the margins they make on it really aren't that small. So these commodity merchants have to have constant turnover and be running lots and lots of trades at the same time. And so if they don't have access to financing, they're not able to do that, and they can't make the money to make their operations profitable.
So what are the implications of this for commodity financing in the future?
It's a scary question, and the industry is looking into this right now. One possibility is that for these smaller sized operations, that they could switch over to something a little bit more digital. There's a firm in Singapore that's starting to do this called Traded Capital Finance that basically uses blockchain technology to digitize a lot of the paperwork involved in making sure that certain traders own the commodities they're buying or selling, et cetera. And so that lowers the cost, and that allows them to do some of these financings for smaller companies that the banks right now are overlooking. So as the big whales get out of the pool, there's room for some smaller fish to really grow here.
All right, Asia Energy reporter Dan Murtaugh there. And here's a quick check of the latest business flash headlines. Boeing 737 MAX has returned to American skies with the first domestic flight since it was grounded worldwide almost 2 years ago. An American Airlines plane flew from Miami to New York after U.S. regulators lifted the ban last month. The MAX's return globally is key to Boeing's attempts to repair a balance sheet battered by the grounding and the collapse of air travel in the coronavirus pandemic. Airbus is close to delivering 550 planes this year after COVID-19 derailed air travel and demand for new jets. It remains comfortably ahead of rival Boeing, although neither is anywhere near where they hoped to be a year ago. Airbus delivered 863 planes in 2019 before the pandemic crushed airlines and leasing companies. Singapore is stepping up support for aviation, allocating more than $63 million to support companies and workers in the industry. The aid comes on top of existing support and will be used to help development and deployment of technology to protect airport workers and aircrew from COVID-19. Coming up on Daybreak Asia, Macquarie Wealth Management's Martin Lakos joins us as markets open in Seoul and Tokyo. This is Bloomberg.
新型にはなんと2万点以上前身でついてます。なので2万点あることにより、その情報が取れない、平面がないんですね。なので全てをスキャンすることができるので。どちらにせよ自分のサイズを1回最初から、適正なものを発見してそれを買って、家に届いてきたらぴったり非常にこうハッピーというのがやっぱりしかるべき姿かなと思ってます。
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Welcome to Daybreak Asia from Bloomberg's World Headquarters in New York. I'm Sherry-Ann.
And I'm Paul Allen in Sydney. Asia's major markets have just opened for trade. Our top stories this hour. Asian markets look set to fall as futures point lower. Wall Street slipped as hope fades for bigger relief checks to American households. The dollar continues its decline. Hong Kong media tycoon Jimmy Lai is stepping down from his Next Digital as he awaits trial under China's sweeping national security law. And Beijing's increasing influence has hit tech hard, slumping stocks, slashing valuations. Jack Ma alone has lost $12 billion since October.
Japan and South Korea coming online. We are seeing real estate and material sectors leading the declines on the Nikkei. This, of course, after the Nikkei closed at the highest level since August 1990 and surpassing that 27,000 level for the first time since March 1991. The Japanese yen has been really range-bound in the past 2 weeks. Do watch out for JGBs. We could see some dip buying in the super longs after some recent losses. Take a look at Korean markets right now. The Kospi under pressure, but again, it was at a record high after 4 sessions of gains. We saw the Korean won leading the gains across Asia in the past session on risk sentiment. But of course, we do have the surging infection numbers. So do watch out for more social distancing and restriction measures outside of South Korea, Paul.
Yeah, we've been trading here in Australia for a little over 1 hour now, and every single sector is in negative territory. The broader index off by 0.8%. Materials lower by 0.75%. We're seeing a bit of a drag from the major miners, Fortescue and Rio Tinto in particular, a little lower on a weaker iron ore price. The Aussie dollar holding up reasonably well with that in mind, though, still above 76 cents. Over in New Zealand, the NZX are giving up some early gains now, off by 0.1%. Well, let's keep our focus on the markets with our next guest, Macquarie Wealth Management Division Director Martin Lakos. And Martin, we've seen an amazing rally over the course of 2020, and there seems to be a fair bit of optimism among most of the people we talk to about equities heading into 2021. But do you wonder at all how this momentum can be maintained?
Paul, good morning. Look, certainly in the very short term, it may well be that we see a pause in this momentum. Obviously, the big picture and medium-term environment for global markets still is very positive towards equities, given the very low interest rates and the fiscal response by governments around the world. But you've got to ask the question, having seen a 12% rally, generally speaking, around the world since the US election, how much of all this positive sentiment is actually being factored in. And so a pause would not necessarily surprise. But we don't see significant downside, although there remains some key risks out there. There's no question about that.
Yeah, monetary policy, as you say, likely to remain supportive. But how about fiscal policy? Because are we getting a foretaste of this in the US? Republicans really reluctant to back those $2,000 stimulus checks. That would have added nearly $500 billion to the stimulus bill. Are governments around the world starting to get a bit more debt averse?
Well, I think there comes a point in time where they've got to be weighing out the balance between the benefits of additional spending and that the balance sheet component for governments. And obviously, I think on our calculation, we've seen since or if we compare this to the GFC, the fiscal response has been double that we saw at the time of the GFC. So we're clearly a breathtaking response by governments. And so there has to be some sense in regards to fiscal responsibility. But obviously each country, is running its own game in this regard. And, at the end of the day, lawmakers are going to make the decisions they need to make in regards to that responsibility around the balance sheet, but also ensuring that they can keep economies afloat.
We could see more stimulus coming next year. We are already seeing market inflation expectations at 2-year highs. Do you have any concern that next year we could see some overheating and perhaps policymakers being forced to tighten?
Well, that's a possibility. You can't say that it's not. But I guess if we look back at the GFC example, and since QE really was invented back then as an experiment and has continued right through, the emergence of inflation just hasn't existed. And certainly while we've got excess capacity in labour markets around the world, including here in Australia, there's going to be very little pressure from a wages perspective, which is obviously a very big component of driving inflation. So although we potentially seeing asset price inflation around property values and obviously the stock market, wages really don't look set to be pretty flat for quite some time. So although we're monitoring that closely and gauge that as a potential risk, we don't see that emerging at the moment.
Yeah, on asset value inflation there, you mentioned, of course, we continue to see asset prices rising, especially across Asia, new highs when it comes to equities. Where do you position at a time when we have really a lot of exuberance?
Well, again, if we sort of follow where the money's going, we saw basically net outflows out of emerging markets globally in the first 8 or 9 months of this year. And that started to reverse since the US election, which I think we've seen positive inflows into emerging markets outside of China of something like $27 to $30 billion. As a result of that, we are seeing that outperformance starting to pick up. But it's very much, to some extent, a bit of a focus on some cyclical markets. So we've seen the pickup in the likes of Indonesia and Thailand. We've certainly seen better pickups in the likes of Brazil and Turkey. But our overall thesis remains a focus or a greater bias towards growth. But we certainly recognise that some value or pockets of value will start to be focused in on by investors going forward, and that will drive performance.
So where would you see better opportunities then, emerging markets or developed markets? And I'm really coming at that through the lens of a weakening US dollar.
Yeah, and look, that's got to be a big focus in this low interest rate environment as well. And you'd be expecting that emerging markets should do okay in a weakening US dollar environment. For us, it's still very much a focus on growth at this stage. So we tend to have a greater bias for our clients' portfolios with that growth bias. But we can't ignore what you just talked about in regards to the value side. Cyclicals, to some extent, have run pretty hard already. And again, it fits into that category for us of whether we see a pause or a small pullback. But any sort of pullback in markets we'd be seeing as a buying opportunity. So it's very much still a buy the dip strategy for us, but still very much that growth focus. And that's the case on the growth side. Once again, it's the rebound in the US. The one caveat for us on this, Paul, is definitely this emergence of the new strain of COVID. And again, if this takes hold, again, this is going to put a time pause on the economic recovery, and global financial markets won't like that.
And in expectation of that economic recovery, we have seen the commodities rally that some have even called a super cycle. Where do you stand on those mining and energy stocks, metal stocks? Can they continue to be supported by the commodity surge?
Certainly run harder than most had forecast. In the likes of, obviously, Australia is benefiting significantly from the significant rally in iron ore, and that's very much driven by both demand side, particularly out of China and Asia, and obviously the supply side where Brazil is struggling on the production side. So Australia is certainly in the sweet spot at the moment, but it won't last forever. So we are forecasting lower commodity prices going to 2021, but still elevated from where most had anticipated even in March or April of this year. So, again, the companies, the major producers of iron ore, such as BHP, Rio and Fortescue, will continue to do particularly well. They've got low cost of production, and with the iron ore forecast from us anyway to be about $100, $110 a tonne by the end of next year, that's still, at a level these companies are extremely profitable. So wouldn't be surprised to see some sort of pullback in commodity prices, but not a significant one at all.
All right, Macquarie Wealth Management Division Director Martin Lakos, thanks so much for joining us. Just get you across an alert on the Bloomberg terminal. The Premier of New South Wales here in Sydney holding a press conference at the moment about new coronavirus cases. 18 new cases reported in Sydney in the past 24 hours. Now, in the grand scheme of things, that doesn't sound like much, particularly when you consider what's going on in the United States and the UK. But the concern is that this is no longer confined to that Northern Beaches area. There are now clusters outside of that in Greater Sydney, and the concern is that this looks a lot like how things got going in Melbourne during the winter. So 18 new cases of COVID-19 reported in Sydney, and some concern growing over the spread of that. Okay, let's get to Karina Mitchell now for a check of the first word headlines. Karina.
Okay, Paul, thank you. Here in the U.S., the top infectious disease doctor says the country's vaccination plan is lagging and repeats his worry about a post-Christmas infection surge. Anthony Fauci told CNN that he had hoped more people would have been given a shot by now. Elsewhere, the EU will take an additional 100 million doses of the Pfizer-BioNTech vaccine, with the reported virus variant in the UK described as a game changer. Meanwhile, the EU and the UK will sign their Brexit trade deal later Wednesday, formalizing the accord they eventually agreed upon last week. It will be signed in Brussels first, then flown to London for the Prime Minister's approval. British lawmakers will have only one day to debate the deal, with Boris Johnson wanting it on the statute book before the UK finally exits the EU on New Year's Day. And the EU and China are set to agree on a historic trade and investment deal later Wednesday, after 7 years of often intense discussions and concerns about control and human rights. Sources in Brussels say a provisional agreement will be announced later, after Beijing committed to ratifying ILO rules on forced labor. The deal is seen as a blow to the America First campaign promoted by President Trump. And SoftBank is rolling out low-cost at-home virus tests, having previously only offered them to companies and local authorities. The Nikkei News says saliva-based PCR kits will be made available starting March for about $20 plus shipping. Users can request kits online and send them back to an inspection center outside Tokyo or in Hokkaido. The results will then return via a dedicated mobile app. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Sherry.
Right, still ahead. It's been the worst financial year for airlines on record. Will we see a rebound next year? Bloomberg Intelligence has crunched the numbers. But up next, Jack Ma's net worth has tumbled by $12 billion since the end of October. And he's not alone amid Beijing's crackdown. The details next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
If we can really get vaccines going in April, May, June, July, and August, by the time we get to the end of the summer, I think we can get to that goal that I'm talking about getting the overwhelming majority of the population vaccinated.
China's crackdown on Alibaba has caused Jack Ma's fortune to tumble by $12 billion since the end of October. And while he's at the centre of the scrutiny, he isn't the only one who's feeling the squeeze. Asia investing editor Lulu Chan is in Hong Kong. So, Lulu, Jack Ma really appears to be facing the most heat, getting the most headlines, but he's not the only one, is he?
Not the only one, indeed. It is a sector-wide crackdown on the China's internet sector, and we're seeing the pain spread across community buying platforms, those grocery platforms that are fetching crazy valuations in China right now, and also Meituan Dianping, his fellow billionaire Wang Xing, and Tencent's Pony Ma are all under great scrutiny right now.
So what do we know about his Ant Group? What's happening on that front? Because they were asked to overhaul their business, right?
Yeah, well, based on what we reported yesterday, I do think that people are relieved that it's not the nightmare case scenario where the company is facing an immediate breakup or a halting of all its financial businesses. Instead, what we're hearing is that the company has been told to fold its financial operations into this financial holding company, and that entity will be regulated more like a bank. It is a curb on its business growth, but not the worst.
Right. Our Asia investing editor, Lulu Chen. And of course, if you do have a Bloomberg terminal, check out Rich Go. You can find Jack Ma where he ranks among the world's richest, and he's fallen to 25th place already. If you check the Asia region, you can see that he's only trailing Tencent's Pony Ma, and he's number 5 at the moment. Right, coming up next, we'll be talking about another tycoon, Hong Kong's Jimmy Lai, resigning from the media company he founded. Details ahead. This is Bloomberg. Hong Kong media tycoon Jimmy Lai has resigned as chairman of Next Digital. He's currently on bail awaiting trial after being charged under Beijing's national security law. Our reporter Gregor Stewart Hunter is on the line from Hong Kong. Gregor, so give us an update on the trial.
Okay, so police arrested Mr. Lai in August under the new national security law, which was imposed by Beijing in June, bypassing the local legislature. Prosecutors have charged Mr. Lai with colluding with foreign powers, a term which potentially carried a life sentence. But judge released Mr. Lai on bail last Wednesday. The People's Daily slammed that decision in the commentary published over the weekend, the Communist Party mouthpiece calling the decision unbelievable. But the judge who made that decision defended it this week, saying that Mr. Lai's statements appear to be comments and criticisms rather than requests for foreign interference. Mr. Lai is going to face a crucial bail hearing tomorrow morning, so we'll be watching that closely.
So what's the impact of this going to be on Next Digital?
It's probably fairly limited. Mr. Lai is confined to his home as a condition of the bail terms. He's had to surrender his travel documents. He's forbidden from giving interviews or publishing to social media. We'll get some sense from Next Digital shares, which will start trading in Hong Kong in about an hour's time. They've been in a bit of a roller coaster this year. Local people have tried to show support for Mr. Lai by buying the shares. That share surge also resulted in 15 arrests by police and fraud charges shortly after. And trading activity surged again after Mr. Lai was freed on bail last week. So we'll get clues on that coming up in about an hour.
So, Gregor, as we continue to see Beijing's tightening grip on Hong Kong, what's the state of press freedom there?
Well, Mr. Lai's arrest is definitely one of the most high-profile arrested journalists this year, and caps a pretty steep decline in Hong Kong's position in Reporters Without Borders' World Press Freedom Ranking. Hong Kong was 80th out of 180 countries this year. In 2002, that figure was 18, so we've fallen quite sharply. And advocates of press freedom fear that the national security law will mean that Hong Kong's laws more closely resemble mainland China. Authorities around the world imprisoned more journalists in 2020 than any other year on record, according to the Committee to Protect Journalists. China jailed the most reporters for a second year running, including recently a Bloomberg News staffer.
Our reporter Gregor Stewart Hunter there. Let's get a quick check of the latest business flash headlines. Hong Kong Exchanges and Clearing loses its chief executive this week with no long-term successor in sight. And now it's said to have lost other senior figures in recent months. We're told that General Counsel Faheen Mohammed and HR head Eva Chow have left this year. HKX has appointed Chief Operating Officer Kelvin Tai as Charles Lee's interim replacement, with a full-time chief executive to be named later. And don't miss our exclusive interview with Charles Lee. He opens up about the reforms that helped transform the city into the world's top fundraising venue, and he hints at what he's going to do next. Get more on a conversation with Charles Lee on Bloomberg Television. Activist investor Dan Loeb is calling on Intel to explore new strategies, including a possible breakup and the sale of assets. Third Point has built what it calls a significant stake in Intel, and Loeb says he intends to push for change, including at board level. He adds that Intel has dramatically underperformed in recent years, losing more than $60 billion in market value this year alone. Apple briefly touched an intraday record as its year-end surge sends the stock above Amazon as 2020's best tech performer. Shares have gained 16% in December alone on strong demand for the iPhone 12 and optimism about its venture into self-driving cars. Wall Street's increasingly bullish about Apple's prospects in 2021, with the COVID recovery seen fueling even more demand for its products. Sherry.
Paul, Ford now saying that reports that Apple is working on an electric car project are neither a surprise nor a concern. Global electrification director Mark Kaufman spoke to Bloomberg about his outlook for the EV sector.
Anyone who works in a traditional manufacturer, we're essentially going to expect disruption now from anyone that might be out there. Back, I know a couple years ago when Dyson was considering getting into the EV business. At that point, you realize any consumer product company could come into the space besides any startup.
So it's very difficult. It's very expensive to the point where, you know, globally dominant companies like Ford and Volkswagen are getting together, pooling resources. Can you tell us a little bit about your work with the German car makers over here in Wolfsburg?
Sure, Matt. Scale is so important, especially in the auto business. So in a case when we have a platform, you know, most platforms have a range of products that it can be suited off of. In the case of our partnership with VW, we had the European market skews a little bit smaller than the U.S. market. So we found there was equal opportunity for both of us, VW to get a bit more scale off their platform. And for Ford, it gave us an opportunity to have a product that's going to be slightly smaller than the product off of our dedicated platform that we have within our company.
I know one of the big problems here, Mark, is there just aren't enough charging stations. And although we hear from, you know, partnerships like Ionity that they're building them as quick as they can, they're certainly not building them quick enough to be ready for the demand that's coming in the next few years. How do you think that issue gets solved?
Matt, that's a great question. And we know a combination of both range anxiety and the ability to charge your electric vehicle when you're traveling are top of mind for consumers. We believe range anxiety, as an example, our Mustang Mach-E has a range just over 300 miles, is helping on range anxiety. But at the same time, that charging infrastructure continues to get built out every year, especially for the high-power DC fast chargers. And it depends where you're at in the world, though. A lot of consumers we're finding are still charging at their residence if they have that opportunity to, because that certainly adds to the convenience of owning an EV.
You know, what's interesting, too, though, is, and I do wonder, you know, Mark, safe to say I think it's fair to kind of respect what Tesla and Elon Musk did, that kind of woke up the auto industry and showed that you can, you know, maybe move faster than everybody anticipated when it came to the EV market. And I do wonder, in terms of strategy, and when you look at maybe what happens next year, you know, how has kind of the timetable changed dramatically? And could it change even more so, meaning sooner rather than later?
Yeah, I would say as I look back at 2020, I know for me the biggest surprise on the year is just how quickly the European market has moved in EV adoption. I would say that was a little bit higher than what we had forecasted at this time last year. And part of that is you're seeing more products come out. So as that EV offering is expanding from other manufacturers, both Renault and VW having products in the market in 2020 in the European markets, that has accelerated the growth. And at this point, you know, we're seeing in both Europe and China, there's a clear race for leadership there in the EV space.
There was Ford Motor Global Electrification Director Mark Kaufman speaking to our colleagues Carol Massa and Matt Miller. Let's take a look at the oil price right now. WTI continuing its slow grind highward, upward, $48.11 for a barrel of West Texas right now. We did have an industry report a little earlier, a third straight weekly drop in U.S. crude stockpiles, spurring optimism for energy demand in the U.S. And if we take a look at the year-to-date chart, oil not quite back where it was at the start of 2020. COVID cases continuing to keep a lid on demand. Plenty more to come on Daybreak Asia. This is Bloomberg.
remember, this was not announced as a complete trade deal. This was announced as a phase 1. So we and the Chinese both are well aware that there's much more to do.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Daybreak Asia. I'm Karina Mitchell with the First Word headlines. Attempts to boost relief checks for American households to $2,000 stumbled in the Senate, with Majority Leader Mitch McConnell blocking Democrat hopes of quick action. His move triggered anger from President Trump, who tweeted the Republicans may have, quote, a death wish by failing to act. Higher checks would cost about $460 billion, which worries fiscally conservative Republicans. Meanwhile, Treasury Secretary Steven Mnuchin saying $600 checks may be sent out starting imminently. In other news, Russia is stepping up pressure on opposition leader Alexei Navalny, opening up a criminal case against him for alleged fraud. Prosecutors say he spent about $8 million on personal use from political donations. Navalny says President Putin wants him in jail after a failed nerve agent assassination attempt in August, and that the latest move against him is Kremlin hysteria. The left-leaning mayor of Tel Aviv is forming a new political party for Israel's upcoming election as the blue and white opposition faction begins to collapse. Voters face a fourth election in just 2 years, and veteran Ron Halday says he can no longer stand by on the sidelines. The Knesset was dissolved last week after failing to pass a national budget. Halday says his new party will be called the Israelis. And Carolina Panthers tackle Russell Okung has become the first NFL player to be paid, in part at least, in Bitcoin. The team will continue to compensate him in dollars, but Okung says half of his $13 million salary is to be sent in digital coin using Zapstrike. The platform facilitates payments that are translated into Bitcoin from traditional currencies. Okung's Twitter bio reads, quote, life, liberty, #Bitcoin. And fashion game changer Pierre Cardin has died at the age of 98. He upended couture in the late 50s when he broke with traditional design houses and offered ready-to-wear clothes in department stores. He made his name with the space-age look, pioneering bold geometric patterns in vinyl and plastic. Fashion was only a part of his empire, however. He also designed eyeglasses, umbrellas, perfume, luggage, even skis. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
All right, let's take a look at how equity markets are trading across Asia. We are seeing downside pressure for the Nikkei, which is falling from the highest level since August of 1990, as we continue to see a little bit of a mixed picture as U.S. stocks also fell from record highs. The Kospi, though, recouping some of those earlier losses and again at a record high and gaining ground for a fifth consecutive session. Of course, we have the Korean won leading the gains in the previous session on risk-on sentiment, although for both countries, Japan and South Korea, do watch out for those COVID infections. The ASX 200 lower, real estate tech leading the declines, and Kiwi stocks also reversing earlier gains and falling from that record high after 4 sessions of gains. Take a look at some big movers in Japan. Fast retailing extending gains after hitting a record high on Tuesday. You have Japan Tobacco as well recouping some of those losses from the previous session as they trade ex-dividend. ANA Holdings also up more than 1%. This after falling in the previous session. Remember, Japan has banned the entry of foreigners given the rise of COVID infections. Sumco under a little bit of pressure right now. They're a silicon wafers company for semiconductors. Let's take a look at one company in particular right now. SoftBank offering a low-cost COVID test in Japan, which can be done at home. That's according to the Nikkei News. This coming in a week where restrictions on entering the country were tightened as virus cases reached record highs. More infectious strain coming from the UK also detected in Japan and other nations. Let's get more from Japan healthcare reporter Lisa Du. Lisa, so very surprising that SoftBank is getting into COVID tests. How are they doing this?
Yes, so they are like you said, they're going to start offering this at-home PCR test for the general public. It's going to start in March. The Nikkei is reporting the test will cost about 2,200 yen, which is about $20. Now, there has been cheaper options for testing popping up across Japan, but this isn't a home option that can be done via the mail. The thing to know about these tests is, it won't be overseen by a doctor. So if people test positive, they still do have to get another government-approved test. But it does kind of offer another option for those that are worried that they may have the coronavirus, especially as the spread is getting worse in Japan.
Lisa, we've heard an announcement from Chinese authorities about Wuhan. What are the details?
Yeah, so Chinese authorities are saying that the scale of the COVID-19 outbreak in Wuhan, which was kind of the initial epicenter of the coronavirus spread earlier this year, may have actually been nearly 10 times the recorded tally. That's according to a study they've done based off antibody testing of Wuhan citizens in April. So the ratio of those who tested positive for antibodies suggests that as many as maybe 500,000 residents may have been infected, which was 10 times the 50,000 confirmed COVID-19 cases at the time.
So what are we hearing on the latest from vaccines in Indonesia?
Yes, so the Indonesian government is actually set to sign an agreement with Pfizer in the first week of January for 50 million doses of its vaccine that it developed, BioNTech. That's coming after they announced a separate deal also for 50 million doses this week with AstraZeneca. Now, both deals also include the option to procure an additional 50 million doses from each company, but just kind of continuing that trend of, these companies that have very promising vaccines continue to sign deals with many countries.
All right, Bloomberg's Japan healthcare reporter Lisa Du there. The CEO of the Russian Direct Investment Fund says the Sputnik V vaccine is safe and many people want it. And that's despite the negative narrative being put forward. Kirill Dmitriev told Bloomberg that Russia wants to partner with others around the world on vaccines and distribution.
Lots of people do want to get the shot. Our estimate is, and we did the survey, that more than 42% of the people would like to get vaccinated, near term. And this is similar as in many other nations where it's about 50-50. We believe that as people see empirical evidence that their neighbors have good immunity, the numbers will increase. But again, lots of people want to get vaccinated in Russia, and there is just very negative narratives that some of the Western media are trying to portray about Russian vaccination, Russian vaccine, that is just done for geopolitical reasons, frankly, is highly unethical. And the real narrative is we have a great vaccine and we will be a major player in vaccines and we'll be saving lots of lives in Russia and outside of Russia already this year.
So if that's the case, then why won't you get published peer-reviewed data?
Well, first of all, we did publish phase 1 and phase 2 in the Lancet magazine. We will publish phase 3 in a top peer-reviewed magazine, I think, in the next 2-3 weeks. And the data has already been submitted. And basically, we have full transparency. It's another part of fake narratives that some of the Western media are portraying. We will publish our protocol of studies. We have done studies on 31,000 people. We've done clinical studies in UAE, India, Venezuela, Belarus. So this is just part of the fake, false narratives that is propagated by people who want to contain Russia. And we actually want to be partners. And, our AstraZeneca deal you mentioned as an example, where we showed that one of our components could be useful to AstraZeneca vaccine, and we offered it right away. So I think time will tell, and time will show that we have a vaccine that is very safe, very efficient. We don't need minus 70 degrees for our vaccine. It's +2, +8, and it will be a major solution for many countries in the world.
I mean, there was a Levada poll that was published this week that said that only 38% of Russians want to get that vaccine. Do you think that poll is totally made up then?
Well, no, you said 38%. Our poll showed 42%. So those are close numbers. But again, it's very clearly that you see, and you will see in January as well, our vaccine is demanded by many people around the world. In Russia, people are being vaccinated. We have lots of people vaccinated. I myself also got vaccinated. So, it's just sad that we see, and you sort of sense a little bit in your questions, this sort of sad narrative trying to portray for competitive reasons Russian vaccine in a negative way. And what we should really do is a blind wine taste of the vaccines. And if you do blind wine tasting, you see that we have much safer track record. We have better price than many vaccines. We are +2, +8. And very importantly, we believe that our shot, because we use 2 different vectors for delivery, will last longer. So if you have blind wine tasting of vaccines, Sputnik wins. And this will be very clear to many nations. But once again, we want to cooperate with other vaccines. We'll announce a major vaccine partnership with a Chinese manufacturer in the next couple of weeks as well. So we are setting this trend of cooperating and cooperation between different vaccine producers.
Russian direct investment fund CEO Kirill Dmitriev. Much more on the virus still ahead on Bloomberg. We'll discuss how Asia is tackling the latest infections across the region and where is likely to see the next hotspots. Hong Kong University professor of epidemiology Benjamin Cowlin is on Bloomberg Markets. Up next, the airline industry is on its knees as international travel all but came to a halt in 2020. We'll look at what next year may bring and where bright spots in Asia can be found. And we have reports of an earthquake shaking buildings across Tokyo. That's a live picture of Tokyo right now. And the Japan Meteorological Agency saying that the earthquake magnitude was 5.1, depth of 60 kilometers. No tsunami threat from the earthquake. But of course, we know that the quake has been shaking an intensity of 4 on a scale of 7. That's according to the National Research Institute for Earth Science and Disaster Resilience. No tsunami threat as of yet. Plenty more to come on Daybreak Asia. This is Bloomberg.
It's been the worst financial year for airlines on record as the pandemic all but destroyed global travel. Bloomberg's APAC airline index is down by almost 20% this year. To survive, Asian carriers have embarked on massive restructuring efforts, cutting thousands of jobs and grounding fleets. But the vaccine could provide a path to recovery. Bloomberg intelligence analyst James Teo has been crunching the numbers on the sector. So, James, is 2021 going to be any better than 2020?
Hi, morning. Yes, I think 2021 will be a better year, but at the same time, a full recovery is quite unlikely because international travel is going to be heavily restricted still, especially in the first half of next year. Now, with the vaccination programs already underway, we still think that we need a large swath of the world population to be vaccinated before international travel can return to normal. So what we expect is domestic travel recovery continuing to lead the way, followed by short-haul regional travel. We might see a couple of travel bubbles starting. Singapore, Hong Kong was already announced, but didn't happen, unfortunately, this year. But we hopefully will be able to see it start next year. And then a couple more in the region, maybe Australia, New Zealand are supposed to start. And so these will help the short-haul regional travel to recover, with long-haul going to be the last to recover, in our view.
At least the cargo side of things hasn't been as badly hit as a passenger segment, right? So what subsectors could recover quicker or slower than others?
Yes, cargo is definitely a bright spot because there's a shortage of cargo supply or capacity with all the passenger flights that's grounded. So the belly hold space that was there before with the passenger aircraft, a lot of that has been suspended or lost. So that shortage of supply has driven cargo rates or air cargo rates up significantly. And we see that continuing to be a bright spot, especially with vaccine distribution going to play a part in terms of the demand as well. So demand is going to be pretty strong or almost the same, and then supply is significantly down for cargo. So that will be a bright spot for the airlines. But overall, I think the cargo revenue is not going to be enough to compensate for the loss of passenger revenue. So for 2021, we might see revenues down 12 to even 63% versus pre-COVID levels, depending on the airlines, different airlines, international exposure.
How about airline stock valuations? That has been a popular trade, but has the recovery already been fully priced in?
Well, the airline stocks have rallied a lot since the phase 3 vaccine results were announced in November. And so we think that further upside in 2021 could be limited, as market has largely priced in the expected recovery. It's kind of run ahead of the expectations. And on a price-to-book basis, we believe most airlines are already near or above their pre-COVID valuations. So there are some gaps or value gaps. We see some Chinese and Japanese carriers offering more value as they remain priced at a slight discount to historical valuations. But there are also a number that have already reached their pre-COVID valuation on a price-to-book basis.
And of course, we have seen cash flow and liquidity being key problems this year. What's going to happen next year?
Well, airlines have substantially reduced their cash burn rates through cost-cutting measures, and also we've seen domestic travel recovering as well, so that has helped their cash flows significantly. So our analysis shows that operating cash flows could turn positive if domestic traffic returns further to around 80% of pre-pandemic levels, and international travel recovers to about 40%. And we've seen that happening with the Chinese carriers, for example. Their operating cash flows are already turning positive. So hopefully more of the rest of the Asian airlines will be able to follow in their footsteps in the near future. And not to forget, many airlines have carried out multiple rounds of debt and equity fundraising. So with the reduced cash burn rates, we estimate that the major Asian carriers have sufficient liquidity to last 21 or even 86 months, assuming that the recovery trend continues.
So is the industry forever changed? What are the longer-term airline trends that you foresee happening in 2021 and beyond that?
Yeah, I think we might see a little bit more consolidation. We've seen, for example, the merger between Korean Air and Asiana being announced. The one to look out for perhaps would be Air India. We have Tata interested in a bid for Air India, and it'd be interesting to see how the Indian aviation landscape changes after that, because Tata is involved with Air Asia India, with Vistara, with Singapore Airlines as well. So I think that's still a huge market, a lot of stock potential, and it'll be interesting how that shakes out. But I think at the same time, I think besides consolidation, we believe that cost competitiveness of the Asian carriers are likely to improve post this crisis because of the restructuring initiatives that they've carried out, such as early retirement of older, less fuel-efficient aircraft, renegotiation of pay packages with pilot unions. They are usually very tough to push through. So these will have lasting impact and potentially improve margins when demand recovers. And we've seen U.S. airlines gone through this consolidation and restructuring phase and become much more profitable after that. So this could be the Asian airlines' turn, in our view, as previous events like SARS and the financial crisis were really short-lived. Didn't really bring them down to their knees like this one.
Our Bloomberg Intelligence Asia transportation and logistics analyst, James Teo. We have some more aviation stories in our Business Flash headlines. Boeing 737 MAX has returned to American skies with the first domestic flight since it was grounded worldwide almost 2 years ago. An American Airlines plane flew from Miami to New York after U.S. regulators lifted the ban last month. The MAX's return globally is key to Boeing's attempts to repair a balance sheet battered by the grounding and the collapse of air travel in the coronavirus pandemic. Airbus is close to delivering 550 planes this year after COVID-19 derailed air travel and demand for new jets. It remains comfortably ahead of rival Boeing, although neither is anywhere near where they hoped to be a year ago. Airbus delivered 863 planes in 2019 before the pandemic crushed airlines and leasing companies. The company abandoned its full-year forecast of 880 deliveries back in March. Singapore is stepping up support for aviation, allocating more than $63 million to support companies and workers in the industry. The aid comes on top of existing support and will be used to help the development and deployment of technology to protect airport workers and their crew from COVID-19. Singapore will also continue offering rebates for fees related to airworthiness certificates.
Still to come, it's been a year of turmoil and upheaval for Hong Kong and its markets, but one constant stands out. Relentless inflows continue to sweep into the city. What does that mean for the year ahead? We'll explore that in a moment. This is Bloomberg.